group despite a ceasefire announced more than 6 weeks ago. Meanwhile, gold prices jump on 60-day ceasefire extension between Iran and US. US futures mildly higher on hopes that the peace deal with Iran was close. All major indices closed at fresh highs on Fridays and closed the month with string gains. Asian markets trade mixed as markets await US-Iran deal. South Korea stock hit fresh record high. The gift Nifty is indicating a lower start for the Indian market. And auto sales for the month of May to be released today. Strong sales growth expected for passenger vehicles and two-wheelers, while weaker monsoon forecast is likely to dampen tractor demand. Hello, good morning. You're tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. In terms of a week, we obviously will have the RBI monetary policy that we'll keep an eye out on. What's going to be happening in the US-Iran war, the deal. Yes, it's going on. Talks are going on. But where are they headed is key to watch out for as well. And because of all this that continues to be there in terms of an uncertainty, we're seeing that the Asian markets this morning have opened up largely mixed is what we're seeing. Most of them are higher, but some of them are open in the red. Taiwan index holding on to gains of 1.8%. We have Hang Seng that's holding on to gains of 0.7%. But on the flip side, you have ASX 200, that's the Australian index, that's quite muted. Down 0.1%. You have Shanghai, that's down 0.06% as well. Nikkei, that's the Japanese index, that's managing to hold on to gains. Now, what's the Nifty implied open indicating for us, right? We are indicating a muted start to a red start is at least what we can keep an eye out on for the Indian market. So not forget, 5-day trading session, we've seen a sharp fall that came in the market as well, especially in the last hour of trade that we saw. And Nifty closed at 23,550. Around that mark is what the Nifty managed to close at. But today, seems like a bit of a red start, at least is what we are keeping an eye out on this morning. But let's talk about that West Asia update, right? US President Donald Trump says that he is close to a very good deal with Iran, with media reporting he's pushing for tougher terms, including safe navigation of and within the Strait of Hormuz, and that Iran does not possess nuclear weapons. However, he also stated that if an agreement cannot be reached, he will request intervention of the US Department of War and end the situation in another way. US Defense Secretary Pete Hegseth told the reporters that US was ready to start strikes on Iran if no deal was made. Listen in.
We're focused on being postured and prepared to re-engage if we have to. I mean, this is a high-stakes negotiation. We've got the best negotiator in the world leading it. Iran may not want to give up their nuclear ambitions, but we believe at the table they can and will over time, given the right set of incentives. But the most powerful incentive is the capabilities we have there right now, which they can't ultimately defend against at any real level. And those are decisions in the future the president will make based on how this ends. But I feel confident that he'll get to a deal that serves the interests of the American people.
Meanwhile, Iran's Foreign Minister Abbas Araghchi says that the exchange of message with the US is ongoing, but that nothing is certain until a deal is finalized. On the other hand, you have Israel's Prime Minister Benjamin Netanyahu, who has ordered his military to push further into Lebanon after Israeli forces made their deepest intrusion into the country in more than 25 years. Okay, on that note, let's look at what's happening in the world of commodities as well, right? What's happening to gold, crude oil prices. To take us through all of that, we have Manisha Gupta joining us, as always, to take us through that. Good morning, Manisha.
Morning, Vinny, and thank you for that. Well, I'll start with the crude oil prices, because after posting nearly 15% of decline in the month of May, which, by the way, is the biggest decline since March 2020, we have seen June start with a positive note in sense of crude. It's trading 2% higher in Asia. There are 2 or 3 factors which seem to be supporting the crude oil prices. One is that Israel has now ordered troops to move further into Lebanon. So that is one part of the whole deal that hasn't been able to be tackled. The other is that there are concerns of mines that have been laid down in straight shipping lines. So that tells you that even as there is a peace conversation or a ceasefire going on, not too many ships are going to pass through that area. And then there is uncertainty on the U.S.-Iran peace agreement as well. U.S., remember, has been demanding for Iran to halt nuclear program, open strait as an international route. All of that is yet to be signed upon, and that is where the crude prices seem to be getting their support in yet again. While the month of May has seen a decline for energy, it has been a great month when it comes to metals. You saw copper prices gain up by 10%. Numbers of 5.5%. The decline in US dollar and the inventory decline in major exchanges clearly has been supportive for many of these metals. And add to that the fact that the Chinese economic data has been positive, that also has been quite supportive.
Okay, Manisha, thank you so much for that, for the latest update in the world of commodities. But on that note, we're going to slip into a very short break. After the break, we'll come and tell you how these overnight cues are going to be impacting our Indian markets. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now let's tell you how the overnight cues are going to be impacting our Indian markets. We have our team of research here to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. And first up, we have Hurmas to take us through the important market cues. Good morning, Hurmas.
Good morning, Vinny. And well, we are heading into a very important month for our markets, and especially after coming on the back of Friday's session, where the losses were both expected and unexpected as well. Where the quantum of the losses, well, unexpected. The MSCI rebalancing was set to bring about some volatility, but of course, the result is that we are now back down to very, very important support levels. The GIFT Nifty for now is indicating a subdued start, but the positive factor is the fact that from its initial ticks, which was around 100-point drop, we are now down to around 20-25 odd points. So the bulls will take that and they would look to rebound from here on. Now there are important things to watch out for. There is still no decisive outcome from the US-Iran negotiations. They continue to remain the key monitorable going into this week as well. Oil prices are now seeing a bit of a rebound in today's session after falling almost 17% last month. Brent and WTI both trading with gains of anywhere between 2.5% to 3% this morning. The biggest trigger this week is going to be the monetary policy from the RBI. Of course, unlike previous policies where the street knew that it's going to be a status quo, the policy decision is going to be an important one, and of course the commentary on the road ahead, particularly so because of the macros that we are facing currently, and after which the markets will look for direction, because there is no decisive trigger now for the market after the policy, considering the fact that the earnings season is also over. For the index now, after Friday's fall, while we were looking at levels of 23,800 as a support, we are now back down to 23,500 as an important support for the index. The bulls will look to defend that, and if that does not happen, then we go down to the May series low, which is 23,262. That will be another level to watch on the downside if 23,500 fails to hold. Going on the upside, of course, we'll look to reclaim 23,800 again and then look forward to what happens next. For the Nifty Bank, well, it's almost become a normal for the Nifty Bank to give a 1,000-point intraday move almost every other day now, and Friday was no different. Then 54,000 to 55,000 remains that range for the Nifty Bank. That level on the downside is something that the bulls will look to defend and then look to go back to that 55,000 mark. Of course, the rate sensitives continue to remain in focus all through the week because of the RBI policy. Now, watch out for textile stocks today because of the recent import duty developments that have taken place. There are final earnings reactions that come in Indigo, NMDC, IREDA. A lot of them react to results today, and of course, as I mentioned, the rate sensitives as well. But for now, the GIFT Nifty is indicating a subdued start. 23,500 on the downside is the most important level to watch, and then if we do manage to recover from those lows, we go and look at 23,800 on the upside.
Okay, thank you so much for that, Hormaz. But let's go across to Ria, who is here to tell us which are the important stocks you should be keeping on your radar. Good morning, Ria.
Well, good morning. The last set of Q4 earnings are in. Let's start off with Indigo first. Q4 has swung into a net loss for the company this time around. We've seen a net loss of around 2,500 crores, and this is largely due to forex losses of over 4,800 crores for Q4 for this company. Moving on to NMDC, the revenue has gone up by around 61% to 11,173 crores, and the top line this time around has been strong due to higher sales in the demerged entity, which is NMDC Steel. For Glenmark Pharma as well, the numbers have been below estimates this time around, with the revenue going up by around 15.8% on a year-on-year basis, but missing estimates, and margins have also improved, but they are lower on a sequential basis. For IREDA, the Q4 loan book momentum has remained quite strong. The loan book has crossed around 93,000 crores for the company, and the higher provisions this time around have been weighing on the net profit. For Gujarat Gas, the EBITDA has declined by around 35%, which is 609 crores this time around. Moving on to Wockhardt, which will be in focus as the US FDA has given its nod for the antibiotic Zanic, and the company has previously said that Zanic can do around $1 to $2 billion in sales, with around 40% of that coming from the US. Lupin has also received a US FDA nod for the generic version of Sutab with a 180-day exclusivity period. And lastly, Cyient will also be in focus as they are set to buy AI-focused company Tau Digital, which is based in the US at an enterprise value of around $218 million.
Okay, thank you so much for that, Ria. But in the final update, let's go across to Sudarshan, who's here to tell us the important cues in the world of F&O. Good morning, Sudarshan. On Friday, last start of trade, we specifically saw that fall coming in, sharper fall. In terms of levels, what are we keeping an eye out on today?
Good morning, Vinny. So as Hormaz told you, for Nifty now, 23,500 will be the level to be watched out for very closely. In all probability, we should see that Nifty holds on to the levels above 23,500 because just one reason, and because of that we saw heavy selling, was MSCI rejig, and that led to a sharp selling by FIs, not only in the cash market but also in the derivative market. And if you look at the addition on the short side, it's the highest addition that we have seen in the last 2 months. But if you specifically talk about the indicators apart from FI positioning are not looking that bad. Rupee continues to hold the levels below 96, it's at 95 against dollar. And if you talk about the crude, even if overnight it has jumped almost 2%, but continues to hold on to the levels below 95, and volatility index remains at 3-month lows. And also, so put call ratio, now it is 0.74. So if there is any positive news, we might see a huge short covering as well. Now, talking about the FI flows, in the index futures, they have sold 6,000 crore. In the stock futures, they have sold more than 1,100 crore. Long positioning reduced by more than 7,000 contracts. On the short side, they've added more than 31,000 contracts, highest addition we have seen since March 27. On the options data put side, 23,500 and 23,700 have seen maximum increase in the open interest, while on the call side, 24,000 and 23,800 were the most active ones. So till last week, 23,800 was the major support. Now it becomes the major resistance level. So support 23,500, resistance 23,800 and 24,000. Some of the stocks that will be in focus, MCX has been seeing fresh shorts for the last few sessions. Cochin Shipyard from Defense Pack has been seeing fresh shorts, and also keep an eye on all the auto companies because auto sales will start trickling in today.
Okay, absolutely. Sudarshan, thank you so much for that. Auto will continue to be in focus as well on the back of the auto sales. Thanks so much for that. But on that note, let's talk about US markets, right? Futures are marginally higher, while there are hopes that US-Iran a deal will come in. Now, after all three major indices actually notched new highs in Friday's trading session as well. You have Dow Jones that was up over 0.5%, while we saw the other indices that also ended in the green. We have CNBC's Angelica Peebles, who's here to take us through what happened on Wall Street.
U.S. markets were up across the board in Friday trading as the three major indexes finished the month at fresh all-time highs. The Dow gained 363 points, the S&P 500 was up 16, and the tech-heavy Nasdaq added 55 points. A federal judge on Friday temporarily blocked the Department of Justice from taking any further steps to implement the nearly $1.8 billion so-called anti-weaponization fund. The hold will remain in place while a lawsuit challenging the fund proceeds. It was created as part of a settlement from President Trump's lawsuit against the IRS for leaked tax returns. The refund is meant to compensate people who allege they were victims of lawfare during the Biden administration. Critics call it a slush fund for Trump allies, including those pardoned for the January 6th riot. And there's a chance that Mercedes could be banned from selling its vehicles in the U.S. New legislation making its way through Congress is trying to limit Chinese involvement in the U.S. auto market. Mercedes' largest individual shareholder is state-owned Chinese automaker BAIC. Several people familiar with the legislation tell CNBC that depending on how the law is ultimately interpreted, it could ban Mercedes from operating here unless the Chinese company sells its stake. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that. On that note, let's also listen into the market experts and economists on their outlook for the U.S. market.
Well, on the surface, Scott, look, I think earnings justify it. Their earnings revisions have been unbelievably strong. Granted, it's coming in, obviously of beneficiaries is a key one, but it's across the board. And if you draw a line at the end of the year, that validates a market that's higher. But I agree with Mike that, look, it's gotten narrow, but it's not just the AI beneficiaries that scare me. It is these unprofitable, very speculative tech stocks. They're the ones that did the best in May. They're the ones that have done the best in quarter to date. And that is a sign of a very kind of bubbly market. We're due to a cooling off, or, it's going to be 2021.
I think it's a combination of several things. One is that the fundamentals remain remarkably good on a basis of resilience, not robust in nature. Well, perhaps earnings for the S&P 500 robust in the first quarter that we're seeing in this earnings season. But in terms of the economy, it's resilient. It's not pulling into a recession. We find monetary policy under Powell is handing off the role at the Fed, with the Fed in good stead, having brought down inflation significantly, even with the recent resurgence in oil bringing up inflation. And overall, we've got the consumer and business are really doing what they're supposed to be doing.
It's hard to argue that there isn't exuberance, but I would echo a point I've made repeatedly and we're discussing right now, which is the fundamentals are changing. And I remember changing for the positive, obviously. And I'm always reminded of the Facebook quarter from 2013, I think it was, when they figured out mobile. And the stock was up 30%. You were on air that day.
I remember that too.
The stock was up 30%, and everyone was like, well, we should wait and see. And the stock never looked back and has been higher ever since. And so, not that that's exactly the same, but from an investment standpoint, if you have something in memory or storage where you're going, and Adam can obviously correct me if he thinks I'm wrong, where you're going from commodity cyclicality to long-term agreements with prepayments and price floors, et cetera.
Okay, on that note, we're going to step into a very short break. After the break, we'll come back and get you the updates in the world of AI. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates in the world of tech and AI. In our special segment AI Pulse, we have Rachna as always to take us through all of that. Good morning, Rachna.
While bringing you from the world of artificial intelligence, first up is the US Department of Commerce that has closed a year-old loophole that may have allowed hundreds of thousands of NVIDIA's most advanced chips to reach Chinese firms through overseas subsidiaries. The new guidance means license requirements now apply to an entity headquartered in China regardless of where it operates, covering NVIDIA's Blackwell and Rubin processors. Then there's Dell that reported a 775% surge in AI server revenue to $16.1 billion, sending its stock up 33% on Friday. Dell also unveiled the new XPS 13 at $699, its thinnest laptop ever, taking direct aim at Apple's MacBook Neo, which is Apple's recent affordable offering. Then there's NVIDIA CEO Jensen Huang speaking at a company event recently in Taipei. He called Taiwan the epicenter of the AI revolution, saying NVIDIA will spend about $150 billion a year on the island and break ground on a new headquarters there this year. And that's not all. The big announcements are expected from his Computex address, which is expected shortly. NVIDIA and Microsoft are set to debut the first Windows PCs powered by NVIDIA's own ARM-based chips at Computex and Microsoft Build this week. The expected devices include Microsoft Surface and Dell models, marking NVIDIA's first consumer CPU in over a decade. Then there's Meta that's reportedly developing an AI pendant as per an internal memo viewed by The Information. Testing is expected within a year, building on Meta's acquisition of wearable startup Limitless in 2025. And finally, Google is seeking EPA approval to release 32 million sterile male mosquitoes across California and Florida using AI and robotics to suppress disease-carrying populations. Public comments close on June 5th, so that'll be one that we will be watching out for soon, and we'll bring you more updates through the day.
Okay, thank you so much for that, Rachna. But getting you some more domestic updates, you have the CBSE that has actually moved very swiftly to address a potential cybersecurity breach after an ethical hacker claimed that Class 12 answer sheets and examination records were exposed through a misconfigured cloud storage system. Now, the board says that vulnerabilities linked to its external examination portal on Mark have now been contained, with cybersecurity experts from the government agencies and IITs assisting the review. Let's move on, and from the world of sports, Royal Challengers Bangalore have been crowned IPL champions for the second consecutive season, securing their second title overall with a commanding 5-wicket win over Gujarat Titans in the finals. Defending champions RCB set up the victory with a disciplined bowling display led by Bhuvneshwar Kumar and restricting Gujarat Titans to 155 for 8. In reply, RCB got off to a flying start before Virat Kohli smashed his fastest ever IPL 50, guiding his side to comfortably chase with 2 overs remaining. Okay, and with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, we'll pass our morning call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. So last night belonged to RCB. This morning, do you think it's bulls or bears? Because Friday, that FI selling figure was really worrying. Gross selling of 1.1 lakh crore, net selling of 21,000 crore. And even if you account for the MSCI, right? The MSCI impact was supposed to be $1 billion. 9,000, 10,000 crore, which means that there was active selling, right? People, actively looked to reduce their exposure from the foreign investor point of view.
Well, that's right. If you're asking which side I'm leaning on, my jacket's telling the story. So let's see whether that's right.
These are bad.
I'm going with the bulls today, but let's see how that goes.
Well, typically after, if Friday was, say, 80% accounted for by the MSCI flows, then typically it should bounce. I mean, let's see. We should see perhaps a little bit more constructive session. The gross number and the, the net number is what it is, but the gross numbers is what is the interesting story here. And then, that is a whole other thing, which we can get into later. For a net negative 21, how do you explain those massive gross buy and gross sell figures? But that's not a new story. It's not just for Friday. It's been there for the last many months now. Okay, let's just take it from the top. Oil prices at 93 actually now, a bit of an up move from the time that I looked at it, so 93 plus. There is uncertainty, not very much has changed, uncertainty around the US-Iran deal, which is still very much the starting point this week. S&P 500 was up about 0.25%. This is, of course, on Friday. We are at all-time highs. And not very much by way of new news flow, except, of course, the security conference which happened. And U.S. Defense Secretary Pete Hegseth said a lot of stuff. But, a few things really stood out. The tone on China seems to be a lot softer now, a lot softer. He's basically said that staying quiet on Taiwan is the best way to project American strength. And he basically went on to say that the era of performative outrage is over. And he basically hailed ties with China as better than they've ever been in many years. Now, that is quite striking. The era of performative outrage, basically he's saying, well, every time, something comes up on Taiwan, countries in the region issue statements and say, well, this and that. But Hegseth essentially is saying that, it doesn't, it's just talk. And the era of just talking is perhaps over, and countries need to step up if they really mean what they say. So there was it's a full speech, and maybe we'd get the opportunity to sort of, play some of that out for you a little later. But I thought it was very interesting. We're, of course, starting a new month, but last month was fantastic. So I just looked at the MSCI Asia Pacific Index. Markets in our part of the world. And the MSCI APAC was up 8.3%. It's the strongest May in over 2 decades. So that's quite something, right? Korea now is up 101% on a year-to-date basis, and Taiwan is up 54% on a year-to-date basis. And both, of course, now exceed China's weight in the MSCI Emerging Market Index. So, some of what we've seen for a while has continued. Korea was the best performing market, up 75% last year. It's up 100% this year. And we are just midway through this year now. So just to come to the local stuff, right? RBI policy decision is the one to watch. It's, of course, later this week on Friday. Will it be a hike? Will it be a hold? Will it be a hawkish hold? We'll get into the depth and details of it a little later. 10:15, we'll have a sort of, monetary policy, Citizens Monetary Policy Committee coming up, and we'll have the top faces to talk about that. But that's a big one with everything which has gone on. Monsoon progress is the other one, right? So the IMD on Friday lowered its assessment with regards to the monsoon progress, 90% compared to 92%. There is an error margin, as there always is. But, the assessment came right before landfall. So we'll see the strength of this one, and this is important for markets as well. Friday, of course, it was the largest ever MSCI rebalance. I mean, ever. This is global. It was a big global event, and it perhaps fully explained Friday's sharp 1.5% cut. So, while FIs have sold, and it's not a new story, but Friday's sort of sell-off, you could put at the doorstep of the MSCI rebalance and not sort of, make too much of it in that sense. Just tying in the levels here, the Nifty support 23,300, and that's a level on the downside. On the upside, 24,074 and 24,300 are levels. So, I mean, actually, since Friday was a big gap, and we'll see where we go today. So the first one, 2474, becomes the first resistance before, of course, the bigger one, which is at about 24,300. GIFT Nifty gives you a quick sense of how we're likely to start. We'll pick it up from there. So 5-point change on the GIFT Nifty this morning, so it's absolutely flat. Nigel is spoke to crash to the wall with the flows, positioning, and the futures and options data. Nigel, take it away.
Well, over the weekend, RCB said they did it again in the IPL. You had PSGs that said they did it again in the Champions League. But for today, the Bulls will want to prevent the Bears from saying they did it again, because the kind of fall that we saw in Friday's trading session was a little bit uncomfortable. But if you're looking at the flows, yes, there was big FI selling, but you need to keep in mind that normally you see mostly the passive flows that hit in the final hour of trade. However, this time around, it appears there was some active as well as passive, active that was pending and passive that had to take place. And that's why we saw such a large FI net sell number. And even the gross volumes are very, very high. For the time being, I will be wanting to look ahead, because actually in the month of May, the FI selling had cooled off. So for now, I'll take it as a one-off. In terms of the FI positioning on index futures, well, they added massive shorts, close to 30,000 contracts added. I've not seen that sort of an addition in multiple days. And if you look at it, it's a 37,000 contract swing, because they unwound some longs and they added short positions as well. The shorts continue to hold at around 88% approximately. Looking at the options data as well, they're fairly defensive. They wrote calls aggressively. Close to around 4 calls were written for every 1 put. So the positioning from the FIs in the F&O market continues to remain rather defensive. But here's what I'm looking at. The FI shorts in the system ain't too bad. The PCR coming down to around 0.74, that as well isn't too bad. So I'm clutching on to both these two data points, and I'm saying that we are unlikely to see that sort of an intensive sell number coming in today's trading session. That's my hope at least. We're looking at the options data then, since I said that the FIs were writing calls aggressively. The 23,900 call, big addition out there. 23,700 call, massive addition out there as well. There's clearly signs of writing as at those strikes, which brings us to the levels. Just in the near term, what was a support becomes a bit of a resistance. So the 50 DMA and the 20 DMA, that's the resistance zone that you're looking at. The bulls will want to get above this mark and then push those FIs to cover the shorts in the system. And if you're looking at a support zone, well, this 23,250 has been a good buy zone. So if we drift towards those levels, then the bulls will fancy their chances. Recent low at around the 23,263 or thereabouts. Well, one technical indicator that's looking up actually, just a couple of months ago, the number of Nifty stocks that were trading above the 200 DMA, they had gone to around 20% approximately. That number has bounced up to around 46%. So that's encouraging. In terms of technical, that technical factor is actually working in favor of the bulls. And if you look at it, you'll say, well, the Nifty is still much lower since the start of this war, but the broader markets have outperformed. And I expect more of the same to continue, even if the headline index has to go through a period of consolidation. The broader markets, the momentum is pretty much with those guys, small as well as mid caps, and earnings as well, to be fair, have been better in the broader markets in comparison to the headline index. Well, the crucial trigger later this week will be the RBI policy meet and the decision out there. The good news from an RBI perspective or from a market perspective as well, crude oil prices have corrected sharply in the last 10 days or so, and the rupee as well. I think this is the positive. The rupee is showing signs of stability. The fear was it shoots past the 97 odd mark, so that now it's at around 95 odd. Both these two will favor a no rate hike, at least in this particular meet. Let's see how that goes. But for the time being, I'm expecting a rather good bounce back today in comparison to what we saw on Friday.
All right, we'll take it from there. And the good news is earnings season is now behind us. But let's get to the equity calls then. It's Venugopal Gare of Bernstein who says that while a de-escalation in West Asia could trigger a relief rally, they expect it to be short-lived given the weak macro underpinnings and a likely revival in equity issuance. They maintain their Nifty year-end target of 26,000 and retain a neutral stance. He says from here, returns are likely to be driven by 3 themes. The first one is under-owned, lower governance names linked to global themes such as AI data centers. The second one is globally exposed sectors like IT and healthcare. And 3, rebound trades as West Asia-related headwinds fade. Within domestic stories, though, he says selectivity remains key. Okay, let's get in Taimur Beg, Managing Director and Chief Economist at DBS Group Research. Taimur, we'll get to the RBI action. But the last conversation, if I remember, is the one which we had pre-conflict, when crude prices were at $63, $65, rupee was at 19.91. The picture has changed completely. So to your mind, how have India's macros changed post the conflict? How much of it is permanent, and how much can we get back to once the headwinds related to Middle East, the oil shock, fades away?
Good morning. I think India's fortunes will not be that different from many other emerging markets' fortunes, which is around dependence on energy import, which is around funding the current account deficit, and the monetary policy exchange rate management nexus that comes with it. So sitting here in Singapore, I look at Indonesia, I look at India, I actually don't see too much of a difference in the challenges that the policymakers are facing. So I would characterize the time that has gone by since we last talked as a global common shock. And India is going to be dealing with it the way most countries in the world that depend on energy imports will deal with it, which is at some point you have to raise petroleum prices, not just the amount that has been done so far, but the amount that sort of meets the minimum threshold for all marketing companies to keep making the kind of money they were making before the crisis. Beyond that, that impact of that energy price increase, the ones that have been done and that ones that need to be done, would feed into inflation. And that is so clearly visible that, in my view, the RBI has to follow the footsteps of the likes of central banks in Indonesia or Philippines who have already started hiking rates. So maybe this RBI meeting is not live, but in my view, it is just a matter of time before the central bank has to adjust the policy rate. I think the key thing that I would like to reflect upon, given now that we have had more than 3 months of this conflict, is that we should not be that afraid about the resiliency of our companies and of our consumers to take that terms of trade adjustment. It is not something that the world, or India for that matter, has not dealt with in the past. Energy shocks come and go. We had $150 oil about 16 years ago, and life did not end. And therefore, these shocks are going to be there. There are many lessons around that in terms of energy resilience, diversifying your supplier chain. I think we have all talked about that ad nauseum over the last 3 months. All of that is valid. But key lesson for me is that we're actually not that fragile. We can take these shocks.
All right. Hi, Taimur. Good to see you, Ben. You just briefly spoke about Indonesia as well. Their central bank went ahead, and I think May 20th, they went ahead and hiked rates. When do you expect India to go ahead? I mean, you're saying probably not in June, but say in the next 9 to 12 months, how many rate hikes are you penciling in here for the Indian markets? And also comment on the Indian rupee. It fell one way from 90 to around 97 odd. The last few trading sessions, it's been showing signs of stability. I would be in the camp that you don't want to see any big appreciation, but that depreciation needs to stop at the pace that it was going. So your comment even on the rupee.
Okay, so let me punt on the RBI rate hike part. My India senior economist Radhika Rao has her call on a modest rate adjustment over the next 6 to 12 months. And by that, we mean, of course, not more than 50 basis points. So I'll leave it at that. I think we need to see RBI leadership's communication in this regard. But as far as the rupee is concerned, when I look at the real effective exchange rate of the Indian rupee compared to key emerging markets economies like, say, China or Indonesia, they have all adjusted or gone depreciated by about 10% in real effective terms over the last 6 years. That does not seem to be at all a lot to me. For me, this is very modest and sort of relatively okay adjustment, especially compared to the peers. Now, what has happened is India's movement in the last few months has been significantly more than the few other countries that I just mentioned. They have been on a steady path of adjusting the real effective exchange rate, where India, it seems like now that we have the data in 23, 24, 25, was very resistant toward allowing the rupee to adjust, and now it has done so. So yes, like you, I don't want to see disorderly one-off adjustments. I would rather see gradual adjustment. If there is selling pressure on the market, in my view, the RBI does not need to combat it every single time by selling precious reserves. It should allow the market to move on a two-way basis. And there is smoothing that is, of course, expected out of monetary authority, but we should basically think about the RBI's core mandate, which is inflation. And around that, if rupee needs to be defended, that's fine. But I don't think the sort of big losses in reserves, allowing the rupee to sort of stay stable when competitor currencies were adjusting, I don't think that had much sort of economic sensibilities around that. The adjustment that has taken place so far, I think in a 5-6 year horizon, totally okay.
Right. Got that. Taimur, hi. Last week we had, I think somebody from Bank of America was it. So basically the point that the gentleman was making that the entire AI capex, which is happening in the US, the actual net boost to US GDP is very, very small. It's not very small. It's I think about 30 basis points or something. I don't know if you have a number, you have your own number. And maybe the reason for that is because while all the spending is happening, this is all kind of being sent out of the country because you're importing everything, right? From Asia, from countries like Taiwan, from countries like Korea, et cetera, et cetera. Is it just your thoughts there?
A couple of thoughts. I mean, the U.S. economy overall is doing extremely well. Atlanta Fed's nowcasting suggests even for the second quarter of this year, the largest economy in the world is tracking close to 4% growth. Those are extraordinary numbers. Even if the nowcasting is a bit off and we settle down with, say, 2%, 2.5% for the second quarter, it is building on a bunch of years of pretty robust growth. And these are pretty impressive numbers, given that, we've had a trade shock, energy shock, and all those things that do hurt consumer sentiment, consumer buying capacity, and so on. And of course, you can sort of take this in the context of this extreme boom that we're seeing in the equity markets and the wealth effect around that. I think that the CapEx cycle is a bit lopsided. A lot of money is being spent on the AI infrastructure and very little money being spent on other things. That makes the cycle a bit vulnerable, that if indeed we have some sort of a reckoning around AI infrastructure spending, it can drag down US growth substantially. The investment related spending that is attributable to AI is actually not that easy an issue to solve. If a company tomorrow buys a couple of CPUs from Intel, is that an AI investment or is it just tech upgradation? If indeed we are seeing some degree of adjustment in the labor market, is it AI related or is it because in 2022 companies hired a lot of people? So I think that it's hard to sort of parse that issue very well, but it is true. Regardless of what the contribution of AI is to the CapEx cycle, is that the US is going through a fairly robust consumer and investment cycle, even as public sector has not been particularly spending a lot of money other than defense. I think that there is actually a very good lesson to be learned from the largest economy in the world for the rest of the world. We should not be scared of importing capital goods that feed the infrastructure foundation for future growth. So the US may seem like importing a lot of things from Taiwan and Korea, but it is going into building US capability going forward.
Yeah. No, I wanted to sort of take up that question in terms of my question was whether these countries themselves are vulnerable in a big way now to what's happening in the US and this entire capex super cycle. Well,
absolutely.
Yeah. And I think that dependence is a lot more. It's very lopsided.
Yeah,
in that sense. Taimur, we leave it there for now. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. We'll take a quick break, just running you through the interactions which are lined up. So 8:35, the management of PG Electroplast will join in to talk about the fourth quarter numbers. 9 o'clock, Jinesh Joshi will put the spotlight on the aviation space. 9:20, Devina Mehra of First Global. 9:30, the management of IREDA. After that, we'll have Bank of America's Vikram Sahu speaking with us on the sidelines of the conference. 9:50, a discussion with the manager of Scient on their latest acquisition. And towards the end of the program, Citizens MPC. And it's a power-packed lineup, which will discuss what the RBI is going to do on Friday.
Time to slip into a quick break. We've got a lot of stock-specific action track for you today. We'll get to that in just a bit in our special Top 10 segment. We'll look at Indiglobe Aviation, IRDA, Tenneco Clean Air, Vocart, Scient, Lupin, as well as textile stocks. They'll be directing to positive news flow while NMDC as well as Glenmark Pharma and Gujarat Gas will react to negative news flow.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our entire research team is standing by this Monday morning, bright and early, with CNBC TV 18's list of top stocks for the day. Let me begin with Devyani, if we have her, on Interglobe aviation numbers.
Indigo reported Q4 losses of roughly around 2,500 crores as a result of a forex loss of over 4,800 crores as the rupee slid over 5% in Q4 of FY26. Now this, along with the fact that the international operations were disrupted, which meant that the natural hedge that Indigo has was also disrupted in Q4, led to a much higher forex loss than was expected. Now revenue from operations was up 1% on a year-on-year perspective to 22,400 crores with a forex loss of over 4,800 crores and fuel expenses of 6,650 crores, bringing profitability down for the company. Now, that said, the fuel cost by itself actually was quite maintained, with the government taking ATF price hikes from April 1st, 2026 onwards instead of the previous quarter. Now, EBITDA came in at 2,227 crores with a margin of 9.9% this time around, as against a margin of over 31% in Q4 of FY25. Now, net loss of around 2,500 crores was clocked this time around against a net profit of over 3,000 crores. Now, PAT ex Forex and exceptional items came in at 1,920 crores versus 2,980 crores, down 36% on a year-on-year perspective. So, operationally, this was a soft quarter, but that was largely expected based on the brokerages that came out before this. Now, that said, the FY27 guidance that the company has given has been quite positive. Q1 of FY27 is the company is expecting a capacity growth of roughly around 3 to 4% on a year-on-year perspective, with a mid-teen improvement in the passenger revenue per ASK in Q1 of FY27 versus the previous year's same quarter. Now, that is as a result of a largely inelastic pricing market, and as a result, based on the positive management guidance, going with a green on Indigo in trade today.
Lovely. Thanks a lot for that, Devyani. Well, moving across to NMDC, the top line was strong because there were higher sales to the demerged entity, which is NMDC Steel. It came at around 2,900 crores approximately. That compares with around 700 crores on a quarter-to-quarter basis. Remember, earlier they were selling a lot to SAIL. Now they seem to be selling to their sister concern, which is NMDC Steel. Volume growth was strong as well, as around 21% odd. But remember, that was on a low, disrupted base. The same quarter last year, there was, there was a labor issue that they had, and that's why the production and sales were relatively low. So on a low base, good amount of top-line growth. But there was a miss on the operational front. That's on the margins as well as the EBITDA front, because there were losses in the pellet sales business, as well as realizations. Well, they have declined, both on a sequential basis as well as on a year-on-year basis. However, as we know, there have been various price increases that have been affected so far in Q1 FY27. Additionally, the selling prices as well, the selling cost was up by more than 30%. The company gave a sweetener of around 1 rupee of a dividend. Remember, the stock ended at the lows of the day on Friday with a cut of around 4%. Probably starts off in the red, but I think we see a bit of a recovery because Q1 FY27 should look up, since volumes will bounce back and pricing as well should be fairly better. So, red start on NMDC. Going across to Ekta, she's here to tell us about Glenmark Pharma. Morning, Ekta.
Morning. Well, the numbers were, a little below estimates. The revenue missed estimates, the margins improved, but they were lower on a sequential basis. What stood out was that India was less than 10% growth this quarter. So India grew around 8.2% on a year-on-year basis. The street was anticipating growth of over 10% because they have a strong portfolio in India. And the US was aided by a deferred out-licensing income for ISB 2001. So the North American business was up around 29.4% on a year-on-year basis. I suspect that maybe the stock would be a little bit in the red today, just a mild red, based on these numbers. Remember, they have their conference taking place tomorrow, which was their annual investor day. So there'll be more details in terms of performance there.
Thank you very much for that. Ananya now joins in with numbers on IREDA.
Indian Renewable Development Agency delivered strong set of FY26 performance, but when we look at the quarter itself, there was some pressure on profitability due to higher provisioning. Now for the full year, PAT rose 10% year-on-year to a record 1,873 crore, while the loan book crossed 93,000 crore, growing 22% year-on-year. Now, however, Q4 profitability was weak. PAT declined 2% year-on-year and 16% sequentially, as impairment and provisioning costs were higher this quarter. Now, asset quality was also one of the talking points. GNPA rose to 3.49% from 2.45% last year, largely due to a legacy account being classified as NPA following an Andhra Pradesh High Court order. The positive takeaway from this was that asset quality improved sequentially, and also PCR improved to 64%. Now, on the growth front, disbursements increased 16%, manufacturing exposure nearly doubled, and the company continues to expand into the new segments such as battery storage, green hydrogen and smart meters. Now, with over 2,000 crore raised through QIPs, AAA credit ratings, and keeping in mind the India's renewable energy targets, the company is likely to benefit in the long term, and the long-term growth story remains intact.
All right, Ria, thanks very much for that. Well, let's focus on Gujarat Gas next. And Sonal is here with more on this one. Sonal, morning.
Good morning, Prashant. Well, it was expected to be a weak set considering the rise in spot LNG prices and lack of availability as well. Revenues for the company declined 3.5% on a sequential basis. EBITDA was down 35%. Margins declined 500 basis points, leading to a profit decline of 46.5%. There was a one-time loss element as well. This, of course, is led by the lack of availability of spot LNG, and they rationed it as well to their consumers. However, CNG volumes surprisingly are at a record high this quarter, came in at 3.6 MMSCMD. They did well on the total volumes front as well, 8.8 at MMSCMD. So volume-wise, it was a thumbs up, but decline in overall financials. Going with red on this one.
Thank you very much for that. Sudarshan now joins in to tell us how Tenneco Clean Air numbers looked.
For Tenneco Clean Air, the earnings suggest the air continues to look clean as far as the earnings and the outlook are concerned. So first, talking about the earnings, revenue was up 17%, and value-added revenue too has seen an increase of more than 17%, and margin though was flat but remains of the level of 18%. And two of their major segments, clean air revenue has increased by 10%, advanced ride technologies revenues were up 26% too. Company had already announced an investment of rupees 71 crore for eastern part of India. Now they have announced investment of rupees 69 crore for western part of India, and and total investment increases to 140 crore. If you talk about the order book, it continues to remain healthy, and it was at 12,400 crore as of March 2026, and it covers more than 100% of their targeted revenue for FY28. So on the back of healthy earnings and the strong order book, I'm going with green for Tenneco Clean Air.
Got it. All right. As clean as can be, as Sudarshan says. Thanks a lot for that, sir. Well, going across to Ekta, she's here to tell us about a couple of pharma stocks, Wockhardt and Lupin. Ekta, take it away.
Well, yes, Wockhardt is in focus because they've received that approval for their antibiotic Xenic or WCK5222, which is a novel antibiotic which is discovered by Wockhardt. They spent many years and a lot of money in this particular drug. It has received US FDA approval. It is basically an IV antibiotic which is given for complicated UTIs for people who are in ICUs where no other drug is working. It had already received QIDP and fast track status from the US FDA, so there was a high likelihood that this was the next step. Now remember that the company has previously said that Xenic could do around $1.1 to $2 billion in terms of sales, with 40% coming in from the US. The CDSCO, which is the Indian regulator, approved the drug just last week as well, and it is currently under review by the European Medicines Agency. So it is definitely a big landmark moment for Wockhardt to have received this drug approval. For Lupin, they've received US FDA nod for Sutab generic. They have first to file on this particular drug, which means that they have 180-day exclusivity. Small drug, $132.8 million in terms of market size, drug used for colonoscopies. So I suspect that Lupin would see sentiment green, but Wockhardt could possibly be the stock to watch out for.
Thank you very much for that. The stock did phenomenally well on Thursday. I think Thursday and Friday stock had surged quite a bit. But let's talk about Cyient. The company has made an acquisition. This is the digital engineering business of the company, where the company has acquired Tower Digital Solutions for $218 million. The valuations, as per the company, are 9.5 times calendar year 27 EV to EBITDA. If you look at the financials of the acquired company, it's been growing fast. Calendar year 2024, top line went up 155%. 2020, the year before that, it was up 57%. But it's a new company. It was started only in 2022. So on a small base, it's been growing very rapidly. And according to analysts, this acquisition should add about 12% to the company's DET, overall business. But the company generally, ex of this acquisition, has been struggling a bit. So last year, their main business had a decline of about 0.7%. Though in April, when we chatted with them, they spoke about a mid to high single-digit growth for FY27. How will these numbers change post the acquisition is the key. But let's talk about textiles, because there has been some regulatory updates there. Sudarshan joins in with more.
So on the first of every month, we do see changes to major duties like excise duty, all these import and export duties. So on the part of that, government today has announced that it will remove the 11% import duty on cotton, and that can be very positive for textile companies. And what does it mean? So basically, why exactly government decided to go ahead and reduce the duty? Because in FY26, there was a sharp increase of more than 55% in the cotton imports. Now, because of this duty free till October, India overall can import 6 lakh of base. Now, why this is positive for textile companies? First, it will reduce the raw material cost. Second, it will improve the export competitiveness that these companies face from neighboring countries like Bangladesh and other countries like Vietnam. And also, it will help in improving the EBITDA margin for major exporters. Now, who all will be benefiting from this? First, home textile exporters like Welspun Living and Trident. Second, yarn and fabric manufacturers like Vardhaman Textiles and Nitin Spinners. And lastly, integrated textile players like Arvind and KPR Mill. All these companies are expected to benefit from this reduction in cotton import duty to nil from 11%.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Interglobe Aviation, IRDA, Tenneco Clean Air, Wockhardt Cyient, Lupin Textile Stocks. Stocks with negative news flow are NMDC, Glenmark Pharma and Gujarat Gas. But lots of block deals took place. Vivek now joins in with more.
Well, that's right. So Friday, you did see large blocks take place, and apart from the names that did see large blocks on account of forced MSCI selling, a couple of interesting names on the radar as well. Anand Rathi Wealth, over here, again, the promoter entity actually sold a little over 1.7% stake. So Anand Rathi Financial Services sold close to 1.7% stake at a little over 3,450 rupees a share. Remember, they held over 43% stake in the company at the end of Q4. The other big stock, that saw almost a 0.8% stake sale was Policy Bazaar or PB Fintech. Here it was the promoter entities that actually sold stakes. So Alok Bansal sold close to a little over 12 lakh shares and Yashish Dahiya sold close to 26 lakh shares. They've been continuously paying stake the last year or so. Among the list of buyers, mainly pension funds as well as domestic mutual funds actually bought significant chunks. Goldman Sachs, Europe SE bought close to 3.28 lakh shares. Society General bought close to 4.3 lakh shares. BNP Paribas Fund and a whole host of pension funds as well as some domestic mutual funds picked up stake. Again, PB Fintech was one of the top drags on Friday's trading session.
Thank you very much for that. Let's get to commodities then. Manisha joins in for a complete roundup.
Well, thank you so much for that. I'll start with the crude oil prices, where we have seen 2% of gains coming in for the Asian markets. Remember, the Brent prices have declined 19% for the month of May, posting a biggest fall since March 2020. But June has started on a positive note. This is on the back of three factors. One, there are Israel ordering troops to move further into Lebanon. So there, clearly, that part of the piece is not sorted yet. Second is U.S. continuing to demand Iran to halt nuclear program and open Strait as an international shipping route. We haven't seen an agreement come in on that one as yet. And then there also are concerns on more and more mines being laid in Strait shipping lines. So even as there is a truce or a ceasefire right now, not too many ships can pass because of the concern from that one. So that is what is keeping the crude oil prices higher yet again. So while crude has rebounded, metals in any case have been on the stronger side. The decline in US dollar, inventories on major exchanges, and of course the closure of Strait of Hormuz has throttled supply for aluminum. So spot prices have been spiking and the exchange inventories have been declining. So when you look at the month of May, it has been a very good one for base metal prices, where copper gained 10%, aluminum was up 5.5%, zinc gained 5%, tin is up 13% as well. So most of these metals have posted May stronger, and the 1st of June today in Asia is starting on a strong note as well.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. We'll come back with the management of PG Electro Plus in just a bit. Vikas Gupta should be with us on the other side. Stay tuned. Okay, PG Electro Plus management is with us. They reported a weak set of numbers for the fourth quarter. We have the management joining us to talk about exactly that. Vikas Gupta is with us. Vikas, good morning. Great to have you with us here on the program. Thanks for joining in. Just sort of run us through what happened in the quarter, because margins have come off sharply. EBITDA and gross margins both have come off quite sharply. Is this largely a result of the LPG shortage and higher costs on account of that? I mean, just contextualize the numbers, especially on the margin front for us.
Yeah, good morning, Prashant. So FY26 has largely been a very difficult year for the air conditioning industry. And air conditioner being one of the large revenue categories for our company, so that has definitely impacted us. So if you look at the air conditioning industry from the start also of the FY26, there was a early onset of monsoon, and there was a almost a collapse of demand after May. June and July were very weak in demand. The channel inventories were very high. Then there was the announcement of the GST rate cut, which led to the postponement of purchases till 22nd of September 2025. So that all led to the issues. Then the big blow came in the quarter 4, which is typically the large and the most significant quarter for the company for the air conditioning business. And in March, particularly, there was a LPG shortage. There were supply chain disruptions, which led to the almost impairment of almost around 60 to 70% of our capacity for 15 days. And that led to almost a revenue loss of almost around 300 crores. And towards the March end, when the situation became a little better, we were able to resume our production. Then there was a shortage of trucks. There was a diesel shortage, and we were sitting with some FG inventory which we could not dispatch towards the end of the year. So all this led to the impact, and another major impact was the forex thing. And in FY25 we had a forex gain of almost around 18 crores, whereas in the case of FY26 we had a forex loss of 38 crores, which gives a swing of almost around 57 crores in our balance sheet. So all these cumulative factors led to the impact of the margins.
Could you give us, okay, this is, I mean, everything which goes wrong, which could go wrong, perhaps has gone wrong. But some of this will not change into this year as well, right? Especially, for example, the rupee depreciation, so imports are much more expensive. Maybe the LPG situation is a little better, but and you got the tailwind perhaps of a hotter summer season because of, I mean, we just talked about how the IMD has lowered its monsoon forecast, so maybe a longer summer. But so tell us, what are you expecting for 27 over 26, Vikas, just realistically? And we won't hold you to the numbers, but some indication will help.
Please do appreciate that we also do a lot of inspection and what went wrong in FY26 and how to improve that in FY27. So we are working on a couple of levers. We are trying to see how we can improve the inventory levels. We are trying to see how we can localize some critical components that will help us in lowering our inventory carrying days. On the forex side, we are trying to see how to cover that, get a forex forward cover for US dollar. Chinese yuan is something that is difficult to cover. But looking at the macroeconomic situation currently in the country, we need to keep our fingers crossed, and we are monitoring that situation. What I can say, April, May has been better in the current financial year, and we hope this momentum continues. But we will have to keep our situation under supervision, and we'll need to see how things play out. But I can assure you that we will definitely give a better performance as compared to what we have done in FY26. It will be difficult to give any kind of a revenue guidance right now in such a volatile situation. Maybe perhaps when we talk at the end of the quarter 1 and we come out with the results for quarter 1 of FY27, we will be better placed to give some kind of a revenue guidance.
So April, May, Mr. Gupta, you said is better. What are the sales looking like for you? And even on the inventory number, you ended March with an overall inventory of 1,600 crore. Of that, AC was about 1,300 crore. Now that secondary sales have picked up, what do the inventory numbers look like at the end of May?
So, Rima, currently, the back of the envelope, I can say the May ending, our inventory level will be almost around 1,100 crores plus minus 25 crores. So the inventory situation is improving, and we were able to ship out a lot of FG which was stuck towards the end of March in the months of April and May.
Okay. And this 1,100 crore of May inventory, you're talking about the AC, which is comparable to 1,300 crore? Or you're comparing it to the overall number of 1,600 crore?
Yeah, overall inventory, sir.
Got that. And if, sir, the El Nino situation worsens, do you expect, the summer sales, etc., in terms of ACs to pick up? Typically, how does it pan out? And again, going back to April, May, could you give us some growth numbers?
Rima, it would be not fair for me to give any kind of a number on how the April and May was. We'll come out with the revenue numbers as and when we come. But definitely, I can say the April May have played out significantly better than how April May was for FY26. FY27 is definitely looking better. But based on the El Nino thing, we are hoping that the sales should continue to have a momentum going forward in the months of June and July as well. And the kind of order book and the kind of forecast that we have, at least for the month of June, I think the demand is still there, robust.
Hi, Mr. Gupta. Quick couple of questions. What are the rough volumes, RAC and washing machine volumes for the past year?
So, Nigel, we did almost around 1.8 million air conditioners, a complete built-up unit. So the finished good sales was 1.8 million. Okay. And in case of washing machines, we did almost around 1.2 million washers.
Okay. All right. And I understand that in the RSC segment, you outgrew the industry because you all grew, the industry degrew. Do you have a rough market share that you have? And do you see that number move up in this year as well?
Nigel, if we talk about the overall AC industry, which is around 16 million, and the outsourcing is almost around 35-40%. So that becomes almost around 4 to 5 million, around 5 million. So out of that, almost 20% can be the market, or I would say around 35-40% can be the market share for us.
Okay, 35% of the outsourced market. Got that.
Yes.
Very quickly, if you could tell us the washing machine margins, what are they at?
So, Nigel, we do not share any
rough margins.
Business
how much lower
wise
or higher than your consolidated margins?
So segment-wise, we do not give the margin breakup for the EBITDA, but I can assure you that our EBITDA margins are in line with the industry norms and almost comparable to the leading colleague in our industry.
All right. The big trigger towards the end of this year will be the compressor manufacturing. Could you tell us what is the capex you've spent, how much is spending, and what gives you confidence that you can succeed without a JV partner? Earlier, when you were joining, we were asking you, what about that JV partner? Now you're saying you're going solo and you believe you'll be successful. So tell us what gives you confidence.
So Nigel, as I told you earlier, also we already have the plant, land and building, which was already in place. We have already placed the orders for the equipment and machines, and that should start arriving into our factory by August. We are hopeful of starting the production in Q4 of FY27. We are tied up with the technology partner, a leading technology partner in China, to help us in this technology for compressors. And in turn, we have also internally created a team for the technology development and evaluation. And we are quite confident that we should be able to launch products successfully towards the end of FY27.
Do you think, Vikas, this will improve your competitive position vastly? I mean, once this is up and running, or you think this is and what will it do for margins, etc.?
So, Prashant, initially we are putting up a capacity of almost around 2 million. We are putting one line, which should be a 2 million capacity line. And it should be margin accretive, definitely. We see an improvement in margins coming from compressor backward integration. Okay. But please do understand, if the compressor things goes well, it will put us on a very strong footing in the overall AC industry for our customers. And we will be able to have a secure supply chain for the critical component like compressors.
Okay, so one final question. You also said that this is the last year for PLI target achievement for all AC brands, and therefore there is some desperation among brands. The word you used was desperation to achieve those volume targets. Is that creating some sort of a pricing pressure? Are these companies asking you to share some of the cost burden? Because you have undertaken some price hikes, but if this unwinds, then again there is a risk to that margin.
So, Rima, we do understand that once the PLI ends, it will have an impact on the margins. And we are working towards that. That the compressor is one large step that we are taking to help in maintaining or restoring that margin profile for us. And for us, please understand, we have been able to achieve our PLI targets for FY26. So we are comfortable in that. So there is no challenge. Regarding the competitive landscape, definitely there is some kind of a desperation, but we are monitoring the situation, and we are maintaining a very strong relationship with our clients. And the way we have grown our business in last 4 to 5 years, that is a testament to that.
All right, Mr. Gupta, we'll leave the conversation here. Thank you very much for joining in. Look forward to the next one. Get into a break. On the other side, Dipan Mehta of Elixir Equities joins in for some fundamental stock talk. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC TV 18. Let's welcome Dipan Mehta, Director at Elixir Equities, who joins us on the show. Hi, Dipan. Good morning. Good to see you win. Dipan, PG Electroplast, we just had a chat with the management. They said that they can't give any concrete guidance. But what was heartening to hear was that after a washout Q4, they're saying inventory levels have come down. Your view on the stock, I think, is a stock that's nearly half from the top.
Yeah, Nigel, good morning, and thank you for having me on your show. I think very nice interview with PG Electroplast. And basically, air conditioning in India is certainly going to be a nice long-term growth story because air conditioning no longer is a luxury, it's a necessity given the way the temperatures are soaring. And another trend in the AC industry is that the branded players are looking at more and more outsourcing the complete air conditioner from players like PG Electroplast and Amber. Both these companies have done much better than the branded players. So from that point of view, I think the prospects are far better. And this backward integration and scale of operations, which provides the economies, is something which is going to be a great competitive advantage for both these companies. And I think that this is certainly a company to watch out for. Optically, it appears to be expensive because of a poor FY26, but I think FY27, 28 onwards, we should see the company going back to growth path. It's just that investors have to tolerate a high degree of volatility in their earnings, but long-term growth trajectory is pretty decent.
Do you own it in your portfolio, Dipan?
No, but we do have investment in Amber Industries. And right now, as you compare, I think Amber is more expensive than PG Electroplast. Although PG Electroplast internals, returns, growth rates are far better than Amber. But who knows, at some point of time, we may certainly look at it as a measure of exploit.
Got that. Do you want to comment on the very, very large gross selling seen by the foreign investors on Friday? 1.1 lakh crore. When was the last time we had such a large amount? Of course, partly explained by the MSCI rebalance. But even if you strip that out, it's still a very large number. What happened?
I don't know, Rima. I'm just waiting for it to end. I mean, there's no way of guessing. Actually, I had an idea just now that, when this thing happened, is that we should take what was the FI holding of all the listed 500, of the top 500 companies, maybe just after COVID and what they are just now, and how much further lower can it go, and estimate how much selling is still left to go. You can assume 5-10% maximum holding of an FI and then see how much more selling has to come because there's just no way of predicting these things. And I think the index will remain highly pinned because of FI selling. That's where it's concentrated. But look at the mid-cap market. I think portfolios are doing well. Mid-cap index is doing very well. And this earnings season has been a breakout quarter for many small mid-cap companies.
What about these transformer companies, Hitachi Energy, GE Vernova? The street is latching on to it. We've seen capital inflows into these individual, and there are very few ways to play it. If you want to play the AI data center story in India, do you have a particular view on these two?
See, Rima, these companies are not about just AI play, but they're more about HVDC, which is high voltage direct current transmission. And India needs a lot of this HVDC capacity because we are relying more and more on renewable. And renewable is in Gujarat, it's in Rajasthan, it's in Tamil Nadu, and the consumption is all over the country. And these companies, Siemens, GE Vernova, and Hitachi are the three companies which have the technology to transmit this thing. So although they are expensive, and mind you, 10 years ago also they were expensive, I think that these companies are entering a new growth phase, and investors should look at having a position in these companies, invest in these companies for the long term. Maybe at a correction, maybe in a soft quarter, I don't know, you need to just kind of time it a little bit better to get the margin of safety. But by and large, you should try and look at these companies in positive light.
Okay, got it. What's your view on Interglobe Aviation, Dipan? Came out with their numbers. How would you view the stock?
Yeah, I think that, it's a well-discovered story. And we can keep on harping about the fact that it has got a massive market share and that's not going to go away in the near future. We know about the international expansion, more and more airports coming up over here that provides opportunities. But when I look at the transcript and the management commentary, I sense that they are kind of pushing the capacity growth away as much as they can. They are trying to optimize operation, and focus has now gone into managing the bottom line more than growing the top line. And I think just the volatility in earnings is really a bit too much. So although we are invested as a measure of disclosure, but we're just waiting for a quarter, which will be like nice breakout quarter and stability and nice earning visibility, which is just not coming, So that's certainly going to tire a lot of investors over time. So if I was like, completely positive and took aviation before the war, I'm just kind of questioning my optimism.
Dipan, stay on. Sonal is now joining in because we have seen a cut in export duty of petrol, diesel and ATF. So Sonal joins in with the implications. Sonal.
Well, yes, there has been a cut in export duty on petrol to 1.5 rupees a litre versus 3 rupees a litre. For diesel, it has been cut to 13.5 rupees per litre versus 16.5 rupees per litre. ATF also has seen a big cut to 9.5 rupees per litre versus 16. The revised duties will remain applicable for the next fortnight, which starts from today, that is June 1st. It is going to be reviewed every 2 weeks. Now, crude prices, they have come off sharply, and that is one of the reasons why we are seeing export duty cuts as well. The other reason could be better domestic availability. The government has been talking about enough reserves available. So yes, this is not something which will impact our petrol and diesel prices, but this is something which will improve financials of oil marketing companies. So those stocks should be in focus today.
Thank you very much for that. We will slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by Jinesh Joshi to put the spotlight on the aviation sector. We'll also be joined by Vinay Rajani and Sudarshan Sukhani for some technical trading ideas. Welcome back. We still have Dipan Mehta joining us here with us on the show. Dipan, the other story over the weekend was the government removing the 11% cotton import duty till October of 2026. So that's a positive for textile companies. It brings down their raw material costs, so there could be margin expansion, improves their export competitiveness. That, along with the kind of rupee depreciation, do you have a view on textiles? Is any stock a part of your portfolio?
No, Rima, but it's a very nice question. And this export competitiveness and rupee depreciation, how it's going to benefit exporters is certainly an investment theme which we are quite actively pursuing. And two names come to mind. One is Gokuldas Export, and another is a small cap company. Again, disclosure that we are actively studying this company and we look at investing in it. So our views could be biased is Kitex. And if I can just take a minute to talk about Kitex. So Kitex has got a separate unlisted company which they are merging into Kitex Garments. And this quarter was a complete disaster for all the reasons that we know. But it is one of India's and the world's largest manufacturing company for children wear, and has got great relationships with many of the retailers in Europe and US. And the profit potential is phenomenal, and certainly this rupee depreciation will benefit them, and they're expanding capacity also aggressively. So it's something which you should look at quite closely. So Kitex and Gokuldas come to mind, and once that's settled down, you will see at least 2-3 years of very solid growth coming from this industry and maybe these two companies in particular.
Auto sales numbers are coming in for the month of May. Prima facie for Hyundai and Bajaj Auto, it looks slightly lower than expectations, but for Bajaj Auto, even at 4.6 lakh units, it's a healthy growth of about 20%. It's just that Nomura's expectation was about 24%. And even for Hyundai, I think the number has come in at about 61,000, which compares with 58.7 thousand. So that's a modest low single digit kind of a revenue growth. But both Hyundai and Bajaj Auto have come in lower than Nomura expectations. For Hyundai, the domestic sales are up 10% on a year-on-year basis. But I think, on total, let's just wait for the numbers, because I can see the comparable quarter last year seemed to be 58,700. So that's Hyundai for you, and Bajaj Auto's sales numbers at 4.61 lakh. It's still a fairly healthy growth. Dipan, any view on the auto sales numbers?
We are invested and overweight in the auto sector as are many investors, but you should temper your expectation. And the reason for that is that the high base effect will start to play out from this month onwards. The benefit of GST cut will kind of get discounted and priced in. And these companies are going to deal with a lot of increases in material like copper, steel, aluminium across the board. Cost increases have come. And it's not that easy to pass on these cost increases. There'll be pressure from their ancillaries as well. So I think a soft 3-4 quarter is something which you must expect for the auto industry. And if you build that into your price and into your strategy, it certainly you will be able to manage the surprises negative surprises far better. So no fresh acquisition of auto companies at this point of time, and just wait and watch what exactly plays out.
Okay, got it. Final question before we let you go, Dipan. What about Wockhardt?
Oh yeah, well, for disclosure that we have an investment in the company, thankfully. And I think that, it's not just one molecule. I think the culture of the company is such and the strategy is such to look at many new such molecules. They're working on 6 or 7 molecules. Maybe one more also can go into commercial. And if they're able to make this one molecule successful, it'll be the first time ever in the history of Indian pharma that we have a new chemical entity which is right out of India's R&D labs, and that's something to be really proud of. And it'll take the company to another level. So I'm very positive on the company. And what I like best is that now the base business also has revived pretty well, whether it is in UK where they have a large presence or domestic market. If you look at this quarter's numbers, the non-R&D business, the brands, the exports, that are also done very well. And if that is sustainable, and I feel that Wockhardt is still attractive even at these levels. Again, a very, very strong disclosure that our views are biased because, we have an investment in the company. And that certainly, kind of clouds our judgment to an extent, because if you bought something, you like it. So please keep that in mind.
Got it. Okay. All right, Dipan. Appreciate you joining in and giving us your take on all of those stocks. Wishing you a good Monday and a rocking week ahead as well. Thanks for joining in. Well, we're getting some initial rates coming in. But first, on the money market, the rupee has shown some strength. It's more or less stable, actually. So that's good news. Remember, the fear last week was 97. Now we're sitting sub the 95 odd mark. So that appears there is some pullback for the time being, which is good. And that's in line with, the pullback we've seen in crude oil prices as well, which is heartening to see. Maybe the rupee overshot itself on the downside, and now it's seeing some signs of stabilization. Let's welcome Vinay Rajani of HDFC Securities as well as Sudarshan Sukhani of Technical Trends. Good morning, gentlemen. Thanks a lot for joining in. Sudarshan, what's your take? We had an ugly final hour of trade on Friday, but that was because of the MSCI rejig. How would you approach trade today?
Yeah, good morning. Actually, this vicious selling started Wednesday afternoon and it's continued. Now, Friday was simply an exaggeration. I have also seen MSCI rebalancing when the markets have actually gone up. So that's only one reason. The tendency was that there were sellers and more sellers, bidding sellers than more bidding buyers. That's the fact. Now, fortunately, we have seen a 600-point sell-off, and the chances are that at least for the time being, we should see some kind of a sort of stoppage of this selling either today or tomorrow. So my suggestion is wait patiently, look for the selling to wane, look for some kind of basis to begin, and 23,700 is the point above which we should become buyers. That would tell us that the Nifty is now willing to go higher on. So we don't buy this dip, we actually buy some minor strength. If that level doesn't come, we do nothing.
So you'll initiate a buy above which level? 23?
23,700 with a stop at 23,500. That needs to be closed.
Got it. Okay, all right. Sudarshan got that view. 23,700 is the level from where Sudarshan will initiate fresh longs. He doesn't mind buying higher, but he wants to watch for that trigger of strength. When I come across to you, how are you feeling about the markets? For the time being, the GIFT Nifty is suggesting that maybe we have some green to kickstart trade. How would you approach trade?
Yeah, good morning. So on Friday, we saw that the crude was coming down, rupee was appreciating and everything was going right. But just because of the MSCI rejig in last half an hour, we saw 300 points fall in the short span of time. So most of the large caps witness a huge selling while mid caps and small caps were holding very well. So entire month of the May was good for the broader markets. Mid cap and micro cap index saw a rise of 3% while Nifty saw a fall of 2%. So broader markets have been doing good while Nifty, as far as Nifty is concerned, it is into a consolidation. If in the month of May we have seen a higher swing lows in the Nifty, the first swing low was 23,262. After that, it registered 23,317. If we are enjoying the upward sloping trend line, it gives the strong support at 23,450 odd level. So that is not breached yet. So there is a hope that we can see a bounce back in the Nifty. However, we are expecting the broader markets to outperform from here because technicals are clearly giving indication that most of the mid cap and micro cap stocks are looking strong and large cap stocks are looking weak. So 23,450 should be the trading stop loss in the Nifty long position while we are expecting broader markets to do well. So participation we can expect from that segment.
Got it. All right. Sudarshan, coming across to you. What about individual stocks? What's on your radar?
It's finance. LTF is a buy, stop under 280. CDSL is a buy, to stop under 1220. SBI Life is a sell, stop above 1875. And TCS is a sell, stop above 2300.
Got it. Okay. Thanks a lot for that. Vinay, what about you?
Yeah, so I would choose one IT stock which were showing very strong move in the Friday session. The persistent system is looking good to me around 5194. One can go long. 5100 should be the stop loss. 5350 should be the immediate target. Second pick is from the diagnostic segment, healthcare segment, Vijaya Diagnostic. So around 1308 one can go long. 1285 should be the stop loss. On the upside, I'm expecting a target of 1350.
All right, gentlemen. Thanks a lot for that. We'll reconnect in the next few minutes here again at around 9:10. For the time being, let's focus on Interglobe Aviation. Jinesh Joshi, research analyst at PL Capital, joins us on the show. Hi, Jinesh. Good morning. Good to have you on the show. Well, Interglobe Aviation came out with its numbers. There were various challenges in the past quarter. So give us your top 3 takeaways from the numbers first.
Sure.
See, I think the first take was that there was a miss on the ASKM side with a growth of about 3%. Their guidance was 10%. But I think after the Middle East crisis hit us in March, it was known that the miss will be there this time around. Secondly, I think the Forex loss hit of about 4,200 crores. I mean, that also troubled the company in this particular quarter. And if I talk about their near-term guidance, I think the 1Q guidance of 3 to 4% growth in ASKM does kind of indicate some kind of challenges on the demand side. And also, if you look at the month of April, the domestic max growth is down by about 3% odd. So I think there are some near-term challenges as far as the overall demand environment is concerned. Yeah.
Jinesh, Motilal Oswal, I was reading their note and they said the EBITDA X of the Forex was actually better than their own estimates. How would you look at the numbers X of exceptional? And have you made any changes to your estimates?
Right. So X of exceptional, as I mentioned, that the overall FX loss was about 4,200 crores. And if you adjust for that, the EBITDA is at about 6,200 crores. So no doubt, I think on that side, X of FX, they have done well. Even at the bottom line level, while the reported PAT was about, or rather a loss was about 2,500 crores. If you adjust for the FX, the profit was at about 1,900 crores. But see, I think there are challenges in the near term with respect to rupee and crude, and we cannot deny that. So I think, and even the ASKM guidance, as I mentioned, is a bit soft, at least for 1Q. And you are also going to see some kind of inflation on the cask side, X of fuel, X of Forex by about mid to high single digit. So yeah, that's the overall reading.
What's your own rating on Interglobe Aviation and the numbers for the full year?
Right. So we maintain our whole view with a TP of about 4,700 odd. We are expecting a 5% ASKM CAGR, but if you look at our bottom line growth for the next 2 years, we are relatively flat.
Okay, all right. What will make you upgrade it from a hold?
See, I think the comfort on ASKM, I mean, if I recollect properly, earlier when I was there on your channel, we had highlighted some concerns on the ASKM side, right? And now with the 3 to 4% guidance, it does indicate that there are certain near-term demand challenges. But I think one positive point is with respect to their unit packs revenue guidance of mid-teens growth, which is expected to come in 1Q. So I think some bit of cost inflation on the crude side is covered by the yield repricing that we have seen. But on the ASKM side, if we see some kind of comfort come through, I think that will really help the operating leverage magnify. And if the crude and rupee kind of maybe settles down a bit, I think that flow through on the EBIT better.
Okay. So Q1 ASK guidance has been given by the company at 3 to 4%. But assume as the quarter progresses, the Middle East crisis comes to an end, international operations show signs of recovery. And plus, there are new airports which are coming on stream. There is domestic travel. So suppose that ASK guidance for the full year, the company in 2 months comes out and says it's going to be 7-8%, high single digits kind of a revenue growth. Is that good enough for you? Because you are currently at 5%.
Right. So see, a 2% difference might not make much of a change in view. But I think what can really help the company is how the yield repricing happens, because I think the mid-teens growth guidance that they have given on the PRASK side for 1Q definitely is slightly comforting, and it takes into account some bit of ATF inflation. So I think a multitude of factors have to play out. The ASKM growth guidance needs to kind of up a bit. The crude has to settle down. The repricing scenario has to be much better. Then you are going to see that EBITDA growth come through. Because if you look at our numbers at this point in time, on a 2-year basis, our EBITDA CAGR is approximately about 4% odd.
Okay, all right. Very quickly, Jinesh, you cover a lot of stocks from aviation to hotels to I think Nazara as well. From your universe, leave us with your top 2 picks.
Sure. So I think the two names that we like at current levels is Safari. I think this quarter they did a very good performance on the margin side. I think the EBITDA margin of 13% was definitely much better than our expectations, and also the top line growth of 12% that they have reported. So I think in the near term, while there are challenges with respect to RM cost inflation, but I think the overall GM and the EBITDA margin performance in this quarter was definitely comforting. We are just building in a 50 basis points of EBITDA margin expansion, and the stock is at about 30 times. So I think given how the crude volatility is, which is impacting their margins in the near term, which has led to a correction in the stock price, does offer a good entry point. So that is one name. And second, I think PVR this quarter they reported good set of numbers because of good performance from Dhurandhar, and I think the balance sheet is now relatively in a much better shape with a net debt of about 1600 crores. So in a volatile business, if you have the comfort of the balance sheet, I think that really helps. And the cash flow situation of the company is also much better. The stock is trading at about 10 times 1 year forward pre-Ind AS EBITDA, which is at the true end of their valuation. So I think that is another name which we like. I think while 1Q would be a bit soft given the fact that not many movies have done well, but on the cash flow side and on the valuation side, there is definitely cushion in PVR.
Okay, Safari and PVR. We'll keep an eye out on both those two, Janesh. Appreciate you joining in. Have a good remainder of the day. Well, let's welcome Sudarshan Sukani back on the show. Sudarshan, what's your 910 call?
LTF L&T Finance with a nice LTF with a stop under 280.
Can you repeat that, Sudarshan? Missed that. L&T Finance, is it?
Yes, buy it with a stop under 280.
Stop under 280. Got it. Okay. Thanks a lot for that, Sudarshan. We catch up soon. Let's focus on Asian Paints. That was one of the better set of numbers actually we got. But there's a bull as well as there's a bear argument. Vinny joins us to fill us in with both views. Vinny?
Hi, so firstly, let's talk about some of those bull arguments that have come in, right? Macquarie, they're maintaining the outperform rating target price of 3,000 rupees per share. And like you said, good numbers that came in from the company. Healthy volume growth in the decorative side of the business as well. 12.4% volume growth there. Better than what the street was expecting, better than some of the peers as well. Now, management is also guided for an 8 to 10% volume growth in FY27. Festive season, that's something that will support the growth as well. And demand strength, that continues to be there in Q1 of FY27 so far is what the company has highlighted. So that's why they're maintaining their outperform rating. Jefferies, they continue to maintain their buy rating, target price of 3,300 rupees per share. They also are highlighting that volumes for the company in terms of the domestic volume growth, that's been at a 12-quarter high. So that's quite a very positive sign that's come in there. The commentary for the management that came in terms of volume growth going forward, that also is positive. Near-term margins, maybe that should be in the guided range that they've given. But apart from that, they're quite positive on the earnings. Nomura, they also continue to maintain their buy rating, target price of 3,600 rupees per share. What they're highlighting is that they continue to maintain this buy. Why? Because they believe the peak in terms of competition now is behind, and disruptions was far less than one was expecting. So competition, they believe from here on will now start coming down. So that's why they're forecasting a EPS CAGR of 13% over the next couple of years. Now to the bear side. CLSA underperform rating, target price of 1,186 rupees per share. Citi 2 is maintaining a sell rating, target price of 2,500 rupees per share, while Morgan Stanley 2 is maintaining an underweight rating, target price of around 2,253 rupees per share. And they believe that March growth of 3 to 4% was reflecting upstocking and price hikes as well.
Leave it there. The first bell has gone. It's 23,700 on the Nifty. It's a positive start. After losing 350 points in Friday's trade on the Nifty, we managed to recoup about 150 points. Sensex opens higher with a gain of 500 points. In percentage terms, we are looking at a gain of about 0.6% on the Nifty Sensex. The advanced decline ratio has begun positively, about 2:1 on BSE, 1,200 stocks advancing to 600 stocks in the red. Mid-caps are moving in step. The Nifty Bank, at least for now, is slightly on relatively underperforming in the green, but a gain of about 0.2%. Well, the top gainer today is Interglobe Aviation, so that's up nearly 4.5%. Then you've got buying in IT names. That's visible. Bernstein today was telling us that how they're overweight on IT names. Infosys, Tech Mahindra, TCS, HCL Tech all start strong with a gain of 1.5–2%. Asian Paints is seeing buying, and that straight away opened up with a gain of about 3%. Other than that, metal names are up and about. So Hindalco, JSW Steel, Tata Steel on the gainers list. I can't see any large banks, at least on the front line, at least in the big movers. The Nifty Bank has now, in fact, flattened out completely. Kotak Mahindra Bank is a bit of a drag. ICICI Bank has opened lower with a cut of about 0.3%. NTPC is under pressure, and consumption names like HUL, ITC are slightly subdued in trade. And Bajaj Auto reported their May sales numbers, and that's opened up with a gain of about 0.5%. The gains have moderated now after opening at 23,700 on the Nifty. We're hovering around 23,600 in the green, but the Nifty Bank has no gains this Monday morning, absolutely flat.
Well, Rima, a few stocks that are calling for attention. PTC Industries, that's one of the reactions of the morning, I think. Not too high volumes. It's more than a 15,000 rupee stock, so that's on expected lines. But PTC Industries, that stock is flying away in trade today, so let's pull that up. Olectra Green Tech, that's another stock that's up close to around 7% in trade today. That's PTC India. In a short while from now, we'll be pulling up PTC Industries as well. So that's the other stock that we're looking at. I think there's a buy rating coming out from one of the frontline brokerages as well. So PTC Industries coming up in just a bit. Wokat, positive news flow is what we are seeing. That stock is well up close to around 15%, giving PTC company with a 15% gain. Vodafone Idea, that's one of the stocks that's moving on rather large volumes. The street likes that. Stock is gradually moving up, volumes rather high, 1.5% higher. Remember, in the rolls into the May series, we had pointed out that they were appearing positive. So some kind of positive news flow is what the street was talking about. The stock was 9.5 rupees at that point of time. Sterlite Technologies, well, that one continues from circuit to circuit. Good up move is what we're seeing out there. Textile names, you have some positive news flow that's coming in there. And the stocks are moving up, and they're moving up quite well. I think I saw Welspun India that was up, Gokuldas Exports as well, that was higher in today's trading session, and Pearl Global as well. All of them moving with good strength. Now on the flip side, RBP Infra stock is down 15%. Nureka is down closer around 13%. Volumes not very, very large, by the way, on both these two names. Som Distilleries, the stock is down closer on 7.5%. Big downtick is what we're seeing out there. Sinores Pharma, that's another stock that's trading with a bit of a cut. So there are select stocks actually that are reacting negatively to the news flow. But on the whole, the markets are still holding up. 100-point gain is what we're seeing on the Nifty, with stocks across the board doing pretty well. And, good to see that even the mid-cap index as well as the small-cap index, both of them are in the green. Individual stock reactions continue, but the headline index is at least pulling back some part of that sell-off that we saw on Friday's trading session in the final hour. Devina Mehra, founder, chairperson, as well as MD at First Global, joins us on the show. Hi, Devina. Good morning. Good to see you in. What's your positioning now, and how are you feeling about the Indian market? So many factors, right? At least the good news from the last time that we chatted is that crude oil prices have come off and the rupee has shown some signs of stability. So your approach?
Good morning, and good morning to your viewers also. My stance has not changed much from earlier times, which is that, be invested to the extent of your equity portfolio. Equity allocation, March and April, I saw that the SIP ratio is kind of turning negative, that there are more SIPs that are coming to an end than new SIPs getting started. And that, unfortunately, is how most investors behave. So you see a nice compounding over decades in equity markets, but most investors don't see that because they probably get in and out at the wrong time. So my strategy remains the same. In the rebalance, of course, we just did a quarterly rebalance, so there have been some changes, but not very drastic changes this time. That's within sectors, within companies, and all that.
Do you want to tell us, Devina? Hi, morning, Rima here, about the rebalance that you've done? And why? What prompted it? What were the trends that you've observed? What's the narrative behind that?
So nothing, special prompted it. We do it every quarter. So, and we do it from base zero. So the question we ask ourselves is that today, if we had cash, where would we be invested? Not starting from our existing portfolio, simply because, otherwise all of us suffer from something called endowment bias, that we always value something that we hold more highly than we should. The hold rating exists in the world because of endowment bias, because objectively anything you will not buy today, you should not hold at today's prices. So this was a regular exercise, and we have been overweight auto components, autos, pharma for over 2 years, and one was thinking whether that story comes to an end. But right now our systems are still showing stocks from that. So actually in pharma, I think we've increased the allocation a bit, even though we were already overweight. Otherwise, there are a lot of bottom-up picks from
Devina, just to come in, autos, pharma, and what else were you talking about?
the components more than also autos and pharma. And then, of course, there are bottom-up picks from places like chemicals, capital goods, FMCG, etc. As a pattern, we've seen a little more of the power sector coming up the system. So both power as well as power equipment. So, that's as a sectoral thing, that's what is emerging from our bottom-up picking. So that's broadly the strokes. But as I said, not very big drastic changes.
Devina, if the war comes to an end, do you see significant upside in the market from here on? Would it be 5%, 7%? Or do you think, because even prior to the conflict, the FIs were still sellers in the Indian market. So what is your view? If the conflict comes to an end, what's going to be the impact and how much of the issues that we're facing are structural in nature?
We're mixing up two things, whether FIs come back or not and whether the markets go up or not. These are two completely separate things. As I've said often enough that if you map it over a long enough period, there is actually no correlation between FIs buying and selling and the market moving in whichever direction it does. So, and on the geopolitics, my stance had been right from the beginning of this conflict, or for that matter, 4 years ago from the beginning of the Russia-Ukraine conflict, and this is based on data of 125 years of data, that you should not react too much to geopolitics unless your country is at war. Because that is what the history tells us, and not in a statistical sense, but in every single war. So here, of course, crude was already sort of due for an up move. So in our February rebalance, for instance, in our global funds where we were already underweight US equities, we had further underweight US equities and put that money into commodities, so mainly oil and some metals. So that pattern had emerged. And yes, I mean, it is good on the corporate earnings front if crude comes down, because a lot of downstream products from crude are inputs for many industries. So, it will accelerate the earnings trajectory a bit. And Q4 also, the earnings were not bad. So, I mean, we were expecting some kind of impact, which I think you might still see on the Q1 earnings because of this crude and downstream petrochemicals. But overall, of course, I mean, we are crude importers, and so that for us as an economy, it's a positive.
Okay, all right. Devina, let's focus on a couple of segments then. Auto ancillaries, if you could give us some color, what do you like? The auto ancillaries that are facing what kind of a theme? The CV space, do you think that's still strong from here on? Or, how would you position yourself?
So as I said, we've been overweight that theme for over 2 years. So from the beginning of 2024 almost, we've been overweight that. So it's not a new theme for us. And we don't believe in either excess sector concentration. So we'll never have like 30 or 40% in a single sector. And within a sector also, we have normally a range of companies. It is not just, one company or two companies. So I mean, our equity product is called India Super 50. So because we target to have about 50 odd stocks. So that's it's a broad theme. And as I said, since we've been overweight for over 2 years, I thought maybe that theme would be tiring, but for now it's holding up.
Okay. And on metals, what is it? Ferrous, non-ferrous? Are you playing the gold finance companies, or I want some color out there, since you'll have added some positions there.
Metals, we are not overweight, and we'd have, I think, a little bit of ferrous and a little bit of non-ferrous, but that's not a theme we are especially overweight. I just said that overseas, I mean, because you can play the commodities also, we had, and that was not the big chunk again in commodity. The big chunk was oil and energy, but we did buy some metals. As in terms of precious metals, I was just, taking a evaluation. Normally we have single digit allocation, but because the precious metals did very well last year and equities did not, we actually are in double digits just now in both our India fund as well as our global fund. So we just actually not in the global fund, but in India we are in double digit in precious metals. So we're just reevaluating whether to remain there or cut it back a bit.
Devina, how much of a negative would SIP ratios turning negative? I know we've seen only early signs, but you did say that this is a trend which happens when markets do nothing for a while. And plus, if markets recover a tad bit, we will see equity issuances come back. So that creates that supply pressure.
See, I mean, that's what I'm saying. Most retail investors enter and exit at the wrong time. I'll give you an extreme example. You know, many of your viewers would have read or at least heard of One Up on Wall Street by Peter Lynch. Now, he was almost the most successful mutual fund manager in American history. That fund compounded, I think, 28 or 29%. But the average investor in that fund compounded only 7%. And a good chunk of the investors actually lost money investing in the best mutual fund in history because they entered and exited at the wrong time. So you had years when that fund did very well, spectacular returns, and everybody rushed in. And often the very next year, there would be huge underperformance and people rushed out. So that's the unfortunate pattern. So all of us look at the 30-year chart and say, obviously, I would not have got out at the bottom or got in at the top. But your mind kind of panics and forces you to do the things you should not be doing.
Devina, were you placed on tech or a debate, right? Globally, AI trade doesn't slow down. In India, we have these tech companies that have underperformed. Which side of the argument are you on? Good time to look into it or stay away?
I have an op-ed coming out tomorrow on the global AI bubble. And I think it is a bubble. It's just a matter of when now. It's not if. And if you see, I mean, we think AI means the mega AI deployers, which is the Magnificent Seven, the big 7 stocks in the US. But actually, that bull has been tiring for a while. Even in 2025, 5 of those 7 underperformed the S&P. This year, 3 of them are down for the year. And the market has broadened there. The Russell 2000, which is the small cap index, has done more than double the return that S&P has. And even in what we now call AI is actually the CapEx people who are supplying for this AI CapEx. So there's like, depending on which estimate you look at, something like $750 to $900 billion of CapEx being put in by these large companies. And therefore, everybody, hardware, networking, semiconductor equipment, they not only have great demand, they have great pricing power at present. But semiconductor companies like that sector historically has been a very cyclical sector, like most capital intensive industries. So this year you have the CapEx, but 2 years later, will you have the same level or higher level of CapEx for you to show the growth? So, I mean, I find it a little silly to look at that very simple PE by growth people look at. Yes, this year there is growth, but will it sustain? Because the problem is that these kind of capital investments will not get the return on capital. That is really the big question mark. That yes, I mean, AI might thrive as a technology, maybe. I mean, again, all the people telling you the hype about AI are either the companies or early investors in their companies, and most of the so-called research reports are all research papers are not peer reviewed or any of that. So, I mean, you are talking to the companies who are raising money either in the private market or on the IPO market, and obviously they will hype up the technology. Whereas the user, like recently the Uber CEO said that we did not see the cost benefit playing out in AI. So that's the one part. As far as India is concerned, the India IT services companies, even if AI comes in, no chief technology officer is going to turn over the keys to their system and database to an AI company. They will still need an intermediary, because otherwise, AI can also cause havoc in your system. So I think, in terms of business, the IT companies in India will be able to pivot their business. The issue might be more for the macroeconomic front, that they may not be, at least for some time, the big employment engine they were for the last 25 years. And we are already not doing so well on the employment front.
Devina, a great conversation, and we look forward to that op-ed on AI. But thank you for giving us that sneak peek.
Thank you.
Great chatting with you. Let's move on now. We've got the management of IRDA joining in on the back of the Q4 numbers. The loan book momentum has remained strong. It's crossed 93,000 crore in FY26, but higher provisions have weighed on profits. To talk more, we have Pradeep Kumar Das, Chairman and MD of IRDA, now joining in. Mr. Das, morning, and thank you very much for joining in. Let me just begin with your gross NPAs and get a sense of the asset quality. When I look at March year ending versus March of last year, there has been a deterioration, 3.45% versus 2.45%. But Q4 is better compared to Q3. So give us an indication of how your gross NPAs and net NPAs will trend. And X of that AP account, which you had flagged off earlier, is there any stress that's building in the broader economy, if you'd like to talk about it?
Yeah, very good morning, and thank you for being me here. As far as overall financial performance is concerned, continuous 6 years, 24 quarters, we have been giving the growth. And the loan book growth, if you see, 22% growth, which used to be generally 28 to 30% range. And earlier to this, 5 years for CAGR was 28% around, and this year 22%. So that speaks the volume that we are focusing more on compliance, governance, and asset quality improvement. See, the asset quality deterioration, what happened, it happened in the beginning of the previous year, which the entire investor community and you all know, majorly for Gensal and other one more Andhra group accounts. And in that Andhra accounts, we have already sorted out around 120 crores here. And in that, we have not sacrificed. So this is one indication what I'm giving. And other things are in pipeline, and we are confident to sort out that. Coming back to the Gensal, incidentally, we are not the sole lender, nor even PFC. We are 16 lenders are there. Since 16 lenders are there, so it is taking time. So apart from vehicle loan, we had some solar EPC loan also. So some portions we had already recovered, which was available with us, and balance the RP is doing the process. And as we know, through the NCLT process, RP normally takes time. But in this case, in the 29 days, we had got the approval to engage RP and admission in NCLT, and then appointment of RP and process went on. So that since 16 lenders are there, so having a committee of creditors, coordination and other things, that takes little time. And wherever IRDA is sole lender or lead lender, in those areas we are doing quite well. And as far as NPA indications are there or recovery indications are there, see, so far even in our lifetime of IRDA, our cumulative write-off till date is 148 crore against 1.91 lakh crores of financing. So, and if you see, as you said, Q3 and Q4, the NPA, recoveries are asset quality is improving, and we are confident in the time to come further improvement and further recovery. And we are trying our level best to minimize, and at best we are trying to not to sacrifice. That is as per our history, so we are trying to maintain. And to the extent possible, in case of Gensal, whatever best course of action to be taken, since the RP process is going on, it will not be appropriate on my part to talk what action they are going to take, because it is a free court process. So therefore, our action with respect to the recovery and support to the RP, that is quite good, and we'll continue to do that.
Okay, all right. You were talking about Gensal, sir? That's the account, right?
Yeah.
Could you help us just revise that number for us? What is the total recovery you're looking at from there?
See, if you look at Gensal account, we had around 672 crore, 434 crore towards cars, and 237 crore towards EPC. Out of that, already we had recovered 222 crore, principal of 138, and as on date, the outstanding is around 1345 crore. We have already made a provision of 975 crore. So if you see the net so far in that account will be coming with respect to Gensal will be around 100. And the other account taken together in this 1345 crore, these two accounts, two groups, it is, we have net around 370 provision now. And as I said, in this Andhra Group assets, we have already recovered whatever the amount. In that, we have not gone for any sacrifice.
Okay.
And we are working out for restructuring some part of that. And we expect that we will not be going for a haircut or sacrifice in that.
Okay, all right. Let's talk about disbursements then, sir. It grew faster than sanctions in the past year. What kind of outlet do you have, on that front? What kind of loan growth can you do for this year?
As I said, we used to have generally 27-28% of CAGR growth for last 5 years. This year it is 22%.
Yes.
And post-Ensel, I would like to be very clear, post-Ensel episode, our focus was completely on scrutiny, review, monitoring, and ensuring compliance and governance. And we have gone through all the kinds of audit, CSG audit, internal audit, stat audit, forensic audit, RBI inspection and all. Our asset quality has already been improving and improved quite a lot in comparison to what happened at the beginning of the previous year. So in future, the lot of business opportunities, and we are also, board has already approved for modifying the object class to capture the not only business opportunity as well as what is the sectoral requirement in the new and emerging technologies as far as green finance is concerned. So we'll be forwarding that to our ministry and then with the general body of meeting. And once we get the approval, we have plenty of business opportunities. And even if you see with major concern of having equity additions continuously, which we were doing last 5 years, and we had a dividend exemption. This year we have started paying dividend, and post-listing it was a concern or rather a perception from the market that when we will start giving dividend. Generally, I say when we are having 22 to 30% growth, giving dividend will not be prudent for the investor. But moreover, in a listed company, it is a general perception that if the company is giving dividend, so it is good. But in a lighter sense, I tell my officers, if you are giving 500 crore dividend, then some 4,000 crores of business opportunity you are losing. Not only that, you are not in a position to support to the sector to the extent of 4,000 crore. And the sector is having tremendous growth opportunity. If you see, RE has been added 55 gigawatt against 37, 38 gigawatt in the previous year. And with the new and emerging technology, particularly battery storage and pump storage, you have this green hydrogen, etc. and all, which is coming up now. And a fair amount of business we have already done in this battery space, storage space. So we are confident in the time to come, our business opportunities, whatever is available, we are not only going to encash and further we are going to strengthen our asset quality and book size.
Is there a loan book guidance, CAGR, over the medium term that you're aspiring, say 25%? In the past, you grew 20 and 30%. What's the number that you can compound at for the next 5 years as this renewable story plays out? And just one more word, your net interest margins. When I look at the 9-month number, it stands at 3.74. But for the full year, you're down to 3.65%. So has there been some NIM compression in Q4? And what's the outlook?
See, our focus is always to pass on the benefit to the sector. If you see, our yield has gone down by around 49 basis points, and so the cost of funds 56 basis points. If you see other industry players in this space, much bigger players in this space and having much bigger book size and all, their NIM has gone down quite a lot. And if you see at the end of the day, if the annual comparison, we have 38 basis points of NIM up. Yeah, certainly, if you are looking at the quarter, December to March, there is slight change. And see, market is becoming very, very competitive. And to make it more affordable, to ensure that the RE growth happens, if you see 55 gigawatt has added last year, somewhere this lower interest rate has played a very key role, in addition to our government policy and other things and the developers' initiative. See, our objective is not only to earn revenue or profit, our objective is also to ensure speedy RE development in the country and ensure asset quality. So when we are passing on the benefit, our asset quality is also sustained. The moment the interest rate will not be passed on, we can make profit, our profit size will go up, but whereas certain portion of the assets may get into stress. So we are very conscious in that, and at the end of the day, if we can bring down the borrowing cost and ensure that the cost of borrowing is going down, so that is what the main motto is.
All right, very quickly, sir, borrowing cost comes down by how much this year? There's been a rating upgrade as well, as I can see, multiple funding initiatives. So how much has it come down in this year? Very quickly, sir.
See, if 38 basis points we have brought down in last year, so and if you see continuously we are trying to bring it down, it is very difficult to tell how we can bring down because it all depends on the market. And you know, it is not Indian market today. If anything happens in the corner, any part of the corner of the world, India's market is getting impacted. So therefore, telling X number will not be appropriate. But our motto and stress or the focus would be to reduce as much as possible and at the same time pass on to the sector as much as possible. And at the same time to ensure fair amount of share for our investors.
Okay, appreciate you joining in, sir. All the best for the remainder of this year. We keep chatting and hopefully we'll get some more concrete numbers in our next chat as well. Thanks for giving us some color.
Thank you very much.
By the way, keep an eye out on the bottom of your screen. You have Mahindra and Mahindra, and those numbers look good in comparison to our poll. The total tractor sales numbers are much better, and the total auto sales number as well much better. So a thumbs up coming in from Mahindra and Mahindra. My colleague Sudarshan will, slice and dice those numbers soon. For the time being, safe to say, thumbs up out there. Though we'll slip into a short break. On the other side, we'll have Bank of America's Vikram Sahu, who will be joining in from the sidelines of the BofA India Conference 2026.
Co-powered by SBI, the banker to every Indian. Truly.
मैं 10 या 12 स्टॉक्स में एक्सपर्ट हूँ, पर कोटक नियो 300 स्टॉक्स में।
Get access to daily trading ideas on stocks, F&O and commodities. Stay tez with Kotak Neo. Investments in securities markets are subject to market risks. Read all related documents carefully before investing.
Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI, the banker to every Indian. Truly.
Welcome back. As promised, let's go across to Prashant Nair. He's in conversation with Vikram Sahu, India CEO and country executive at Bank of America from the sidelines of the BofA India Conference 2026. Prashant, take it away.
Well, thanks very much, guys, for that. This is the Bank of America flagship conference 2026. Lots of, chatter at the conference here already. It's a two-day conference, and you'll have top corporates, you'll have top investors. And of course, the entire Bank of America team sort of interfacing between both sides. And I'm sitting down with Vikram Sahu, who's the India CEO at Bank of America. Vikram, great to have you with us here. Thank you very much for your time.
Morning.
So what are you expecting personally from the conference? If you had to kind of sort of, maybe the top question which you think is on everyone's mind, which you hope gets answered through these conversations over the next 2 days, what is going to be the dominating sort of agenda of this conference?
Top question. That's a target-rich kind of topic to choose from, because we've had so many challenges that we faced in India over the last year. A lot of it not of our own choosing. But rather than top question, what I'd say is actually I'm slightly mildly surprised. And let me explain what I mean. Given everything that India has gone through, given where FII ownership is of India at present, given what's happened with the rupee, I wasn't really certain how much interest there was going to be in coming to India to be at this conference this year. What we've ended up with is a 30% increase to our foreign institutional investors who are participating in the conference this year relative to last year. And that tells you something. It tells you that investors, while India may have been out of favor in the last year, at least foreign institutional investors are prepared to look through that. They want to invest in India for the long term. And I think what they are here at this conference to do is to sharpen their pencils, talk to the sources, talk to companies, talk to policymakers, understand what's going on, and try to decide how to position themselves. So I think it speaks to the resilience of India to have this sort of participation in the conference.
As in 30% over last year.
Over last year.
And this at a time when, we've not done badly. There's too much, I think, negative narrative, self-loathing, that kind of thing, right, here in India right now. That's a general feel. And it's not just about markets, but generally outside of it, the macro-ish kind of environment. And sometimes those are times when you got to sort of look hard through some of this noise, and that's when you get to take positions which make you money over a period of time. Would you agree?
Yes. In fairness to investors, though, I think the noise through this last year has been louder than normal, and there are some very real issues that India does need to contend with. So if we think about the litany of problems that we've faced, and again, I want to emphasize, not all of this has been of India's making. So whether it was a border conflict about this time last year, whether it was the ongoing trade dispute, it's a little bit like waiting for Godot to see the US trade deal come through. The Russia-Ukraine conflict has been grinding on, going into its 5th year now. We've also seen West Asia, which has been problematic for India, given our dependence on imports from the Middle East. So these are all, and then as an overlay to that, it's the rise of AI. So some of these are real ongoing structural issues. But I think what we should not ignore is also two really important variables. One is that India is showing resilience through this, in part because of the investments that have been made by India in the decade prior to that, whether it was in the physical infrastructure realm or whether it's in digital infrastructure. And I think that's positioned India. But the second also is the responsiveness of the administration. So if you look at the period from, let's call it Diwali last year till now, we've seen a number of trade deals that have been announced by the government. We've seen a number of reforms, and if you look at the reforms individually, each of them are interesting, but when you accumulate them, it's probably the biggest wave of reforms we've seen since 1991. So I'm encouraged by the responsiveness and the resilience, and my belief, like you were saying, is I think we're going to get through this.
This last bit, Vikram, which is the AI bit, right? I mean, that I think is really put the spotlight, and I think that is one reason why you see markets around the region doing very well, and you say, oh boy, you know, as you said, we've been resilient, we've not fallen too much despite this huge oil dependency, etc. But the point is, there's this huge AI capex super cycle going on, and you've got a bunch of countries in Asia, North Asia specifically, which are benefiting, and we're not sort of, you know, we're not riding that boom, and that kind of makes that comparison more stark, right?
Yeah.
And I think that's been the differentiator, would you say, over the last 12 months more?
I think it's fair to say that because, you know, one of the things that India's benefited from in the past has been the TINA factor. So if you think about countries that have growth of this scale and growth at this pace, there's been very, very few countries that have that to offer. And so India benefited. So 18 months to 24 months ago, when you look at valuations in India, we were trading 2 standard deviations above our own history. So very, very rich valuations. And as you said, in that environment, then you suddenly have this whole AI phenomenon play out. And India is not just perceived not to be participating in it, but it's also perceived to be a potential loser from this.
Net loser in that sense. That's a perception.
Perception. That's a perception. And you know, the stats that people will cite is to say, if you look at per capita income in India, if you take out services, it drops from $3,000 a head to about $1,500 a head, and it underlines just our dependence on what's happening over there. And there's this known unknown about what AI will actually mean for the IT services industry in India. I think that narrative is overdone. For instance, what it does not adequately reflect is the investments that India has been making across the board when it comes to the whole tech stack. Whether it's from LLMs like Sarvam or whether it's coming to chips. Now, albeit these are going to be chips that are not going to be bleeding edge chips, but nevertheless, these investments are being made. So I believe that... Of
course, there is the application layer, which at some point...
Absolutely.
So much of the focus right now with regards to this AI thing is physical, right? But at some point, it'll all, once enterprise adoption picks up, you will need that application layer to come in, right?
Yes.
What Jensen Huang calls the 5-layer cake. The 5th layer is the applications.
Yes.
And that's where India comes in.
True. And so when you look at some of the work that's done out there, some of the conclusions are, it's counterintuitive. It's going to be that what AI is going to do is actually expand the set of solutions that are required the opportunities that are there going to be to work on them, and that's going to create opportunities, I think, for potentially for Indian companies. But it's still murky. That's the known unknown that India needs to work its way through. So the bridge between now and then comes back to some of the things that we've been talking about, which is to say the continued investments India's been making in physical and digital infrastructure that continues apace, as well as the responsiveness of companies to the environment that they find themselves in.
The other big thing, which is sort of, it's all happened together over the last couple of years, is, local retail investors have become such an important part of the market. And that's been this constant bid, refusing the market to not letting the market fall, right?
Yes.
And what that has also enabled is lots of exits, big exits.
Yeah.
Right? And now people are looking at capital. I mean, the reason why macros, perhaps the rupee has been under pressure is largely because of the capital account.
Yeah.
And these exits are being blamed, and then people sort of, work backwards and say, well, it's a domestic bid for equities, which is unrelenting, which is allowed for all of this. How do you think about it, Vikram?
So I'll break this up into two different parts. I think let's start with the first one, which is unequivocally healthy. And I think you and I have talked about this previously, which is the phenomenon of domestic AUMs. And I think, as I've said previously, this is a story that's still in a very early innings. We have equities historically been a very small part of household savings in India. That variable is changing. You're seeing new brokerage accounts being opened, and our view is that that's going to continue well into the future. So you've got three vectors three variables that all increase. Per capita income increases for the proportion of India's population that has disposable income. That income increases. You have the number of households with brokerage accounts increasing, and equities as a share of household savings increasing. So we put those three variables together, and our belief is that those flows will continue for a long time into the future.
The worry is the last is happening. Number 3 is happening, which is number of brokerage account, demats accounts, etc. But per capita, I mean, and I've made this point to you at one point in one of our earlier conversations as well. The level of financial access to financial products at a per capita GDP that India has, I mean, it's unparalleled. You have this kind of penetration at much higher levels of per capita GDP, right?
Yes.
So, I mean, is that a worry? Do you worry about that at all, or?
No, I think it's just a function of time. And if you sit down and think about just that, how many Indian households had bank accounts? 10 years ago, the number was 35%. Now you've got the numbers in the 90s, and so I think it's just a function of time. And you may have some periods where it sort of plateaus, and then you'll see a step change taking place. So I'm not as worried about that issue. The second part of the topic has been what's happening with, and that's been enough to offset FII outflows, because had you had this volume of selling in the past, then Indian markets would not have held up as well as they have over the last year. The other issue, which is one that still is to be resolved, is the balance of payments issue that India faces, and that's a different matter altogether. And that's something that the government needs to focus on.
But that is again, there is the FPI bit, which is the exits. There is the FDI.
Yeah.
FDI flows, which have kind of sort of slowed to a trickle as a percentage of GDP. I mean, over the last 2 years or so, right?
Yes.
I mean, you sit at the intersection of foreign investors wanted to come in, FDI wanted to come in. I mean, you're involved in lots of large transactions. What are you seeing, Vikram?
So, undiminished interest. And what I mean by that is when you come back to what is it that investors find fundamentally, intrinsically interesting about India, it is size and scale, velocity, and last but not least is governance. You'll have lots of markets which will have one of those three variables, but the combination of all three is something that underlines the interest of global investors, and whether that is corporates who are looking to increase their exposure to India, or when it's FIIs who are trying to figure out what is the right entry point. So I'm seeing undiminished interest. Now, that does not mean that we should be complacent about it, because what India has to do for its own part also is to figure out how to roll out the welcome mat and to improve ease of doing business in India. Try to work on ways to reduce the regulatory cholesterol that we have within India. But again, I come back to this point, which is the posture of the administration, the posture of policymakers is very lean forward. The posture is to try to listen to what's being said, to take on board constructive feedback, and try to implement those changes that makes it easier for foreign investors to invest in India.
Undiminished interest in India. India offers scale, size, and governance. But India perhaps just needs to take some steps to roll out the red carpet and reduce the regulatory cholesterol or friction of entering into India. But let's get in the next management on the show, and that's signed. The company is all set to buy Tower Digital for $218 million. The company says this acquisition marks a transformative moment in the company's history. We have with us Executive Director, CEO Sukamal Banerjee joining in on the show, and some of the talk points that we'd like to discuss with him are also up for you on your screen. So let's begin, Mr. Banerjee, but just trying to understand what the combined entity will look like. Your DET revenues were about $658 million. Tao adds $79 million as of last year, which means combined we're looking at about $737 million. On this base, what kind of revenue growth are we looking at? Because Tao was growing very well while your organic business was struggling a bit. And what are the margins of the acquired entity? And will this acquisition be EPS accretive?
So let me thank you firstly for having me. Let me start with the latter part of your questions first. The answer to EPS accretive, the answer is yes. It'll be substantially EPS accretive from CY28. Margins that the acquired entity is operating at is close to 20% EBITDA. From a perspective of growth, we, as you know, we do not give any guidance for the business per se, but we are definitely pursuing a growth path towards mid-single digits for this year. And this entity will definitely help us achieve that and potentially surpass.
But your guidance was mid-single digits even prior to the acquisition when we spoke in April. Now that you've got this adding about 12% to your top line, do you not have the confidence that you could do better, maybe hit a double-digit revenue growth rate for FY27, even if assuming it contributes for half the year?
So I think firstly, let me clarify, we do not give guidance. And that is a stance we have taken for the time being. What we had talked about was what is our ambition for the year. And we definitely remain focused on that ambition. The accrual of this acquisition will definitely be for H2. And I think it will definitely obviously add to our growth numbers for this year. But will it substantially change given it is partial year? Probably not.
Okay. And can you tell us how you plan to fund it? The total enterprise value is about $218 million. Plus, you'd announced that buyback 2 months back. So combined, what is going to be the outgo and what is the cash on the balance sheet post this?
So the funding will be a combination of debt and equity. And it'll be largely driven through debt. From a perspective of layout, the upfront payment that we are doing is roughly 60%, and the rest of it is linked to outcomes, which would be the earnouts over the next 2 years. So about $130 million is the closure amount that we're going to pay upfront for 100% acquisition of the shares of this company. And the rest of it will be through earnout, which is driven by goals that have been set up. From a perspective of cash, we have roughly about $180 million in the bank, and we're going to use some of it, but we'll probably raise we'll fund this from a debt perspective for the rest.
You've also said so margins of the acquired entity Tao are 20% plus EBITDA. Did I get that right?
Around 20% EBITDA, that's correct.
So you've said in the press release the way to look at the valuations of the acquired entity is a 9.5 times EV to EBITDA calendar year 27. So what is the EBITDA run rate that you are assuming going forward for the acquired company?
We are assuming the EBITDA run rate will remain similar, including all the costs that we have to accrue from an integration standpoint and the charge of the one-time charge of doing an acquisition. All of that put together, we expect it to remain flattish. The focus would be on growing the revenue and keep the EBITDA at similar levels.
Now, just coming back to what happened in Q4 and trying to assess the change in the macro situation. In Q4, you said that 3 of your customers delayed starting their programs, and that impacted the pipeline. It was a bit of that impacted the revenue. It was not a pipeline issue. Have those 3 programs restarted in April or May? And now, what is the situation in Q1?
So, from a Q1, in terms of those 3 specific programs, the answer is yes, they have started. They have probably not started at the levels that we wanted in terms of the speed at which we were expecting it to move as per the deals that we closed. But they are in the process of ramp up as we talk about in this quarter. There are other dynamics at play, which are part of geopolitics that everybody is aware of, which is affecting one of our segments, which is energy. But otherwise, I think on what we had called out for 3 of our specific customers, we are on significant recovery path there.
And you said, but the ramp up has not taken place as per your expectations. So if your expectation was 100, where are we right now in terms of ramp up of new projects? And are there any more such delays that you witnessed in Q1?
Not from these accounts or these customers that we had called out in terms of delays, but there is an overall softness in energy projects and energy-related segment activities that we are witnessing at this point in time. But overall, in other segments, I think we are going as per plan.
And you also had an aspiration of 15% EBIT margins by Q4 FY27. Now that Tao is growing well, is there a change to this aspiration on the EBIT, sorry?
So from an EBIT perspective, combined EBIT will, because of amortization, will obviously have an impact. But from a standalone EBIT perspective, which is the organic business, we are pursuing it. But obviously, it does need a ramp up in revenue to achieve it. But we are still working towards that number. Our aspiration remains the same. And in terms of what it takes for us to get there, we have partial visibility. We are working on completing the visibility towards that number, which we do not have right now.
And getting back to this acquisition and the kind of synergies that you expect from it, and what is the total addressable market it opens up for you?
So it is a combination of not just from this acquisition, but something that we have been already working on at Cyient, which is to shift our focus from just being an ER&D outsourcing company to be a lifecycle engineering company. What that means is essentially pursue the entire product lifecycle. And the industries that we operate in, the lifecycle is anywhere between 8 to 10 years on the lower end to 30, 40 years on the higher side. And increasingly, our customers are witnessing 2 things. One is obviously the amount of data, because products today have far more sensors. They have manufactured at a different level of granularity of data points. They are monitored at a different level of granularity of data points. We are seeing a significant explosion in terms of data created. In fact, in our market segments, our customer segments, data is doubling every quarter. So what it opens up for us is a significant downstream activity around data engineering in that life cycle of the product, from the product development, the processes of product development, to the manufacturing cycle, to from supply chain, and then of course, where our customers are seeing a significant growth, which is services revenue for them, which is in the services of aftermarket, MRO, and so on. And that is where we see the unlock happening. If you look at ER&D outsourcing today, it's probably about an $80-100 billion business. And we expect the market that we are talking about is probably 20x. Obviously, it's going to take quite a lot of work and time to open up that entire market space, but that's the level of TAM which is available to go after.
Appreciate you joining in, sir, and giving us all those details. Have a good day, Mr. Banerjee, and all the best with this acquisition.
Thank you very much.
Okay, all right. Well, the markets have come off actually from having a good, rocket start actually. Now the Nifty has flattened out completely. The problem is the Nifty Bank. It started off in the green, it hit resistance, and it's pulled back a little bit. So some kind of nervousness continues in our markets. It was a good start, but that got sold into. Shilpa Rao of Prabhudas Yadar joins us for a technical check. Hi, Shilpa. What are the levels you're looking at on the index, and would you buy this intraday fall?
Good morning, Nigel, and thank you for having me on the show. Talking about the indices, I feel that there is some sort of resistance at around 23,800 24,000 zone for Nifty. And for Bank Nifty, the same lies at around 55,000. As for option chain, we have seen in rollovers that the support comes at 23,000 for Nifty, and for Bank Nifty, it is around 52,500. The rollovers has also been on the softer side. So I believe there's some sort of nervousness, definitely, but stock-specific, conditions are looking pretty good. So I have a buy and a sell. The sell would be in NMDC. NMDC is having a resistance at around 91 zone, so that should be a stop loss and keep, looking for targets of 85 to 82. The other one would be a buy in Infosys. Infosys is looking quite strong. Keep a stop loss of 1180 and look for targets of 1240 to 1260.
Okay, thank you very much for that. We will get into break. On the other side, Manisha Gupta will join in to talk about commodities. Stay tuned. Welcome back. Let's talk commodities now. Manisha Gupta is joining in as always, and today she's talking about the textile space because the government has removed the import duty till 1st of October. Manisha, over to you.
Well, thank you so much for that. This has been happening for some time. You know, between August and December last year as well, the government had waived off 11% duty. It came back in the month of January. And that also is a period when you see the crop started to come back. So the government clearly has been balancing it quite finely. So when it is India cotton arrivals into the market, so that it doesn't hamper the farmers too much, is when you have this duty come back. And when it is not the case, and that is the time that duty has been removed. So 11% import duty as of now has been done away with. This has been a demand from the industry for a very, very long time. This is being done to improve the global competitiveness. Remember, the last year wasn't so great because of the kind of tariffs that US had laid. But now it seems to be getting better. The exports are expected to pick up, and the markets also are looking at better competitiveness with the Asian peers like Bangladesh, Vietnam, etc. That is where major textile production, manufacturing and exports happen in from. So if you look at the overall production numbers, well, India produces 23 to 25% of global cotton. India, by the way, is the largest producer of cotton in the world. And as you can see, the last couple of years have not been so good in sense of production as compared to FY23. And for this year as well, while the government estimates stand at 320 lakh tons, industry believes that it is tough for the cotton crop to cross beyond 300. So that is a number that we'll have to watch out for. At this point in time, the expectation is it's going to be better than last year, but perhaps not 320 therein. When you look at the textile exports, and this is exactly where the move has come in for, has seen a decline of 2.2%. This is all because of the tariff that the markets did see, and the anticipation that you will see perhaps FTAs happen from India with various other partner countries. So you could see that number increase therein. Also remember, we've seen the ministry continue to say that there is a target of $100 billion of an export by 2030. Now, the industry tells us if not by 2030, then perhaps by 2032, 2033 is when that number perhaps is a possibility, not perhaps in the next 4 years therein. When you look at the overall imports as well, what India imports is not what India produces. So import is of high, long staple, different quality, and most of the companies, they import specific, quality specifications when you import this cotton. So raw cotton imports have seen a 54% of a jump in the previous year, almost to the tune of $1.8 billion there. This, of course, has been at a higher import duty. The markets do anticipate that you could be looking at nearly 600,000 bales of imports coming in for the next 6 months till the time the duty has been waived off. Interestingly, when you look at the overall FY26 therein, as I said, it has been nearly 2% of a decline in exports that India has seen. And within this number as well, the ready-made garment has actually seen a sharper cut coming in there. The markets have been anticipating stronger numbers there, but we have seen 2.9% of a jump onto that one. Cotton commodities, not so much of a gain. But when you look at the man-made textile, 3.5% of a jump coming in for that one. And value-added handicraft clearly has been a very strong number that the ministry has talked about. And that is what has taken the numbers on the higher side as well. The cotton prices should come in on your screen because that has seen an increase in this year as well. January was 54,000 and May has seen 64,000. Of course, with the duty now going down, you could be looking at that number also easing off. And now why the Indian prices are higher? There are 3 reasons for that. One, of course, is higher MSP, where we saw 11% of gain in the previous segment as well. And then you're looking at local deficit, and it also has to do with the higher crude oil prices that has taken the man-made fiber or the synthetic clothing prices on the higher side. But the street does believe that this step and more FTAs that India would do would definitely be positive for the textile sector.
Thank you very much for that. Interesting data over there. We will slip into a break. On the other side, Lata speaks to CNBC TV 18 Citizen MPC on what to expect from this Friday's RBI policy.
The Reserve Bank and its MPC will be announcing its policy when there is much to worry about the fall of the rupee and possible rise in inflation. However, growth looks resilient. As always, the CNBC TV 18 Citizens Monetary Policy Committee is here with me to discuss what the RBI may and should do in its June 5th policy. Let me welcome Chairman of our committee, Pranab Sen, and members Sajid Chinoy, Samiran Chakraborty, Shaumika Ghosh, and Sonal Verma. Sonal and gentlemen, thank you very much indeed for your time. Sajid, may I start with you? Well, inflation is the mandate of the Reserve Bank, and chances are it is going to be pushed. If you go by their MPR announced in April, they said if there is an average of $95 crude for the current year, then the current year inflation gets bumped up to 5%. For a 5% inflation, a 5-quarter repo looks less. Is there a fair chance, therefore, for a rate hike?
Good morning, Lata. I don't believe so, because I think what's important is this is a flexible inflation targeting, and we're looking at supply shocks here. If this is a demand shock and you expect inflation to be upwards of 5% for the foreseeable future, there's a compelling case for the central bank to act. But when you've got a supply shock, and possibly two supply shocks here, right? Two adverse supply shocks, an energy shock that we're living through and a potential El Nino shock. Both of these could be adverse and could push up headline inflation. But, you know, raising rates is not going to bring crude prices down. It's not going to make El Nino into La Nina. What the central bank needs to look at is, A, how sustained will the supply shock be? And more importantly, is it spilling over into a more generalized, entrenched inflation? And the best way to assess that is to look at how core inflation evolves, right? So I think what the central bank is going to look carefully is, if A, do these shocks pan out for months to come? B, do they translate into core inflation? C, do they unanchor inflation expectations? And then there is a case for central banks to act. Remember, back in 2015, we had a pretty severe El Nino. But for a variety of reasons, we had strong buffer stocks, initial conditions were favorable. That did not translate into the kind of broad-based inflation we had feared. And I think similarly, starting points here allow the central bank to be patient. Buffer stocks are high, reservoir levels are normal. And more importantly, we come into the shock with very benign inflation. Core inflation has been running, correctly measured. If you take out precious metals, take out petrol and diesel, is running at 2.2%. That suggests that producers in this environment don't have much pricing power. So even though input prices will surge, it remains to be seen if this gets translated to a broader output price inflation. Therefore, I think the RBI will and should be patient.
Okay, fair enough. Sonal, now let me ask the other question that the markets are asking. Indonesia has raised rates because of the attack on the currency. It's been similarly impacted like India. So is Philippines. They raised rates in April. Whether or not the flexible targeting allows it, theoretically, practically, there is a market expectation. Shouldn't the RBI oblige with a rate hike for the sake of the exchange rate as well?
Yeah, Lata, I think, MPC needs to conduct policy based on what is effective. In Indonesia's case, FX stability is part of the BIS mandate, but, the surprise 50 basis point hike actually did not help stabilize the IDR. And in Philippines, inflation is running above 7%. So compared to the upper bound of 4%. So the inflation picture in Philippines is very different to India. So we need to look at our own scenario. I think using the interest rate to defend the currency is inadvised for actually a number of reasons. First, we've spent more than a decade trying to anchor expectations in terms of the inflation targeting regime and what the monetary policy framework is about. The moment we start targeting FX to manage using rates, I think that essentially undoes a lot of the hard work that has been done to anchor expectations. Second, interest rate hikes to defend the currency are not effective, as seen in the case of Indonesia and also as seen in India's case back in 2013. And third, we need to do a cost-benefit analysis. The cost of doing a very aggressive rate hike in order to curb demand vis-a-vis, the benefit, we will end up in a situation where the growth damage is so substantial that we'll start worrying about the fiscal side and other consequences of weaker growth rather than on the balance of payment situation. And, as we've discussed in the past, India does get a lot more of growth capital. And finally, I think we have, a number of non-monetary measures on the current account, on the capital account, on the macroprudential toolkit that can be used to manage the currency. So I think, the market argument of using the interest rate to defend the currency, I think both from the currency side as well as, from the inflation side, it is not essential and not needed in my view.
Okay, I'm going to bounce the same thing to Samiran as well. Because there is a lot of voices in the market which believe that the optics are that the Reserve Bank may be falling behind the curve, both on inflation, but even on interest rates. The defense is being asked for by some quarters. Samiran.
Yeah, thanks, Lata. I guess Sajid and Sonal have very eloquently argued in favor of the view that why RBI can delay any rate hikes at this point of time. And it's also our view that that's probably likely in the June policy that RBI defers it. But it's interesting that there could be another way to play this also. First, we have to understand that the December rate cut actually did not have any intended effect on the transmission. So in our view, probably another 25-50 basis point hike from here is simply normalization because we probably cut too much in the cutting cycle at that point of time. So it just creates a little bit buffer for RBI to work with. The second issue is that we all are forecasting that inflation in the latter part of the year is definitely going to go up. By how much, we probably don't know for sure. But that increasing trend of inflation, again, it's possible that the MPC decides to create a buffer now so that they don't have to scramble too much at the latter part of the year when there's a sudden spike in inflation, partly simply because of base effects. And the last point, which you also mentioned, which is about this whole perception about falling behind the curve. And there is a risk that if the markets feel that the RBI is falling behind the curve, then the exit route or the valve that the markets will try to play through is likely the currency. And that's where the fear is that if RBI is seen not to be doing anything, then is that going to be some sort of an additional risk that the market will try to price in on the currency front? So we remain with the baseline view that probably not a hike in June, more likely in August, because RBI wants to give some guidance generally to the markets. But having said that, there is we will not be surprised, at least, if the hike is advanced to June itself.
Okay, so the governor has, elbow room on both sides. Soumya Kanti, actually the bigger thing that the market is waiting for is what's the package for the rupee? If not rates, what? What do you think? They can, they just have to sound, the optics have to be pro-rupee. What will this announce?
Yeah, thank you, Lata. I think there are a couple of options on the RBI before the table. And in my sense, I think given the rapid and the unprecedented depreciation in the value of the rupee, which is, I think, has somehow been significantly higher compared to any other currencies, I think possibly and addressing the issue becomes more important at this point of time. There are various options. I think the first options, all the other members have already debated, an interest rate hike. I am of the view that a policy rate hike may not be appropriate for this currency, the currency, because of the simple reason is that the more you try to hike the currency, the more the market will believe that the rupee could actually, it is being done to protect the rupee. And better way is basically to work on regulatory to other measures. For example, the measures which attend to address the market microstructure, which raises the short-term rates and lowers the long-term rates, like Operation Twist, or even widening the corridor for a limited period, which was done in 2013. So that could be one of the options. Regarding the second option on the balance of payment, I think there are a couple of options, but the options are on an FCNRB window like which we did in 2013, or even raising bonds at this point of time would be a little defeatist, because the cost of such mobilization could be in double digits. And I don't think at this point of time, for example, even if they give the options of an FCNRB deposit mobilization, the end use of that funds with a 10% upwards, I think nobody is going to willing to borrow. So it's an avalanche of liquidity in the system.
Okay.
Apart from this, there could be issues like capital controls. There could be also controls on the repatriation of funds from the NRI deposits. There could be some simplification of the tax structure on the portfolio outflows. And there could be also some measures which tries to addresses the LRS.
I take your point, Soumya, but much of this falls in the remit of the government. Not all of them fall like taxes or capital controls. Dr. Sen, as Samiran also said, they first like to guide and then hike. What should the RBI's message be? Because this policy, more than any, is going to be a matter of optics. How should they sound?
Well, the point is that we are in a situation where the government or the RBI should make no effort at all into downplaying the seriousness of what we are facing. And the RBI needs to talk about it. I mean, it's not that people are insensitive, but the conditions that we are facing are really quite serious, because everybody's talked about the supply side shock, which is absolutely true, but there's a demand shock that's going on as well simultaneously. And so that puts us on a really serious tightrope walk at the moment. And this is something that the RBI has to make very clear, saying that things are in the process of development. We will watch and take appropriate action when the time is right. But a full description of the situation that we are facing upfront and clearly is what the RBI should be doing. And I agree with everybody else that this is a time to actually give them not necessarily a guidance, but at least give them the likely scenario that the RBI is visualizing.
Okay, fair point.
The guidance may come, but it's not absolutely necessary. But people need to know where RBI stands, how RBI is analyzing the situation, and what its stake is on the likely future.
Okay, fair point. No pussyfooting on the difficult issues, is what you're saying. Absolutely, point taken. Actually, I want more of your views on what is in the what are the options available for RBI, and more on whether of the dangers of falling behind. Considering the growth is resilient, why not now? I want to ponder those questions more, but we have to take the first vote. So, gentlemen and Sonal, be ready. First question: what will RBI do on June 5th? I've more or less guessed, but Sonal, you go first.
On hold.
On hold on repo rate. Okay. Samiran, what will they do to the repo rate?
Hold.
Soumya?
Hold.
Sajid?
Hold.
Okay. Chairman, your role is easy. Would you agree?
Hold.
Yes, you sounded that way. Okay, it's a universal hold or unanimous hold. Let's see if the next question throws up a difference. Sonal, how many rate hikes do you think in this year, FY27?
None, and can't say right now.
Okay, can't say. Samiran?
We have penciled in 50 basis points.
Okay, 2 hikes. Soumya?
Can't say at this point.
Okay, playing it safe. Sajid?
As of now, none. I think
None.
that's certainly, but as of now, none.
Okay, this is a divided house. Dr. Sen, what would you say?
It's difficult to say, but at least one will have to come sooner or later.
Okay. There, it's as divided as that. The Reserve Bank has a lot on its plate to decide. We have to take our break, but we're going to be back and analyze more the questions of how bad inflation can get and whether rupee needs some more steps. All that coming after the break. For Bazaar viewers, the entire show after market hours.
Asian Paints trades more than 2% higher on positive management commentary on volume growth. Brokerage firms Jefferies, Nomura and Macquarie issue bullish calls on the stock.
And Wockhardt zooms in trade after the company gets its first US FDA nod for an antibiotic. The stock is up more than 10%.
Auto sales data for the month of May trickle in. Bajaj Auto reports sales that are largely in line with estimates. Hyundai sees sales below estimates, while M&M reports healthy numbers in both auto and tractor. Escort sees strong domestic growth.
On the earnings front, Interglobe Aviation reports a net loss led by forex loss of around 4,823 crores, but the management commentary remains optimistic. Meanwhile, Inox Wind sees a weaker quarter. Glenmark 2 reports quarter four numbers below estimates. Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and with me today is Ekta Batra. Hey, Ekta, morning. Market's a little under pressure. We are down, actually. We've come off from the highs of the day, but I think till around 11:30, 12 o'clock, we'll see some of those margin calls that continue to get triggered, and there'll be some positions that will be squared as well. So expecting more of the same, and then hopefully from 11:30, 12 onwards, we'll see some kind of stability in the markets. But broader markets under immense pressure as we speak.
Hi, Nigel. Yes, absolutely. You know, the broader markets are definitely under immense pressure. We have the advance decline ratio, which is in negative terrain. So we have around 1,700 stocks advancing to over 2,100 stocks declining on the Bombay Stock Exchange. So no respite really coming in for the broader markets. We do have the mid-cap index itself, which is down around 1%. So that's really the pressure point for today. Not to mention that the bank Nifty is under pressure as well. So down over 360 points currently for the Bank Nifty. Let's welcome Shivangi Sarda from Motilal Oswal Financial Services to get a tech check on the markets. Shivangi, hi, welcome to the show. Well, definitely a rough day for the broader markets, rough start. What's your strategy there? Any specific stocks that you would be looking at both for a long and short call?
Very good morning, Ekta and Nigel. Thank you for having me. Well, of course, we've even closed on a rough way in the previous week. But overall, we will be expecting some sort of weakness to continue here for the Nifty index because it has just started to, gain strength where it again failed to surpass and hold above 24K levels. So this continues to be a very strong resistance point for the Nifty index. But immediate basis, we can look at the resistances stuck at 23,800. And on the downside, we might expect levels like 23,400 odd levels on an immediate basis for the Nifty index. So some bit of pressure and some bounces will be sold on an immediate basis. Now, talking about the Nifty Bank, we've seen some excitement did creep up in the previous week as the short covering move was seen in some of the private names. But again, it failed to hold those levels, and it has been making lower bottom structure on the daily basis again from the last 3 to 4 sessions. So now some bit of weakness would continue over here as well, and we are looking at 53,150 as the next support level for the Bank Nifty index with a resistance at 54,350 zones.
Got it. Okay. All right. Hi, Shivangi. Good to see you. And as always, what about individual stocks?
Individual stocks, of course, IT has been the flavor of the day, and it is holding on to the little bit of strength that the index is showing. So Coforge is one pick, which is kind of given a Poland flag pattern formation breakout on the daily basis. It has come out of its consolidation of the last 8 trading sessions, and volumes have been fairly high from the last 2 sessions. Which is kind of indicating a good amount of strength over here, which would continue. So I'm recommending a buy on the Coforge stock with the next target of 1550 levels and a support of 1450 zones. And the second pick on my radar would be Coal India. This one has also kind of stayed, it's a little bit volatile, but of course, with the markets, we've seen strength building in from the lower levels. And the volumes and the OI has been significantly high from the last 3 sessions. The stock on a weekly basis is kind of trading in an upward sloping channel. So overall, looks quite positive, and I would recommend a buy here with the next target of around 495 with a support of 465 levels.
Okay, all right, Shivangi. Thanks very much for joining in and giving us all of those strategies. Well, for the Nifty, we're just about flat at this point in time. The Sensex has moved a little bit into the green, so let's see whether that manages to build on. But as of now, just about flat. But let's shift focus to our special segment there, where we will get you a few ideas for profit from Money Control Pro. Kanchi Shah of moneycontrol.com joins in now to talk about a stock that she's tracking closely. Kanchi, over to you.
So today's stock idea is Fractal Analytics, which is among the early Indian companies building a strong presence in the enterprise AI and analytics space. The company delivered a strong revenue growth of 17% in YOY in Q4, and the profit also more than doubled, which was supported by margin expansion and improving execution. The healthcare and the BFSI vertical continues to remain the key growth drivers, while the TMT vertical remained weak because of some client-specific issues. However, the management has said that this has normalized and FY27 should see a higher growth. What stands out for Fractal is that the company is transitioning from a traditional analytics service model towards a more AI-led platform-driven business. So currently 60% of revenue comes from the input-based engagement and around 40% from the output-based contracts. Management aims to gradually reverse this mix and increase the output-based revenue to nearly 60%, which will support better margins and scalability. Another key focus area is the license-led revenue, which contributes around like 3% of total revenue right now, but management believes this can increase to a solid of 20 to 30% over the medium term. Fractal is also investing aggressively in AI research and product development, with R&D spending expected to gradually rise to nearly 10% of revenue. So overall, as enterprise AI adoption scales up globally over the next few years, Fractal looks well placed to benefit from this trend. Thus, I recommend Fractal Analytics to be purchased from a long-term horizon.
Okay, thanks a lot for that, Kanchi. For the time being, we slip into a short break. On the other side, Bank of America's global analyst, we have Sachin Salgaonkar, who will be joining us from the sidelines of BofA India Conference. Stay with us. A small programming note as we wrap up. Uncertainty in the market is rising given the geopolitical and trade headwinds. We at CNBC TV 18 are featuring some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune into CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amit Shah as well as Mr. Vikram Sahu. You can also catch the macro and the market opinion from Morgan Stanley's Chetan Iyer, Rhythm Desai, and Jonathan Ghana. Citi's Managing Director Sue Lee and CEO Jane Fraser will also be part of the blockbuster panels lined up only on CNBC TV 18.
Welcome back. You're still tuned into Chartbusters on CNBC TV 18. Well, it's turning out to be a session where we are seeing that pressure come in for the broader markets, but there's a little bit of a recovery on an intraday basis that we've seen. So the mid-cap index is now down around 473 odd points. It's down 0.7%. When we started the show, there was almost a 1% cut that we saw on the mid-caps. But let's get talking about one specific sector. Sachin Sargaonkar, who's the senior analyst at APAC Telecom e-commerce at BofA Global Research, joins in now from the sidelines of their conference. Sachin, hi, welcome to the show. Well, let's start with your view on the entire digital consumption story and how it's playing out in India. You say that you have a barbell approach as of now. Explain to us what that means.
Hi, good morning, good day. So what we mean by that is, unlike other markets, what India has evolved differently is for every set of consumer, you have a particular business platform or a model servicing them. For example, at the high end of the India, you have quick commerce, which is servicing the needs of these people, where a consumer wants something in 10 minutes, they get. At the low end of the India, you have a completely different model called as value commerce model. Out here, you find the cheapest things out there. But clearly, the consumer has to wait for 4 to 5 days for the product to be delivered. And if you see, the high end of India is growing at 100% plus, which is what quick commerce is growing, and low end of India is growing at more like a 35 to 40%. What is in between is growing relatively slower. So that's what we mean by a barbell approach. So companies who give exposure in the listed space, either you could play it through the high end of India or the low end of India by a quick commerce or a value commerce model.
All right. Hi, Sachin. Been a while since we spoke. Nigel on this side. Let's talk about the quick commerce players then itself. I'm looking at the unlisted market. Zepto shares actually have come down drastically. We have our listed entities as well. They've pulled back a little bit from the top. How do you see this competitive intensity playing out right now? If you could help us out.
Hey, Nigel, we are missing you this time at the conference. Just to answer your question on competitive intensity into the market, look, it has been intense. And one way to think why competitive intensity is intense is all the unlisted companies who are adding more dark stores also are in a phase where they are sort of discounting. Because if you're a new app in a particular area, you need to tell a consumer I'm present out there. Our general view is within 6 to 9 months, competitive intensity should normalize because unlike in the past, none of these platforms have unlimited access to capital and they are not keen in terms of deploying cash in an unlimited manner. So at some level, competitive intensity should ease. And what we believe is a first mover advantage matters in quick commerce. So all the dominant platforms who are early to the game have higher exposure to affluent users and they ideally should do well in the medium term.
So you don't think that e-commerce has hit its inflection point as yet?
So from an e-commerce point of view, look, India penetration continues to remain low at 10 to 12%. The inflection point, as we saw in some of the other countries like in Indonesia and China, came where GDP per capita was around 3,500 levels. India is still around 2,800. And generally at that point, we do see an inflection point hitting where at that time the growth in e-commerce sector should meaningfully increase. You should see also margins improving because ad revenues will start increasing at that time.
Got it. All right, Sachin, so we got a little bit in terms of these new age plays. What about the telecom space? I recall we chatting, I think 3 years ago at your conference, maybe 2 years ago as well. Will there be 3 players that will survive? I think you were hinting at the same. One weaker player and the other 2 solid ones. What is your take now with regard to, do you believe that it will continue to remain a 3-player race? And also if you could help us out with ARPUs. Directionally, what kind of increase are you working with for FY27 and 28?
Yeah. So Nigel, you're right, not much has changed from a telco landscape point of view. We have 2 large dominant players with close to 40% market share. And we have a third operator who continues to sort of lose market share. The pace of decline of the market share of a smaller operator has sort of come down. But where things stand today, India is a sort of a what we call as a 2.5 player market versus largely a sort of a 3-player market. In terms of ARPUs, the theme for the last 2 to 3 years is they are directionally moving up. And there are 2 reasons why ARPUs move up. One is a natural migration from a prepaid to postpaid or a sort of a feature phone to smartphone. And second is what telcos do every 2.5 years, where they take a headline tariff hike. And whenever the headline tariff hike happens, ARPU moves up in a meaningful manner. Last headline tariff hike happened around July 2024. We are at that point where, 2.5 years might be around Jan or Feb of 2027. So ideally, that could be a time frame where one could look after that a headline tariff hike happening into the market. So the directional, way is ARPUs will continue to move up.
Okay, just wanted to circle back, Sachin, and talk a little bit about the digital e-commerce story. But separately, you've written a lot about AI. For example, how the penetration of ChatGPT is, how Indian companies have started using AI as well. Just give us a sense in terms of where we're probably going to see this journey go in terms of specific company innovation when it comes to AI, and how important is it going to be?
Yeah. So Ekta, from a generic point of view, AI has been used by companies for two areas. Number one, cost optimization. For example, you don't need too many call centers. You could rationalize your processes. And number two, on the revenue side, where you end up increasing personalization. And on the back of it, you actually see more sales increasing. Now, where India is at a very interesting point, as you know, in a population of 1.6 billion Indians, roughly around 100 million people could speak English fluently. There are next 100 million who could understand it, but there is a huge vernacular or a regional language population which is out there. This is where AI comes out there, where a next set of user who's coming and theoretically looking to shop is the one who's going to go towards a sort of a voice-based agentic AI model and start ordering. So directionally, you do see the 350 million TAM in a meaningful manner increasing in next few years. And in our view, AI will sort of, play a big role in that direction out there. And you're right, a lot of LLMs in India, in fact, for most of the big LLMs, you see India is the largest market in terms of users. That ideally makes India a platform where you do see a lot of agentic AIs picking up. These models will first grow up in India, and then directionally you do see a mass adoption of these models globally.
Well, Sachin, always a pleasure having you on the show. Maybe I'll try to hit you up at the conference, in either today or tomorrow. But wishing you, the team, all the very best. And thanks a lot for joining in. Have a good conference, mate.
Thank you, Nigel and Ekta. Cheers, bye.
Okay, all right. Time to slip into a short break. Come back. We'll continue to focus on markets as well as stock-specific action. Stay tuned. Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. The markets have recovered a little bit from the lows, but the stock that's firing all guns is, in fact, Wockhardt. Ekta, explain to us the news flow of the weekend.
Well, yes, good news coming in for Wockhardt, and you can see it reflect in terms of the stock performance. It's up 11% today. It saw a huge rally on Friday as well. Now, the news is that the US FDA has approved the company's drug Xenic, or WCK-5222. It's basically an antibiotic which they've had in their portfolio. They've been doing R&D for it since 2011. Finally, they have received approval both from India as well as from the US FDA. So in terms of the Indian regulator, they approved it on the 28th of May based on phase 3 data that they had, which showed that this particular antibiotic, Xenic or WCK-5222, had more efficacy than the current standard antibiotic that is used in certain conditions. So that's positive news, and hence they gave the approval. This particular antibiotic is used via an IV, and it's only used in hospital settings. So for example, if you have a multi-drug resistant infection, only then do you use this kind of an antibiotic as a last resort. That's how it's been used till now. The compassionate use, which has been used at over, in terms of over 80 people, has been very positive. So that's the positive news with regards to it. So the US FDA gave them fast track approval. They said that we're going to expedite in terms of approval. And now they are happy with all what Wockhardt has done in terms of the drug and given the US FDA nod for it. So now what happens is that how much will they actually make from this particular drug? Company has previously told us that Xenic could make around $1 to $2 billion in sales, with 40% majority coming in from the US. CDSCO approved Xenic in India last week, and the estimate is that they could make 150 crores in the first 2 years from this particular drug. And it is also currently under review from the EMA, which is the European Medicines Agency, which would be another approval to watch out for, which will probably now get expedited because the US FDA has given its approval. So that's the news coming in for Wockhardt. Big news because it's the first Indian company to go so far in terms of a novel drug.
Well, big news, big move. Thanks a lot, Ekta, for explaining that to us. But let's focus on another stock, that's Asian Paints. We've got mixed views coming in from brokerages. Vinny joins us to help us out with the bull versus the bear scenario. Vinny, take it away.
Hi, good morning. So first up, let me start with the bull scenarios that have come in, right? Macquarie, they're maintaining the outperform rating, target price of 3,000 rupees per share. Obviously, it was a good set of numbers that came in from the company, right? Decorative business volume, 12.4% versus Berger Paints that had seen 11.8%. So better than what the street was expecting, better than its peers in terms of the volume performance there. But when you talk about what the management has said in terms of commentary as well, they've said an 8 to 10% volume growth in FY27 is what they're expecting. Plus festive season, they've spoken about the positive signs there as well. So that is why Macquarie is maintaining their positive stance on Asian Paints. Asian Paints has taken a price hike as well. Obviously not enough to match the inflation in terms of the cost that one has seen in, but still a positive sign there. So that is why a positive in terms of margin growth for the company going forward as well. Jefferies too is maintaining the buy rating. Target price is 3,300 rupees per share. Domestic volume growth, they said, is at a 12-quarter high as well of more than 12%. So positive there. And overall positive commentary continues to even for Jefferies to maintain their positive stance. Nomura maintaining their buy rating, target price of 3,600 rupees per share, and their forecast for EPS CAGR, they believe that will be in the range of around 13% for the next couple of years. They believe the competition in terms of the peak competition that one has seen, that has started coming off now, and that will taper off going forward. Now on the bear side, you have CLSA that's maintaining the underperform rating, target price is 1,186 rupees per share. Similarly, Citi is also maintaining their sell rating, target price is 2,500 rupees per share, as well as Morgan Stanley is maintaining the underweight rating, target price is 2,253 rupees per share. They said that while Q4 they've seen double-digit revenue growth across all the 3 months, they believe that there could be some concerns that come in going forward in terms of the growth as well as cost inflation. That's still a concern there.
Okay, all right, Vinny. Thanks very much for that. And on that note, it's a wrap on Chartbusters. Stay tuned. Trading Hour up next.
Good morning. This is time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormus Vatakia. Joining me from the studios in Bangalore is Ritu Singh. Well, the markets are looking to find some stability after the initial collapse that we saw from the opening highs. And that's after the first hour settlements that were made. The index, after briefly sleeping into the red, has now started to find some footing, 50 points higher on the Nifty, managing to hold on to levels of 23,500, which we were mentioning as well at the start of today's session. So that remains the key monitorable, of course, on the downside for the index. Of course, we are heading into a very important week. It's the RBI policy decision that comes out on Friday. The markets will be waiting for that. But so far, the market's looking to recover from the lows of the day, Ritu, and a lot of auto sales data and the last few earnings reactions also taking center stage.
Well, the last of the earnings, yes, Hormas, they're trickling in, but, 23,500, that's the key, support zone that we look at the bottom, and that's a level that the markets have not gone below since the 13th of May. So do we hold that up in this new month of June? We'll have to see how that goes. But yeah, lots of, names in focus today, whether that is the rate sensitives, real estate, auto, also on the back of what's happening with the RBI policy, the auto sales numbers, so that as well, and textile stocks, so lots of individual movers and shakers that we will keep our eye out on. But apart from that, let's go across to Hormaz now, who's on the wall, to give us a list of the key stocks to keep in mind. Hormaz.
Well, indeed, and that's been the first couple of hours of today's trading session. It's the start of a new month as well. So the month of June, of course, for the markets, historically, it's been a mixed trend, no significant trend as such. But the mid-cap index, after the initial 400-450 point fall, has now started to see some bit of recovery from the initial lows. So still a 0.25% lower, underperforming the benchmarks, but a recovery that is coming in nonetheless from lower levels. The question is whether that recovery sustains as we go along into the trading day. The one sector that is lending support to the market, though, is IT. And even when the index was collapsing from the highs, the IT stocks stood firm, and they continue to stay firm as well. Look at Infosys now, 4.5% higher on the stock. Persistent Systems is up 5%. Coforge is up 4.5%. LTM is up 3.5%. All constituents of the IT index are trading with gains in today's session, and healthy ones at that, mind you. The sector that's sulking today is the Nifty Bank. The PSU banks in particular, they too are recovering from the lows of the day, and all of them seeing losses of anywhere between 1% to 2% in today's session. The last bits of earnings that were reported on Friday and over the weekend, Indigo is seeing a positive reaction despite the net loss that it reported during the quarter. Most brokerages continue to remain positive on the stock as well. Inox Wind, down around 7%, is down in 7 out of the last 8 trading sessions as well. As we speak, it's the 4th straight day of losses for this stock. JM Financial as well, a negative earnings reaction, 6.25% lower. And NMDC, a sharp recovery from the initial lows, still 1.5% higher on the stock. The stock that I actually wanted to talk about is NMDC Steel. That stock is down around 4 to 5%. The newsmakers in today's session, PTC Industries at Goldman Sachs projecting a 60% upside for the stock, expecting a sharp earnings ramp up from FY29, 15% higher on PTC. Wockhardt continues to grow from strength to strength, continuing from where it left off on Friday. Natco Pharma was down 15% on Friday after its results, is down another 7% in today's session as well. So well over 20% knocked off in 2 sessions. And Z Entertainment continuing to move towards the 100 mark now, 6.5% higher in today's session as well. And some other losers from the broader markets today, with the advanced decline being in favor of the losers so far. Phenolics Cables is down around 5.5%. RHI Magnesita among the top losers on the Nifty 500 today, 12% lower on the stock. Jupiter Wagons is also an earnings reaction, down 4.5%, and Linde India too, not having a very good day at the office, but the broader markets are still trying to stage a recovery from the opening lows, Ritu.
Yes, and we hope to see more of that. Hormaz, thanks very much for running us through that list. Let's focus on some auto names, because auto sales data for the month of May has started to trickle in. Sudarshan joins in with the data that's come in from Bajaj Auto, Hyundai, M&M. How's it looking so far, Sudarshan?
So far, most of the companies that have reported sales so far are looking largely in line with what our expectations were. So we'll start with Bajaj Auto. Numbers have looked largely in line. Export continues to be more than 2 lakh units that company has been guiding for. On domestic front too, company had expected things to moderate from Q4 level. That has happened. The growth has come in around 10%. Exports have increased by 34%. Two-wheeler domestic sales were up 9% and three-wheeler domestic sales remain healthy. It was up almost 12%. So for Bajaj Auto, largely in line. For Hyundai, sales both on domestic front and on the export front were below expectations. Total sales have come in at 61,137 units. Our expectations were around 64,500 units, and total sales have increased by 4%, and domestic sales were up almost 9%. If you combine April and May, total sales have increased by 13%. Coming to Mahindra & Mahindra, both auto and tractor segment have reported numbers that were much better than expectations. But for Mahindra & Mahindra, which is a major player in the tractor segment, more than the numbers for the month of May, what would be in the focus is the outlook, considering the IMD's monsoon forecast of below normal. So we'll have to see what exactly management talk about the guidance. But talking about the sales, auto sales have increased 20%. SUV continues to see a healthy growth. Even for the month of May, it was up 11%. For tractor segment, it has reported a healthy growth of 23%, and growth was driven by timely completion of Rabi harvesting and favorable terms of trade for farmers. Last one, Escorts Kubota, like Mahindra & Mahindra tractor segment, this company too has reported a healthy growth. Total sales have increased by almost 23%, but company has said that emerging El Nino conditions may influence rainfall distribution going forward. So we'll have to see the outlook, what both the companies give. But as of now, the sales we have received so far are largely in line.
Largely in line with expectations, but of course, as Sudarshan was highlighting, the management commentary on the road ahead and of course sales data for this month is going to be key. Of course, the auto index too recovering from the lows of the day, back into the green as we speak. Now, some earnings reactions. As we spoke to you earlier about Indigo, reported a net loss in the fourth quarter, and that was largely on the back of forex losses. Devyani is now joining in with more details on the company's fourth quarter performance. Devyani.
Well, despite a weak set of quarter four earnings, majority brokerages still have a buy call on the stock of Indigo, with only Investec being the one with a sell call after the results that were posted for quarter four, as the weakness was on expected lines, and there is positive commentary coming in from the management for quarter one of FY27. Now, what is this commentary? The capacity growth guidance of 3 to 4% year on year, and the management also expects mid-teen improvement in the revenue per seat kilometer in quarter one of FY27 versus the previous year quarter one, and as a result of the price inelasticity that has been seen so far. Now, as for the quarter four earnings, the company saw a net loss due to the forex losses of 4,823 crores, with rupee sliding 5% in quarter four alone. Now, revenue came in at 22,480 crores, up 1%, with fuel expenses largely maintained, with ATF prices seeing a hike from FY27 onwards. Now, operating expenses ex forex were up 35%, which led to an EBITDA ex forex drop of 6%, with margins holding up at roughly around the 29% mark this time around. PAT ex forex and ex exceptional items though came in at 1,920 crores versus 2,980 crores, down 36% year on year. And as a result, a net loss of 2,536 crores was clocked this time around, majorly impacted by a forex loss and a one-time additional impact of changes in labor code of 250 crores in quarter four. Now, nonetheless, a top Nifty gainer this time around with a positive outlook that's driving the stock.
Devyani, thanks very much for bringing us that update. We have to slip into a short break, but up next, we're going to focus on the bond markets with Manisha Gupta. Welcome back. Markets at 23,600, so above that 23,500 mark. The Bank Nifty has also made a bit of a recovery, but still in the red. 54,145 is where the Bank Nifty is at. But the broader market still seeing some pressure in the red. But let's, as promised, shift focus to the bond market action. And Manisha Gupta joins in with the latest there. Manisha.
Thank you for that. Well, it's trading steady into the markets right now. The equities are doing slightly well, not just in India, but the regional markets seem to be trading steady as well. On the first day of the month, you have seen rupee stabilizing a bit. But all of these markets clearly will watch out for the RBI policy rate decision, and that is what is keeping the markets on the sidelines right now. The yield, in the meanwhile, for 2035 note is expected between 6.97 to 7.02% for this week, is what various traders and treasury guys tell us. And then you have most economists also expecting that the RBI would keep the repo rate unchanged on 5th of June. That is when the policy meeting is. The RBI, in the meanwhile, while of course is expected to update the inflation and growth forecast for FY27. Remember, the crude oil prices, West Asia conflict, all of that is still ongoing, and we perhaps would see or hear more in that regard. But this also is a week where you have a lot of private bond issuances as well coming in, and we have a list of that ready for you if you want to invest. The first one on my list is Real and Time Heights. They're planning to raise 950 million rupees. They're doing it via issuances of zero coupon bonds, which are maturing in Jan 2030. Frequency, FinCorp is also looking to raise 100 million by Jan 2026 maturity bonds therein. But you also have SIDBI, which is looking at 30 billion rupees is what they are looking to raise. And they are doing it via issuances of 3-4 floating rate bonds. Union Bank of India also is in the market today. That bidding is going to happen tomorrow. They are looking to raise 30 billion as well, and they are issuing 3-year floating rate bonds for this. You also have Housing and Urban Development, HUDCO that is. They are looking to raise 700 million, and they are also doing this via yen denominated bonds. This is for April to June quarter therein. And then you have IDBI Bank. They're looking at long-term fundraising, and they're doing it via bonds up to 100 billion for all of FY27. There also is a board approval that has come in for IRDA, which are looking to raise 400 billion for FY27. So both of these long-term bond raising for whether it is SBI or IRDA, it is board approvals that already have come in. The details, of course, would come in days to come.
Manisha, thank you for those updates there from the bond markets. Time for a short break here on Trading Hour. But on the other side, HDFC Bank faces governance scrutiny following reports of an internal vigilance probe. We discuss the implications of that with Abhijit Divanji when we return.
back, let's shift focus to HDFC Bank with that recent Indian Express investigation that has again put the spotlight on the bank's practices, citing findings, from an internal vigilance probe into payments of roughly 45 crores that were made to Maharashtra State Road Development Corporation or MSRDC. Now, according to this Indian Express report, these payments were allegedly routed through the bank's marketing budget and presented as sponsorship or campaign expenses, while the vigilance probe is said to have concluded that they effectively compensated MSRDC for an interest differential on deposits. Now, CNBC TV18 had also subsequently reported that this was an industry-wide practice, but the differential is typically much smaller than the 2.5% in the case of HDFC Bank. To help us unpack the issue, the regulatory implication and the wider impact on the system, we're joined by Abizar Diwanji, who is the founder of Neostrat Advisors. Abizar, thanks very much for being with us here. To begin with, tell us what you make of the issue and what the RBI regulations clearly state when it comes to differential pricing. Is it a violation of norms, or is there some way of going about this?
So let me tell you first about the RBI law or RBI rules. And RBI rules are very principled. One has to agree with it. What RBI's principles basically said earlier, interest rates in India were very regulated. This is what you could give in an FD. This is what you put on a savings account. This is and current account is no interest. However, over time, the RBI allowed flexible pricing. And on flexible pricing, all they said is that for particular classes of deposits, you can define pricing. And the only issue is that whatever pricing you offer to one, you also have to offer to the other. It's as simple as that. Now, operationalizing some of these things, and I do believe that this is more of an operational issue. Simply because operationalizing some of these things is very difficult. A corporate may, based on its own treasury estimates, say, I'm going to deposit X. And if it ends up, say, depositing only Y, then suddenly the slab reduces. Then what do? One option is to tell the corporate, fine, I'm going to pay you a lower interest rate. The other option is to tell the corporate, and by the way, it can go the other way around too. It can go to higher interest rates too. The other thing to tell the corporate is, I will still honor the commitment because I know it's a treasury issue. Over time, deposits come, deposits don't come. But let's honor the commitment that is given. Now, in honoring those commitments, as you rightly put out, the general practice a lot of people follow is that they pay you, compensate you in some form or the other. Now, this is not ratified or an approved policy. Now, what happens in such cases in banks especially is that an internal audit, not necessarily vigilance, internal audit investigates and comes out with these differences. These differences are placed before an audit committee, and the audit committee then takes appropriate action. So appropriate action would be to say, we shall do nothing like this. So when you negotiate with your people, please negotiate that it is a quantum-based interest rate. If you deposit lower quantums, we'll pay you lower quantums. However, industry practice, especially the fight for deposits, is so large that some of these things may have practical nuances. So the practical nuances are actively considered by the audit department, by the audit committee. And then the audit committee would either ratify it or stop the practice if it is across or whatever else. So there is some ratification done. Now, the important thing to note and where RBI, I think, draws comfort from is the fact that, yes, there is a rule and there is a discipline to be followed. RBI also understands the practicality of things. All RBI needs, and I think any governance organization needs, is to make sure that these issues are escalated and cleared by the appropriate authorities. Either way, cleared as in not necessarily approved, could be stopped, could be continued, practical difficulties could be understood, management comments could be taken on board, but transparency in approach is key. Anything clandestine is not necessarily accepted.
Okay, you're calling this an operational issue. Just do hold on, Abizar. We also have Ashwin Parekh, managing partner of Ashwin Parekh Advisory Services, who's joining us now. Mr. Parekh, very briefly, if you're aware of what's happening with HDFC Bank, one, is this in any way a violation of RBI norms that clearly say you cannot offer differential prices to one depositor versus another? And two, is it a common industry practice for banks to offer slightly higher interest rates to some depositors versus others?
Well, you see, I'll tell you what. I mean, one thing is pretty certain, as Abizar rightly said.
then the interest rates flagged out by at the time of monetary policy and thereafter are only benchmark rates. Then thereafter, we know, for instance, Ritu, that when it comes to lending, for example, the banking companies do apply an element of risk premium, for instance, depending on the rating of the borrower institution. They will normally price it accordingly. Something similar would apply to a certain extent for the deposits as well. If the deposit size is very large, we've seen time and again that from the ALM perspective, for example, interest rate structure of each and every bank may vary, for different durations. So you may come across one bank which may be needing more, let's say, deposits during a 6 to 12 month tenure. The other bank may be requiring something else. So they work out some amount of flexibility within the interest rates on their deposits, let's say, whether it's for individuals or for institutions. They do it on a very regular basis. So to a certain extent, I suppose, if there was proper governance observed. For example, if there is a strategic decision, the amount of deposit in this particular case is just too large. It would certainly invite a certain order of differential, a certain order of additional incentive for that amount itself. And if it is a strategic decision, brought to the audit committee, as it was pointed out earlier. And if the audit committee did find that there was a good reason for, a business call rather than sort of, not complying with any regulation, then in that case, I don't see anything wrong with it. What needs to be now examined is, and I get an impression from the first denial that, let's say, the bank has made, that the matter it was actually come out from the audit committee, proceedings itself from the minutes. The audit committee did get an opportunity of examining this, and they, in fact, investigated. Then there is one more thing that the bank has very clearly said, that no individual has personally gained out of this. It was a strategic or a business call that the bank made. No individual has actually benefited from out of this particular
Mr. Parekh, the question is not about any individual gaining. The question is whether the bank went out of its way to pay a much higher interest rate than it typically would have to get these deposits. So, the simple question, when you say if the audit committee brings it up and it is cleared, would it not be called a violation of RBI rules? And two, when you say it is common in the industry, typically, I know I'm asking for a simplification and a generalization, but typically if a bank does end up offering higher interest rates, is it as high as 2.5%?
Not really. It is on a case-to-case basis. Very clearly, it's a business call. It's a business call that the bank has made. And a certain amount of leeway could be given or is given to the banks. All the banks do it. It's not that if you look at the rate at which, let's say, different deposits, institutional deposits are gathered, you will not find that there is any element of uniformity. If an ONGC, for example, places a certain order of deposit, for example, it would expect, or a large corporate the treasury, puts a deposit, it would expect a certain higher rate compared to the normal rates and all. So, I still believe that this is a business call.
Abhisar, HDFC Bank until very recently was the benchmark or the epitome, or the phrase associated with it was the best in class, or for the lack of a better one, sharafat ki kasmein khate the log is the kind of thing that used to be associated with it. But then with one issue after another, how much does this erode an investor confidence in an institution as big as HDFC Bank, and more so because of the fact that it is such a heavily foreign institution owned stock?
So I'll tell you, Amos, I have spoken with a few foreign investors, right? And I don't think people are as much worried about the operational issue than about the strife in the management that could derail the longer-term efficacy of that operation. Now, frankly, I have answered that in many ways. One is that I think there was a strife with the chairman, and I think to some extent that has been resolved. And it's appalling that issue after issue is coming out in some form in the press, not formally, but through informal means, actually reflects more on individuals rather than the organizations. That's point number one. Point number two is that the organization itself has always come together as a single governance board and responded to issues. I think that is something that investors appreciate much more. The transparency is appreciated, as against the fact that issues are coming out. And, because, as Ashwin also said, issues are operational in nature, and banks do have operational issues. I sit in an audit committee and of a bank, and we have enough and more operational issues outstanding to be resolved, processes to be changed, policies to be changed going forward based on experiences. But the intent is always good because the governance system brings it out rather than an emergency, as we have seen in some other banks.
Abizar, since we've run out of time, just one clarification. If you say it is a common industry practice for banks to offer slightly higher interest rates, in the interest of garnering these deposits, is it okay as per RBI rules to categorize these higher interest payouts as a marketing spend? Or is it not interest expended, then that is not rightly accounted for?
I agree with you on that. I think that point of policy has to change, because not accounting for, so then RBI needs to give that level of flexibility to say that, yes, if there was a committed deposit, just taking a situation, if there was a committed deposit rate and I'm against that, I have committed an interest rate. If that deposit falls short of something, if the interest rates have to be lower, then there is a leeway exception that can be taken to the audit committee and ratified. If that is the case, and if the regulator kind of allows that, I don't think these practices will happen. Nobody needs to do this. And nobody really benefits out of these practices. That's point number one. By the way, in other sectors like insurance, wasn't this rampant? Is it not rampant in the AMC industry? Now, what happens is the market reality versus the cap needs flexibility in the market in today's dynamic. And if any regulator understands that well, I don't think people will need to do something. They should not be doing, for sure.
Well, something that is out of the rule book being followed by the industry doesn't make it right for everyone to follow. But irrespective, both of you, Ashwin Parekh, Abizar Divanji, thanks as always for taking out the time to help us go through this issue. And we'll keep coming back to examine this as and when more details emerge. But let's take a short break on that note. Up next, we'll have Bank of America Securities' Arvind Maheshwari, who will be with us to discuss the current market environment and the outlook ahead. So stay tuned for that.
Just at the start of the show, we were mentioning the fact that the index is looking to find some ground, but that very brief recovery is also being sold into right now. The index is flat as flat can be. But let's go back to the BofA conference where Nimesh Shah is with Arvind Maheshwari, the head of equities at BofA Securities. Over to you, Nimesh.
Thanks, Harmaz. Yes, as you rightly said, Arvind is joining me from the BofA conference. Arvind, let me ask you the billion-dollar question, which everybody would be asking you as well. When will FIs return to India?
Morning, Nimesh. Thank you. And yes, I know that's partly why we are here hosting our conference. This is the annual flagship conference. I'm pleasantly surprised actually by the level of attendance. We thought that Indian markets have been seeing this deluge of foreign outflows over the last 15, 18 months now. And it has we've not seen this kind of concentrated selling for a long time. And the question is, what is causing this? And then more importantly, when do foreigners come back into the country? So I think partly why the level of attendance that we are seeing we have 400 plus investors, which is much higher than where we were last year on this mark, is they are trying to understand what is changing and finding out what are nuances that that the Indian story is offering, that they are missing out on, and valuations, which has been the big reason why people have been shying away from investing in India, that sort of has tempered down. And so people are out here looking for ideas as to what could be the next phase of growth that they can invest in. So it is a tactical retracement from foreigners, and we can see that, and with good reason. There are genuine problems that India is facing here and now. So the near-term pain obviously exists, but it seems more cyclical driven rather than a structural reassessment. So it will be a matter of time. Hard to say exactly when, but as the West Asia crisis it's already in the de-escalation phase, and hopefully as it retraces and goes away, we will start to see interest come back into as people start looking at what next.
Arvind, we look at the long-term picture, but from the very short-term point of view, just for the viewers' experience and for their understanding, what we saw on Friday was a massive $3 billion sell figure. The gross number was also very high. The net number was also very high. Of course, there was an MSCI angle to it, but if you can just briefly explain what led to this big $3 billion selling on a single day in India.
Sure. So look, on that day in particular, obviously the MSCI rebalance was the big impact.
It was close to $1 billion.
We were estimating about $2 billion coming out of that MSCI rebalance itself. And on top of that, I think people used the increased liquidity to sell a little bit more into that event. So that was that day. But to your point, I think it's also partly the fact that foreigners are using every opportunity they can to, and India has become a bit of a funding market. And where is all this money going and flowing into? Well, some of that is recirculating within Asia. So going into the AI thematic, which is at the front and center of all things equities at this point. So you are seeing a lot of that money going into Korea, Taiwan, but also the US itself is attracting a lot more money back to the home base. So you are, it's a very, very narrow rally. As you can see, only 2% of emerging markets is responsible for most of the returns, and just 4% when you look at the S&P. So it's an extremely narrow rally in some sense that is driving gains, and unfortunately India falls outside of that AI thematic which is currently driving all equity indices.
Right. Arvind, you said nearly 400 FIs have registered, and this is by far the large number that they're attending India at this point in time. You must have spoken to some large investors as well. Are you getting a sense now that they are really hoping for some sort of a relief from the government with regards to the taxation in India? I mean, that's something which has been talked about for the last 2 weeks now. But is that a hope getting built up with the institutional investors as well?
Yeah, sure. I think there is definitely an expectation of reform building. And in fact, there have been positive comments on how this government has actually navigated a very tricky situation that has, it's an external shock, and how the government has been nimble in taking steps. But there is definitely expectations of more reforms to come through. Taxation is one of them, and it's been an ask.
Do you think that can change the sentiment towards the global investors if there is a bit of a relief in terms of taxation?
For sure, it's definitely a big sentiment boost. I don't say that by itself will drive money back into the country, because ultimately it is about earnings, it is about fundamentals, and in the longer term, if we have to attract capital, we need to be able to deliver on those fronts. But we are fighting with one hand behind our back if you're a foreign investor, because most other markets that we compete with for capital have zero capital gains tax, and we don't. And that is something that we have to we have to cross the hurdle for foreign capital to come into the country becomes that much higher. So there is expectation that something will be done on that front.
The other big challenge for the global investors is the depreciation, the rupee getting depreciated. And that's the reason why in dollar terms, the returns have been quite negative or flat for most of the global investors. In your conversation with these global guys, what's their take on India? I mean, because, all said and done, markets are slave to earnings, and that's not coming up. At least in the large cap Nifty names, the earnings seems to be a bit disappointing. What's your call? What's your in-house call in terms of earnings? And what's the big takeaway from an FI perspective on what they're looking forward to in India?
Yeah, so if you look at how India has suffered in terms of market performance in the last 2 years, it clearly is driven by fundamental changes. All things aside, we had single-digit earnings growth. When we started the year in-house as well, we started with about 14-15% earnings growth estimates, and that now is down to about 8.5%. So there is obviously that dose of realism that is setting in, and which is why valuation multiples have also been compressing, especially on the Nifty stocks. Now, what changes and how India is able to deliver that earnings growth, I think it will be a matter of time. Like I said, most investors that we speak with have longer time horizons, and for them, this feels like more tactical in nature. They understand that this is cyclical, that there are obviously the geopolitical shock at some point will wear off. It is not going to be permanent, and there will be stories that will emerge as this pain subsides and people will start to look to come back into the country.
So, in your interactions with the global investors as well as local investors, do you think there is a bit of frustration that India has been a completely non-AI play? There is absolutely nothing from an AI perspective to play in India. Is that something which is missing for a lot of the global investors, that they're not able to look at India at this point in time?
See, some of this is also very sentiment driven because all the flow right now is going into the AI thematic. And I think when you look at some of the large cap plays in India, AI unfortunately is not a theme. Not to say that AI is not a story at all in India. I am sure there is a lot going on under the surface, and there are startups and ecosystem that is developing and gearing towards building out the AI story in India as well. But it's not something at this point where public market equity investors are able to invest in. And so we'll have to wait that one out, at least in the near term.
Arvind, the other big theme for the last couple of years has been the big stake sales, the promoter stake sale, the PE stake sales in India. India has become a very good exit market for the FIs. I don't think that's been the trend in the past, right? I mean, only in the last few years, we've seen so much of domestic money that the FIs, the promoters, the PEs are easily able to exit without any much impact. What can that change? I mean, do you think if there is a reversal of domestic flows, that will also mean that it will become even difficult for FIs to exit?
To be honest, that is two sides of that coin, right? I would look at that as a positive as well, because it is deepening of the liquidity pools in the market. You could not have this kind of selling getting absorbed. And one can argue if you did not have the domestic buy flow, maybe the foreign investors could not have exited. But we don't want a market which is shallow and where because you are unable to sell is the reason you are not selling in the market. I think it's much healthier for our markets to be deeper, broader in terms of participation, where foreigners can at least get liquidity, or whoever else. In tomorrow, it could be domestic investors selling and foreign investors buying stock. And I think it's a great positive story for India over the last 7-8 years that the markets have become so much deeper with this kind of selling getting absorbed. If you look at market performance relative to other markets, we look poor, but it's not done too badly given the kind of shocks that we have seen both on the fundamental side as well as on the flow side.
Sure. From a tactical point of view, India's MSCI weightage is at the lowest in the last 5 years. The FI holding in India is the lowest in probably 2 decades. Whatever can go wrong, maybe has gone wrong. Macros have been challenging. But tactically, you think this is the worst is priced in, and any positive news can really see a big upside? Because again, the challenge with the likes of MSCI is When things are good, they up the weightage. When things are bad, they cut the weightage. So it's kind of at the fag end, right? So from that perspective, you think large part of the bad news is priced in, and any positive news can really see a big FII inflows into India?
So there definitely seems to be a lot of pricing in that's happening, and I think a lot of the pain which is cyclical is being also starting to get priced in as permanent. Cycles by nature will reverse at some point, and we were at the receiving end of it just a couple of years back, but now we are paying the price for it. It's going to, at some point it will change. I think India has this. It can disappoint both the optimists and the pessimists, and I think that story is playing out again. I think you don't want to get too pessimistic about what's going on and here and now in terms of foreign outflow, because earnings will come. The economy is still growing. It's 6.5, 7. You can argue a little bit. GST collections are at record highs. The market, it's an economy which is resilient. These are all signs that all the pain, when the macro pain starts to fade, you will start to see foreign investors look for ideas, and which is why we also have this gathering here trying to look for new ideas.
I'm sure I know you're going to convince a lot of FIs to come into India back. I think you have to run back to the conference, so I won't take much of your time. Back to you guys. Arvind has to rush back to the conference.
Thank you, Nimesh.
Nimesh, thank you for that conversation there with Arvind Maheshwari. Of course, that billion-dollar question, when will FIIs return to invest in India? Take a short break, back with some trading ideas and a quick chart check with Saumil Mehta from Mirae Asset Share Khan. Stay tuned.
Welcome back. We have with us Saumil Mehta from Mirae Asset Share Khan, who's joining us now for a quick technical check of the market. Saumil, thanks very much for being here. As we start this new month with a bit of a volatile day, where do you see Nifty sustaining? It's below the 23,600 mark, 23,535 near-term levels you'll be watching out for. And, any top stock picks you'd like to call out for us?
Good morning to everyone. My view at the moment in the very, very short term is a little negative. Market has been in the range. The upper end is around 24,200, 300 levels, and the lower end is around 23,250, 23,100. I'm still expecting markets to be in this range, in this broad range. On the upside, there's one more resistance around 24,600 levels, which is 200 daily exponential moving average. So I'll be expecting markets to be a little range bound here in this broad range. However, we need to be a little cautious at this point of time because Nifty has started making low top, low bottom the weekly charts. Nifty is right now trading below 20 and 40 daily moving average and 200 daily exponential moving average, which is a sign of a little caution. I'll be expecting weaker stocks from here to go down. We can have a short position in the very short term, but in the medium term outlook, I'm still a little positive, where I'll be expecting markets to take support around 23,000, a little lower probably, and again shoot up. The opportunities on the long side are in the a few sectors like pharma. I like metals as well. So there are a few opportunities there. There is FMCG, which I'm thinking would take support around these levels and again start the move up. So there are opportunities on the long side, but at this point of time, a little negative. A short position can be created in a few weaker stocks. I have two stocks on my list. First one is PG Electroplast on the short side. It has formed a bearish flag pattern, and I'll be expecting that to break on the downside. My stop loss would be 488 and target is 435. The second stock is SBI Life. Even the stock has created a big triangular pattern below 200 daily exponential moving average. Already started the downtrend, making low top, low bottom on the daily charts. My target is around 1720 and my stop loss would be around 1860.
Saumil, thank you for spending time and joining us today with your views on the index and on the specific stocks as well. The one stock that's not taking a break whatsoever is Wockhardt. It's up 14% on Friday, is up another 12 in today's session as well. And that's after getting the US FDA approval for a very important drug. Ekta is here with more details on that. Ekta.
Thanks for that. Well, yes, Wockhardt has received US FDA nod for the first novel antibiotic from India, which is WCK 5222 or Zenic. Now, it is approved for urinary tract infections and targets multi-drug resistant superbug infections. So basically, these are infections which are not treated by other antibiotics successfully. It is an IV antibiotic and it is only mainly used in hospital settings, ICU settings, and it is used as a last resort antibiotic, which is when the basic standard antibiotics do not work on that particular condition. The market size of superbug infections is around $9 billion. Now, US FDA has granted fast track and QIDP status to Zenic earlier. Wockhardt had filed a new drug application with the US FDA in October of 2025. So this approval from the US FDA comes in less than a year of that application. Now, the Indian drug regulator, the CDSCO, had approved Zenic on May 28, 2026 as well, which is just last week. And hence, it has received 2 regulatory approvals just in the span of a couple of days. Europe has granted accelerated assessment for this particular antibiotic in December of 2025. Now that other regulators have given their nod, there's a higher likelihood that this would possibly see an approval soon enough. Annual sales is potentially estimated between $1 to $2 billion. Majority of the sales from a geography are expected from the US at anywhere around 40 to 45%. India sales can go up to around 150 crores in the first few years initially. That's what analysts are working with at this point in time. Remember that this particular drug has been a decade-long investment, over a decade-long investment for Wockhardt. They started in 2011 and finally it's come to fruition. But they do have other novel antibiotics in their portfolio as well. So for example, they have other drugs such as Mroc, Micnaf, Mroc-O, as well as Fovisco. Now, lastly, just want to point out that while this particular drug has received approval, what the commercials will be, how much the offtake will be, is something that the street will want to watch for. Also, any kind of partnerships going forward, any kind of distribution partnerships that Wockhardt would probably sign up for with any other pharma company in order to increase distribution globally.
All right, Ekta, thanks very much for running us through that. Another stock that's up and about almost 2.5% gain in trade is Acme Solar. Now, we understand that the company is mulling a fundraise. So let's go across to Vivek for the details on this one. He's picked up this. Vivek, what are your sources telling you? How soon and how large could the fundraise be?
Well, that's right. So what we are picking up from our sources is that renewable energy major Acme Solar is looking to garner funds via the QIP route. We understand that the company could look to raise up to 2,500 crore via the QIP route, and we understand that this particular QIP, has a threefold purpose. Number one, capex plans that the company has outlined. Number two, growth is something that the company has gone ahead and outlined, especially as far as FY30 plans are concerned. And number three, more importantly, remember the promoter shareholding in the company is in excess of 83%. So with this particular QIP, the promoter shareholding could come down and will be able to meet SEBI's minimum public shareholding norm. So that could be one of the key reasons why the company is going ahead and mulling a QIP or launching a QIP. From our sources, we understand that this particular QIP could be launched as soon as this particular week itself. Important to note that in August 2025, the company had taken an approval for the board or an enabling provision to go ahead and raise up to 3,000 crore rupees. We reached out to Acme Solar. They did not respond to our queries, but we also understand from our sources that demand has been quite robust for this particular fundraise.
Another QIP in the offing. Vivek, thank you for that update. Acme Solar 2.5% higher, just about managing to trade over its issue price, which was 289, currently at 317. Take a short break. Macro signals on the other side.
Welcome back. Let's get you the macro signal of the day, starting with the markets that are now at about 23,540 as we speak. Almost slipping into the red now. In fact, they briefly dipped into the red, down about 2 to 3 points. That's where the broader market, it also pulled up the broader markets that have seen some pressure. The mid-cap index is now down by almost 0.6%. And the Bank Nifty also down 0.3%. The rupee, that opened slightly higher compared to Friday's close of 95 against the dollar, but it has since appreciated a tad, now trading at about 94.92. That's where it is at. And of course, this follows a rise in oil prices. The other factor that's also weighing on the rupee today is a bit of the heavy foreign outflows that we've seen. FPIs, remember, have sold about 21,000 crores of equities on the 29th of May, the biggest single-day outflow 2026, but that coincided with the MSCI semi-annual index rebalancing. So all of those factors playing out for the currency markets. The oil prices, meanwhile, they've also surged by, almost 3% as we speak. Brent crude at 93.61, a barrel. Prices, of course, have gone up after, Israel ordered additional troop deployments in southern Lebanon that intensified the conflict with Hezbollah. And that military action has dampened hopes for a durable extension of this US-Iran ceasefire agreement. The 10-year benchmark yield, again, responding to that, trading higher today at about 7.02% on the back of these higher oil prices, concerns on energy-led inflation. Markets are also turning cautious ahead of the RBI MPC meet, which will be scheduled for later this week. On Friday is when it will be announced. And of course, lastly, bond markets also bracing for a fresh debt supply, including a planned auction of about 320 billion rupees. That's coming up for the benchmark 10-year bond yields. So all of that is keeping the macros on edge. And on that note, we'll take your leave on Trading Hour from Hormaz and me. It's a goodbye. But stay with us. Halftime Report will take all of the action forward.
Midcap sees some selling even as frontline stocks hold steady amid continued uncertainty around US-Iran trade deal. IT and healthcare gains while utilities, industrials and financials drag.
The stock of Indigo owner Interglobe Aviation perks up on an optimistic FY27 outlook, riding on better pricing. Lower than expected cost inflation in Q4 also aids the move despite the big forex impact.
Wockhardt leaps after the US FDA approves its novel antibiotic Xenic for urinary infections. Estimates suggest the new drug could notch sales of over $1 billion a year.
In a relief for tariffs struck a textile sector, the government has allowed duty-free import of cotton till October 30th. The step is expected to lower costs and improve export competitiveness. Textile stocks rally on the news.
Hello and welcome to a halftime report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Putra and Vinny Motiwala. Well, it is turning out to be a day which is quite choppy for the market. So the mid-cap index is really the sore point in today's trading session. We have the mid-cap index which is back at the low point of the day after recovering on an intraday basis. So down around 0.9%. Remember, at one point in time it had recovered to a cut of close to around 0.5% but not able to sustain that. The Bank Nifty down around 370 odd points. So we're seeing pressure points coming through there along with the Nifty as well, which hadn't been in consolidation mode for most of the trading session, but now showing a cut of around 56 points for the Nifty and over 150 points gone for the Sensex at this point. Advanced decline ratio has seen a little bit of an improvement, but still weak. So 1,900 stocks advancing to over 2,300 stocks declining on the Bombay Stock Exchange. Hi, girls.
Hey, girls. Good afternoon. And as we speak, of course, as Ekta pointed out, the advanced decline ratio has turned for the worse. We do have the Nifty at the day's low with a lot of these big names which are putting that pressure. ICICI Bank, we have Bharti Airtel, Axis Bank, SBI. So Bank Nifty continues to be the pressure point for the markets. That has been the case. But IT on the flip side, we spoke about it on Friday, how IT stocks were perking up. Today as well, IT is the top Nifty gainer. So watch out for that one. Other than that, most elements of the market are in the red, but the uncertainty continues, and we are in June already, girls.
Goodly, uncertainty continues 5 months down already for the year as well. But when you look at it, like you said, right, IT that continues to shine in trade as well. Today, you just saw right now Persistent System that was also buzzing away in trade. You had some flashes at the bottom of the screen for you all as well. Apart from that, today, you have media that is holding on to some bit of a gain. But other than that, there's red across the screen. Individual names that are doing well in the trading session, so watch out for that, right? NMDC Steel, Walkhard, Aditya Infotech that continues to see an up move after its numbers as well. But what do we have on the show for y'all? We have a big conversation lined up with the management of M&M on their May auto sales numbers. Also, we'll have the management of Asian Paints who will speak to us about the outlook of the company going forward after their Q5 FY26. We'll also get a conversation with the management of Max Estates on their Q4 results and the road ahead, and we'll focus on buzzing stocks and big movers in the trade as well. So stay tuned in for that. In our Commodities Corner segment, we have Siddhartha Rajagopal of Cotton Textile Exports Promotion Council, who will join us as the government has waived import duty on cotton. So that discussion too is lined up. But first up, Vivek is here to take us through which are the stocks that are moving around in the trading session. Afternoon, Vivek, a volatile day in terms of the markets, but which are these individual names?
Well, that's right. Thank you so much for that. Friday, you did see the sharp sell-off. Today, again, it's been quite volatile, but quite a few stock sectors in focus today. First, of course, has to be the entire IT pack. Clear standout performer in today's trading session, and the mid-cap IT names doing much better compared to the large cap. You did speak about Persistent, and along with that, look at names like Infosys, Birlasoft, Coforge, all of them up anywhere between 3 to 6%. Walkhard is the other name on the radar. Very strong approval coming in for Zenik from US FDA. That particular stock has cooled off a little bit, but still up 10% on very good volumes today. NMDC Steel, the demerged entity of NMDC, that particular stock, extremely strong numbers on a year-on-year as well as on a sequential basis. That particular stock doing quite well. NMDC Steel is the stock that we're referring to. Rubicon Research, another name, from the broad end of the market, so a very strong Q4. Along with that, FY27 margin guidance is something that the company has given, which is quite strong. That particular stock higher by 12.5% with good volumes today. And Asian Paints, again, this particular stock standard performer in terms of the Nifty index itself. EBITDA margin guidance for FY27 retain in the range of 18 to 20%. That is something that the street does like. On the other hand, quite a few laggards as well. Wind OEMs, both Inox as well as Suzlon, weak results, weak Q4. FY27 outlook is quite clouded at this point of time. Both these names under significant stress. JM Financial, after a muted Q4, that particular stock has fallen quite significantly. Natco Pharma has seen selling pressure continuously post a very muted Q4. Capital goods stocks, which have been significant outperformers so far, have seen a bit of profit booking emerge today. Names like Cummins, Siemens, BHEL, GE Vernova, as well as Triveni Turbines amongst the top laggards as far as the broader end of the markets are concerned. And RHI Magnesita, a very weak Q4 coming in for this particular name, and that particular stock down in double digits now.
All right, Vivek, thanks very much for bringing us all of the buzzing stocks in today's trading session. But let's get talking about one particular company, Nalinkant Golagunta, who's the Chief Executive Officer, Automotive Division, M&M, joins in to discuss the May sales gone by. Hi, Mr. Golagunta, thank you very much for taking the time out. I just wanted to start by talking about the SUV momentum that you saw in the month of May. Sales were up around 11% as compared to April to May, which was up around 9%. So there was a little bit of increased momentum, which seems to have come through. Just take us through what exactly the granular data was for SUVs and what are you expecting in terms of the rest of the year?
Yeah, thank you for having me. So firstly, strong month again across the board. You talked about domestic SUVs, even light commercial vehicles. If you look at it, they did 24,000 vehicles at about 19% growth as well. And we've had significant growth in exports. So overall, I think it's been a robust month for us across the portfolio. Quite a bit of this demand has sustained since the GST reforms, which happened as well. So that's continuing to happen. Of course, we had two major launches a couple of quarters ago, and that has added momentum for us. We had the 7XO, which is the largest SUV on the ICE side, and we had the 9S, which is a seven-seater SUV on the EV side. That's added quite a bit of momentum for us. So portfolio is quite strong. Momentum across the portfolio at this point in time, and we're hoping this will drive us to get to the mid to high teens growth projections we've done for SUVs for the year.
Okay, mid to high teens for SUVs for the year. In your commentary, but you also indicate, Mr. Golagunta, that there is some constraint because of supply chain challenges due to manpower shortages at select suppliers. Tell us more about that. Is this something which could be a risk? Is it making you a little more cautious? And the overall 20% growth that you've seen in total vehicle sales, is that something that could be impacted going forward and in SUVs as well?
Yeah, at this point in time, we see this as a short-term pain. Primarily, this was triggered by the West Asia crisis in about March timeframe, and there's quite a bit of labor who have gone back to their home states. And of course, elections happened, so folks stayed back for the elections as well. And we're starting to see some of those labor coming back, but at a tier 2 level within the ecosystem. This is not just what Mahindra is experiencing, this is across the industry to that extent. We are seeing that labor shortage kind of extending a little bit into May. We expect some of this to improve in June, but it's a short-term phenomenon. We believe by end of June, a large part of it should get addressed. Some of it happened in specific areas like forging, for example, which is a labor-intensive area. So we are seeing some of that happen, but our expectation is this should get eased out by about the end of this month.
Okay, by the end of this month, you're expecting these challenges to ease out. So, what I also want to know, while you said that you're maintaining that high teen growth, right, for FY27, when I'm looking at it in terms of numbers, seems like that growth that one has seen for SUV, the growth rate has seen a reduction. Is there any concern around that in terms of demand trends, or what was that specific reason for the growth rate seeing a reduction?
Yeah, so it's a great question. Firstly, like I said, the demand is quite strong. If we didn't have the supply constraint that I'm talking about, we could have easily had another 10 points of year-on-year growth happen on SUVs as well, and even on LCVs. So demand is not necessarily a constraint for us. It's a question of supply at this point in time. So that's a bit of the challenge that we'll have to solve for, which is more on the supply side. The indications on demand is quite strong. And if you look at EV specifically, very strong demand for the products. Of course, post the West Asia crisis as well, there's increased interest that we are seeing in our portfolio as well. So I'm not necessarily worried as much on the demand side, as much more on the supply side we have to solve for.
So based on what you are seeing in terms of, say, the supply side challenges, what is the waiting period like in the SUV portfolio, especially for your two new launches, which you alluded to? And what are the pricing changes at this point in time?
Yeah, so let me start with the pricing. We announced price hikes in early April. As you know, 1.8% we had announced at that point in time. And that is holding us good for now. But of course, with the input costs going up in several areas, this is something we watch very closely. And there's a possibility that we'll have to go in for another hike in the next 4 to 6 weeks or so. But again, we'll have to see how the numbers play out across all of the different commodities as well as memory costs and all of those pieces. So we're watching that closely as well. Yeah.
Yes, I was. Please continue.
Yeah, so that's the primary. Sorry, what was the first question? I missed that.
In terms of the waiting period, considering that
the
you are
waiting
seeing...
periods, The waiting periods depends on the variants that we have, but it is anywhere between 6 to 8 weeks. We see at this point in time for most of our high volume variants.
What about EVs? Because you did indicate you have seen a pickup in EV demand. There is a push coming in from the government as well. What was the growth that you saw in the month gone by? And have you seen more, I would say, people coming and inquiring about it? Has the inquiry increased there? And just in terms of pricing, are you planning to take any price hikes, particularly in the EV portfolio, considering that you spoke about supply chain constraints and raw material prices have increased as well?
Yeah, so far we haven't taken any price increases on EVs, and we're watching it closely. So too early to predict at this point in time, but if the current trends are something to see, then probably if the battery costs go up or if any of those other input costs go in, then we'll probably have to take a price increase as well at that point in time. On the EV front, just to walk you through, last year on average, we were doing about 4,000 vehicles. For the first 2 months of this year, we are averaging more than 6,000. So 6,200, 6,300. So that gives you the kind of momentum that we are seeing in the portfolio between the two of them. And the demand is, like I said, consistently across the products. Niners, of course, gave us the momentum as well. We increased the capacity to 8,000 on BEVs. So I'm hoping that in the next couple of months, we should start to hit that 7,000 number. And with that, our penetration in the portfolio of EVs is about 10%. It's sustained itself over the last 2 months. And we are hoping that will continue into the rest of the year as well.
Okay, you're hoping that to continue in the rest of the year for EVs. Commercial vehicles, a quick word on that segment as well. How is the demand trend there overall? The growth that you saw during this quarter, that is going to continue 16+%.
Yeah, so light commercial vehicles are doing extremely well. I think 24,000 vehicles we sold on that side, greater than 2 tons. 19% growth is what we have seen in that specific segment, and robust growth again. Like I said, this growth cycle, replacement growth cycle, got triggered during GST reform. So we see that sustaining itself at this point in time. We'll have to see how with the fuel hikes and the inflation, how this could play out. But so far, nothing to worry at this point in time. Very robust demand indicator so far.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and speaking with us and taking us through the month gone by. So that's M&M, the automotive division. Just want to turn back on the markets for a second because we do have the mid-cap index, which has recovered a tad bit from the day's low. The Nifty's also flattened out. So there's been a little bit of buying, which has taken place at lower levels. But the overall texture of the market continues to be extremely precarious and weak at this point in time. We'll take a short break. But up next, a conversation with the management of Asian Paints on their Q4 numbers. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. Nifty as of now is at 23,500, above that level, recovered from that absolute low from when we started the show. But let's put the spotlight on Asian Paints, right? That's come off the day's high. But on Friday, we saw it run up and trade. Strong numbers that was reported by the company. The margins of the company expanded. We saw the decorative business volume that came in over 12% as well. I spoke with the MD and CEO of the company, Amit Singhal, and I started off by asking about the volatility that we're seeing in commodity prices, right? The company has taken price hikes, but is it enough? What's the outlook in terms of impact of volumes? Listen to that conversation.
It's been a great quarter for us overall in terms of both value at about 11% and the volume at about 12.7. I think PBDIT margins have been strong in terms of what we've been able to register. Yes, I think the environment has been pretty volatile in terms of what we have been seeing, especially I think in the month of March, we have seen a lot of volatility in terms of the raw material prices. Overall, inflation has been very high in terms of what we have been able to see. I think as a leader, we've been able to kind of really see that we have taken some calibrated increases in the market till now, almost about 10.6% in terms of the price increases we have kind of already taken. We've announced another price increase of about 2 to 4%, which will be effective in mid-June in terms of what we see to that extent in terms of going. So I think our entire endeavor has been that whatever we can take from a point of view of maintaining and not really affecting the customer demand. At the same time, a part of this inflation we will continue to absorb through our cost excellence measures, and seeing that as we go forward, we are able to maintain certain premiumization, able to look at a better product mix in terms of going forward. And therefore, the endeavor going forward would be that do a calibrated increase and see that the entire price inflation which is coming is not passed on to the consumer, so that we are able to kind of see that the overall demand conditions are still kind of really strong, because we also have an oncoming festive season which would be there, and we would really watch out in terms of the demand condition, in terms of what really pans out in the market given the price increases we are taking.
Okay, calibrated price hikes is what you want to take. You want to maintain, absorb some bit to the margins as well. But sir, then this 12%, 14% range, maybe we could say that comes into effect. That's going to be enough as of now, or there is going to be a bit more that we could expect to see in Q2 as well?
So as we see it till now, I think currently it takes care of the current environment in terms of where we are sitting. Obviously, we are watching the whole geopolitical situation in terms of how it goes. If the volatility continues, we might be able to force to kind of take something more. But currently, I think the endeavor is that we look at balancing in terms of whatever we pass on to the market, because we really don't want to affect the demand conditions going forward to that extent. And that's the overall endeavor in terms of what we are aiming at.
Okay. Point taken there, sir. Some margins also, what is the expectation? I believe you've said that you will maintain this 18 to 20% range, but could first half at least of FY27 see a bit more of an impact, and then second half onwards you'll see a better recovery?
See, given the current condition, it is very difficult to say in terms of how would possibly the year emanate. I think it's better that this year we look at quarter to quarter. And therefore, for quarter one, definitely what we are trying to see is that given the calibrated increases, given the strategy of premiumization, looking at a better product mix in terms of going forward, we should be able to kind of really guard the margins in the 18 to 20% bracket in terms of what we are kind of looking at going forward. And I think we will look in terms of seeing what really happens in Q2 and then the second half of the year as we kind of go by.
So, what about competition? People have, and other players also have highlighted competitive intensity that continues to be strong. Is that the case? What is obviously, you're the leader there, so discounting is better for you all. But in terms of competitive intensity, any word there?
So as we see it, I think we have seen good competitive intensity last year as well. And, our belief is that while everyone has taken price increases to that extent, some people slightly higher, some people slightly lower. Basically, largely everyone is in the same bracket in terms of the price increases, in terms of what have been taken. But I think there is no let up in terms of the discounting we see from the other players in the market to that extent. I think Asian Paints strategy has been very clear that we've taken
a far more balanced approach in terms of spending strongly on the brand, maintaining the brand equity, looking at wooing the customer from a point of view of buying into the brand and so on and so forth. At the same time, I think calibrating our overall discounting in the market to trade partners and other stakeholders which are there to that extent. And therefore, we feel that the intensity of competition will definitely continue in terms of the coming year to that extent. And we do not know really in terms of how demand pans out. If the demand definitely shrinks to a little bit to that extent, I think the intensity would only increase.
Okay, so what about the international business as well and the Middle East plant? Any concerns in terms of the plant being operational or any worry because of the current situation?
So yes, I think it has been a tough time in terms of what we have seen, especially I think when we look at markets of UAE, Qatar, Bahrain. I think these markets definitely have had stress in terms of looking at it. We are seeing absolutely no exports which are happening from these markets in terms of what we used to do to that extent, given the fact that the ports are closed. We have maintained a very strong way in terms of seeing that all our plants are open. I think there have been minor disturbances in terms of what we have seen here and there. But definitely, I think there is a little bit of a toll in terms of the retail demand in terms of what we see, because the overall construction segment has a little bit slowed down in terms of what we see overall to that extent. And therefore, possibly from a normal situation, I think definitely we see in markets of UAE, Bahrain, a deficit of about 5 to 10% definitely in terms of the overall sale in terms of what we see.
Okay, just the last word, sir, from me is in terms of rural versus urban. Rural is outperforming urban, but is this any indication that we're seeing weaker spending coming in from the urban side?
See, currently, I think given the fact that last year the monsoons have been good, we've had, I think, a fairly positive sentiment in terms of the agrarian output and so on and so forth in terms of what we have seen. And I think that's something which is really kind of picking up the rural demand to that extent. I think it will also depend in terms of how possibly the current monsoons augur out in terms of going ahead. Obviously, there is something which is being speculated at the moment in terms of going forward. But definitely, yes, I think the rural demand is definitely has a correlation to the whole area of monsoons and the agriculture in terms of how it pans out. So I think we are watching it cautiously and hoping that I think the rural demand continues.
Okay, so that's management of Asian Paints, just about higher by around 0.2% in today's trading session. We're going to do one thing. We'll take a short break, but up next, we're going to talk technicals. Rajesh Palve of Access Securities will be joining in with his trading call. Stay tuned.
Welcome back. Where there is some recovery from the lows, Nifty Metal Index, that is the one which is leading that recovery. But of course, we'll have to see whether that sustains or not. JSW Steel is the other one which is at the day's high. So we'll watch out for some sustenance of these levels that we are seeing. But what's happening in the F&O space? Nigel is joining us now with all the update. Nigel.
Well, quick check on the options data first. The call writers, they are feeling they're back in the game. And I'll tell you what, till around 12:30 odd, those leverage positions, that got impacted in Friday's trading session, there'll be some forced squaring off of positions in the first couple of hours. So I'm hoping for some kind of stability from now on. The reason I say that is because the call writers, they're getting very confident. 23,600 call, just take a look at the premium. That's down to around 79 rupees. It's down close to 60% in a single trading session. Even the 23,700 call out there as well, the premium has crashed by more than 65%, currently around 46 rupees or thereabouts. So call writing is aggressive, and that's why the PCR that was at around 0.74 at the start of today's trading session, that's come down to around 0.69. Remember, at around 0.65 or thereabouts, you do see a bit of a technical factor that plays out, and that helps in a bit of a bounce. So PCR moving to the lower end of the range. You have the FI shots that are moving to the aggressive end in terms of the addition out there. So both those two could actually favor the bulls, but will require some good news. So in terms of levels that you're tracking, the recent low 23,250, that becomes the important support zone. However, going by today's high and looking at the 20 as well as the 50 DMA, both those two become a very, very aggressive resistance zones, and the bears will want to defend this mark because we went to these levels and that got we got sold into. The tech index has come back into its own, and from the large cap as well as the mid cap space, you have a couple of tech stocks that have actually come in for short covering. TCS is coming for a short covering bounce. You have KPIT as well that's coming for a bit of a short covering bounce, and you have Coal India that's seeing some fresh buying in today's trading session, some growth after a while. The street likes that, so that's why that's outperforming. Net, we're at a crucial support zone. The PCR has moved down, so maybe in fact we could see some kind of a bounce from these levels.
Okay, all right, Nigel. Thanks very much for that. Let's get talking about the technicals then. Rajesh Palve of Axis Securities joins in on the show to discuss what he's strategizing at the start of the week. Rajesh, hi, welcome to the show. Well, how would you approach the Nifty today, considering the kind of volatility that we've seen, as well as for the broader markets, the underperformance?
Hi, good afternoon. So Nifty is still not able to take out 20-day, 50-day moving average and is struggling to cross the major call writers supply zone of 23,600. So major writing activity has been witnessed at 23,600 on intraday basis, as well as on the higher strike also call writers are looking quite confident. Though put writers are still trying to defend 23,500, 23,450 area where they are, still writing puts at this strike. So I think 23,450 needs to watch as closely. If we breaks below these level, then this down move can extend further. As broader market is also attracting some profit taking in today's, especially in today's session. And many mid cap, small cap stocks are also, correcting in this fall. But some of the pockets where, strength are still there, like, metal, as you spoke, metal is still holding the ground. Some of the, pharma stocks are also holding on the higher side. Some of the, oil and gas related stocks are also showing strength. So I think some of the pockets where strengths are still there, chart structure is still looking bullish, where one can deploy some long trades. But on the bank Nifty, still there is no contribution from the large cap private as well as PSU bank in this market. And I think whatever pullback which we have seen in last couple of days for bank Nifty has attracted major profit taking and now broken the important support area of 54,000 level. So I think if it continues to trade below 54,000, we may see furthermore, profit booking, and possibly bank Nifty may slide further to 53,600 level also on a intraday perspective. So here structure has already weakened on the bank Nifty front. On the stocks front, IT is supporting in today's market, and some of the IT stocks managed to view breakout on the near-term chart. So Tech Mahindra is looking attractive on the derivative data. Long built up is there. Stock has managed to cross its 20-day, 50-day moving average. Stock managed to surpass its previous swing high also. So looking at the breakout on Tech Mahindra, I think we could see some more up move in this stock. Possible target towards 1590, 1600 we could see for Tech Mahindra. Buy is one can buy with stop loss of 1525. And another stock where we are focusing on the long side of trade is from cash segment, that is Chennai Petro. Stock is clearly moving in up sloping channel on a weekly chart, and looking at the sustained buying action, we believe that this stock has potential to extend gain, projecting target of 1150 to 1160. One can buy with stop loss of 1070.
Okay, all right, Rajesh, thank you for explaining that to us. We do have some queries that we would like you to answer. Inder Singh is writing to us from New Delhi. He has an investment query, wants to know whether he should invest in M&M for a period of 3 months. Considering it's a short-term call that he wants to take, what do you suggest? What are the charts suggesting now?
So stock is in, showing some bit of, profit taking from its 20-day, 50-day supply area, which is placed at around 3160, 3180 level. So until the stock not crosses those level, our trend is likely to exhibit slightly on the weaker side. Maybe in this correction, stock may correct further, and on the downside, 2900 is the key level to watch for. If you are holding the position, 2900 needs to keep as a stop loss. As a structure has already turned on the weaker side, so that stop loss one needs to follow.
Rajesh, we also have a query that's coming from Swati Jain, who's writing to us from New Delhi, holding 200 shares of HUL, and this is at a price of 2019 rupees per share. Wants to know if you should buy more shares of HUL at the current levels. What's your view on this one?
HUL is still in the corrective mode. In this correction, I think stock may slide further, as stock has already broken the important support area of 2150. I think if it's remain below 2150, it may correct further towards 2050. That's the next support area where, if you want to buy and accumulate stock, so wait for, another 2-3% of correction, and then you can add on the decline. But even at 2050, that's the crucial level to watch for. If it's break, then we may see further more decline. So wait for another 2-3% if you want to add this stock.
Okay, Rajesh, thank you so much for joining us this afternoon, helping us answer a couple of viewer queries, as well as telling us your individual bets as well as strategies. On that note, we're going to slip into a very short break. After the break, we'll have Siddhartha Rajagopal of Cotton Textile Export Promotion Council. We'll be discussing the import duty on cotton. Stay tuned in.
Welcome back. Joining us on the show now is Siddharth Rajgopal. He is Executive Director at the Cotton Textile Export Council. Mr. Rajgopal, hi, thank you so much for joining in. This is exactly what the industry had been asking for some time now. And now that you have a period of around 5 months with no import duty of that 11%, what is the immediate impact? What are the kind of imports that you are anticipating within this period to come in?
Thank you very much for having me on this show. Now, it's an important decision, which I think, as you rightly said, industry has been requesting because, and it has also come at the off season, as we say, in the sense that most of the cotton has now come out, and the gap that is there. For instance, the primary reason why this all came up is because there's a shortfall in production. Last 4 or 5 years, we've seen that somehow the cotton production that India has is unable to meet the demand, both the domestic demand as well as the demand arising out of exports. So now that this 4 or 5 month window has been given, hopefully we expect about 35 to 40 lakh bales of cotton to come in and that will be something which is a requirement, primarily because there has been a shortfall in the domestic production. So hopefully this is a measure which will try to take care of the reduce the input costs, especially in the current geopolitical environment in which we are working. And it will also give relief to some of the targeted groups like apparels, the spinning sector, and also the SMEs, who are also dependent on buying the cotton. So overall, I think it will not have a major material impact because if you are producing about, let's say, 290 lakh bales, or 35 or 40 lakh bales out of that, which gets that because the consumption is to be expected around 328 to 330, even 340, because the demand continues to be there for cotton textile products. Therefore, it's not going to be a major import, but surely it's a relief in terms of the impact it will have to especially on the supply side. So it is basically a supply side measure, which will stabilize, in our view, the way the raw material is being sourced.
Oh, absolutely. Mr. Rajgopal, when I look at FY26, the numbers are not so great when it comes to exports, and the industry was also dealing with the US tariffs therein. Now, as we enter the new season, tariffs more or less are competitive with 11% duty gone. Would you say that exports for the new season, for the new year, perhaps are going to be positive?
So surely, I mean, with the 11% duty, which was a major impediment, because after all, you start with the raw material cost. In whatever production you do, the raw material cost is an important element. So therefore, this 11% was in a way, of course, coming in the way. But since you are a large cotton producing country in the world, you have to protect the farmers also. So that point is very well accepted. But then at the same time, when the shortfall takes place in production, you allow some imports, and this will have a competitive bearing on the prices. And hopefully, as we go forward in our export targets, and also the size of the industry that we are looking at, we will definitely get a very good support and traction. And primarily because even as we stand today, about 59 to 60% of our garments are cotton-based. So if that is going to lead the way. So therefore, it's important that this decision has come in at the right time. And it will surely balance the prices and without having a material impact on the cotton.
I get that. Mr. Rajgopal, as you mentioned, 59 to 60% of India's cotton, India's garment are still cotton-based. That's not the percentage or a ratio that we see in the international markets. What is it that is there in sense of synthetic or man-made fiber vis-a-vis cotton? How are you looking at India's ratio? And are you looking at a change coming in there?
So that point comes up every time when we have a discussion on the textile sector. You see, the world is moving at 70-30 and you're still 60-40. But the point here is that if you take the total cotton produced in India, almost 60% of that cotton finds its way in exports, whether as fiber, whether as yarns, whether as fabrics, or whether as garments. So technically speaking, the cotton component is largely export driven. So your cotton that is produced is largely going into exports. Now, when you have high cotton prices, and they compete in the domestic market, making it difficult to produce cotton, you have created, and obviously the demands of fashion, the domestic market is more oriented towards the man-made fiber.
Is it?
If you see almost the sort of allocations, you'll find the domestic market is almost 70 to 75% man-made fiber and 25% cotton. On the contrary, if you see the Indian, this is about the Indian use of the fibers.
Okay.
India, 60% of cotton gets exported. So in a way, when we are dealing with the cotton, economy here, and the numbers that we have, our production, which is the second largest in the world, you are trying to say that the cotton is still export oriented.
Sure.
So, yes.
Mr. Rajgopal, I have one final question, and this one is on prices really, because when I compare January and May prices in sense of cotton, by the time we reached May, the cotton prices had gone up. Now with this 11% duty having gone away, would you think that there's going to be that impact on prices also? Are you looking at cotton prices coming off those kind of
There will be a
prices?
moderation, quite right. There will be, in fact, a correction, if I may say so, because currently even the cotton index was moving high, and the Indian prices were also high. So now there has been a correction because the reports currently, as of today, they say that there have been good prospects of cotton grown in in United States. So there is a correction in the cotton index, and therefore there is a correction in India. And now 11 bring the price on par with the international prices. So that is what the industry is looking for. Industry is looking for raw material at international price, and hopefully this, which was a protectionist measure and which is important. And nobody denies the fact that the farmers have to be protected. There is no doubt about that. But then you create a window when there is a shortfall in production. How do you meet that shortfall? And supply side economics tells you that the only way you meet it is try to allow some import. And this has been done across commodities, as you would have seen in your own, covering different commodities. So this is at that point in time, off season, relevant, when balance, the costs are, the prices will sort of stabilize and availability of cotton will also increase. So to that extent, we will move forward and overcome any shortages, scarcity, and the target that we have set for ourselves. They will surely get, to some extent, we'll be in a position to realize them. So that's my take on this.
Got that.
Okay, Mr. Rajagopal, as well as Manisha, thank you so much for taking us through that conversation move that was required by the industry in terms of import duty on cotton. So, right time that the move has come in at. But on that note, we're going to submit a very short break. And after the break, we'll have the management of Max Estate, who will be joining us to take us through their Q4 FY26 numbers, as well as the outlook of the company. Stay tuned.
Welcome back. You're still tuned into Halftime Report. Let's get a corporate conversation going now. Max Estates, the company's bookings fell flat in Q4. Collection saw 61% uptick. The company, we did indicate that they could not meet their guidance of 6,000 to 6,500 crore rupees for FY26 because of West Asia concerns. Let's talk to the management of the show. We are now joined by CFO of the company, Mr. Nitin Kansal. Nitin, good afternoon. Thank you so much for joining in. We had a conversation earlier and you had indicated that yes, there was a delay in sales due to West Asia war and hence you did not meet the guidance. For FY27, you have not given a guidance this time around. Is this because of a cautious approach that you're seeing because supply side constraints still continue because of West Asia war?
Hi, good afternoon. Having a pleasure being on the call. So yes, last time around we did mention that there were concerns regarding the West Asia crisis, but still we were able to achieve significant numbers and able to clock a sales of close to 1,800 crores on a project in Noida, which was launched in the last week of March. Having said, in the current year, we believe that the current scenarios, in the current evolving macro scenario, it's important for us not to give a guidance at this point of time. Giving a guidance more guides us towards taking a short-term views and rather than focusing on the long-term value creation. So what we are giving a guidance to our investors and to public markets is that we have a portfolio of close to 17,200, which we plan to monetize over the period of next 3 years. And we would like to stick to that.
So how much of it do you think you'll be able to realize in FY27, if I put it that way? Is it 50%? Is it 60%? What kind of indication are you getting as per the demand that you are seeing on ground since you're specifically in the NCR region?
See, what is happening now, gradually the Delhi NCR market is moving much more from a speculative market to a more end-user driven market, whereby the customers are more focused on getting on value-driven ecosystem, community and trust. What we are very bullish on achieving a significant number of that. Currently, we have got close to 3,800 crores of inventory, which is already has been launched in the process of selling. And we've got another 13,000, which will come up to for launch in the current year. We are not giving any explicit guidance, but very hopeful on having a good growth.
Okay. Hopeful on a good growth. You're not giving a guidance, but hoping that this grows from here on as well. But in terms of supply, are there any constraints that maybe could lead to a reduction in that growth rate that you're expecting? Any concerns around the amount or the hike that is there in the supply material as well from the previous levels you had indicated?
So currently the way we are structured is we have all our raw material supplies are predominantly coming from the domestic market itself. And a very small percentage of inventory is sourced from the overseas market. So this logistics things does not have a major impact. In fact, all our projects which are underway at currently, which is in the range of close to 17 million square feet, are fully on track on cost and also on the timelines to be delivered on the timeline piece.
Okay, so let's talk about the 3 million square feet launch pipeline that you have spoken about. You could not meet that, the project addition that I'm talking about. You could add only 1.3 million square feet. Now it's again 3 million square feet for the year to come. What is the gross development value that you're targeting? Considering that input cost material prices have hiked considerably. The last time we spoke, it was 50 to 100 rupees per square feet. Are you seeing additional hike in that? What will that do to pricing going forward? Will you see additional price hikes to come by?
So that 50 to 100 rupees, which we mentioned last time, what we have done is we've got a very robust budgeting process whereby we built in a lot of contingency measures. So this increase in cost does not make an impact on our margins. Going forward, what we don't expect this numbers to move significantly from here with an assumption that these things will settle out sooner than later. Obviously, if this thing continues, this crisis continues for a longer period of time, we would have to reassess at that point of time.
So, what about your net debt as well? It is at around 174 crores. Do you plan to take more debt to fund the new pipeline? What's the strategy here?
So if you see, currently we have got close to a debt of 1,800 crores, against which we have a cash of close to 1,750 crores. The way to look at it is that this debt is predominantly made up of either money which is on this debt is towards lease rental discounting and construction finance, which have a long tenure and much more secure. In fact, as we speak today, we have got close to 600 to 700 crores dry capital available to acquire fresh assets.
I'm just trying to understand it. And the last time we had spoken, you did indicate that, yes, demand still stays. But of course, the decision making has become slower for individuals. And that is something that could translate into final bookings for players like yourself as well, right? Where are we in the cycle currently, specifically in the NCR market, where a lot of it, as you said, it used to be driven by speculative buying, but now it's very end user specific. What is the indication currently for residential real estate market?
Yeah, as you rightly pointed out, last time also we mentioned that the sales cycle is increased, but in fact it is good for people like us, because once the customer is able to spend much more time in our experience center with our sales team, he is clearly able to appreciate the difference between investor driven projects or customer driven projects. So although the sales cycle has increased, but the quality of sales has improved, and also the appreciation of the projects which are really customer centric has gone much up.
That's about the residential segment. Tell us about the commercial segment. You did see strong growth in lease rentals this time around. What is the growth that you're targeting in FY27? Will it be 2,000 crore rupees of rentals coming in from commercial? What is the pipeline addition you are anticipating in FY27?
Yeah. So currently we reported a number of close to 154, and we have given a guidance that we will be reaching a lease rental income of close to 700 crores by FY29-30. Now what the interesting thing is, in the three assets, in fact, in which we are doing, which are under construction, two of the assets, we have seen a strong pre-leasing activity happening. In the case of the Gurgaon asset, which we have seen 2 lakh square foot area getting pre-leased, and in the case of Noida, we have got another 1.75 lakh square foot of area getting pre-leased. The important point to note over here is, in spite of project being at least 1.5 to 2 years away, there's a strong traction for indication from people to lock in the assets at this point of time. When we are signing on these leases, it's not only that these leases, we are in active discussions for more than 2 million square feet in both the assets, and we are seeing a very strong traction happening on the commercial leasing side.
Okay. Mr. Kansal, thank you so much for joining us this afternoon and speaking with us about the outlook of the company going forward as well. Thanks so much for joining in. But on that note, we are going to actually slip into a very short break. We'll get you more on the markets, more stock-specific action after the break. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is managing to hold on to those 23,500 levels, right? We're not moved back to the green territory, but at least we're recovering from that absolute low, still around that level. But 23,500, we're holding on to that. IT continues to shine in the trading session, holding on to very strong gains of around 3 to 4%. We have media as well as metals also that was flip-flopping between the red and the green during the show. So keep an eye out on the Nifty metal pack as well. We've seen that recovery come for the Nifty metals, now comfortably in the green, 0.5% of gain there. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Mid-cap see some selling even as frontline indices are trying to hold on to important support levels amidst continued uncertainty around the US-Iran trade deal. IT and healthcare are the top gainers, while utilities, industrials and financials are the big drags.
The stock of Indigo owner Interglobe Aviation perks up on an optimistic FY27 outlook, riding on better pricing. Lower than expected cost inflation in Q4 also aids the move despite the big forex impact.
Wockhardt continues its winning run after the US FDA approves its novel antibiotic Zyanic for urinary infections. Estimates suggest that the new drug could notch sales of over $1 billion a year.
In a relief for the tariff-struck textile sector, the government has allowed duty-free import of cotton till October 30th. The step is expected to lower costs and improve export competitiveness. Textile stocks rally on the news.
And auto sales in May look healthy, with passenger vehicles climbing off a low base and tractors seeing strong growth and a positive trend ahead. Two-wheeler sales also mostly meet or beat expectations. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormas Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormas. The market's slightly off the lows of the day, but, Nifty right now below the 23,500 mark. Broader markets underperforming.
There's not been a good start to the month of June. And, when we ended Friday's trading session, we were speaking about this in the morning as well, that the fall on Friday was expected and unexpected at the same time. time. The expected was of the fact that there was MSCI rebalancing, yes, but the quantum of the fall was unexpected, and based on that, now we are down to support levels which were earlier 23,800 for a better part of last week, is now back to 23,500, and that is the level that the bulls will look to defend, is now back towards the lows of the day. And the problem with today's session has been that every intraday recovery that has come in has been sold into, and that's the problem for the index. And the principal culprit of that is the Nifty Bank, and the banking stocks are the ones that are sulking. Look at ICICI Bank, Axis Bank. Most of the PSU banks are also trading lower in today's session, and the fall could have been far worse had it not been for IT. Take a look at Tech Mahindra, TCS, Infosys, all of them are doing very well for themselves, and they are the ones that are lending any semblance of support that you're seeing for the market today.
Absolutely, and it was the same thing that we saw on Friday as well, right? The IT stocks are lending support, and this is on account of, some of these global names doing really well in their earnings, so that's lending support to Indian IT as well. We've got Infosys that's soaring 4% now, TCS up 3%. If you take a look at the mid-cap IT names as well, Persistent Systems over 5% in the green, Coforge as well 5% higher. We've got some stocks that were reacting to their earnings as well. We've got Asian Paints that's doing well in trade. It was higher, it's come off those highs right now, but still managing to hold in the green. And Interglobe Aviation as well perking up in trade. But as Hormaz pointed out, on the downside, we've got those PSU bank names, which is the top losing index. We've got Canara Bank, Union Bank, PNB, all of them down between 1 and 2% in trade. We've also got those defense names that are also falling in trade. MTAR Tech down nearly 7%. We've got Hindustan Aeronautics down nearly 1%. And we've got Bharat Electronics as well down nearly 1%. And Data Patterns down over 4% in trade. And that's how the markets are shaping up today. But on top is our focus on those auto names, right?
Yes, they are starting to trickle in as well for the month of May. Sudarshan is joining in with more data on that. Sudarshan.
So most of the companies that have reported auto sales for the month of May so far are not looking that bad. And these growth numbers have to be looked with the perspective of that last year's base is very low. So for two-wheelers, numbers are largely in line or say slightly better than our expectations. For passenger vehicle, growth has been healthy on a low base. As far as the tractor segment is concerned, more than the numbers, what matters the most is the outlook. So talking about the company-wise, starting with Bajaj Auto, export monthly run rate continues to be more than 2 lakh units. Domestic sales growth almost 10%. That's in line with company's guidance. Company did expect slight moderation from Q4 level, and that's what we have seen for the month of May. Coming to TVS Motor, it was all-round beat, much better than our expectations, and all the segments have seen growth of more than 30%. And EV, it was highest ever monthly sales, and their growth is more than 50%. Coming to passenger vehicle segment, Maruti growth has been very strong on a low base. Entry-level segment growth is almost 144%. For utility vehicle sales or say SUV sales, there also growth is more than 40%. For Hyundai, it was slightly disappointing. It has underperformed the peers. Total sales have just seen a growth of 4%, and both domestic and the export segment have performed lower than expectations. Coming to Mahindra and Mahindra, both the auto segment and the tractor segment, sales are much better than expectations. For SUV, growth was around 10%. Tractor segment, if you combine April, May, growth is more than 22%. Even for the month of May, growth is almost 22%. So there also, growth remains healthy. But going forward, after the monsoon forecast of below than normal, now exactly we'll have to see how the next few months pan out. But so far, company does maintain mid-single digit growth outlook for FY27. So overall, whatever companies have reported numbers so far are looking slightly better than expectations. Still few companies are left. Let's see how they report the numbers.
Absolutely. We'll have to wait and watch for all those numbers that are trickling in through the day. Thank you so much, Sudarshan, for taking us through those details. Now, shares of Wockhardt traded higher today after getting a nod from the US FDA. Ekta Batra joins us now to give us more details on that front. Ekta, what's aiding the stock?
Wockhardt has scripted a landmark moment for Indian pharmaceuticals, becoming the first Indian company to receive US FDA approval for a novel India-discovered antibiotic. The US drug regulator approved the company's antibiotic WCK5222, branded as Zenic, for complicated urinary tract infections. The IV antibiotic used in hospital settings is designed to tackle multi-drug resistant superbug infections, one of the fastest growing global healthcare threats and a market estimated at nearly $9 billion globally. Zenic, which received Fast Track and Qualified Infectious Disease Product designation from the US FDA, secured approval in under a year after Wockhardt filed its application in the US. In India, the CDSCO also approved the drug last week following phase 3 data where Zanuck outperformed the standard of care antibiotic meropenem. Europe has already granted the drug accelerated assessment status, and expectations are now building for a faster approval process following the US FDA nod. In terms of commercial potential, estimates suggest Zanuck could eventually generate between $1 billion and $2 billion in annual sales globally, with nearly 40% of revenues expected from the US market alone. In India, analysts estimate the drug could generate around 150 crores in sales over the first 1 to 2 years. The drug has already demonstrated encouraging real-world outcomes under compassionate use programs, where nearly 85 critically ill patients were treated. The next trigger for the street will be commercial execution, including pricing, hospital adoption, and any potential out-licensing or distribution partnerships that Wockhardt may pursue globally. Zanuck itself represents over a decade of research and clinical developmental work, with the program starting in 2011. Investors will now closely track Wockhardt's broader anti-infective pipeline, which includes 4 other novel antibiotic assets. These include Micnaf, which has already been approved and launched in India, Emroc and Emroc-O, which reported good growth in Q4, and Faviscu, where the phase 3 clinical trial has been completed. The approval of Zanuck is now being seen as a significant milestone, not just for Wockhardt, but for India's ambitions in innovative drug discovery.
Ekta, thank you for summarizing that for us. The 5th straight day of gains for Wockhardt. At the close on the 22nd of May, the stock was at 1575. It's now trading well over 2150. It almost reached 2400 levels at their intraday high, almost 40% in the last 5 trading sessions. Take a short break. More news and updates on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. At 4 p.m. today, the MOSPI, or Ministry of Statistics, will release the first data of their revamped IIPO Industrial Output Series. Lata Venkatesh is here to explain what we can expect from this. Lata?
Well, in the light of GDP and other series CPI being revised, the IIP Index of Industrial Production That's the full name of IIP. That's getting revised. The new base is 22-23. It used to be 2011-12. Now, when you revamp, you also do other things. And this committee, led by Professor Mridul Sagar, who was formerly with RBI, they have included minor minerals, rare earths, gas supply. Originally, only electricity was there. Gas supply, water supply, sewerage and waste management, because all these are important activities which have picked up after the 2011 series. They've also revised items and weights. Removing outdated ones. See, you remove tube lights and add in LED. Things like that. What you use now, instead of, you remove old telephones, landlines, and replace it with smartphones. That kind of removing outdated articles and giving different weights. Food is a lower weight, and consumer durables could be a higher weight. The revised basket contains 1,042 products. They're also more granular. Everything is an index, okay? They don't tell you how much is produced. Everything is indexed to 100, and then it increases from there. So there are sub-indexes like how much of renewable power, how much of non-renewable power. In the previous index, old index, we only had electricity. Now we have a sub-index. Likewise, there are sub-indexes in others as well. They've also removed closed factories, or factories which were producing something else are now producing something else. So all those revamping has been done. New large-scale, new factory setup have been included. And then they've used the geometric mean method, we needn't go into the details, to backcast the 2011-12 series so that we can have a comparability. And today's release will give us data from April 2023. So it's not that they impose a new number for June 2026 and we don't know whether it's good or better or worse than previous. You're going to get a 3-year series. So we will well know whether we have done better in April 2026 from month ago levels, year ago levels, and last 3-year average levels. So that's a very, very useful way of presenting the new data. The other reason why IIP is important is that it's an input into GDP. So obviously of national importance.
All eyes at 4 p.m. this evening when the IIP numbers are released. Lata, thank you for previewing that for us. Now, BofA Securities India is hosting its flagship investor forum, the BofA India Conference 2026. And from the sidelines, we spoke exclusively with their India CEO and country executive Vikram Sahu and head of India Equities Arvind Maheshwari on the FII view on India and what could revive investor interest. Listening.
If we think about the litany of problems that we've faced, and again want to emphasize, not all of this has been of India's making. So whether it was a border conflict about this time last year, whether it was the ongoing trade dispute, it's a little bit like waiting for Godot to see the US trade deal come through. The Russia-Ukraine conflict has been grinding on, going into its 5th year now. We've also seen West Asia, which has been problematic for India given our dependence on imports from the Middle East. So these are all, and then as an overlay to that, it's the rise of AI. So some of these are real ongoing structural issues. One of the things that India's benefited from in the past has been the TINA factor. So if you think about countries that have growth of this scale and growth at this pace, there's been very, very few countries that have that to offer. And so India benefited. So 18 months to 24 months ago, when you look at valuations in India, we were trading 2 standard deviations above our own history. So very, very rich valuations.
It is a tactical retracement from foreigners, and we can see that, and with good reason. There are genuine problems that India is facing here and now. So the near-term pain obviously exists, but it seems more cyclical driven rather than a structural reassessment. So it will be a matter of time. Hard to say exactly when, but as the West Asia crisis starts to, it's already in the de-escalation phase, and hopefully as it retraces and goes away, we will start to see interest come back into as people start looking at what next. Foreigners are using every opportunity they can to, and India has become a bit of a funding market. And where is all this money going and flowing into? Well, some of that is recirculating within Asia. So going into the AI thematic, which is at the front and center of all things equities at this point. So you are seeing a lot of that money going into Korea, Taiwan. There is definitely an expectation of reform building, and in fact there have been positive comments on how this government has actually navigated a very tricky situation that has, it's an external shock, and how the government has been nimble in taking steps. But there is definitely expectations of more reforms to come through. Taxation is one of them. We are fighting with one hand behind our back if you're a foreign investor, because most other markets that we compete with for capital have zero capital gains tax, and we don't, and that is something that we have to cross. The hurdle for foreign capital to come into the country becomes that much higher. So there is expectation that something will be done on that front.
On that note, it's time for us to head into a short break, but a small programming note as we do that. Uncertainty in the market is rising given geopolitical and trade headwinds. We at CNBC TV 18 are featuring some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune in to CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amish Shah and Vikram Sahu. You can also catch macro and market opinion from Morgan Stanley's Chetan Iyer, Rhythm Desai and Jonathan Garner. Citi's Managing Director Sue Lee and CEO Jane Fraser will also be part of the blockbuster panels lined up only on CNBC TV 18.
Welcome back. On to updates from West Asia. Then US President Donald Trump says he's close to a very good deal with Iran, with media reporting he's pushing for tougher terms, including safe navigation in the Strait of Hormuz, and that Iran does not possess nuclear weapons. However, he also stated that if an agreement cannot be reached, he will request the intervention of the US Department of War and end the situation in another way. CNBC's Dan Murphy now joins in with all the latest updates. Dan.
President Trump saying this Iran deal is close, but it's not done. And this morning, fresh exchanges of fire also threatening to derail this momentum. In fact, just this morning, Kuwait's army said the country was under attack by missiles and drones, but didn't say where they were coming from. And over the weekend, we saw the US and Iran also trading blows once again. As you reported, US Central Command saying American warplanes struck Iranian radar sites and drone command and control facilities on Saturday and Sunday. That was in response to Iran shooting down an American drone. US fighters also downing 2 Iranian attack drones threatening ships in the Strait of Hormuz. So all of this taking place while a deal is supposedly being written. President Trump reportedly also spending Friday in the Situation Room reviewing what's now being called a draft memorandum of understanding. Now, according to Axios, the president asked his team to make some amendments here, particularly around how the U.S. gets Iran rich uranium and the timing of that transfer. He also wants changes to some of the wording around the reopening of the Strait of Hormuz as well. President Trump on Fox News on Saturday saying he is in no hurry and would finish Iran off militarily if they didn't make a great deal. But the deal is also, of course, being complicated by the worsening situation in Lebanon. And if you've checked in on the CNBC website or any news website this morning, you'll see this is quite a significant development for the region. We've seen Israel expanding its military incursion into Lebanon, Israeli forces seizing what's called Beaufort Castle. This is a nearly 900-year-old fortress that Israel last held during its 1982 Lebanon war. We heard earlier from the Prime Minister of Lebanon, Nawaf Salam, speaking on this. Here's part of what he had to say. Take a listen.
Israel is no longer targeting only specific sites or areas. It's implementing a policy of total destruction of cities and towns and of all the essentials of life within them. It's also carrying out mass displacement that amounts to collective punishment against our peaceful civilians. These policies are condemned under all international norms, conventions and laws.
Nawaf Salam speaking there. And of course, this is causing great angst here in the Gulf, fury in Lebanon, in fact, and Prime Minister Netanyahu of Israel saying he now wants to deepen and expand Israel's hold there. So that is obviously clearly a concern when it comes to finding any kind of diplomatic off-ramp for this conflict now in its 4th month. More than 3,000 people have already been killed in Lebanon since fighting began back in March, and more than 1 million have been displaced from southern Lebanon as well. Of course, on the Iranian side, we know that Tehran has made an end to fighting in Lebanon, one of its conditions for an agreement, but Israel appears to be escalating here, not de-escalating. The Wall Street Journal also reporting that Netanyahu, of course, is under heavy domestic pressure to hit harder, and many Israeli politicians also frustrated that US restrictions have basically prevented their strikes on Beirut.
So Dan there with the latest on what's happening in West Asia. But moving on, NVIDIA, which has dominated the market for AI chips in data centers, is now expanding its prowess to chips that will serve as the main processor for personal computers. During a keynote address at Taiwan's Computex conference, NVIDIA CEO Jensen Huang unveiled a new N1X processor made alongside Microsoft. It will be incorporated into a new RTX Spark superchip, debuting in the fall on a fresh line of Windows personal computers. The move marks a challenge to high-profile names in the PC market like Apple and Intel. Let's listen in to what Jensen Huang, CEO of NVIDIA, had to say about the new AI chip.
A chip that, frankly, would take 33 years to build. And the reason for that is because 100% of NVIDIA's software stack runs here. If you want to run digital biology, no problem. If you want to do seismic processing, no problem. You want astrophysics, no problem. Everything associated with CUDA, all the physics, all the biology, all the genomics, all the AI, no problem. All the computer graphics, no problem. Every single application NVIDIA has ever created and every single application that Windows has ever run. Microsoft and NVIDIA meticulously optimized everything so that this computer literally runs everything the world has ever created, plus it now runs agents. An incredible computer. I'm so proud of it.
Jensen Zhang there on the new NVIDIA chip. With that, the market is back towards the lows of the day. We take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Lows of the day is what we are seeing, a bigger cut on the broader market. So the Midcap index is down 1%. Bank Nifty is also not doing so well. So overall, a weak texture, though IT is batting it for the bulls. And that is a surprise.
Right. Good afternoon, Sonal. As we will discuss in this show itself, the impact of the AI risk now with the BofA analyst. So that'll be something they'll be watching out for. But overall, weak texture as far as the market is concerned. A lot lined up on the show, some interesting conversation as well. So let's start off with the top headlines. Mid-cap sell-off extends while benchmark indices also fall in the red amid continued uncertainty around the US-Iran deal. IT and metals gain while utilities, industrials and financials drag.
Wockhardt leaps after the US FDA approves its novel antibiotic Xanic for urinary infections. Estimates suggest the new drug could notch sales of over $1 billion a year.
Sources say Acme Solar is mulling a fundraise via a QIP to raise up to 2,500 crore rupees. QIP funds likely to aid capex and also help promoter trim stake.
Shares of Rubicon Research boasts as the company's strong March quarter earnings and FY27 guidance spark an up move.
And shares of Inox Wind fall over 8% as on-ground execution challenges and geopolitical tensions hurt the company's profitability.
Okay, those are the top headlines that we are tracking for now. The Nifty is down 65 points. We do have a bigger cut on mid-caps. It's down 640 points as we speak at the day's low again. So we are below the 23,500 mark for now on the Nifty. The advanced decline ratio, actually, those lines should come up for you on the screen. They are in favor of declines right now. But, you know, at the start of the trade, it was in favor of advances. So there is a crisscross there as well. And it has continued. In fact, that gap is widened by the minute. So important to see the weakness that we are seeing. IT is doing well, but we do have a lot of stocks which are in focus. So let's do that. This is our special segment, Mid-Cap Movers. Ria is here to take us to the mid-caps that are moving around in trade. Ria.
Well, yes, a lot of stocks moving around in today's trading session. Starting off with the gainers first, all of these names are reacting to strong Q4 and FY26 results, starting off with PTC Industries, which is seeing the highest gain today, up around 15%. Rubicon Research as well seeing a strong gain, and this stock is up around 76% just in the last 6 months. Vishnu Chemicals also seeing a strong gain today and up 30% just in the last 2 months as well. Uflex is also seeing quite a positive momentum in today's session, but this stock, remember, is down nearly 30% in the last 1 year. And Nibe Limited, this one also performing well and continuing its momentum. This is up nearly 50% just in the last 1 month, but down 8% for the full year. On the flip side, looking at some of the losers in today's trading session, there's Premier Explosives reacting to a weak set of numbers in Q4 of FY26, but the stock is up around 72% just in the last 3 months. Ingersoll Rand as well as EMS also reacting to weak Q4 numbers, and EMS has nearly halved just in the last 1 year. JP Power also seeing a strong move today. And lastly, MTAR Tech also down nearly 4 to 5% in today's trading session, down nearly 7% at this point, in fact. But the stock, remember, is down up nearly 4.5 times just in the last 1 year. And apart from this, taking a look at some of the stocks that have hit their 52-week highs today, these include the likes of Arvind Limited, Centum Electronics, Kernex Microsystems, InSwift Labs, as well as E2E Networks, which has hit an upper circuit of 5%.
Okay, thank you so much, Ria, for joining us and giving us a sense of all the top movers as far as the broader end of the market is concerned. Well, as we promised, it's a good time to welcome Kunal Dayal, Senior Analyst, IT and Real Estate at BofA Global Research. He joins us from the sidelines of the BofA India Conference 2026. Thank you so much, Kunal, for joining us. It's a pleasure to have you on the show. First up, give us a sense of the mood as far as the Indian IT names are concerned, especially given the fact that a lot of these names have seen significant trepidation going into FY27.
Great, thanks. So on the IT sector, of course, there is the ask for clarity on 2 aspects, the displacement risk being posed by AI and the ability of the sector to respond to such risks. Given the technology itself is quite nascent, the range of outcomes being debated in the street is quite wide. Now, our take on this is really twofold. From a very fundamental perspective, we actually think that the advancements that have happened in AI since the start of the year are actually constructive to the opportunity set for the IT services companies. And I say that essentially because the advancements that have happened this year go on to say that there is now use cases or application of AI beyond coding and into the realm of business processes. And on this part of the equation, IT services companies stand to gain in terms of net new opportunity. The second aspect I would also highlight is that we've also seen a lot of the services companies have started to partner with the intelligence providers. We would think sort of then points to the relevance of these companies in the new ecosystem. And third and last, I would also highlight is more recently you have seen announcements from OpenAI and Anthropic around establishing a services arm, which again goes a little bit of a distance in terms of saying that there should be a market opportunity on the services side as well. So that's really on the fundamental side. Now, of course, from an investment or a market perspective, our view is still very selective in terms of picks. And that is essentially keeping in mind a couple of things. Point number one, in the here and now, we do find that the focus for a lot of enterprises is increasing their consumption of tokens, which then might just leave limited space in terms of their ability to maneuver or take up the budgets for IT services. The second aspect also is that ever since the outbreak of the West Asia situation, we've had feedback that the intent of enterprise customers to spend on IT has been a little bit weaker versus how it was right at start of the year.
So Kunal, you did indicate that a lot of these services companies are looking at partnerships with AI companies. There are things that could happen beyond from just service provision that's happening. While that is positive and stocks are reacting to that, do you think it'll take a lot more time for it to actually convert into meaningful opportunities? And in that case, don't you think the street is getting excited way before time? What do you think is leading to these gains that we're seeing in the IT sector already? And is this something that you think could be sustainable overall?
Sure. So look, in terms of the new opportunity, this could play out over a few different dimensions. The two biggest ones that we are keeping an eye out for is, number one, opportunity coming from tech modernization initiatives. This we think it should unfold in the not so distant future. And then aspect number two is more around agentification of business processes. And I would concur with you that this is an opportunity which could take a while to emerge. Now, whether the street is getting far too excited about it in the here and now, remember that in the lead up to where we are as of now, the scenarios being discussed by investors is, can you also have a phase where revenue growth goes to zero? Could you have a phase of revenue decline for these companies alongside margin compression? As against that, the guidances that have come out from various corporates in India is pointing to growth being stable or better in comparison to last year. Late last week, you also had Capgemini, a European IT services company, give out a view on revenue growth for the next 3 to 4 years, which did not indicate any deceleration. On the balance, there was a marginal improvement in growth rates that they pointed to as part of their expectations.
Well, Kunal, to round off the IT discussion before we move on to the realty space, one thing we want to understand from you, within the Indian IT basket, while you may not be able to name companies or give us recommendations, which are the type of companies you feel are better placed to navigate this uncertain scenario? Which are the names you will avoid, or which are the types of companies you will avoid? And a quick view on valuations.
Absolutely. So, I guess the question to be asked and top of mind for all investors, interestingly, it happens to be a situation where the entire basket is being basically treated with the same yardstick at this point in time, when there should actually be several differences. So what we find is that there are pockets of opportunity on the engineering services side. There are pockets of opportunity on the data and analytics side. And then there are also pockets of opportunity on the BPO services side. A few areas, or the kind of companies rather we would want to avoid, is if the business model was a very Me Too model, essentially winning deals on the basis of price aggression, that we do not think will go far when it comes to an AI-led services approach, and therefore that's the lot we would want to avoid. I think to the point of view on how to look at valuations, a quick yardstick, I think if we look at these firms being able to grow at low single-digit growth rate, what it means given their capex requirements and ability to generate cash, that usually is enough to justify a valuation range somewhere in the teens. If growth rates were to sort of have clarity around returning to high single digits or so, that does take up the valuation benchmarks in our mind to a 20x plus sort of a range.
Okay, take that point. We did have a lot more questions, but completely out of time. But a pleasure speaking with you, Kunal. We'll touch base on the realty space soon, because that also continues to be in focus. All right, with that, we'll slip into a break. When we come back, we'll get chatting with the management of M&M Farm Equipment on the other side. Stay tuned. Welcome back. You're still tuned into Mid-Cap Radar. Well, the markets continue to trend lower, but we are getting a lot of auto numbers and auto sales continue to be on our radar. So let's get into a conversation then. We do have Mahindra and Mahindra's total sales in the domestic tractor segment, which saw 23% growth, while total sales rose by 22%. My colleague Sudarshan spoke to Vijay Nakra, who's the president of Farm Equipment Business, and began by asking how the below-average rainfall forecast by IMD will impact M&M's estimate. Listen in.
When we had put out our industry estimate of mid-single digit growth, we had factored in the possibility of the impact of El Nino. So for now, we still hold the estimates that we put out. The two, three things that I'd like to talk about as far as that is concerned. And the reason why we put that out is, if you look at the last year numbers of growth, it was actually a story of two halves. The first half of the year, or rather the second half of the year after the GST reduction played out, saw an over 30% growth in the second half of the year. Whereas the first half of the year was in sort of low, mid double-digit growth. So if you look at this year, the performance for quarter one, which is what you see in the month of April and May, as you said, double-digit, over 20% growth, comes from the low base effect of last year, the strength of the structural correction in GST coming into the first quarter of this year, and with that, good cash flow in the hands of the farmers. So we still hold on to the estimates we put out, and we believe that the first season, which is till the month of July, where 40% of tractor sales happen, we believe that we are seeing demand to continue to remain stronger.
Perfect. So you are holding on to your mid-single-digit growth guidance, that industry growth guidance that you had given after Q4 earnings. So now if you can talk about some of the factors, growth factors, because 2 months consecutively, the growth is more than 20%. And also it's because of the low base that you have talked about. But going forward, some of the important factors that you can talk about that will lead to a healthy growth or will lead to you maintaining or doing much better than the industry growth.
Well, I think, we need, like I said, we need to wait to see how the season after the first Kharif season tractor purchase that happens, how the industry will play out. But I just think that as we get into that, there are two areas that we should look at. One is there is enough in terms of positive sentiments which is still there at the moment. So, like I said, whether you see the cash flow in the hands of the farmer because of 97% of the Rabi harvest, which has happened. The acreage of the summer crop is also up by 3% compared to last year. Reservoir levels are about 12% higher than the previous year. So I think these are some of the positives as we get into the year, which will play out. Of course, the potential headwinds that we see are some of the impact that could happen in terms of trade to the farmer. Which also is linked with El Nino. But while that will play out, firstly on El Nino, I think it's important. I just want to share with you that if you look at the last close to 50 years of data, there have been 16 years of El Nino. In 11 out of those 16 years, we've not seen an impact to the tractor industry, and that's largely because of multiple other reasons that play out, which include the dissipation of rain, which states get affected, actions taken by the government during an El Nino year. And we can see that the government has already taken significant actions, whether you talk about 40,000 crores plus in terms of fertilizer subsidy, so that terms of trade don't change, national seed reserves to address weather-related disruptions, crop diversification, announcement of prices of 14 Kharif crops, so farmers sow those seeds for Kharif season. So I think some of these will also have a positive rub-off to sort of take care of some of the impact of El Nino. So I think we need to wait to see once closer towards end of July or August how that pattern will play out, but we believe that the first season where 40% of tractor sales happens will continue to remain strong. The demand is strong.
Very important statement that you have said, that 11 of 16 years where the El Nino was there, the tractor industry had not seen the impact hardly that normally people talk about. But now just one factor, because obviously rural is the area which leads the growth for tractor industry. So what are your channel checks suggesting? So rural industry or rural growth remains resilient, or anything that over the last few months we are seeing that rural growth is doing a bit lower than the urban growth?
Firstly, I just wanted to put another sort of perspective to rural income. Rural income is not solely dependent on agri income or farm income. I think today the rural economy is diversified quite a bit. So 25-30% of household income in rural India is dependent on agri, but there is still a lot of other forms of income that come into rural India. And in rural India, when people have good cash flow, they tend to buy tractors because it is an asset. Almost the equivalent of, let's say, purchasing gold, if I can use that as an analogy, because it is one of the safest assets that someone buys in rural India, which is used for livelihood. So while there could be some challenges that will play out because of El Nino, there are other forms of rural income which continue to give indications of strong rural demand. And one can see that in multiple other categories, right? Whether you talk about two-wheelers or small commercial vehicles, you can see that the demand in those categories continue to remain strong. And they, in a sense, are sort of also indicators of rural health. So our view on rural health is that it will continue to remain strong in terms of income for rural households.
Due to time constraint, I'll just add one more question, because your focus over the last few years has been on the premiumization in the tractor segment. So if you can talk about any launches that you have in the store for our next few months or in the remaining part of this fiscal, and on the premiumization front, any new steps that you are undertaking?
Yeah, so even 2 months back, we had put out that we have a number of launches between both Swaraj and Mahindra as a brand. We are well on track for those 11 launches that we spoke about. We already have launched the Protect brand of tractors in Swaraj and the H1 refresh range of tractors in the farm division of Mahindra. And they both have been extremely well received. These are tractors which we've launched, which aid farmers in terms of better productivity and utilization of mechanization in their farms. And for example, Protect we've launched in Punjab, Haryana. The H1R we've launched in 7+ states across the country. They have been received well, and we intend to scale those launches up during the course of this year.
Well, that was our colleague Sudarshan with the management of the farm division of M&M, and they say that they'll wait for a couple of months to see the impact of El Nino on demand. Well, with that, we'll slip into a short break. We'll get him on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, it's now time for our special segment, Midcap Spotlight. Indocount is the stock in focus on the back of Q4 results as well as news flows surrounding the sector. Devyani joins in with more details.
While the entire textile pack is up and buzzing in trade today on the back of the cut on the import duty on cotton, it's Indocount that's shining the brightest. Now that's as a result of the strong forward-looking FY27 guidance from the management in spite of a set of mixed results coming in from the company. Now revenue came in at 1,057 crores, that's up 3.4% year on year, driven by a scale up in the new business segment, that's the utility bedding and USA business, along with better realization in the core bed linen business of the company. New business now accounts for roughly around 25% in Q4 of FY26 and 17% for full year FY26, up from 7% that was seen in FY25. Now EBITDA came in at 86 crores, down 3.8% year on year, with margins coming in at 8.2% against 8.8% year on year, and PAT came in at 24 crores, up 15% year on year, and that was aided by the bump up in other income that the company saw. But like we can see, these were a mixed set of results. It's the FY27 targets that the management has set that are the reason why Indocount is doing so well in trade today. Now, there's a revenue target that's set for 5,500 crores, up 30% from current levels, with 4,000 crores coming in from the core bed linen business of the company, with 1,500 crores coming in from the utility bedding and USA brands. That's almost twice as much as the company clocked this year from their new business segments. Now, EBITDA margin target of 13% has been set against the 8.2% that the company clocked in Q4 of FY27 of FY26. So we can expect a good margin expansion going forward. All in all, a mixed set, but a strong management guidance, and the cut on cotton import duty is also helping the stock out in trade today.
Okay, Devyani, thank you so much for joining us. That's about Indocount and the entire textile space. The stock is higher by 9.5% as we speak. The markets, they continue to trend lower, so we'll take your leave on this edition of Midcap Radar. Do stay tuned, your stocks, when we return to answer all your stock queries.
Hello, good afternoon. You're tuned into CNBC TV 18. You're watching Your Stocks coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, good afternoon, but not a good afternoon again coming in for the markets. On Friday also it was a similar trend that we started with. And now the markets are at the day's low right now. 23,450 is what the Nifty is holding on to, day's lowest point as of now. So we've seen a significant fall coming in from the high of the day. That was 23,630 around that mark. And now look at it, day's low. So did try to make a recovery, then couldn't sustain, fell back, again tried to make a comeback, and now moving further lower also in trade. Down 0.5% in the trading session. Nifty IT, that is still managing to hold on to gains. Around 3.5% gains is what the Nifty IT is holding on to. So yes, that's still holding on. That is also slight bit off the day's highest point, but no complaining, right? Strong gain, strong green across the screen for the Nifty IT. Let's pull up the Nifty Metal. You know, what was that doing? That's a very good recovery in today's trading session, and seems like we are seeing that Nifty Metal continue to hold on to that as well. So they're holding on to gains of around 0.3% to 0.4% in the trading session. Hi Arundhati.
Hi Vinny, absolutely. The market's trending lower. It's those IT stocks that are helping on the upside, and that was the same case on Friday as well, right? But on the downside, the underperformance coming in from those banking stocks, right? It's the PSU banks, we've got the private bank sector, all of them not doing well. We've got ICICI Bank, HDFC Bank in the red. PSU bank names, if you pull those up, SBI, PNB, all of them trending lower in trade today. We've also got those FMCG names, we've got those defense names that are lower in trade, and also those auto stocks that are not doing very well after those sales numbers have been trickling in through the day. But that's how the markets are faring today. Not a very good day for the markets, but it's time to answer all of our viewer queries. And joining us today to do exactly that is Gaurang Shah, Senior Vice President at Geojit Financial Services, and Ajit Mishra, the SVP Research at Relegate Broking, to answer all of those queries. Gentlemen, thank you so much for joining us on the show. Let's get straight into it. The first query coming in from Puneet Saxena. He writes to us from Ghaziabad, and he wants to know the target price and stop loss for ICICI Prudential AMC for a period of 15 days. Gaurang, let me come to you first. Give us the fundamental view on ICICI Prudential AMC. He's looking at it for a very short-term period, but what's your view on the stocks? And we'll then go to the other guest for the stop loss and the target.
Well, thank you so much, Arundhati, for having me on the show. Good afternoon to all the viewers of CNBC TV 18 and to all of you all. A small disclosure before I go any forward that all recommendations that I'll be sharing with you this afternoon on your show, they are part of our fundamental research team recommendation from a long-term point of view. Our company, Geojit, or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest, but we share similar investment ideas with our clients. They might have their investment interest. So first of all, Arundhati, that query is for a very short period of time. Having said that, we remain extremely positive on the asset management side and Indian capital markets as a sector, because very closely related, of course, AMCs and stock market. We don't have any specific coverage on ICICI Pru AMC, but we are positive on the AMC side of it, and we like HDFC AMC and Nippon India. These are the two AMCs on which our fundamental team is positive, but ICICI Pru also happens to be a very strong and a large player in the AMC side of the equity market related investment platform providers. So we remain positive. Unfortunately, no specific comments since we don't have coverage on ICICI Pru AMC.
Okay. We do not have coverage, but other names also Gaurang mentioned. Hi Gaurang as well as Ajit. Good afternoon. What about the technicals for ICICI Pru AMC, right? Ajit, they want target and stop loss also, and for a period of 15 days. So very, very short term right now. What's your suggestion?
Yeah, good afternoon, Vinny. Good afternoon, everyone. So basically what we are seeing right now that after the strong move, all the AMC counters either witnessing consolidation or a bit of a profit taking. ICICI AMC made a new record high in the last trading session, and today we are seeing that's witnessing profit taking down by roughly around 5%. Possibly we may see consolidation now after this sharp move from 3,000 to 3,600. It was almost a vertical rise. So probably in this range of 3,200 to 3,300 band is something that the stock might take a breather before witnessing the next leg of the up move. So since his view is next 2 weeks, my recommendation is to stay put with 3,200 as a closing stop. And gradually, in case if the stock manages to cross this barrier of 3,600 mark, he can wait for 3,800 plus level targets.
Okay. Sorry, that's the word coming in on ICICI Pru. Let's move on to the next query. We have A. Subramanian, who's writing to us from Mumbai, holding 200 shares of SBI. Price that they bought it at is 825 is their average price. Wants to know whether to hold or sell. Ajit, let me come to you first on the technicals for this one. What's your view for SBI? Or is averaging or adding more also an option that you are keeping?
Yeah, so I guess he has bought it at lower level and still getting profit despite the sharp correction the stock has witnessed from 1,200 to 950 levels. See, the texture of the PSU bank looks more of sideways now after this sharp correction, especially SBI. So I believe that maybe close around 870 to 900 area where the stock might take a breather before the next leg of a rebound or at least some bit of a consolidation. So for a timing now, you should definitely stay put with a trailing stop at 870. But for any fresh momentum, the stock should cross 1,020 levels, and then probably we may see a next leg of up move towards 1,100 plus in the near future.
All right. Gaurang, what's your view on SBI in the long term from a fundamental perspective?
So they're extremely positive, especially the kind of improvement that we've seen in some of the PSU banks' reported numbers. Of course, for SBI, fourth quarter, there was miss or a stag below expectation as far as the treasury income was concerned. But having said that, I think the correction is witnessed in the stock. And the good thing about this investment by this investor is the level at which he is invested in State Bank of India. Don't be in hurry. If you have time by your side, I would request to hold on to it. And we are extremely positive on the entire BFSI segment, be it public sector bank, be it private sector banks or strong NBFCs. I think the credit growth is going to pick up extremely well, and that's going to translate into a lot of positivity as far as earnings is concerned.
All right, so very positive on the BFSI space is what you're saying, Gaurang, whether it's private banks or PSU banks. But the next query also comes in from the same sector. Vishwanath is writing to us from New Delhi, and he is holding HDFC Bank for the last 5 years. He asks whether to hold or sell at current levels, as the stock has not seen any major progress. So we don't know how much he bought it at, but he's been holding it for a while. So Gaurang, what's your view on HDFC Bank specifically?
Well, so one was a large public sector bank, and this one is a large private sector bank, Arundhati. There have been spate of negative news flows, and because of which we have seen the stock being under pressure. Having said that, we have also heard from the management, and the statement has been there in public domain, that this is not a long-term systematic risk that may cause a larger dent on the future earnings. Yes, there has been issues, and the resolution is a part of it which is undergoing, and all the loopholes would be plugged, and whatever has gone wrong would definitely be straightened up as we go forward. So first of all, hold on to it. HDFC Bank. If you have it at higher level and if you have investable amount, I would even take a step forward and advise that you can average at current level, provided you have a long-term time horizon.
Okay, that's the view coming in there for HDFC Bank. Ajit, what's your view for HDFC Bank on the technicals also? They're asking from a 5-year point of view. He's been holding it for 5 years, so long-term investor. What is your suggestion right now? Like Gaurang was saying, we've seen so much of news flows coming in around it, which is sentiment in terms that negative that brings in for investors. What should the viewer do?
True. In fact, Vinny, if you see that in 2021, the stock was at around 770, 780 area. That was the high. And currently we are at the same level. So that's why I can understand his pain. Means he has been holding for 5 years with no returns. Now, after this, phase of underperformance, possibility of short-term underperformance may continue, considering what we are seeing on the basis of price action. Means, in fact, in the recent rebound also, it made multiple attempts, Vinny, but it couldn't sustain above the short-term average. So they clearly show that bears are completely under control, especially when it comes to the short-term trend. But at the same time, I believe that basis the long-term charts, means not daily or weekly, but monthly and quarterly charts, close to around 670, 680 area is where last time it spent considerable amount of time before the noticeable recovery or rebound. So we are very close to that area. So probably maybe for a couple of weeks or maybe more than that, we might continue to see this underperformance. But around that area, it's good opportunity to accumulate. So if the view is long term, he has already spent 5 years, maybe 1-2 years of further wait may result in decent returns. So for a time being now, it's a hold.
Okay, a hold for the time being. That's the word on HDFC Bank. Let's move on then to the next query. We have Vishal Mohan, who's writing to us from Patna. Investment query, and this is on Vodafone Idea at current levels for the long term. Gaurang, obviously we have seen a slew of announcements now come in, which is a trigger in terms of the positive side. Obviously, they still have to pay those AGR dues, but at least you know the amount that's come in. Everything that has come in so far, what's your suggestion for Vodafone Idea? Would you say look at it, or maybe Bharti Airtel is still something better as an investment for the long term?
Hi, Vinny. Good afternoon to you. So, yes, I do agree with you, Vinny, that there has been some positive news flows after a very long time as far as Vodafone Idea is concerned. So, let me give our stance on Vodafone Idea. We have a neutral stance. That means we don't expect the stock to go anywhere, at least for some time. And the primary reason is that they need to do a lot in terms of bringing the balance sheet into the green and soothing the sentiments of investors, both short-term, medium-term, and long-term. Now, one thing that good has happened with Vodafone Idea is that the month-on-month subscriber base that they were losing, I think that has come down or that has stopped. Second thing is that, yes, there is a long winding road for this particular company as far as ATR dues payments are concerned. And it goes on for 5 years or maybe more. That's what I read last. If you have not invested in Vodafone Idea, of course, I can't give buy, sell and hold because we have a neutral stance. That means we don't expect the stock to go anywhere. But if you're looking at investment opportunities in the telecom service provider sector, though I am also of an opinion, this is my personal view, Vinny, that we need more service providers in India, given the large base that we have. So we are positive on Bharti Airtel and Reliance Industries because of Jio Mobility business comes under Reliance Industries balance sheet. So if you've not invested and if you're looking at investment, I think Reliance because of Jio Mobility and Bharti Airtel would be a preferred choice.
All right, so neutral stance on Vodafone Idea there. But if you're looking at the sector, Reliance would be a better bet and Bharti Airtel a better bet. But Gaurang, Ajit, stay on. It's time for us to take a quick break, but we'll answer more stock queries on the other side. Stay tuned. Welcome back to Your Stocks on CNBC TV 18. We still have with us Gaurang Shah of Geojit Financial Services and Ajit Mishra of Religare Broking to answer all of your stock queries. Now, we have a more generic query coming in. Binny is writing to us from Mumbai with an investment query. He asks, which is the best stock to invest in with a horizon of 3 months? So he's looking at a very short-term period. Gaurang, I mean, he's willing to invest in any stock in any sector, but what would you say at the top of your mind would be the best stocks or the best sector to invest in at this point from a very short-term period, from a 3-month horizon?
Yeah, Andriti, for 3 months, I'm absolutely not qualified to comment, to be very honest, because, with the ongoing geopolitical situation, deficit rainfall, I think you are just taking a wild guess in terms of making your short-term profitable trades. It's extremely difficult to, for me at least, because I don't look at technicals. But yeah, from a long-term point of view, if you will, and if you are looking at maybe about a year and a half plus kind of time horizon, which I would advise this investor to have instead of having short-term because of the volatility in the market. And like I was mentioning, we were discussing banking, we discussed HDFC Bank, we discussed State Bank of India. So again, one name that comes to my mind from the private sector banks, which numbers were very good compared to Axis or HDFC Bank, is ICICI Bank. So Andriti, my advice would be to look at ICICI Bank. This is not a short-term advice, this is a long-term fundamental advice.
Long-term fundamental advice, ICICI Bank, the banking side is the name coming in from Gaurang. Better always to invest for the long term to get better compounding returns as well, and to avoid the volatility or short-term uncertainty. Ajit, your view, are they wanted for the short term? Your suggestions, short term, long term, we'll accept both.
So, Vinny, considering that the market, especially the index, is at least not offering a clear picture to what is going on in the market overall, means if you see that the mid-cap index have recently made a new record high, right? And then we have sectors also on the rotational basis, which have done pretty well, means the Nifty Metal have made a new record high, then auto did well in the recent past. So selective opportunity on the stock-specific front can still be explored, provided that you are a disciplined investor, means you can definitely maintain stop losses. Capital market theme wherein we have seen strong run up, be it BSC, Angel One. So the Angel One, I still feel that after almost 2.5 years of consolidation, the stock has made a new record high of late. So still we have opportunity of further up move from the current levels. The stock is currently quoting at 339. So with stop at 310, one can look to accumulate even at current levels with 380, 385 as the next 3 month of target horizon, so which is a decent upside of around 10 to 15%. So we stop at around 3 to 5%. One can continue to look to accumulate Angel One, and then we have Varun Beverages, in this consumption theme, wherein we are seeing after a long underperformance, the stock has witnessed a decisive break. It's still holding strong despite what's going on in the market. That clearly shows that maybe the stock is setting the pivot for the next leg of the up move. So here with stop at 490, one can accumulate Varun Beverages also with 575, 600 as the positional targets.
Okay, some of the names coming in there from Ajit on the technical front over there. Let's move on then to the next query. We have this query was written by Avinash from Bangalore. He is holding 1,440 shares of Yes Bank. Average buy price is 33.83. So obviously it's on that higher side. They want to know whether to hold or sell, get out, book the losses at current levels. Gaurang, your view?
Well, Vinny, things have changed for better, but consistency is something that we need to watch out for. And like Vodafone Idea, Yes Bank is also a counter which is extremely, extremely overcrowded, Vinny. A small move upside and you see, short-term, medium-term, long-term investors or traders rushing to the counter to take the exit route, which caps the upside. Again, no specific comment since we don't track Yes Bank as a fundamental investment idea. My sense is if you're looking at a small to mid category bank in the private sector universe, then Federal Bank would be a preferred destination for long term.
All right, so Federal Bank, a preferred destination in the long term. But Ajit, coming to you, what should he do with the stock? He is making a loss on it. So should he average buy price or he wants to know if he should sell the stock?
So Anti, in my opinion, he can continue to stay put. It's just that the upside seems capped, means close to around 24 we have the next hurdle, but once it crosses, then probably around 26 to 30 is something that stock might test. So as of now, it's a hold cause, the kind of price action that we are seeing, and probably a base formation around 22 gives us the comfort that the support is also nearby. So with that as a stop, you can continue to hold for 26.30 as a position targets.
Okay, we'll keep an eye out on the numbers over there for Yes Bank in terms of the levels. Let's move on then to the next query for today. This query is coming on Cummins. Yash Kapoor is writing to us from Odisha. It's an investment query. He wants to know whether he can buy shares of Cummins at the current levels. We've seen that, Gaurang, Cummins numbers, they were good. There was no complaining. Commentary came in as well. But some challenges were highlighted, right? Globally, what is going on? Export environment, that's a bit of a concern for them. What's your view? Cummins India, is that something you would look at given in this whole, power transmission, data center story? All that is a play and all these companies do benefit from this. But is that something you would be looking at?
Well, absolutely, Vinny. And we very recently come out with a fundamental buy coverage on Cummins India. Look, Vinny, for a sector like this and companies which are associated with these sectors, there would be short-term teething troubles. The short-term could be 1 month, 3 months, 6 months, depending upon the challenges that the sector and the company faces. But look at the opportunity from a long-term point of view. And I'm glad that this investor has asked a question when the stock has actually corrected, because after the numbers, I believe the stock did rally to a certain extent, and then now a phase of consolidation because of some short to medium-term concern. So if you're looking at long-term, yes, you can definitely go ahead and invest into Cummins from a long-term point of view. My only request, Vinny, is that start at current levels and add on dips. Don't put all your money at one time. You will get plenty of opportunities because of the uncertainty in the market.
All right, so add at current levels, but buy on dips as well as he goes forward. But Ajit, if you could tell us the levels that he should be watching to enter Cummins at this point, if he wants to buy the stock.
So, Arunti, post numbers, the move was almost vertical from 54 to 61. In the last two trading session, we are seeing a bit of a cool off. So probably this cool off may extend, considering the market tone is also slightly wobbly. So maybe in the range of around 5,400 is a good buy, the first tranche, and then gradually towards 49, 4,800. So not at one go, as Gaurang has rightly mentioned, accumulate gradually on dips.
All right, accumulate gradually on dips is the word coming in there on Cummins. All right, Ajit and Gaurang, we're completely out of time on the show, but thank you so much for joining us and answering all of our viewer queries. And a small programming note as we wrap up. Uncertainty in the market is rising given geopolitical and trade headwinds. We at CNBC TV 18 are featuring some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune in to CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amish Shah and Vikram Sahu. You can also catch macro and market opinion from Morgan Stanley's Chetan Iyer, Rhythm Desai and Jonathan Garner. Citi's Managing Director Sue Lee and CEO Jane Fraser will also be part of the blockbuster panels lined up only on CNBC TV 18.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Asian markets this morning have opened up largely mixed.
But I feel confident that he'll get to a deal that serves the interests of the American people.
The tone on China seems to be a lot softer now.
The first bell has gone. It's 23,700 on the Nifty.
There are some very real issues that India does need to contend with.
Has approved the company's drug Xenic or WCK 5222.
Well, the markets are looking to find some stability.
So for Bajaj Auto, largely in line.
Demand is not necessarily a constraint for us. It's a question of supply at this point in time.
A deficit of about 5 to 10% definitely in terms of the overall sale in terms of what we see.
Lows of the day is what we are seeing, a bigger cut on the broader market. So the mid-cap index is down 1%. Bank Nifty is also not doing so well.
Okay, well, that is the day so far, and it is not doing well. I think that last word which came through, we're down 150 odd points, so that bounce or whatever is not visible. I mean, we thought in the morning that perhaps after Friday's, what was largely a technical sell-off because of the MSCI rebalance, perhaps, we start a fresh week with perhaps a positive, slightly more positive Monday, but not to be seen. We started, I think, with a small downtick, and it's become a slightly bigger downtick now as we approach the last 60 minutes of trade. This is Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me my colleagues Reema and Nigel. Guys, hi, afternoon.
Hi, afternoon. So at the day's low now for the markets, 23,400 on the screen. And now we're gravitating closer to the lower end of the trading band, which we thought we had broken out on the upside just last week. This marks the fourth consecutive day of losses now for the market. Mid-caps is selling off sharply. The mid-cap index is underperforming with a cut of 1.25%. The advanced decline ratio is negative. And all the sectors, barring IT is the lone sector fighting for the bulls today. The Nifty IT index going strong with a gain of 3.5%. But look at the PSU banking index. That's down over 2%. The FMCG index is down 2%. Auto is down 1.5%. Realty is selling off very sharply. So it's not looking good. And crude prices have inched up even more. So when we started the show, the trading session, crude was around 92. Now we're at $94.50 per barrel. So that's not helping.
Well, that's right, Reema. Breadth of the market still not as bad as what the headline index is. You still have more than 1,000 stocks that are advancing. But important information coming in on Z out there with regard to that FIFA, getting the FIFA rights, I think, for the next few years, explains why that stock is now almost at the 100 rupee mark. I think the street was sniffing that when the stock was 80, 85 rupees or thereabouts. But now officially it's come about. They're partnered with FIFA to bring 39 global football events, including the FIFA World Cup 2026 that begins in the next few days. So that stock almost at around 100 rupees or thereabouts.
So would you pay how much? 100, 200, 300 for a month? I think people would, right? I don't know. But if Z, as Z says, that is the alphabet Z is going to be the home for all FIFA events, etc., is going to be this new platform. And it's if this is basically just Z Entertainment, the company using FIFA as an event to kickstart its, this new venture, or maybe try to revitalize its business, etc. It's a big one in that sense. So there is, of course, FIFA and the upside from FIFA, and I guess analysts will do the numbers in terms of what the last viewership was and how much they probably will be able to charge and what the overall revenues will be, etc., etc. But I think, the bigger story, of course, is going to be beyond this. Is this being used as a stepping stone, as a launch vehicle, as a launch event for maybe trying to do more stuff within Z, and especially that platform, which is Z. All right, well, that is Z. It's making a bit of a move, 6.5% higher. Let me just quickly run you through what's happening right now and what's coming up, basically. So we're, of course, off and down. Oil prices, by the way, have moved up over the last many hours. I think we're up about 3.5% over the last many hours or so. PSU banks, autos, real estate are dragging. IT index is up 3%. Metals are higher as well. Auto sales numbers have been coming through. So we'll get you some update there. Walcott, of course, big move last week, 7% today afternoon. So the FD approval finally coming through as well. Well, how should you position yourself? That's a question. Ashish Kayal is with us from Wave Strategy Advisors. Ashish, good to have you with us here. Good afternoon. What's the advice?
Afternoon, Prashant, and to all the viewers. If you look at the overall market index, I think Nifty has broken below the low of Friday as well, and that's not a good sign. And the selling pressure is not only limited to Nifty. We can see Bank Nifty also down by more than 1.2% right now. So the pressure is there, but Nifty has a multiple support zone around the area of 23,280, 23,330, and let's see if it can find some kind of a support there and show some stability around these levels. What is very interesting is that the mid-cap index touched lifetime high levels. Last week, small cap was on the verge of a breakout. So there is outperformance from the broader market, and that suggests that the broader market this time is outperforming rather compared to Nifty, barring today. Today, mid-cap is down by 1.5%, but generally what we are seeing is stock-specific action has continued, and then one should focus on the stocks in this kind of a market scenario rather than focusing on Nifty.
Okay. Got that. Then Ashish, give us the stocks that are on your radar.
The first stock on my radar is NBCC. We can clearly see the stock has formed a very clear higher high, higher low pattern. Past 3 to 4 days, we can see the volumes have spiked up significantly, and the stock is possibly starting its third wave higher. So NBCC one can create long positions for the target of 110, maintain a stop loss of 100 here. And the next stock on the buy side is Persistent Systems. This is after a long time we are seeing some mid-cap IT names that are now started buzzing again. So there is a possibility we can see a good reversal risk-reward setup here as well. Persistent Systems one can buy for target of around 5,800 levels. And on the downside, maintain a stop loss of 5,300.
Okay, got that. Let's talk about Walcott then, trading higher after the company got a nod from US FDA. Ekta now joins in with the details on this. Ekta.
Walcott has scripted a landmark moment for Indian pharmaceuticals, becoming the first Indian company to receive US FDA approval for a novel India-discovered antibiotic. The US drug regulator approved the company's antibiotic WCK-5222, branded as Zenic, for complicated urinary tract infections. The IV antibiotic used in hospital settings is designed to tackle multi-drug resistant superbug infections, one of the fastest growing global healthcare threats and a market estimated at nearly $9 billion globally. Zenic, which received fast track and qualified infectious disease product designation from the US FDA, secured approval in under a year after Walcott filed its application in the US. In India, the CDSCO also approved the drug last week following phase 3 data where Zenic outperformed the standard of care antibiotic meropenem. Europe has already granted the drug accelerated assessment status, and expectations are now building for a faster approval process following the US FDA nod. In terms of commercial potential, estimates suggest Zenic could eventually generate between $1 billion and $2 billion in annual sales globally, with nearly 40% of revenues expected from the US market alone. In India, analysts estimate the drug could generate around 150 crores in sales over the first 1 to 2 years. The drug has already demonstrated encouraging real-world outcomes under compassionate use programs, where nearly 85 critically ill patients were treated. The next trigger for the street will be commercial execution, including pricing, hospital adoption, and any potential out-licensing or distribution partnerships that Walcott may pursue globally. Zenic itself represents over a decade of research and clinical developmental work, with the program starting in 2011. Investors will now closely track Walcott's broader anti-infective pipeline, which includes 4 other novel antibiotic assets. These include Micnaf, which has already been approved and launched in India, Mroc and Mroc-O, which reported good growth in Q4, and Faviscu, where the phase 3 clinical trial has been completed. The approval of Zenic is now being seen as a significant milestone, not just for Walcott, but for India's ambitions in innovative drug discovery.
Okay, thanks Ekta for that. Well, let's welcome Gurmeet Chadda on the show. Hi Gurmeet, good afternoon. Good to see you in. Thanks for joining on the show. Well, you heard what Ekta had to say about Wockhardt. Any view on that particular stock? You started off with a 15% gain. Currently, it's holding with a gain of only around 5%. Do you all have any kind of exposure out here, or are you sticking to other pharma names?
So I think the Zenix news has been a key factor. Nigel, also, if you see that they've been able to do a lot of debt reduction as well. I think the PBT also improved. Operating margins, have gone up, and they, as Ekta was mentioning, they have 6 QIDPs approved with US FDA, and Zenix is the new one. Other than that, there are a few more names, and especially the oral respiratory segment is where they have a significant portfolio. So I think that the valuation is expensive now. Market cap is now upwards of 34,000 crores. I think the market would now want to see a lot of these approvals and how they translate into numbers. If there is any meaningful correction, then definitely we would like to add. For now, we have the portfolio Laurus, DVs, Newland. This is largely in the CDMO space, and branded generics. We have Mankind Pharma.
Okay, just want to quickly reference a note that CLSA put out earlier. This was on 30th May, and they've titled it, "How Much of the SaaS Apocalypse is Real?" Now, they're going back to the US earnings and earnings from companies like SAP, Snowflake, Salesforce, ServiceNow. And their key takeaway is that at least as of now, the numbers are strong and AI has not negatively impacted the demand or the outlook. So, irrespective of what the stocks have done, because stocks have gotten pummeled, but SAP maintained its full year guidance, at 12 to 13%. Snowflake raised it, ServiceNow raised it, whilst Salesforce has maintained it. So it's either maintained or it's a beat. And many of the Indian IT companies, remember, have partnerships with these SaaS companies. So they have across the board, but just to list out some, which is top of mind for the IT companies. So Infosys has a deep partnership with SAP, LTM has with ServiceNow and others. And CLSA says the SaaS companies roughly account for 10 to 25% of the overall revenues. And what the Indian IT companies do for the SaaS companies is product engineering and also help with implementation related work. So now that the SaaS companies' numbers are intact, the outlook is strong. The fear for the Indian IT companies, the fact that there will be business compression, at least for now, CLSA says could be a bit unfounded. And even what we had heard, that there were some project-specific delays in SAP for HCL Tech or Wipro, according to CLSA, could be more client-specific and not as an overall level. So I guess the key takeaway that CLSA is trying to say is that the SaaS apocalypse fear seems to be overblown. So that's the only news I could gather for the IT stocks. And IT is the only sector which is doing very well. Gurmeet, increasingly we are seeing capital being rotated back into SaaS software companies in the US and now even sporadically in the Indian IT names. The ferocity of fall seems to have stopped, and an odd day you've got a big up move in IT names. Do you think it's overdone?
So from a selling point of view, yes, looked a little oversold, because market tends to discount things both sides. But Indian IT has twin problems. One is, the AI narrative. The second is internal competition from GCC. So you got to be a little selective here. Even if you mentioned Salesforce guiding 10-11% constant currency, SAP guiding 12%. Our problem has been our constant currency growth and guidance has hardly been anything. It's been 1-2%, and it's been like 5-6 quarters. Even HCL, which was doing well, suddenly had a very very subdued Q4. So I think we are more focused on more IP driven names in this. We've added KPIT on those. We've been holding it for a time now. We did add a little bit in Persistent, but again, units run up a little bit. So we're more focused on mid cap IT names. Our universe in terms of tracking includes Persistence, Coforge. There's another company called Fractal Analytics, which I think is another very niche play. And we have KPIT. So these are the names we are more adding. And as a contra play, more from a tactical point of view, we have HCL Tech. But other than that, we continue to be still underweight IT. Our exposure would be sub 4% versus, let's say, a double-digit exposure to the leading benchmarks.
Okay, all right. Gurmeet, I wanted your view on Coal India. Let's run our viewers through why Coal India is actually excited in today's trading session. We just got the May numbers, and we know that, power demand had bounced back. And it's clearly evident in the offtake agreement, because The production is down by close to around 12%. That's disappointing in itself. But the street is looking at the offtake, which has grown by close to around 2%, and they're taking heart from that fact. The reason is that after many, many months, we are seeing a growth of around 2.2%. I'll tell you what, in March, it saw a growth of less than 1%. And this 2.2% is the best growth that we have seen on Coal India all the way since August 2025, when at that point of time, it grew by more than 5%. So after a while, we're seeing this sort of a growth on the offtake front. Remember, when I spoke to the management, they were talking about production growth of close to around 5 to around 6% approximately, and they were saying dispatches could even go up by close to around 10%. Now, as of now, that 10% seems very, very steep in terms of an ambition, but at least there's a bit of a turnaround coming on the offtake front. The second factor is there was an OFS, right? That was a big overhang when the stock went earlier as well to 480 rupees odd. There was a bit of an heads up that there could be a possible OFS. Now that OFS has come and it's out of the way. It was priced at a base price of around 412 rupees. And I'll tell you what the cutoff price was, both for retail as well as non-retail, was 447. So 447 is where you saw a lot of demand in comparison to the base price of around 412. So all those that subscribed, they are actually in the money and the shares have already been delivered to their account. And point number 3 is, you'll say that this production degrowth of close to 10% is worrying. But they have been indicating that the inventory levels had gone to more than 120, 130 million tons odd. And they want to gradually draw down on the inventory. So it seems it's more strategic in nature, focus on dispatches, use some part of the inventory and slow down in terms of production. Put all these factors together, a decent growth, OFS out of the way, and in fact, a more a calibrated strategy where they're focusing more on dispatches rather than production. It seems, for the time being, the street likes that. One of the outperforming stocks today. Gurmeet, what's your take on Coal India? It's knocked investors out cold in the past, actually. Whenever it promises something or the other comes and then, it disappoints. But this time around, they have got the tailwinds. Power demand is strong. They haven't grown for the last couple of years. In fact, there's a bit of a degrowth. 2021 to 2024 was good. Last couple of years have been disappointing. Lower base could help them as well. What would you do at 470?
So looks good, Nigel. And I think we got benefited through solar industries, where Coal India is one of the leading clients, more in terms of demand for explosives. I like the subsidiary of Coal India, the CMPDI, which is more like a consultancy firm, because that's more asset light. If you see the very solid return ratios, that we are sitting at almost at a cash of, I think, 1,500 crores, if I'm not wrong, which is like roughly 8-9% of market cap. And they also want to now diversify from Coal India, because 65% revenue comes from Coal India. The guidance is almost 30% PAT margin and 40% EBITDA margin. And that's about 24, 26 times kind of a multiple. So that looks like a play. But as Coal India unlocks more value, I think this coal gasification of 38,000 crore, I think, would be a big game changer for thermal power. I think the globe is underinvested in coal-based power because of the too much focus we've had on renewables. So pretty positive there. But as I said, looking at more asset light, better return ratios way of playing this rather than Coal India.
Asset light. There is a Coal India subsidiary, asset light. Gurmeet. What is it, Nigel? CMPDI. Which is like the EIL. EIL is oil and gas. CMPDI is coal prospecting.
Yeah.
I don't know if you've looked at it, Gurmeet.
So I mentioned that, Prashant, actually.
I see you did. Okay.
Yeah. I mentioned CMPDI in terms of looking that over Coal India in terms of playing this.
Yeah, just one more point. BCCL, the other one, the coking coal subsidiary.
Yeah.
All of the last 25, 30 days, everyone's been talking about international coking coal prices going up. And BCCL will be the stock to look at. They've come out with the production numbers. Take a look at the reaction on the stock price. No, not strong. In this sort of environment, if you can't push up the uptake, either there's a problem with the quality, that's why domestic consumers are rather importing, or in fact, you're struggling on the logistic front as well. Perfect scenario. And wham, bam, 6% down after seeing a big run. The stock was up, I think, 25% in the last 1 month or so. And then they come out with this sort of, numbers. But there's some important information on the bottom of your screen. Source-based information to money control. ASUS is looking to increase local sourcing of electronic components from its partner, Dixon Technologies. Interesting one out there. And the flashes are telling you the other part of the story. The stock has perked up a little bit. It was trading in the red, I think, a few minutes ago. So it's moved up a little bit. Gurmeet, what do you think? Dixon, a stock at 18,000. Everyone was excited about the tailwind of the EMS opportunity. At 11,500, you're interested, or still too expensive for your liking?
No, so we continue to hold, Nigel. Haven't added more. We did trim a little bit when the valuations became too stressed around 20,000 levels, but we haven't added more. I think, I think this looks like a very promising theme. There's another one we are looking at is Amber Enterprises. There is news that they may get a major mobile brand, and there could be more diversification which can happen. Also, the earnings have slightly disappointed across EMS, maybe with an exception of Sirma. If you see Dixon, you see a bit of Amber, you saw PG Electroplast. I'm not like, it's not an apple-to-apple comparison, but once valuation means lower earnings, that entire thing gets a bit of a derating happening. I don't think so there's any much change in the structural story. You will see more incentives through different versions of PLIs there. So we like Dixon. I think it's been a decent correction, but if it, let's say, goes in 4-digit, then open to add that as well.
Open to adding that as well. That is Dixon for you right now. 150 odd points lower is what you have at this point. MTAR Tech is down 8%. Basically, it's come off a little bit after a very, very serious rally that we had. I'm not sure if there's any news flow. This is, they do a bunch of things, but the last big leg up has been, of course, their agreement with Bloom Energy in the US. So I'm not sure there's any news flow there, but it's a very decisive 8.5% move down that we have on this one. One of the strongest stocks of 2000. I mean, it's up 200%. So far this year, just in 2026. Well, Gurmeet, thank you very much for joining us. Good speaking with you. We take a break. We are back. Aman Chauhan of Abacus Asset Managers on the other side. Stay tuned.
Welcome back. Let's go across now to Hormuz, who's joining in to decode the record FPI selling that we saw in Friday's trade. Hormuz, over to you.
It was an eye-watering number, maybe pun intended or not, but it was indeed a massive FII selling number that we saw on Friday. 21,105 crore rupees. That was the net sell figure that you saw on Friday. Of course, not entirely attributed to just plain FPI selling. Part of it, of course, was also because of the MSCI rebalancing, but that was, according to Nuvama Alternative, was only around $1 billion. So even if you exclude that number is still a very, very significant one as well. Now, it was on anticipated lines because most of the index heavyweights had seen a trimming of their weightage on the MSCI Standard Index, and they look at the outflows that they were supposed to get according to Nuvama on Friday. Bajaj Finance is around 204 million, and from most of the others, TCS, Infosys, M&M, HUL, the outflows ranged anywhere between 109 million to as high as 200 million for Bajaj Finance, and these were just 5 names out of the multiple whose weightages were trimmed on the MSCI Standard Index. Now, if you take a look at the instances that have happened in the past, Friday's instance, of course, was the largest in absolute number on record, but it's not for the first time that something like this has happened. Now, on the 4th of October, when just a week after the markets had made a top on the 27th of September, we saw selling of over 15,000 crore rupees. The 5th of June, over 12,000 crore rupees. That's exactly just a day after the Lok Sabha election results that you saw. And of course, on the 24th of March, with the height of the US-Iran tensions and of course the rising oil prices, also we have seen a sell figure of well over 12,000 crore rupees. Now, at this point, the markets have done precious little ever since they topped out in September of 2024. Based on that, the Nifty on a 1-year forward basis is currently trading at around 18.1 times, and that is well below its 5-year average of 20 times. It's not very often that you see the index trading at a discount to their 5-year average, but today it's that kind of a scenario that you are in. And we posed this question, this $1 billion question to Arvind Maheshwari of BofA Securities earlier in the day, that when will FIIs return to India? He sounded a more optimistic tone, saying that it is only a matter of time that they come back to India, and the current selling that you are seeing in the Indian markets is cyclical rather than structural. And he goes on to say that investors should not be pessimistic about the fact that FII outflows are going on to such an extent, on hope that there will be more reforms from the government, that along with the de-escalation of the tensions in West Asia and a potential valuation comfort as well, might just prompt FIIs to finally pour in some money again after this massive exodus.
Okay, well, Hormuz, thanks very much for that. Pretty interesting stuff. Let's listen in to BofA's view, right? This is Arvind Maheshwari on the FII view in India and what could revive interest here. Listen in.
It is a tactical retracement from foreigners, and we can see that, and with good reason. There are genuine problems that India is facing here and now. So the near-term pain obviously exists, but it seems more cyclical driven rather than a structural reassessment. So it will be a matter of time. Hard to say exactly when. But as the West Asia crisis starts to, it's already in the de-escalation phase. Yeah. And hopefully as it retraces and goes away, we will start to see interest come back into as people start looking at what next. Foreigners are using every opportunity they can to, and India has become a bit of a funding market. And where is all this money going and flowing into? Well, some of that is recirculating within Asia. So going into the AI thematic, which is at the front and center of all things equities at this point. So you are seeing a lot of that money going into Korea, Taiwan. There is definitely an expectation of reform building, and in fact there have been positive comments on how this government has actually navigated a very tricky situation that has, it's an external shock, and how the government has been nimble in taking steps. But there is definitely expectations of more reforms to come through. Taxation is one of them. We are fighting with one hand behind our back if you're a foreign investor, because most other markets that we compete with for capital have zero capital gains tax, and we don't. And that is something that we have to cross. The hurdle for a foreign capital to come into the country becomes that much higher. So there is expectation that something will be done on that front.
Okay, well, that is the BofA view. We'll get you more opinion. Aman Chauhan is with us. He's fund manager at Abacus Asset Management Manager. Aman, great to have you with us here on the program. Thanks for joining in. So just a quick word on the, this is, of course, a question, and probably you'll have to lean on your conversations with participants in the market, etc., to figure out what happened. Friday, of course, was a big sell day. Today, we are kind of sort of seeing a follow-through day with some pressure. I mean, is this just sort of plain vanilla at the margin? Oil prices are up a little bit kind of reaction that we are seeing? Or as Arvind, I don't know if you heard him say that, we continue to see India being used as a bit of a funding market to buy into other markets around the region, Japan, Korea, etc. I mean, Taiwan and whatnot. What's your sense?
It's combination of all. It's not just funding market. What is also happening is that investors chase returns, right? So right now, the AI trade is making tremendous kind of returns for the investors, and that is where bulk of the interest is. Even if the money is not moving on a news flow basis, if you want to track 5 markets, the 5 markets will be AI-driven markets, not India. So that's, can say, very little interest of fundamentally driven incremental money flowing into India, right? Everybody is, and a company like Dell at that scale and size can give you a 3x return in 3 months, then you see that's where bulk of the interest is. So that is one thing. Second, markets have bounced back enough. So you can say bulk of the fall in crude price is already discounted. Crude is still 90 plus, but market is already discounted, is coming to 80s, right? So now we need next big trigger, which is still some time away. So there have been the chatters of the income tax thing. There have been some chatters. The government will take some policy. Unless and until we see a meaningful policy, there is no incremental now trigger for the markets to move. So domestics have bought what they have wanted to in the month of April and some bit in May also. But now we're waiting for the next trigger for you to deploy further capital. Also, the IPO and the QIP market have also opened up. So you see 2-3 PE deals coming in where they wanted to offload something. IPO market has started to open up. So good amount of liquidity moves there also. So that's what the liquidity situation is. You need a decent amount of inflow for markets to move further from here.
And talking about that inflow, Aman, are you seeing some fatigue setting into retail money, smart money, HNI? And now for the first time, we've seen the SIP stoppage ratio exceeding 100%. So more SIPs were stopped compared to the new registrations. At some point, you're going to say that this is not earning me any kind of money. At least an FDI will get 6-7% return. Is there some fatigue setting in?
In the near term, could be 3-year SIP returns is mid-single digit, which is somewhere comparable to the FD return, right? So you need some trigger for the market to deliver decent return. There's enough liquidity. It's just a matter of conviction, trigger, news flow, or that excitement that somebody needs, right? So I'm not saying there is no liquidity in the market. There is enough of liquidity, there is enough of interest. Right now, it is not channelized towards Indian equity. It is not channelized towards what the market wants it, but it can come back. So just waiting for the right triggers is what I'll say. And hence, yeah, fatigue is also there because market is oversold. You bought into it. Now what? That's what the question we don't have an answer to.
All right. Hi, Aman. Good to see you in, Aman. What about the capital market themes? That's on your radar as well. You have these listed companies, MCX, BSE, all of them have done very, very well. That's a theme you'll continue to hold on to, or do you think it's running a little bit ahead of itself?
We are holding on to it. Yes, on the valuation side, they are now almost closer to fuller valuations, but now we are playing for the earnings growth. So as markets keep on expanding, the earnings growth will keep on expanding. So I believe bulk of the PE re-rating could be behind us, but still we can capture the earnings growth from here on.
What about some of these material players? In the past, you'll have latched on to Welspun Corp. And in a market that's been wobbly, that's given you 50% returns, I think, in the last 1 year or so. You'll have been a little ambitious. I think JTL is another one that you'll have gone in there and try to see whether the cycle is bottoming out, because these stocks have taken a sharp knock. The leader itself has pulled back so much. That's APL Apollo Tubes. Tell us a little about this theme that you're like. One is the oil and gas maker. One is the other play on construction, and other products.
So two things on play here. One, we like the metal space overall. So you guys will be aware we have worked with metal since multiple quarters now, and that stance continues. Second, with this oil shock and the Middle East shock coming in, the capex for the oil and gas, which is definitely going to see a fill up, right? So
many of these companies have also gone beyond India. So they have capacities in America, they have capacity in Middle East. That is also going to see good amount of traction coming in. Plus the domestic capex is going to go up. Plus, when the metal cycle is positive, you tend to build inventory, right? Rather than destocking, there's a restocking that keeps on happening, and that helps benefit these companies. In a rising metal scenario, you have a scope to make better margins also. At least you have the possibility to do that. So multiple factors at play. And most of the names that we own would be sub 20p. APL Apollo would have corrected, but that is a 50p plus stock. So there's some derating there. That money could be moving somewhere else. So for us, it's a combination. It's a combination of positive macros, positive even metals, plus decent valuation for the companies that we own.
Okay. All right. So you don't think it's yet time to get off the metals momentum rally, right? You think there's still more in store, going by what you're saying?
Yeah, we're still positive on metals.
All right. The other theme that has become a little debatable is EMS. We had some positive news flow on Dixon. The stock has spiked up a little bit. But EMS, 24 months ago, the entire setup was totally different. Everyone was talking about giving it a higher multiple. They're going to grow by such a large extent. Suddenly, that story has gone a bit wrong. And these stocks have pulled back, 30, 40, 50% as well from the recent peak. What is your view on that theme post the recent correction? Now they have a lower base to contend with. Hopefully things are improving. There'll be some PLI benefits as well that will start trickling in for select names. And their working capital days as well should actually improve, aiding some cash flows. Your view on this theme, has it corrected enough or still too frothy the valuations are?
I don't think valuations are frothy anymore. So definitely there are pockets of opportunities here. In the near term, many of these companies got impacted because of input raw material cost and because of plastics going up or gas prices going up, something like that. That soon should be behind us, right? From that perspective, they'll have a favorable base 1 or 2 quarters down the line. And hence, that theme looks interesting to us, right? So we have some exposure here and have a positive view.
Positive view on the EMS space. Well, Aman, thanks a lot for joining in. We'd like to push you a little bit on names, but we'll let you go for now. At least we've got the themes out of the way. EMS, metals, a couple of other sectors as well that are quite positive on. Thanks for joining in.
Thank you.
Well, let's take a check on the F&O market. Well, today will go down as a bit of a disappointing trading session. When in the first 10 minutes, you're up 150 points, and you're going to be in all likelihood end with a cut of around 150 points, you'll be a little bit disappointed. And the intraday chart will tell you the story with regard to the Nifty. Hopefully, there is some recovery in the last 30 minutes, but we're down more than 150 points. Now, the PCR has moved to the lower end of the band. Remember, at around 0.6, 0.64 odd, there's a bit of a bottoming out process that takes place. Last I checked, it was around 0.69. So we're closer to the lower end of the range. And the reason is these call writers, they come in there. They believe that, in fact, this market is going to actually crack down further from here on. Because the 23,600 call, the premium out there has come down to 32 bucks. I'll tell you what, when we left off on Friday, the premium was more than 200 rupees. So writing is seeing at those levels. 23,500 call as well. Take a look at the premium. 282 rupees has become close to around 52 rupees. So that's the kind of writing that you've seen. So these call writers believe that this market can't get past the 23,800 odd mark. But the important support which we're approaching, which is 140 points away from those levels, is at 23,250. I say that because in May, a couple of times we went to the vicinity of around 23,250 to around 23,300, and from there we saw a bit of a bounce. So that's the crucial mark you want to defend on the downside. On the upside, the 20 DMA, the 50 DMA, both of them are going to be a strong resistance zone out there, because today as well we visited that mark, and from there we did sell off. So that chart that is telling you that those lines, the green as well as the orange line, they're going to be very, very important in terms of a resistance mark. But individual stocks are doing a thing of their own. Coal India, in this sort of a market, the stock is up close to 3%. There was a lot of shorting awaiting that OFS. Some of the shorts seems to have got stuck out there, because there is a bit of a short covering bounce. There is fresh buying that we're seeing in the cash market, backed up by some open interest build up as well. So that stock I'll be keeping an eye out on, because it's looking quite good, in fact, with regard to the fundamentals as well. HCL Tech, that's coming for a bit of a short covering bounce. These are stocks that have seen a very, very sharp correction from the top. Now there's a bit of a bounce playing out there. And on Suzlon, the stock is down, but there appears more amount of unwinding of positions being seen out there. Last week, it did a quick 10% move, and from there, it's seeing some unwinding, as is the case with Tata Motors as well. Good uptake is what we're seeing, some unwinding of positions on that stock as well. So a weak trading session, it'll go down as a disappointing one, but the bulls will hope that this 23,250 mark serves as an important support, and we see a bit of a bounce from there as well. Time to slip into a short break. Come back. As always, we'll get a check on dealing rooms. Nimesh is waiting for us on D Street Chatter. Our technical experts will also be joining in. Stay tuned. Well, there's some cutting of losses that's taking place as we speak. HDFC Bank, I think we should pull up the intraday chart out there because that's trying to cut its losses, which has helped the Nifty pull back 20-25 points or thereabouts. It's trying to move into the green, as is the case with Kotak Mahindra Bank as well. The stock was down 2.5%. Now it's down 1.7%. The metals pack continues to do quite well. So minor pullback, but otherwise it's a disappointing trading session. But if you want more information, I'll tell you what we do. Let's go straight to D Street Chatter. Nimesh joins us to help us out in terms of what is he picking up on dealing room action. Hey, Nimesh.
Hi, Nigel. Disappointing day of trade, except for IT. Large part of the market is under pressure and a bit of profit booking across the board. Whether it's the broader markets, whether it's Bank Nifty, we've seen a bit of selling pressure today. IT stands out. The index itself is up another 3%, and looks like there is a bit of not only fresh buying but covering as well in some of those IT names in today's market. From a flow perspective, again a sell day, not as big as what we saw on Friday. Friday was an aberration because of the MSCI rebal. But even outside of rebal, there was a bit of selling pressure in the large cap names. Today seems to be a sell day, but at the same time, there is a bit of buying as well in some of the select PSU names in today's trade from the large institutions. Looks like 23,300, 23,350 is acting as a bit of a support for the Nifty, and we've seen a bit of a pullback as well in the last few minutes of trade. So that's a level to watch out for on the downside. But from a tactical point of view, watch out for the PCR, which has now fallen below 0.7. Typically around 0.65 is a bit of a pullback. But from a flow perspective, it's still a negative day and selling across the board, whether it's financials or the broader markets.
Nimesh, in terms of individual stocks, what's on your radar?
Well, so the first stock is Sikagal India. Well, the stock has been consolidating of late. The seed is anticipating some corporate development very soon. A potential small monetization could be on the cards for this company. So watch out for that in days to come. The second stock is NBCC. In a weak market, that's been buzzing in trade, large volumes as well. My sense is the management is doing a roadshow and meeting a lot of larger investors. And the city is anticipating that the company is likely to back some large order wins very soon. So that's the trigger in NBCC. The third name is True Bio. Again, a stock which has been consolidating in a very narrow range for the last couple of weeks. But even in True the city is anticipating some corporate development. A small minority stake sale to an MNC is on the cards for True. So that's the buzz there. And the last is Oil India. As I said, some bit of buying by PSUs. Oil India stands out in terms of delivery-based buying by larger institutions today. So expect high delivery volumes on the buy side in Oil India today.
Got it. Okay. All right. Thanks a lot for that, Nimesh. Well, let's hop across to Ashish Kyal, who's rejoining on the show. Ashish, the call on the Nifty, 2 days when you pull back, I think now around 550 points approximately. Do you think you would want to fancy a buy call, or do you think that this market is breaking down? And also fill us in with your calls, stock-specific action.
Hi. See, if you look at Nifty, I think there is multiple support zone near the levels of 23,330 and 23,300. So going below that, as of now, looks unlikely, but it has to happen. It will happen with a gap. So as of now, and there is no positive price action. So my take is going to be, if I have to sell this market, I'll not sell here. I'll sell on pullback for a better risk reward. So if we get Nifty around back towards 23,500, 23,520, looks unlikely as of now, but maybe tomorrow if we get it there, then sell it again for the levels of around 23,330 levels. That's the risk reward, which is good. And from a stock specific, action has continued, as I mentioned earlier also. The pick is going to be Tech Mahindra. We can clearly see a very strong breakout on the upside in Tech Mahindra, forming a triple bottom pattern. And one can create long positions here, aiming for the target of around 1629. And one can maintain a stop loss on Tech Mahindra at the level of 1497. And the next stock also on the buy side, I'm keeping a very close watch on Anantraj over here. We can clearly see the stock is attempting to give a good move on the upside. The volumes have started picking up since today morning itself. So there is a possibility we can see some positive traction in tomorrow's session. So it can be a BTST call. One can create long positions in Anantraj for the target of around 580. One can maintain a stop loss on the downside at around 515 levels.
Okay. All right. Thanks very much for that. More later, Ashish. Well, later in the evening today, the Ministry of Statistics will release the first data on their revamped IIP or Industrial Output series. Lata is here to tell us what to expect. Lata, take it away.
Well, in the light of GDP and other series CPI being revised, the IIP, Index of Industrial Production, that's the full name of IIP, that's getting revised. The new base is 22-23. It used to be 2011-12. Now, when you revamp, you also do other things. And this committee, led by Professor Mridul Sagar, who was formerly with RBI, they have included minor minerals, rare earths, gas supply. Originally, only electricity was there. Gas supply, water supply, sewerage and waste management, because all these are important activities which have picked up after the 2011 series. They've also revised items and weights. Removing outdated ones. See, you remove tube lights and add in LED. things like that. What you use now, instead of, you remove old telephones, landlines, and replace it with smartphones. That kind of removing outdated articles and giving different weights. Food is a lower weight, and consumer durables could be a higher weight. The revised basket contains 1,042 products. They're also more granular. Everything is an index, okay? They don't tell you how much is produced. Everything is indexed to 100, and then it increases from there. So there are sub-indexes like how much of renewable power, how much of non-renewable power. In the previous index, old index, we only had electricity. Now we have a sub-index. Likewise, there are sub-indexes in others as well. They've also removed closed factories, or factories which were producing something else are now producing something else. So all those revamping has been done. New large-scale, new factory setup have been included. And then they've used the geometric mean method, we needn't go into the details, to backcast the 2011-12 series so that we can have a comparability. And today's release will give us data from April 2023. So it's not that they impose a new number for June 2026 and we don't know whether it's good or better or worse than previous. You're going to get a 3-year series. So we will well know whether we have done better in April 2026 from month ago levels, year ago levels, and last 3-year average levels. So that's a very, very useful way of presenting the new data. The other reason why IIP is important is that it's an input into GDP. So obviously of national importance.
Thanks a lot for that, Lata. Well, let's focus on the key cue that we're getting today. That's the auto sales data for the month of May. Sudarshan has been a busy man all through the trading session. He's here to give us a complete roundup of all those that have reported. Sudarshan?
So it's been a mixed trend that we are getting from auto companies for the month of May. If you talk about two-wheeler sales are looking largely in line to slightly better than expectations. For passenger vehicle, on the low base, all the companies, most of them are seeing a healthy growth, especially Maruti Suzuki and Mahindra & Mahindra. And if you talk about tractor segment, more than the numbers for the month of May, what is important for the sector is the outlook. And Mahindra & Mahindra has maintained the outlook that it had given for the industry of mid-single digit growth. But talking about the company in the details, starting with Bajaj Auto, for export, company continues to maintain the monthly run rate of more than 2 lakh units. Even on the domestic front, it has seen a growth of 10%, largely in line with its guidance. For TVS Motor, it was an all-round beat. All the segments have seen healthy growth of more than 30%. For EV, it was highest of monthly sales, and the growth here is almost 56%. If you talk about Eicher's Royal Enfield, again, here also, sales were largely in line. It was at 1.03 lakh units versus our expectation of 1 lakh units. One segment that continues to do well for them is segment up to 350cc, where company has seen growth of almost 19%, while segment above 350cc has seen a decline. Talking about the four-wheeler, especially passenger vehicle segment, Maruti Suzuki has seen a huge growth on the low base. Entry-level segment has seen growth of almost 140%, and SUV, or say utility vehicle sales too, have seen a growth of almost 44%. For Hyundai, it was slightly lower than expectations. Both the segments, domestic as well as exports, have done lower than expectations, and total sales have increased by 4%. For Mahindra & Mahindra, both the segments have done better than expectations, and company has maintained the outlook both for SUV as well as for the tractor segment. Coming to Tata Motors commercial vehicle, sales were slightly below expectations. Total sales have increased by 17% versus our expectation of 24% increase. Ashok Leyland was the biggest disappointing this month. It's the only one company that has seen a decline in the sales, while all the other companies have seen a growth. Total sales for Ashok Leyland have declined by 3%, and the culprit here is that all the other segments except LCV. So LCV, if you leave aside, all the other segments have seen a decline. So we'll have to see how the next few months pan out. But overall, the numbers for the month of May were largely mixed.
Thank you very much for that. Amrish Barika is now joining in on the show. Amrish, thank you very much for joining in. Let's begin with the stock that you like right now, that you're recommending, and then we'll get to others.
Yeah, my pick is Thomas Cook, which is anyway a well-known brand in travel and financial services, with businesses spread across holidays, foreign exchange, hospitality, and destination services. Other than Thomas Cook, they have brands like SOTC, Sterling Resorts, and DEI, which covers leisure holidays, corporate travel, meetings and events, visa services, destination management across India and overseas markets. Operations are across 28 countries, and they service both physical and digital channels, and have about 6,500 partners. Travel and resorts contributes majorly to the top line, whereas Forex business contributes to the margins, because the margins are very high out there. And that's, this business also has a decent amount of moat. continuously introducing new products in travel like Bhutan charter flights and Kailash Mansarovar tours. Sterling Holidays, which is a wholly owned subsidiary, is expected to demerge and list separately. So I think this should be shareholder wealth accretive over the next year and a half. And hopefully travel and tourism should improve once the US-Iran accord is done. So my expectation of FY28 EPS on a consolidated basis is ₹7. And with this, I think the target price should be 126.
Amrish, do you have a view or ever looked at names like TBO Tech or Rate Gain or any of those? There are some OTAs like Ixigo, etc. out there as well. Yeah.
No, in fact, I've not looked at them in depth. Overall, had a look, no doubt. And surely, just like the other travel companies, including, Thomas Cook I'm talking about, all of them have been affected because of the expected lower travel happening because of the geopolitical issue. But I think once the accord is done, all these stocks are going to fly.
Yeah, I think fair enough. TBO, of course, is below the listing price. I'm not sure the IPO price, but it definitely is below where it listed at. That's the name. We'll take a quick commercial break here. With the other side, we'll wrap up things for you. There's about 6 minutes to go for market closing.
Welcome back. Well, we're still going to be going home with a sharp cut of around 170 to around 180 points. Amrish Balika is still with us. Amrish, I wanted to ask you about a couple of stocks. We had Jinesh of PL Capital who joined us earlier today. And we asked him about, we spoke about Interglobe Aviation and what are the other picks. He spoke about VIP as well as Safari. And today those stocks have reacted positively. I'll tell you what, they've seen a sharp correction from the top. But the point that Jinesh made was that, margin recovery should improve. And post the correction, valuations are pretty okay. Would you buy into either of these names, VIP or Safari?
I would prefer a Safari because that's consistently done better. And as far as VIP is concerned, again, the management is not a promoter management, but it's more of an investor management. So I would be a bit careful as far as VIP is concerned, although the stock has performed at least in the last couple of days. But from a longer perspective, I would prefer to stick to Safari.
Okay, got that. Amrish, your view on the auto sales numbers that have come through?
I think, the numbers were decent and clearly, I think it shows that uptick for EV And what I've been saying in the recent past, I'll again reiterate that what demonetization and COVID did for digital transactions, I think this energy shock due to US-Iran war will do for EVs. And we were looking at the inflection point. I think we have come close to that. I think over the next couple of months, you'll keep seeing that the percentage of EVs will move up much faster than what we have seen in the last 2 to 3 years. And you just look at the Tata Motors EV numbers. I think for the first time, they've crossed that 10,000 mark.
So what would you bet on? If you believe that EV is at an inflection point, would you go with an Ather, Ola, or would you just bet on Tata Motors passenger vehicles because it encompasses EV?
I know when you talk of two-wheelers, I would surely look at Ather. And those who can possibly take a higher risk possibly could look at Ola. And as far as passenger cars are concerned, yes, I think Tata Motors PV would make sense.
Got it. Okay. All right. Qadar, Amrish, thanks for joining and giving us that call on all those stocks. By the way, keep an eye out on Rain Industries. That stock continues to move from strength to strength, even in today's trading session. It saw an intraday dip, but those dips are getting bought into and volumes are very, very high over the last 1 week. Rain Industries is the stock that we're talking about. Let's wind this down then with, what went on in today's trading session. Disappointing day. The Nifty goes on with a cut of 160 points, following up the big fall that we saw on Friday. The Nifty Bank, even more disappointing, down close to around 600 points. The FMCG names came in profit-taking, HUL, Tata Consumer, ITC. The top losers from the Nifty pack itself. On the flip side, what helped us today was the tech names. Tech Mahindra was up 3.5%, Infosys was up in today's trading session, and TCS as well did quite well. Mining and metal stocks, well, they in fact supported the Nifty as well. You had JSW Steel that was up and about in today's trading session, and Coal India as well did pretty well. What else? Some of those textile-related names did well. Welspun Living was up close to 5.5%. From the pharma pack, you had Boca that was up close to around 5%. And, a couple of other notable movers in today's trading session was Lloyd Metal. I'll be interested to see, if there is any name that comes out today. There's the largest trade that took place in the initial part of the trading session. So we'll wait by to see if there are any disclosures. Inox Wind was down close to around 10%, reacting to its numbers. Bharat Coking Coal, well, that stock has seen a big rally. It came in for profit-taking today. The main numbers were quite disappointing out there. And Delta Corp continues to see selling pressure. That was down close to around 6%. IRDA, the management sounds confident about the way ahead. But for today, the stock ended with a cut of around 5%. And Ola Electric, it saw a big run-up, anticipating good numbers. Well, the numbers were as good as what the Vahan data suggested, but it's still a far cry away from the kind of numbers that we have seen in the past. So the street sold into the stock. Tilaknagar Industries as well was down close to 5% in reaction to its numbers. Net, a disappointing trading session. Number of stocks advancing were just around 1,000. Advanced decline ratio was one stock that advanced for two stocks that were declining. Monday starts off on the back foot. Let's see whether or not the bulls can fight back from here. We'll wrap up on this edition, though, of Closing Bell. You don't go anywhere. The team of Markets Forward is waiting for you on the other side.
Market fails to hold, opening gains ends at the day's low. Nifty below the 23,400, dragged lower by banks. Mid-caps underperform.
Automobile sales top street estimates in May. Passenger car sees robust domestic sales growth on the back of a low base. Commercial vehicles underperform. Tractor sees strong growth and positive trends ahead.
Walkout leaps after the US FDA approves its novel antibiotic Xenic for urinary infection. Estimates suggest that the new drug could notch sales of over $1 billion a year.
Good afternoon and hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vivek Iyer and today with me is my colleague Vinny. Good afternoon, Vinny. Well, we've actually seen quite a bit of a disappointing day as far as Street is concerned. We saw record FI selling figure on Friday and we were hopeful that we would see a bit of a bounce back after the MSCI selling got absorbed. But despite that, what we've actually seen is some follow-on selling. The Nifty down by over 160 points. The Bank Nifty down close to 600 points and broader markets too falling in tandem with the benchmark indices.
Hi, Vivek. Absolutely. The broader market fall, that was also quite sharp in today's trading session, right? 1.5% decline for the Nifty mid-cap as well. And advance decline ratio obviously was in the favor of declines versus advances through the day as well. Advances were just about 1,000 stocks versus declines of more than 2,000 stocks that we saw coming in on the NSE side. While apart from that, IT, that was just that bright green spot that was in the trading session today in terms of sectors. Media, that also managed to hold on to some bit of a gain. And interestingly, what picked up pace today was Nifty Metal. When you look at it, it was in the red at one point of time, and then we saw good recovery sustained through the day as well. 0.5% of uptick that we saw coming in for the Nifty Metals. But Nifty, that didn't hold on to gains, like we said as well. Not a good day coming in for the markets. We are closing at around 23,381. Around that is what the Nifty is at. But let's move on and talk about what's on the show for you all today, right? And we have a very exciting lineup for you all on the show today. First up, we have a lineup where we will start with the top movers and shakers of the day with Hormuz Fatakia. We'll also decode Walkart's rally post US FDA's nod and break down the auto sales numbers for May and analyze textile stocks that are there as well. And those were the big movers. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session.
Well, now on to our first segment of the day. Hormuz Fatakia is standing by the big wall with all the top movers and shakers of the day. Hormuz, a bit of a disappointment, red dominating.
A forgettable day indeed for the bulls, and red predominant over green in today's trading session. You take a look at the heavyweights that pulled the Nifty down today, and ICICI Bank was among the top contributors to the downside, with L&T, M&M, HUL, Bharti Airtel, all of them contributing, seeing losses of anywhere between 1% to as much as over 3%. So HUL continuing to see selling in today's session as well, even after the MSCI selling that took place on Friday. Now, the only sector that lent support to the market today, and it was only because of the 3% odd up move that you saw in IT that you managed to see this kind of fall on the index, else it could have been far worse. Almost every constituent of the Nifty IT ended with gains in today's session, gains ranging anywhere from 3% to as high as 4%. The last bits of earnings that trickled in on Friday and over the weekend, you see the impact on those as well. Inox Wind was the casualty of the day, 10% lower on that stock. The other casualty was JM Financial, another 9% knocked off in today's session. On a positive earnings reaction on NMDC Steel, 13% higher on this demerged entity of NMDC. And IREDA, after its results, 6% lower on the stock. At one point, it had a record high of well over 300 rupees, now at 125. You take a look at the newsmakers in today's session. Zee Entertainment's official announcement with FIFA finally came in just before closing, and the buy the rumor, sell the news theme played out perfectly for this stock. The stock cooled off from the highs of the day and ended 3% higher. Aditya Infotech continued its winning ways, was up 10% on Friday, adding another 8.5 today. Infosys, of course, among the top gainers on the IT pack, and of course Ashok Leyland after its auto sales figures, ending among the top losers on the Nifty Auto Index. And lastly, stocks at 52-week lows in today's session. ICICI Prudential is at a 52-week low, still managing to hold above its issue price. United Breweries, RVNL, SBI Cards, and a name as big as ITC2 ending at a 52-week low in today's trading session.
Well, thank you so much, Hormuz. The day dominated by the color red, as you just rightly pointed out. But moving on, it's a shot in the arm as far as Wockhardt is concerned. The stock soared nearly 7% after it got the US drug regulator's nod for its novel antibiotic Xenic. Ekta Batra joins us to decode what this means for the company.
Wockhardt has scripted a landmark moment for Indian pharmaceuticals, becoming the first Indian company to receive US FDA approval for a novel India-discovered antibiotic. The US drug regulator approved the company's antibiotic WCK-5222, branded as Xenic, for complicated urinary tract infections. The IV antibiotic used in hospital settings is designed to tackle multi-drug resistant superbug infections, one of the fastest growing global healthcare threats and a market estimated at nearly $9 billion globally. Xenic, which received fast track and qualified infectious disease product designation from the US FDA, secured approval in under a year after Wockhardt filed its application in the US. In India, the CDSCO also approved the drug last week following phase 3 data where Xenic outperformed the standard of care antibiotic meropenem. Europe has already granted the drug accelerated assessment status, and expectations are now building for a faster approval process following the US FDA nod. In terms of commercial potential, estimates suggest Xenic could eventually generate between $1 billion and $2 billion in annual sales globally, with nearly 40% of revenues expected from the US market alone. In India, analysts estimate the drug could generate around 150 crores in sales over the first 1 to 2 years. The drug has already demonstrated encouraging real-world outcomes under compassionate use programs, where nearly 85 critically ill patients were treated. The next trigger for the street will be commercial execution, including pricing, hospital adoption, and any potential out-licensing or distribution partnerships that Wockhardt may pursue globally. Xenic itself represents over a decade of research and clinical developmental work, with the program starting in 2011. Investors will now closely track Wockhardt's broader anti-infective pipeline, which includes 4 other novel antibiotic assets. These include Micnaf, which has already been approved and launched in India, Mroc and Mroc-O, which reported good growth in Q4, and Faviscu, where the phase 3 clinical trial has been completed. The approval of Xenic is now being seen as a significant milestone, not just for Wockhardt, but for India's ambitions in innovative drug discovery.
Thank you so much for that, Ekta. And that is why we've seen Wockhardt was in focus today, buzzing in trade today. But to take the discussion forward, let's bring on board our experts for today. We have Jay Thakkar from ICICI Securities and market expert Amrish Baliga here with us. Amrish as well as Jay, thank you so much for joining us on the show as always. Before we talk about Wockhardt, Jay, I want to talk about market levels, right? By the end of the day, we actually ended up closing at the day's low. 23,381 for the Nifty. Bank Nifty also seeing a very sharp fall coming in. What are the levels that one should watch out for in tomorrow's trading session? Where is the support now for the Nifty as well as the Bank Nifty?
Hi, good afternoon to you, Vinny, and to you, Vivek. Since last week, we have seen this selling pressure rather increasing in the Nifty. We did see, yes, there was a huge selling by the FIs on Friday on the MSCI rebalancing day. And, we had seen a breakdown clearly happening in the last hour of the last trading session, and which continued in today's trading session as well, Vinny. And now I think that on the upside, any reversal, if it has to happen in the June series, it has to happen above the levels of 24,000. I think only beyond those levels it will be confirmed that the short-term correction or this consolidation, the ongoing consolidation is over. Now on the downside, the immediate support is at around the levels of 23,000 to 23,100 from the derivatives perspective, wherein we have a good amount of put open interest as well for this series. The cumulative put stands at 23,000 levels. Also, the gap area for the Nifty is at around 23,150. So if at all Nifty has to fill that gap now, after this, huge sell-off and a breakdown, clearly it has to take support around the levels of 23,150 to 100. So hence, I think we need 23,000 to 23,100 will now act as a very, very critical support level. If those levels are held, we may see a Nifty bounce back from those levels. Failing to do so, I would fear that it might just slip towards 22,500 as well. However, until then, 23,000 to 24,000 seems to be a short-term range for Nifty. The positive thing, Vinny, in this recent fall, I would say what is the positive thing is that we haven't seen the crude oil spiking much. So that's not a worry as of now. We haven't seen the rupee depreciating again, and we haven't seen volatility index, sharply bouncing.
Right.
So all of these three things seems to be in control. Hence, I think 23,000 levels should hold on.
Okay, Jay, thank you so much for your view over there. Amrish, coming across to you, when you're looking at one particular sector that stood out today, it was the IT pack. So many worries, so much valuation destruction that you saw in terms of multiples. But now, certain voices are indicating that maybe the threat of AI could be overstated. Within the IT pack, do you like any names or will you stay away at this point of time?
To more or less stay away at least for the next 2 to 3 quarters, because whatever said and done, I think AI issue will continue to haunt the IT sector for a while. And at the same time, we need to also see as to how the order flows pan out, because the management commentary overall hasn't been too great. And even when we start looking at the IT stocks, it will be more on the mid-cap side than the large-cap ones, because I really don't expect the large-cap ones to utilize AI, as fast and as quickly as the mid-cap ones.
Mm-hmm. Point taken there, Amrish. But let's move on and talk about the auto pack, right? You had the May auto sales numbers that came in as well. PVs, CVs, what did well, what underperformed. Let's go across to Sudarshan, who's here to take us through those details. Sudarshan.
It's a mixed picture as far as auto sales for the month of May are concerned. So starting with two-wheelers, most of the companies have reported sales that look largely in line to slightly better than expectations. For passenger vehicles segment on the low base, most of the companies have reported a healthy growth. And for tractor segment, more than the numbers, what is important is the outlook. And Mahindra has maintained the outlook of mid to high single-digit growth as far as the tractor segment is concerned. Mid-single-digit growth, basically the guidance was for industry. Now starting with the company Bajaj Auto. On the export front, company continues to maintain the monthly run rate of more than 2 lakh units. Domestic segment has seen a growth that was largely in line with its guidance. For TVS Motor, it was an all-round beat. All the segments have seen growth of more than 30%. EV was the standout, where the growth was as high as 56%. Now coming to the passenger vehicle, in the two-wheeler segment also, Eicher Motors Royal Enfield, sales were largely in line. Total sales were at 1.03 lakh units. And one segment for Eicher Motors Royal Enfield that continues to do well is the segment up to 350cc, which has seen a growth, but segment above 350cc has seen a decline in the month of May. In the passenger vehicle segment, Maruti has seen a huge growth for entry-level segment. On the low base, the growth was as high as 140%. Even SUV has seen healthy growth of 44%. Hyundai sales were largely below expectations. Both the segment export as well as domestic have disappointed, and total sales have increased by just 4%. For Tata Motors passenger vehicle segment, numbers look largely better than expectations. EV was standout, where the growth is as high as 85%. Now in the commercial vehicle segment, before that, Mahindra and Mahindra, both auto and the tractor segment, have done better than expectations, and company has maintained the guidance both for SUV as well as for the tractor segment industry growth outlook. In the commercial vehicle, Ashok Leyland was the most disappointing. Except LCV, all the segments of the company have seen a decline. For Tata Motors commercial vehicle 2, sales were largely below expectations. Total sales have increased by 17% versus our expectation of around 24% increase. So just Hero Moto is left, but as of now, the picture looked mixed.
Okay, mixed picture coming in there. Thank you so much for that, Sudarshan. But let's talk about a stock that was falling one way, and that was Inox Wind today. This came in after it reported its Q4 FY26 numbers. Nothing good that came in terms of the numbers for the quarter, right? Very muted growth, and actually a decline that you're seeing of 2.3% in terms of revenues. Margins of the company also have seen a contraction coming in of more than 300 basis points around that we're seeing of the margin contraction. Profits of the company, that also saw a decline. The company has highlighted some challenges in its presentation, saying ground execution, there was a challenge there. There were some supply issues that came in due to geopolitical tension. That continued. Logistical support, that was a challenge as well. And customers, were they paying? No. Seems like they were holding back in terms of payment, and that's why the working capital cycle, that also saw an increase coming in, impacting the overall cycle. Though the order book for the company that stands at 1.3 gigawatt is what it stood at. They've given an FY27 guidance, revenue of 75% plus growth for FY26 is what they saw, while over FY26 is what they're expecting in FY27, and margins also of 22% around in that range is what they're expecting for FY27.
Well, that's right. Winnie, both Suzlon as well as Inox Wind in FY26 have missed in terms of execution, and that's being reflected as far as the stock prices too are concerned. But Ambrish, coming across to you, well, you heard Sudarshan, and wanted to get your view as far as the auto pack is concerned. In terms of results, management commentary indicating that demand is robust, but supply chain worries indicating that there could be margin pressures. May sales has been quite muted. Your top picks here, and how do you look at the auto space?
No, in fact, the way I see it is, I think the adoption of EVs is going to get much faster now. I mean, since we've already seen that energy shock because of the US-Iran war. As far as the EV sales are concerned, I think we should see that inflection point much faster than what we had earlier thought. I mean, just look at the Tata Motors numbers. I mean, it's about 102% higher as far as EV sales are concerned. I think they've crossed about 10,231 EVs for the month. So that's quite positive. And in fact, I would be more positive on the EV two-wheelers. For example, Ather would be the one I would be looking at from that point of view. And as far as the passenger cars are concerned, I would surely go in for something like Tata Motors PV.
Okay. Jay, your thoughts coming in on the auto space, anything you like in the auto sector? Two-wheelers or four-wheelers? What's your preference? And in that, if yes, then which one?
Well, it has to be two-wheelers initially, because definitely I would say that the overall data as far as the auto stocks are concerned, the two-wheelers data or the two-wheeler stock names are better relatively. One of them is definitely Bajaj Auto. Interestingly, what has happened, Vinny, is that initially we did see a good up move or a bounce in this stock, particularly on account of short covering, because this was the only stock, Vinny, I would say, within the two-wheeler space wherein there were shorts. Otherwise, Hero, Eicher, you see TVS, all of them had seen a good long build-up, and the overall trend was also positive. This was the only stock which was pending to bounce back, and finally it did so. And now slowly and gradually we are seeing the numbers improving fundamentally. Not only that, but the derivatives data also seems to be improving. So I think that positionally until now the 94,000-95,000 levels are held out there on Bajaj Auto. The probability of an upside, the stock inching towards 11,500, 12,000 positionally seems to be very high. So this is one stock which I definitely like within the two-wheeler space, Hero MotoCorp and Bajaj Auto. And second would definitely be Eicher, because overall the Eicher numbers have also relatively been better so recently. So I think that until 6,800 levels are held there on Eicher Motors, the chance of a bounce back in this stock at least until 7,500 to 7,700 is quite high.
Okay, thank you so much, Jay, for your views as far as the auto space is concerned. But another sector that did quite well today were textile stocks. They rallied in trade after the government scrapped import duty on cotton for 5 months. Devyani Vibhute is here with all the details.
Well, India's textile sector just got a direct cost relief. And the government has removed the 11% import duty on raw cotton, and it's effective till October 2026. Now, in a conversation with CNBC TV 18 earlier today, the Cotton Textiles Exports Promotion Council gave us more insight into what exactly triggered this particular move. Now, it's a domestic supply shortfall. Now, India needs up to 340 lakh bales of cotton, but the local production is falling short. To bridge the gap, up to 40 lakh bales are expected to be imported during this particular time frame. Now, why does this matter for garment manufacturers? Cotton goes into more than 55% of all apparels that are manufactured in India. In fact, we export more than 60% of the cotton that we have in India. So, cheaper imported cotton should ease input costs for spinners, apparel manufacturers and small textile businesses, along with helping bring down the cost of cotton prices and align them with international ones, making us more competitive in the textile space, as well as aiding in margin expansion across the textile industry.
Okay, Devyani, thank you so much for that. And that's why we've seen all these names buzzing around in the trading session, right? Whether Indocount or Nitin Spinners, Wellspun Living, all of them. And everyone uses cotton. As of now, it's a relief that comes in for these players, right? Because importing cotton at a bit of a lesser rate is something that benefits the cost, given that we've seen so much of the tariffs, trade deals, those issues still continue as well. But on that note, we're going to take a very short break. But Amrish as well as Jay, thank you so much for joining us on the show as always, and hope to see you all more often as well. But on that note, we're going to slip into a break. After the break, we'll get you top corporate voices, so stay tuned in.
Welcome back to Markets Forward. Time to take stock of all the top corporate voices of the day. Cyient is betting on its recent acquisition of AI-native platform Tau to drive future growth as the company guides for mid-single-digit growth in FY27. Speaking to CNBC TV18, the company's management said that the acquisition is expected to start contributing meaningfully to earnings from FY28. The management added that the company continues to see weak demand in its energy business segment.
Okay, we also spoke to the management of Asian Paints. They delivered a steady performance Q4 FY26, and the management told CNBC TV18 that the price hikes undertaken so far are adequate for the current environment. However, the company indicated that it may consider further price increases if geopolitical volatility intensifies. Management also flagged continued competitive pressure through FY27 and said it would assess market conditions and business performance on a quarter-by-quarter basis and on depending on the ongoing global uncertainty.
And real estate developer Max Estates Noida sales have crossed 1,800 crore rupees despite the West Asia conflict. Speaking to CNBC TV18, the company's management said that it is planning to monetize its 17,200 crore rupee portfolio over the next 3 years. The management further added that demand was increasingly coming in from end users rather than speculative buyers. Lastly, the management held back on providing fresh guidance, citing current global uncertainties.
Okay, and with that, we're absolutely out of time on this edition of Markets Forward on CNBC TV18. Thank you so much for tuning in. After the break, we'll be back and there'll be more on news, updates, everything on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices climbed 3% after the US strikes military targets in Iran over the weekend. Kuwait reports drone attacks as Tehran claims it struck a US base. Iran says a ceasefire in Lebanon is one of the preconditions for a peace deal after Israel seizes a strategically important castle. Tehran also denies any talks on its nuclear ambitions. President Trump says it will all work out well in the end. The Sensex and the Nifty failed to hold on to their opening gains, ending near the low points of the day. The Nifty drops below 23,500. Mid-cap see sharper cuts. The rupee remains around the 95 mark against the dollar. The RBI is unlikely to hike rates in the upcoming monetary policy this week. CNBC TV 18 Citizens Monetary Policy Committee votes unanimously for a status quo amidst geopolitical tensions and adverse monsoon forecast. India and the US begin four-day talks in New Delhi to finalize the details of an interim trade agreement. The US delegation is led by the chief negotiator, Brendan Lynch. The Indian team is led by Additional Secretary at the Commerce Ministry, Darpan Jain. The chairman of Tata Trust, Noel Tata, writes to the RBI opposing the listing of Tata Sons as going public will risk its philanthropic mandate. Tata Sons chairman Chandrasekaran is non-committal on the listing. That's a Money Control exclusive. Automobile sales top street estimates in May. Passenger cars see robust domestic sales growth on the back of a low base. Commercial vehicles underperform. Tractors see strong growth and a positive trend ahead. Technical issues continue to plague the CBSE re-evaluation portal for Class 12 students. The website was supposed to go live today after crashing on the 19th of May due to heavy traffic. More than 4 lakh students have applied for re-evaluation. The world's most valuable company, Nvidia, takes AI to the PC, unveils RTX Spark super chip for laptops and desktops. Nvidia claims the chip can run AI models with up to 120 billion parameters, set to launch later this year in the new Windows PCs from Microsoft, Dell, HP, Lenovo and others. SoftBank pledges to invest 75 billion euros to build AI infrastructure in France. This will be the company's biggest investment outside the US. SoftBank also surpasses Toyota as the most valuable company in Japan. RCB fans celebrate his second straight IPL victory indoors. No victory parade in Bengaluru after 11 fans were killed in a stampede last year during the celebrations. The new Chief Minister, DK Shivkumar, also expected to be sworn in this week. Well, straight to the top story this evening. Crude oil prices climb over 3% after a fresh clash between the US and Iran. Let's break down the latest developments for you. Now, the US carried out strikes on Iranian military targets. This happened over the weekend. The Pentagon claimed that the attacks were in response to what it called aggressive Iranian actions, including the downing of a US drone operating over international waters. This comes after multiple indications from the White House that a peace deal is closer than ever. In response, Iranian forces targeted a US military base. Kuwait intercepted missiles and drones as air defense systems were pressed into action across the Gulf. Kuwait's foreign ministry has condemned what it calls heinous and repeated Iranian attacks. It went on to say the attacks represented a dangerous escalation. Meanwhile, Israel is expanding its invasion of Lebanon despite global condemnation. France has called for an emergency meeting of the UN Security Council after Israel's Prime Minister Netanyahu ordered evacuations in southern Beirut. This is the most serious escalation in Lebanon since the ceasefire was agreed upon on the 17th of April. U.S. Secretary of State Marco Rubio held discussions with leaders of both Israel and Lebanon, hoping to avert an escalation. Iran has made it clear that a ceasefire in Lebanon remains a precondition for a deal with the U.S. Iran's chief negotiator said the talks are taking place in an atmosphere of severe suspicion and mistrust. Tehran accused the U.S. of constantly changing its views and putting forward new or contradictory demands. Iran maintains that no negotiations have taken place on the nuclear issue and that it has raised the issue of damages from the U.S. and Israel for reconstruction. Amidst all of this, President Trump took to social media yet again, saying, and I quote, "It will all work out well in the end. It always does," end of quote. French President Emmanuel Macron held talks with the U.S. president, welcomed efforts for a swift agreement for peace.
We're focused on being postured and prepared to re-engage if we have to. I mean, this is high-stakes negotiation. We've got the best negotiator in the world leading it. Iran may not want to give up their nuclear ambitions, but we believe at the table they can and will over time, given the right set of incentives. But the most powerful incentive is the capabilities we have there right now, which they can't ultimately defend against at any real level. And those are decisions in the future the president will make based on how this ends. But I feel confident that he'll get to a deal that serves the interests of the American people.
Violations of the ceasefire are themselves indicative of U.S. misconduct and bad faith and merely intensify the existing mistrust, which rightly must always remain in our minds in any interaction with the American side. These U.S. actions are not merely violations of the ceasefire, they constitute an act of aggression and a violation of Article 2, Paragraph 4 of the United Nations Charter. They entitle and authorize us, in line with the right of self-defense, to undertake corresponding defensive measures.
Well, that's Iran's foreign ministry. Now, on to the day's market action. The markets failed to hold on to their opening gains this Monday afternoon. The Nifty ending below 23,400. The Sensex was down about 500 points, almost 900 points gone on the Nifty mid-cap. The Nifty IT index, by the way, that saw a big move up, closing almost 3% higher, gain of about 700 points there. Prashant standing by now to wrap up the market action for us. Prashant, it's opened the week on a nervous footing.
Absolutely, Shireen. I mean, Friday was a complete collapse in the last 1 hour. We could blame that, of course, to the MSCI rebalance which happened. And, there was some expectation at the margin that, well, once that technical event has been cleared, which is the MSCI rebal, maybe things will look a little better, but no luck. From the opening highs, I mean, it was basically just like a waterfall, a gentle kind of downward sloping one, but, a sell-off nevertheless. 160 points lower, and today's close on the Nifty gets us very close once again to about 23,300 levels, which is kind of a bit of a support area. Nifty Bank under pressure as well. Mid-cap and small-cap indices down, I mean, 0.75% to over 1% in that range. The IT index, does bounce occasionally, and today was one such day. We'll see if this continues because we've seen strong follow-throughs. It's been broadly down, but we've had weeks when the index is up 4%, 5%, and then sort of, starts to decline once again. So was up 3% today. But otherwise, apart from the IT index, FMCG, defense, real estate, there was selling pressure here as well. Large cap stocks, Lever, Tata Consumer, ITC. So FMCG, as I said, the cuts showing up sharply. Shriram Finance and Mahindra were some of the others. We, of course, got auto sales numbers today for the month of May. Gains in technology, so Tech Mahindra, Infosys were two of the top Nifty gainers. Coal India did well. Broader market, clean 2:1, declines to advanced kind of ratio. So MTAR Tech, which is up 200% this year, was down about 8%. So bit of profit booking here. The Adani stocks have all done very well. Adani Total Gas was lower. And this entire, power, AI, grid infrastructure names, Hitachi, GE Vernova, TD Power, Apar Industries, this entire pack, of course, saw some profit booking as well. Hero MotoCorp was lower. Data Patterns, which is a defense company, was down. Natco was down sharply. Lodha, Craftsman, and of course, you had the ICICI, Pru, AMC, and ICICI Lombard, both which actually sold off. Now, in terms of what did well, Wockhardt, it got that US FDA approval for, its blockbuster drug, so another 7% has done very well last week. Coforge, Persistent, that entire IT pack, as I said. Rubicon Research, I mean, listed at about 600, it's basically doubled from there. And that's the kind of market we're in, where, some of these names ignored, no interest at the time of listing, but then, they creep higher in a very strong fashion. This is one such name, and a Kernex Micro, which did quite well as well. So that's the picture overall, but at a broad market level, a disappointing day because there was at the margin some hope that you'd get a bit of a bounce after Friday's steep sell-off.
Yes, no bounce this afternoon. Many thanks, Prashant, for joining us. And let's bring you the monsoon tracker this afternoon. India's Met Department has said it will take another 3 to 4 days for the monsoons to reach Kerala. The IMD has also told CNBC TV 18 that showers are expected in Maharashtra a week after that. The entire country will receive monsoon showers in 45 days. Pre-monsoon showers and thunderstorms are expected to begin in South Konkan by the 3rd of June. Now, commercial LPG prices were hiked across major cities today. However, oil marketing companies have kept the prices of domestic cooking gas unchanged. In Delhi, the price of a 19 kg commercial LPG cylinder has now been increased by 42 rupees to over 3,110 rupees. In Kolkata, the rate has gone up by over 53 rupees to 3,250 rupees. The under-recovery on domestic LPG is pegged at 650 rupees per cylinder. Jet fuel prices remain unchanged. Oil marketing companies are losing about 30 rupees a litre on jet fuel that is being used by domestic airlines. Remember, for foreign airlines, the prices were hiked. The first is when we actually see that monthly revision up or down, but there is status quo there as far as pricing is concerned. Auto sales topping street estimates in May. Passenger cars seeing robust domestic sales growth on the back of a low base, while commercial vehicles underperformed. Sudarshan is here to wrap up the details. Sudarshan, take us through the auto report card.
So it's been a mixed trend that we are getting from auto companies for the month of May. If you talk about two-wheeler, sales are looking largely in line to slightly better than expectations. For passenger vehicle, on the low base, all the companies, most of them are seeing a healthy growth, especially Maruti Suzuki and Mahindra & Mahindra. And if you talk about tractor segment, more than the numbers for the month of May, what is important for the sector is the outlook. And Mahindra & Mahindra has maintained the outlook that it had given for the industry of mid-single-digit growth. But talking about the company in the details, starting with Bajaj Auto, for export, company continues to maintain the monthly run rate of more than 2 lakh units. Even on the domestic front, it has seen a growth of 10%, largely in line with its guidance. For TVS Motor, it was an all-round beat. All the segments have seen healthy growth of more than 30%. For EV, it was highest of monthly sales, and the growth here is almost 56%. If you talk about Eicher's Royal Enfield, again here also, sales were largely in line. It was at 1.03 lakh units versus our expectation of 1 lakh units. One segment that continues to do well for them is segment up to 350cc, where company has seen growth of almost 19%, while segment above 350cc has seen a decline. Talking about the four-wheeler, especially passenger vehicle segment, Maruti Suzuki has seen a huge growth on the low base. Entry-level segment has seen growth of almost 140%, and SUV, or say utility vehicle sales too, have seen a growth of almost 44%. For Hyundai, it was slightly lower than expectations. Both the segments, domestic as well as exports, have done lower than expectations, and total sales have increased by 4%. For Mahindra & Mahindra, both the segments have done better than expectations, and company has maintained the outlook both for SUV as well as for the tractor segment. Coming to Tata Motors commercial vehicle, sales were slightly below expectations. Total sales have increased by 17% versus our expectation of 24% increase. Ashok Leyland was the biggest disappointing this month. It's the only one company that has seen a decline in the sales, while all the other companies have seen a growth. Total sales for Ashok Leyland have declined by 3%, and the culprit here is that all the other segments except LCV. So LCV, if you leave aside, all the other segments have seen a decline. So we'll have to see how the next few months pan out. But overall, the numbers for the month of May were largely mixed.
All right, so many thanks. Now let's talk about the GST collections rising to 1.94 lakh crore rupees in May. Government sources say gross GST collections registered an adjusted growth of 9% year-on-year after factoring a one-time 10,000 crore rupees spectrum-related payment made by a telecom operator in May of 2025. Collections were supported by higher import-related revenue and broad-based growth in economic activity. That's the GST number that's come in for the last month. Well, to a money control exclusive, sources say Tata Trust Chairman Noel Tata has written to the RBI opposing any potential listing of Tata Sons, the holding company of India's largest conglomerate. Now, Tata Trust is the controlling shareholder of Tata Sons, and its chairman N. Chandrasekaran was non-committal on the possible listing of Tata Sons when the board of Tata Sons met on the 26th. As per sources, Noel Tata argued that listing Tata Sons could alter the long-term character of the group's holding company and disrupt the philanthropic objectives of the trust. Remember, the RBI is yet to give a decision on whether Tata Sons is granted an exemption from listing, or in fact it will have to go through with that. Noel Tata now writing against a possible listing of Tata Sons. India and the US have begun 4-day talks in New Delhi to finalize the details of an interim trade agreement. The US delegation is led by the chief negotiator Brendan Lynch. The Indian team is led by Additional Secretary at the Commerce Ministry, Darpan Jain. Abhimanyu joins us now with more details. The Commerce Minister did say this is the last lap. It is getting closer to the finale, to the climax. Abhimanyu, what can you tell us?
Well, exactly. It is indeed the last lap. And also, as indicated by the US ambassador to India last week, he had indicated that 99% of the negotiations are done. Only the last 1% bit is left. So clearly, it's the last lap, and all pending issues pertaining to market access, pertaining to non-tariff measures and investment facilitation are going to be discussed between both the sides. It's likely that both the sides are going to seek an early harvest as far as conclusion of the negotiations is concerned. What the US ambassador had indicated last week, that perhaps both the sides can see finalization in the next few weeks or months. So clearly all eyes would be on what all is going to be discussed between both the sides, even as areas of discussion will include even customs and trade facilitation, as well as economic security alignment between India and the United States. Now, India and the US had agreed on a framework for an interim agreement on reciprocal and mutually beneficial trade as per their joint statement, which was issued on the 7th of February 2026. And the framework had reaffirmed a commitment for a broader India-US bilateral trade agreement negotiations. Subsequently, the Indian negotiating team had visited the United States earlier this year in April, and now the American team is going to be in New Delhi. It remains to be seen how early both the sides are going to negotiate and thresh out a final agreement as far as an interim deal is concerned, which is likely to be followed by far-reaching negotiations, more detailed negotiations on a larger trade agreement. Now, earlier today, Commerce and Industry Minister Piyush Goyal had addressed media. Here is what he had indicated back then.
जैसा आप जानते हैं कि अभी यूएस के एम्बेसडर मिस्टर सर्जियो गौर ने भी कहा कि 99% चीज़ें तय हो गई है, छोटी मोटी कॉमास और फुल स्टॉप्स पे चर्चा चल रही है. फाइनलाइज करते वक्त जो वहाँ पे बदलाव आए थे, कानूनी बदलाव आए थे यूएस में, उसको किस प्रकार से फाइनल एग्रीमेंट में रिफ्लेक्ट करना, उसके हिसाब से किस प्रकार से बदलाव होगा, उसको तय करके मुझे पूरा विश्वास है कि यूएसए के साथ भी जल्द से जल्द हम बायलैटरल ट्रेड एग्रीमेंट का पहला ट्रांच खत्म कर देंगे, साइन करेंगे और आगे की चर्चा चालू करेंगे.
Well, that is the Commerce Minister. And speaking of trade deals, the India-Oman Trade Pact offering zero-duty access to a whole range of Indian labour-intensive exports kicks in today. The Comprehensive Economic Partnership was signed in December last year during Prime Minister Modi's visit to Muscat. Commerce Minister Goyal says that over 10 consignments being shipped now will avail preferential duty access in Oman. Back to corporate news. Vocard has secured US FDA approval for Zynic, a breakthrough antibiotic for complicated urinary tract infections. The drug becomes the first novel antibiotic from an Indian pharma company to secure US FDA clearance. Vocard sees the US contributing at least 40% of sales, with global revenue potential up to $2 billion. The stock hit a record high in trade today. We'll head into a break, but up next, technical issues continue to plague the CBSE reevaluation portal for Class 12 students. The website was supposed to go live today after crashing on the 19th of May due to heavy traffic. That and more when we return. AI giant NVIDIA has announced a new chip for personal computers. It's called RTX Spark. Speaking at an event, CEO Jensen Huang said that this chip will be the reinvention of personal computers. Rachna joins us now with more details. Rachna, take us through what's special about NVIDIA's new chip.
RTX Spark, that's what NVIDIA is calling its first chip built for the PC. Unveiled by Jensen Huang at Computex in Taipei, it combines an ARM CPU with a Blackwell GPU on a single die, 128 gigabytes of unified memory and the ability to run 120 billion parameter AI models entirely on your laptop. No cloud, no data center. Just the machine in front of you, 30 plus laptops from Microsoft, Dell, HP, Lenovo, who will carry this chip when it ships later this year. Huang, who danced onto the Computex stage to a roaring crowd, has built NVIDIA into the world's most valuable company as we know it, and it's all been on the back of data center chips. But now he has signaled the next frontier is the PC itself. But the announcement lands against a complicated backdrop. On Sunday, Washington moved to tighten export controls on exactly these kind of chips. The US Department of Commerce published fresh guidance clarifying that a license is now required to ship advanced AI chips, including Blackwell processors, to subsidiaries of Chinese companies operating outside of China. A potential loophole has now been closed. So NVIDIA finds itself in an interesting position at this point, dancing on one stage in Taipei, navigating tighter regulatory ground on another in Washington. So Huang has a big task cut out for himself, but as we can see, he's dancing his way through it.
He most certainly is, and with good reason. Rachna, many thanks for joining us. And speaking of AI, Japanese giant SoftBank has spent 75 billion euros over the next 5 years to build 5 gigawatts of AI data center capacity in France. French President Emmanuel Macron said SoftBank CEO Masayoshi Son jointly addressed the media during the annual Choose France summit. The conglomerate said it will invest 45 billion euros in the first tranche to develop 3.1 gigawatts of capacity in northern France. With this, SoftBank's project will be one of the largest European investments in AI infrastructure to date. CNBC's Arjun Karpal brings us the latest.
Yeah, it's absolutely huge, Carolyn. And just to set the context, you mentioned 5 gigawatts of capacity. That is effectively the equivalent of the output of 5 nuclear reactors. So it's a lot of compute, and that is something that the industry has said has been a constraint, the access to computing power to run all of this AI as well. Now, just a few more details about this deal. The first phase of this is going to involve a 45 billion euro rollout of data centers in a region just north here of Paris. That is going to provide 3.1 gigawatts of capacity as well, the largest infrastructure investment in Europe. Now, why France? President Macron here has been trying to push France as the center of Europe's AI ambitions and prowess here. The key missing piece really has been this infrastructure. We've seen some smaller deals announced around Europe, but nothing on this scale that SoftBank has announced as of yet. This is a huge commitment that is not only going to boost compute here in France, but certainly for Europe more broadly as well. Now, France as well has the advantage of having low carbon energy, nuclear power as well, and that's something that President Macron has been very keen to promote to anyone looking to build data centers in the region as well. We know that energy is a key bottleneck for data centers. Now, from the SoftBank side, this is all part of a bigger strategy we've been hearing from SoftBank over the last couple of years as the company looks to sort of position itself at the center of the many different parts of the AI technology.
Well, that's Arjun Karpal reporting there from Paris. Now, Prime Minister Modi met Myanmar's military leader and president at Hyderabad House. The Myanmar leader's 5-day visit comes less than 2 months after he became president. Foreign Secretary Vikram Misri said both leaders discussed trade and economic cooperation, defense and security, border management. West Bengal's BJP government expanded its cabinet, adding 35 ministers. This comes 3 weeks after Chief Minister Suvendu Adhikari and 5 others took oath. The additions include 13 cabinet ministers, 19 ministers of state and 3 ministers of state with independent charge. Senior BJP leader Swapan Das Gupta was among those sworn in as a cabinet minister. Technical issues continue to plague the CBSE re-evaluation portal for Class 12 students. The website was supposed to go live today after crashing on 19th of May due to heavy traffic. It is not up yet. Ashmit joins us now with all the details. Ashmit, take us through what has gone wrong systematically to get us to this point today where the re-evaluation process, which is supposed to kickstart today, has it?
Well, we'll just dial back a couple of years to look back at this entire timeline. Bear in mind that in 2019, there was a company called Globalina Tech. That was the company responsible for Telangana intermediate examinations. And there was a major fiasco then affecting thousands of students, leading to state government action. This was flagged by BRS chief K.T. Ramarao, who said that the very same company that had led to that fiasco in Telangana has been selected under a rebranded version by the CBSE, leading to a much greater case of chaos, referring to the latest situation that the students are dealing with. Nonetheless, with respect to Coempt, the company currently in focus, well, the tender began in February of 2025. That's the first time the RFP was put out. That was unsuccessful. It did not lead to any successful bidders. Subsequently, there was a second round of tender that was initiated in May of 2025. This time there were 4 applicants, but all of them failed on technical criteria, and therefore, again, no successful winning bidder. But it's after that there was a dilution of various tender conditions. To begin with, the years that were cited within the tender conditions, which would be considered for computation of your minimum eligible threshold in terms of annual revenue, that was changed. It's only under these revised criteria that Coempt became eligible. Importantly, there was also a tender condition initially which said that all companies that are blacklisted earlier will not be allowed to go further. That was diluted to only companies that are blacklisted currently. This again benefited Coempt going further. There was also another condition which said that the company in question will be required to have its own data storage facilities, which Coempt didn't have initially. This was diluted to allow third-party vendors, hyperscalers, the likes of AWS, which again has been alleged that it suited Coempt going further. Nonetheless, it's after that, in August of 2025, there was the third and the final tender conditions that was put out. There was an RFP. The bidders came through. Coempt emerged as the winner. In December, Coempt was awarded the contract, and what many have flagged is a case of not having enough preparation. Only 66 days after award of contract in February is when the CBSE had allowed for a complete overall national rollout of the OMS system, which many educationists have flagged points towards not having enough time for developing of SOPs, developing and preparing the staff, and importantly, leading to the current situation that the students find themselves in.
All right, Ashwat, appreciate you joining us. Still no end of this nightmare for students. They are still waiting for the re-evaluation process to start. Remember, of the students who have taken the CBSE examination, Class 12 examination, 4 lakh students have applied for re-evaluation. Time for us to head into a short break, but up next, the news will return right here on CNBC TV 18. Stay tuned, we're back in a minute with more.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Crude oil prices climbed 3% after US strikes military targets in Iran over the weekend. Kuwait reports drone attacks as Tehran claims it struck a US base. Iran says a ceasefire in Lebanon is one of the preconditions for a peace deal after Israel seizes a strategically important castle. Tehran also denies any talks on its nuclear ambitions. US President Trump says it will all work out well in the end. Sensex and Nifty failed to hold opening gains and end near the low point of the day. Nifty drops below 23,500. Mid-cap see sharper cuts. Rupee remains around the 95 mark against the dollar. The RBI is unlikely to hike rates in the upcoming monetary policy this week. CNBC TV 18 Citizens Monetary Policy Committee votes unanimously for a status quo amidst geopolitical tensions and adverse monsoon forecast. India and the US begin a 4-day talk in New Delhi to finalize the details of an interim trade agreement. US delegation is led by Chief Negotiator Brendan Lynch and the Indian team is led by Additional Secretary at the Commerce Ministry, Darpan Jain. The chairman of Tata Trusts, Noel Tata, writes to the RBI opposing the listing of Tata Sons, says going public will risk its philanthropic mandate. Tata Sons chairman Chandrasekaran is non-committal on the listings. That's a money control exclusive. Automobile sales top street estimates in May. Passenger cars see robust domestic sales growth on back of a low base. Commercial vehicles underperform. Tractors see strong growth and a positive trend ahead. Technical issues continue to plague the CBSE revaluation portal for Class 12 students. The website was supposed to go live today after crashing on the 19th of May due to heavy traffic. More than 4 lakh students have applied for revaluation. World's most valuable company, Nvidia, takes AI to the PC, unveils RTX Spark superchip for laptops and desktops. Nvidia claims that the chip can run AI models with up to 120 billion parameters, set to launch later this year in new Windows PCs from Microsoft, Dell, HP, Lenovo and others. SoftBank pledges to invest 75 billion euros to build AI infrastructure in France. This will be the company's biggest investment outside the US. SoftBank also surpasses Toyota as the most valuable company in Japan. And RCB fans celebrate a second straight IPL victory indoors. No victory parade in Bengaluru after 11 fans were killed in a stampede last year during the celebrations. New Chief Minister of Karnataka, DK Shivkumar, is also expected to be sworn in this week. All right, top story this evening. Crude oil prices climb over 3% after a fresh skirmish between the US and Iran. Here are the latest developments. The US carried out strikes on Iranian military targets over the weekend. The Pentagon claimed the attacks were in response to what it called aggressive Iranian actions, including the downing of a US drone operating over international waters. This comes after multiple indications from the White House that a peace deal is closer than ever before. In response, Iranian forces targeted a US military base. Kuwait intercepted missiles and drones as air defense systems were pressed into action across the Gulf. Kuwait's foreign ministry has condemned what it calls heinous and repeated Iranian attacks. It went on to say the attacks represent a dangerous escalation. Meanwhile, Israel is expanding its invasion of Lebanon. Despite global condemnation, France called for an emergency meeting of the UN Security Council after Israel's Prime Minister Benjamin Netanyahu ordered evacuations in southern Beirut. This is the most serious escalation in Lebanon since the ceasefire was agreed on the 17th of April. US Secretary of State Marco Rubio held discussions with leaders of both Israel and Lebanon, hoping to avert an escalation. Iran has made it clear that a ceasefire in Lebanon remains a condition for a deal with the US. Iran's chief negotiator said the talks are taking place in an atmosphere of severe suspicion and mistrust. Tehran accused the US of constantly changing its views and putting forward new or contradictory demands. Iran maintains that no negotiations have taken place on the nuclear issue, and it has raised the issue of damages from the US and Israel for reconstruction. Amidst all this, US President Donald Trump took to social media saying, and I quote, "It will all work out well in the end. It always does," unquote. French President Emmanuel Macron held talks with the US President and welcomed efforts for a swift agreement for peace.
We're focused on being postured and prepared to re-engage if we have to. I mean, this is high stakes negotiation. We've got the best negotiator in the world leading it. Iran may not want to give up their nuclear ambitions, but we believe at the table they can and will over time, given the right set of incentives. But the most powerful incentive is the capabilities we have there right now, which they can't ultimately defend against at any real level. And those are decisions in the future the president will make based on how this ends. But I feel confident that he'll get to a deal that serves the interests of the American people.
Violations of the ceasefire are themselves indicative of U.S. misconduct and bad faith and merely intensify the existing mistrust, which rightly must always remain in our minds in any interaction with the American side. These U.S. actions are not merely violations of the ceasefire, they constitute an act of aggression and a violation of Article 2, Paragraph 4 of the United Nations Charter. They entitle and authorize us, in line with the right of self-defense, to undertake corresponding defensive measures.
All right, let's talk about the day's market action. The market failed to hold on to the opening gains, with Nifty ending below 23,400. Sensex fell over 500 points and 25 out of 30 constituents ended in the red. Broader markets underperformed while Nifty IT ended higher. India's Met Department has said that it will take another 3 to 4 days for the monsoon to reach Kerala. The IMD also told CNBC TV 18 that showers are expected in Maharashtra a week after that. The entire country will receive monsoon showers in 45 days. Pre-monsoon showers and thunderstorms are expected to begin in the South Konkan region by the 3rd of June. Commercial LPG prices were hiked across major cities from today. However, oil marketing companies have kept prices of domestic cooking gas unchanged. In Delhi, the price of a 19 kg commercial LPG cylinder has been increased by 42 rupees to over 3,110 rupees. In Kolkata, the rate has gone up by over 53 rupees to more than 3,250 rupees. The under-recovery on domestic LPG is pegged at 650 rupees a cylinder. Domestic jet fuel prices remain unchanged, with oil marketing companies they're losing around 30 rupees a litre. The RBI is unlikely to hike rates in the upcoming monetary policy this week. CNBC TV 18 Citizens Monetary Policy Committee voted unanimously for a status quo amidst geopolitical tensions and adverse monsoon forecast. However, the panel is divided when asked about their expectations for a rate cut in this year.
What will RBI do on June 5th? I've more or less guessed, but Sonal, you go first.
On hold.
On hold on repo rate. Okay. Samiran, what will they do to the repo rate? Hold. Soumya? Hold. Sajid?
Hold.
Okay. Chairman, your role is easy. Would you agree?
Hold.
Yes, you sounded that way. Okay, it's a universal hold or unanimous hold. Let's see if the next question throws up a difference. Sonal, how many rate hikes do you think in this year, FY27?
None, and can't say right now.
Okay, can't say. Samiran? We have penciled in 50 basis points. Okay, 2 hikes. Soumya?
Can't say at this point.
Okay, playing it safe. Sajid?
As of now, none. I can uncertainty, but as of now, none.
Okay, this is a divided house. Dr. Sen, what would you say?
It's difficult to say, but at least one will have to come sooner or later.
Okay. There, it's as divided as that. The Reserve Bank has a lot on its plate to decide.
All right, time for a short break. Coming up, India's industrial output grew up 4.9% in April. Lata Venkatesh will join us with top economists to decode the data under the new series. Stay tuned.
Welcome welcome to the big story. Where's that? Okay. The big story that we are tracking is the industrial growth number, and that for April has come in at 4.9%. But this is the first month that we have the index according to a new index. The original index was based on the year 2011-12. It has now been updated to the with the base year of 22-23. So we are to get the data for all those years. We are still struggling with the number not exactly showing which the MOSPI website is not up. But we do have the April index number at 4.9%, and that compares with 4.1 as per the original index. We will get more data as and when the MOSPI puts it out. The PIB data is a little confusing at this point in time. But let us just discuss what is the important change that has come because of the new index. Mridul Sagar, the chairman of the committee which revamped the new index, former executive director and former member of the MPC, former executive director at RBI, now professor of economics at IIM Kozhikode, is with us. Sakshi Gupta, the principal economist of HDFC Bank, will also be joining us. Mridul, thank you very much for your time. Unfortunately, we are still struggling with the website not giving us adequate data. But at 4.9%, that represents it's definitely better than the April data, March data that we had, which was 4.1. If you can just elaborate on how much richer this data is.
So difficult for me to say till you get the back data. We have given the splicing, the splice factors in the report, and they need to be worked out by the MOSPI, and they will be putting it out today, I believe. Okay. So you can wait for that. I think we need not give too much importance to month-to-month variations. Rather, we should look at the internals thereof and see where the growth is improving, what needs to be put right. For instance, if we did badly on thermal power generation last year, is there something we are doing better now? Okay. So that is the kind of matrix the high-frequency matrix are supposed to address in some respects.
Okay, now I take your point, but I'm unfortunately not able to help you since the way the PIB has presented the data, I am not able to give you the previous numbers. But Sakshi Gupta is with us. Sakshi, are you any luckier? Can you get the comparable data? How does this 4.9% compare with the previous years? They promised us data from 2023. So are you able to access any of that data, and does 4.9 look better than a year ago or month ago?
Right. No, unfortunately, Lata, I am having the same luck as yourself. But just at looking at the data, there are a couple of observations that I could pick up. One is, with this new series, as Professor Sagar was saying, look at the details, right? So one thing that is standing out, look at electricity, production growth. Right. You see that number is, pretty strong. And once you drill down and look at what's happening to renewables and non-renewables and gas, you will find that, the production growth for renewables is double digits. I think close to about 16 or 18%, if I'm not wrong. Right. So we knew from the core sector data as well that electricity production was very, it picked up in the month of April. And that's something that is getting picked up in this, new data as well. I think on manufacturing, again, the number looks, although we don't have a reference point here as of now, but, the 6% number on manufacturing also looks, not that bad. In fact, slightly on the higher side. I think this perhaps is reflecting some amount of stocking up because you had the energy shock playing out in the month of April. And if you look at sector wise, there are clear sectors where growth is very strong within manufacturing. So you have your auto, you have electrical components, you have transport equipments. So here, these are some sectors that I could find where, production growth was strong. And this ties up with some of the sales data that we have earlier discussed.
Okay. Thank you, Sakshi. That's about all we have at the moment in terms of data. But I will be able to enlighten Mridul Sagar on some of the numbers that I can access. It is mining and quarrying has done badly. It is minus 5.1, but that is the only bad news so far. As Sakshi pointed out, the good news is in electricity and manufacturing. Manufacturing is up 6.2%. I can't remember when we last saw that kind of a good number in the old series. And likewise, we have 4.9% rise in electricity. And it compares with 25-26 data. Last year's full year data of 6.1. So that, of course, is the full year average. And we had very strong data earlier in the year. But 4.9 is a decent number, and we have 6.6% for water supplies, sewerage, and other new additions, Mridul. And the general index, of course, as I told you, is up 4.9% compared to 5.7% for full year last year. The annual growth, the growth in April last year was 5.7. This year is 4.9, according to the new series. And the growth for the full year is 4.3. So, I mean, I'm sorry, I'm not giving you too much by way of data. But can you tell us, manufacturing itself has done very well. Is this because the number of factories were revamped? Is it because of the new series, or is it because something is good about the economy?
I can't give a categorical answer because there are too many moving parts in this. There are just too many moving parts. If, for instance, you are seeing electricity, you have also to recognize that gas has been added to that sector in alignment with the international practices now that we have adopted ourselves into. So water supply, sewerage is a new category altogether.
Yes.
And it seems to be doing well now. We have to see how it...
6.6%.
6.6%, exactly. And the gas is doing, sort of has added on to the electricity numbers.
Okay.
I think need not really even bother to see what the aggregate growth on a month is slightly up or slightly down.
Now I have the comparable growth.
So
overall,
it is higher.
Yeah. Overall, IIP is not higher, 4.9%. Last April, it was 5.7%. Water supply, sewerage, the new addition is up 6.6%. Last April, it was 8.2%. Electricity, as Sakshi also said, 4.9% this year. It was 6.1% last April. Manufacturing, 6.2% this year, 6.4% last April. And gas, of course, has been very bad, minus 5.1. And, mining is minus 5.1. It was 0.6 last year. So
you're seeing the YOY numbers, the sequential thing also.
Sequential, we don't have. March, I cannot find. But basically, this is not a very positive number in terms of April manufacturing itself. Sakshi, just a word on that. If you looked at April on April for all the 4 categories or 5 categories that are available, it's not looking better than last April. Is that one takeaway?
No, you're absolutely right, Lata. It's not. I mean, I just looked at the numbers as you were reading them out. But that being said, look, I would have anticipated these numbers to be much worse, right? Given the extent of the energy shock that we continue to face in the month of April, I would say manufacturing, I think you said 6%, 6.2 this time compared to slightly higher same time last year, right? So you're still getting above 6% on a very, very high base. I think that still shows that, some part of manufacturing, although there would be a lot of variation within sectors, some part of manufacturing clearly is pulling up this number. So I would read it, but for things
Did you have a number? Did you have a number?
Not for the new series, Lata. Okay. For the old series, I was assuming that there's going to be some amount of moderation compared to March that we would see in the month of April. Just one final point, I think on mining, the number that we are getting, right, a negative number for this, for the month of April, is reflective of what we saw in the core sector data, right? So you've had contraction in production for things like coal, natural gas, oil, etc., which is something we picked up even in the core sector data that had earlier come out.
Okay. So thanks a lot for your initial comments, Sakshi. So that's what we have at this point in time. There is one poll which Cogensis put out saying that the April IIP is 3.7 by the old series, obviously. Nobody knew the new series. According to the new series, 4.9. So it looks good. But if you look at 4.9 compared to what the production was a year ago, it is not looking that good. Last year, it was better at 5.7. As per the new series itself, it is looking slower. So the takeaway we can have is that the market was expecting a worse number because of the energy shock and because of a range of shocks. I mean, packaging material was not available initially because of lack of sulfur. Fertilizer was a problem. So with a whole series of logistical and availability shortages, 4.9 is good, as Sakshi says, better than what the street expected, which is 3.7, but it is still slower than year ago April. But we have the author of the entire revamp. So some more comments from him. Mridul Sagar, what makes this revamp better?
Okay, I'll answer your question. And for the number part, I'll say I'm glad the growth is holding against this extreme shock. So that's how one has to view the data. But on the methodological part, there have been a series of improvements done by the MOSPI, and that needs to be appreciated. First, the recategorization, which has now been brought in terms of waste management, in terms of capital goods, they are, the use-based obviously has been reclassified and different weights are there, but water management and gas supply has made a whole lot of a difference there. And also, item baskets have increased. Yeah. We've allowed for substitution of factories if need be, because what happens is there's a creative destruction in the industry, and when the new base is launched, the growth looks good. Yes. And as you go down the line, the growth tends to fall because some lines go out of production, some factories stop producing, and they need to be replaced and stuff. So that is, and also we'll be moving towards the chain-based methods. So basically that will allow to capture more recent production lines much better with a reweighting of the pattern and stuff. Things like harmonic mean use, so that will be also affecting.
Will this improve GDP? This is some kind of an input.
It would. So I know if you're going down the line, whether GDP is good or not, which generated so much of international debate, this will contribute to improvement of the GDP estimates. They'll have to really then move on that. But this is a small part of GDP. Absolutely. Let's understand that. But MOSPI is doing other things to improve GDP.
Of course. Industrial output is what? Maybe about 23% of...
less than that,
Okay, so it's not a big contribution, but nevertheless, the fact that it is cleaned up is certainly a very big addition. And it's also a more reliable number. Old factories removed. Old products which are not used anymore have gone out. New products have made their appearance. Weightages have changed. The big takeaway, of course, is that the first number that we have at 4.9% is not that big a disappointment, because given the energy shock, it could have been worse. The market was expecting 3.7% as per the previous series. The fact that it is so much better is important, but it is definitely a slowdown compared to April ago levels. That's the key takeaway from the new IIP series that has been released by the MOSPI. Thank you very much, Mridul Sagar, for joining us. Well, that's it on this edition of the News Bulletin. Thank you very much for watching.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, technical issues continue to plague the CBSE re-evaluation portal for Class 12 students. Now, the website was supposed to go live today after crashing on the 19th of May due to heavy traffic. More than 4 lakh students have applied for re-evaluation, and the CBSE is facing a crisis of credibility. A 17-year-old student's blog post has taken center stage in the row over CBSE's on-screen marking system. Now, Sarthak Siddhant reviewed tender documents on the Central Public Procurement Portal after he received blurred and incomplete scans of his answer sheets. In his post, he alleged that the board rewrote rules across 3 tender rounds for the online platform to allegedly favor the Hyderabad-based company Coempt EduTech. Now, former Telangana IT Minister and BRS Working President K.T. Ramarao pointed out on social media that Coempt was formerly known as Globe Arena Tech, a company that had been in trouble in 2019. He wrote, and I quote here, "It is unfortunate that Globe Arena, the same company that botched up the Telangana Intermediate 2019 results, had simply changed its name and secured an even bigger contract from CBSE only to create a far greater chaos." End of quote. So here's what Sarthak's blog has been alleging. In February of 2025, the first tender round concluded unsuccessfully. 3 months later, another round was cancelled after 4 bidders, including TCS and Coempt EduTech, failed on technical benchmarks. After this, the tender conditions were diluted and fiscal years for benchmarking the eligible annual turnover changed from FY21 to 23 to FY22 to 24. Coempt, which was previously ineligible, now qualified under the revised conditions. Here's another change. Under the earlier conditions, companies blacklisted in the past were barred, but that was now changed to bar only companies that were currently blacklisted. Meanwhile, here's another key change. Earlier, companies were required to have their own data storage facilities, but that norm was modified to allow the use of cloud service providers impaneled by the Ministry of Electronics and IT. Now, the blog pointed out that after these modifications, Coempt emerged as the lowest qualifying bidder in the 3rd tender round in August. In September of 2025, a provision blacklisting companies for errant behavior was also allegedly removed. And in December of 2025, that's when the contract for conducting the exams was awarded to Coempt EduTech. Now, just 66 days later, the CBSE announced the full-scale rollout of the on-screen marking system. Both the board and Coempt EduTech have denied any wrongdoing so far. And well, joining us now to help us discuss this issue that's brewing in the minds of students, parents, and of course the broader nation itself is with us the student himself. In fact, the man, the boy of the hour, that's Sarthak Siddhant. Also with us is Harsh Kapas, the Chief Operating Officer of Arihant Academy, and Sara Bedi, the mother of a CBSE student. To all of our panelists, thank you so much for joining us. Sarthak, let me come to you. Tell us, when this issue struck, when you got affected, tell us what inspired you to actually go ahead, to write about this, to post about this on the blog, and to actually get so much attention as you finally did.
Thank you so much, sir, for inviting me to your platform to speak about this. First of all, I'd like to inform you and correct you that I did not do it of any personal grievance. I did not receive any blurred copies or mismatched copies. Now to the next thing, why did I do it? I was in a group chat with Nisarg Adhikari. He was the ethical hacker that hacked CBSE, CBSE's OSM portal. And we were discussing how Coempt's on-mark solution was being preferred over other industry-leading platforms. So I started digging more onto this, what this on-mark platform was. It was being used by many fragmented colleges, group of institutions over India, more so over the South and Deccan India. So I started digging more into it. And I found out that Coempt has a very bad background with the Globe Arena thingy. 23 students, Telangana State Board students, killed themselves because of it, because of their incredibly discrepancy-filled performance in the Telangana State Board intermediate examinations.
Right.
So I started
Sarthak, you've spent a lot of time, you've spent a lot of energy digging up on Coempt. Let me ask you, of course, we've all gone through your posts on social media. We've gone through your blog post as well. Tell us, at the time when you began writing this, you were, of course, taking on the mammoth institution of the CBSE. Was there perhaps some apprehension, some fear as to perhaps you may invite online trolling, you may be targeted online on social media as well? Was that something that was weighing on your mind?
I was totally not thinking about what going to happen. I was just investigating because I like to delve deeper into documents. I just wanted to investigate why was Coent awarded this. I downloaded all the 3 tenders. I downloaded 2 tenders because I could not find the first one. And I started comparing them. I started reading them, and then I started finding discrepancies. And then I decided that these discrepancies are too much. I should publish a blog post on this. I did not think my blog post would do so many numbers, but I'm glad it did. And many people are aware of the discrepancies in the tenders. And I think that's a very good thing because it should invite some transparency through CBSE to the students and to the parents and to everyone involved in this mess.
Well, you've been very brave, at least that's been the chatter within our newsroom, at least in terms of taking on such a huge mantle on your young shoulders. Tell us, any word of caution that your parents gave that, beta, perhaps don't try to do this, don't try to garner so much attention? Any word of caution that your parents gave you?
My parents were my mother was supportive of this, and like I was doing this between the limbo time from the end of entrance examination and start of colleges. So I was not really doing it under her supervision. So I was doing it alone. I was focusing on it alone. So she did not know about it.
So she didn't know about it while you were putting in these hours. Tell us, how did you find the time between such a hectic schedule of a CBSE student in class 12?
Sir, again, I'm telling you, I was in a limbo time between the start of colleges and the end of entrance examinations. So I was having a lot of free time. I work on technological projects, and I work on many projects, and I like deeping delver into legal things. Civic technology is one of my passion. So she did not really care then, but now she has told me to stay safe about things and be factual whenever possible.
Sure. Sarthak, do stay on with us. We also have with us 2 guests who are joining us. Miss Bedi, let me come to you. What is the situation that you find yourselves in with your students as well, with your children in class 12? What does this do in terms of future planning? Does this throw out of whack the plans that students may have had for entrance examinations, for planning their counseling sessions, for planning their future?
Yes, of course. This is really, adding to the lot of stress that children were already in to clear the exams firstly. And now being in the same state for as long as possible, it's just disheartening to see all the kids and the parents along with them suffering because of all this, the fiasco that has happened. A lot of children who had conditional offers from abroad, whether it's UK University, Singapore University, or Hong Kong University, their offers are all conditional. They haven't met their conditions. Most of them haven't met their conditions, which is again causing extra stress because you're back to square one without any admission in hand. The ones who were sitting for NEET also are suffering right now. The ones who were giving JEE, some of them have not met the 75% cutoff as well. So again, they're in a limbo. So I think all across the board, people, either the students who are staying in India wanting to pursue their higher studies in India or abroad, except for the US, which is unconditional offers, are all suffering and in the same boat. So anxieties are really high. They're struggling to kind of, sail through all this nonsense. But as you said, there's no choice. I mean, we just have to wait and watch what's going to happen. And honestly, my daughter is in grade 12 right now. Currently, she is going to sit for the boards next year. So we are equally in a state of anxiety and stress because we don't know how this is going to pan out for the current batch and what is going to happen for the next batch also.
Right. Mr. Kapasi, let me come to you again. Some of the facts that have been emerging over the last couple of days, thanks to people like Sarthak who've been putting in the hard yards. Tell us, what we've learned so far is that the contract, as far as this edutech company is concerned, was granted in December. In February, just 60-odd days after that, we've seen an announcement from the CBSE for a complete national rollout of the entire mechanism should there have been perhaps a greater waiting time for perhaps testing, developing SOPs, for taking out, addressing the teething worries?
First of all, thank you for having me here. Yes, definitely, I feel that large-scale reforms in education ideally benefit from phased implementation. Phased implementation would have definitely helped launching the on-screen marking examinations in certain cities and experimenting to certain papers for a certain period of time would have definitely helped. And I'm sure following the manual marking scheme with this marking scheme would have definitely helped them. So yes, to answer your question, yes.
The fact that the situation has gotten so dire, what is the next best situation that can be done? Of course, what the CBSE did is that they came out with a new portal, but the portal itself, even today, is facing difficulties, facing challenges. Does that indicate perhaps a lack of preparedness in dealing with the technological requirements of a nationwide rollout of such a scheme?
The issue is not digitalization, it is implementation. I guess that the implementation was mishap, and there has been a lot of issues implementing the on-screen marking examination. Definitely students' confidence, as Sathik mentioned, should be at the center of every decision, and transparency and accountability are the best ways to reform or regain trust, which they have, the CBSE government, the CBSE has lacked in. So yes, still the exam should be in the digital format, but it should be rolled out in the phased manner, and there should be certain hiccups that needs to be solved, some technical errors that should be solved as soon as possible.
Ms. Bedi, coming to you on the question of accountability, the numbers are of course quite stark. We have as many as 18 lakh students who sat for these examinations. 4 lakh of them are estimated to want to seek access to their answer sheets to get clarity on how the marks had been computed. What about accountability? From a parent standpoint, what would you want in terms of accountability, in terms of assuring that people responsible address the issue at hand?
Yes, I mean, that is the way forward. They need to figure out what has happened. We are a vast country. It is difficult to roll out anything in the first go to that extent, and especially going digital is the way forward. But I think accountability matters here the most, because they were told by a lot of educators that this should have been rolled out in phases, which went on a dead ear. And they just wanted to do this. I don't know what was the rush. They could have done this in phases, rolled it out, seen the technical issues, worked on that, and then figured out a way forward. I mean, it is sad to see what state we are in. Accountability is very, very important for CBSE as well as the Education Ministry. I mean, the Education Minister came on board and said that he's sorry, but that sorry doesn't help the children to move forward in life. And this is a very tender age at 17, 18, where, this is going to be an impression of the Indian education system for the kids all along throughout life. I mean, they're going through such a, issue, and I don't think there'll be a way where they'll forget about it. So, I mean, everyone has to be accountable, has to take measures. Whatever has happened, they have to move forward from this and find a solution which is permanent and feasible, primarily. Like I'm a part of a very strong Facebook group called Senior School Moms. And, there are minimum 10 posts every day of stressed out mothers talking about this. I mean, it's not just about what has happened. It's also about how the portal is acting right now. There is just no resolution. People are suffering to even, put in their papers for evaluation, reattempt, everything. The portal crashes every second minute. So, I mean, there is no accountability here from any source, anybody who can come and say that, okay, we are working, and there has to be a plan forward.
Right, Mr. Bedi. Again, a parent there, a concerned parent at that, is voicing concern as to what this means as far as the impact on students is concerned, and of course, making sure that there is some degree of accountability foremost on the minds of the parents at this stage. With that, let's slip into a very quick break. We'll come back and we'll continue this conversation with our panelists on the other side. Well, welcome back to News Center. We're discussing the situation regarding the CBSE and the tech issues that have plagued. We've seen them play out over the last week or so, affecting large number of students in the lakhs. And that's something that we're trying to address with the help of our panelists. So we have with us Sarthak Siddhant, Harsh Kapasi, as well as Ms. Sara Bedi. Mr. Kapasi, let me come to you. The situation that we find ourselves in, number of students wanting to raise concerns, not yielding any results. The CBSE portal continues to be inactive as we speak. What is the way out? Is a retest perhaps the most feasible solution that the parents, students can hope for?
I would largely view that a retest should be the last option, as we should remember that lakhs of students have their mentality, and it's really draining giving exams and twice. They have planned their vacation. In fact, some of students have also planned their future pathways. So retest should be the last option because we must remember that lakh of students have already completed examination, received results, and started planning admission. Before considering any extreme measures, every effort should be made to resolve this issue through verification, re-evaluation, correction mechanisms, or targeted interventions of genuinely affected students. At this stage, I believe that strengthening corrective mechanisms appears more practical than restarting the entire examination cycle, as then this would be again a disturbance in the entire mental state of all the students who are going to appear the CBSE exam twice.
So retest should be a port of last call. But Mr. Kapasi, while we have you also, let me ask you that if a retest is perhaps not the best answer, the digital tools are clearly not yielding the desired results. What happens now in the interim? Should we go back to the analog mode through manual checking of answer sheets, at least till there is a very clear established system that works and can deliver on the students' expectations?
I believe that the future of education is undoubtedly digital. The question is not whether we digitize, but how we digitize this. I believe every technological transition comes with some hiccups. The objective should be improve the system rather than discontinuing with it. So going backwards really doesn't make sense. We should focus on building stronger digital systems with multiple quality checks, audit mechanisms, and some way out wherein we figure out this issue that has been happening should not happen twice. So yeah, I don't believe that we should go with the manual evaluation process.
Right. Ms. Bedi, coming to you again, Mr. Kapasi is saying that a retest should be, again, a last resort option. I just want a parent's perspective on that. Retest, is that something that students would be open for?
No, I think I would agree with Mr. Kapasi here. That should be the last resort unless, like I said, some kids have conditional offers. If they're really not meeting their conditions and revaluation doesn't help them anywhere, because right now we are still at a limbo. There is no revaluation result which has come out. So once the children have those results in hand, and if they make their cutoffs, whether it is in India or abroad, I think they would want to go ahead and, put this behind themselves and just move forward in life. I don't see revaluation. And also, you have to understand the exams happened in February and ended in March. We are already sitting in June now. So, I mean, they are not in a constant touch with their books, except for the ones who gave JE and the ones who are reattempting NEET. The rest of the children have just kind of given up on those books. Most of them have actually lended those books further down to the other batch. So literally getting rid of them, and now you expect them to go back and study again is not really a good solution. So I would also agree with Mr. Kapasi here that the way forward is that the digitalization is the way forward. We need to just figure it out technologically. We have to make ourselves much more stronger. The RFPs have to be much, much more technical, and the bidding process has to be more transparent and clear.
Right.
So that in the future, we do not face same music again.
Ms. Bedi, let me also come back to you. Previously, we've seen in other instances where you've taken legal remedy to ensure accountability, to seek the appropriate response from the authorities. In such a scenario, where again there are lakhs and lakhs of students whose futures are at stake, is that something that's on the cards? Is that something that's being discussed within parent communities, that perhaps there's a need for some kind of legal oversight to ensure accountability?
I think, of course, there should be one. Everyone should be held accountable legally as well. But I think right now the vision is very, very narrow to the extent that all parents just want their children to finish grade 12, put an end to it, move forward. Maybe down the line, before the next year processing starts, we might consider taking a legal battle ahead, not more so for what's happened, but the way forward. We want to be very clear this time that we don't want to be in the same boat next year as well. So that can be on the card, that we want a clear picture of how the tendering is done, how this, whatever mess they have made this year does not repeat itself.
Just one quick question to both of our panelists before we end. Mr. Kapasi, this situation, the way it's evolved, has largely been fronted by Gen Z, by the students themselves who've gone on social media, who've in fact flagged these issues for the benefit of a wider audience, for the benefit of the authorities in charge. Do you think there's a change in narrative in terms of how Gen Z is perceived basis just this challenge that they've taken upon their shoulders?
Yeah, definitely. I see that the Gen Zs are very transparent and they need accountability. So they need their trust, that somebody to win their trust. In fact, what has happened with all of them. So yeah, I see that they are very independent and also accountable for whatever has happened. So they need some solutions, quick solutions basis on whatever has happened, so that they don't have to face this thing again in their lives.
Ms. Bedi, again, the same question to you. Very often we find that in conversations about the Gen Z, the earlier generations, whether that's the boomers or the millennials, they often refer to Gen Z as being lazy or entitled. Have they proven otherwise in this episode?
For sure. I think for sure they've taken charge this time. They're fighting their own battle, which also tells a lot about the generation and gives us hope that we are, going to be in safe hands. When it comes down to such issues, they are standing together and fighting it out, trying to bring in technology, all the issues in front of us. So I think the generation is doing good, and I just hope they don't struggle. That's all. That's all.
Well, one can only hope that the situation is resolved quickly for the benefit of course, more than 18 lakh students whose future is at stake here. And hopefully there begins to get more clarity. We begin to get more clarity on what this entire evaluation process will be like. And of course, giving more certainty to both parents as well as students. I'd like to thank all of our panelists for joining us. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Kotak Life and CNBC TV 18 present Insuring Lives, Securing India. Insurance for all.
Hello and welcome to Insuring Lives, Securing India, Insurance for All, presented by CNBC TV 18 in partnership with Kotak Life Insurance, a special 5-part series aligned with India's vision of achieving insurance for all by 2047.
Insurance for all, what do we mean by this? Appropriate product, affordable product, and accessible product for all segments of the population, all economic entities, different type of entities, and also for all parts of the country.
Insurance is such a product, it cannot be entirely digitally driven. It has to be physical. With the trust of the bank, customers may come and buy few products if bankers are teaching to them.
We got to be where the customer is. UPI apps, they are in platforms, they are in marketplaces purchasing things. So we got to go where the customer goes.
Bima Sugam can be a transformative intervention in terms of getting value for the customers.
India's insurance sector stands at a defining moment. As the country moves towards its vision of insurance for all, by 2047, the focus is rapidly shifting towards affordability, accessibility, digital innovation, and deeper financial inclusion. At the heart of this transformation lies a collective effort to build a more financially secure and resilient India. Hello and welcome to Insuring Lives, Securing India, Insurance for All, presented by CNBC TV 18 in partnership with Kotak Life Insurance, a special 5-part series aligned with India's vision of achieving insurance for all by 2047. To launch this powerful series, we have an esteemed panel of experts joining us today. We are honored to welcome the man leading the institution at the heart of India's insurance for all vision, Shri Ajay Seth, is Chairman, Insurance Regulatory and Development Authority of India, our guest of honor for this launch episode. Joining him are two stalwarts from the BFSI industry. Mr. Binod Kumar is Managing Director and CEO, Indian Bank. And we have Mr. Mahesh Balasubramanian, Managing Director and CEO, Kotak Mahindra Life Insurance Company. Gentlemen, welcome to the program. Thank you very much. I want to start by asking you, Mr. Seth, what is IRDAI's vision? Because insurance slogan, what is IRDAI doing to ensure that this becomes a reality? What are the 2 or 3 most important sort of aspects that you are working on?
Insurance for all, what do we mean by this? Appropriate product, affordable product, and accessible product for all segments of the population, all economic entities, different type of entities, and also for all parts of the country. Put it in the context of our country with a very large young population, very large digital savvy population, and very large do-it-yourself population. So that's the context. And then moving from 20th century adage, insurance is sold, to a 21st century digital India belief that insurance is also bought. What it would take, a much higher order of affordability, transparency, and much better claims experience. Because this is unique financial services where one pays today for a service to be delivered in future and the need for service may not arise. So what are the key elements in the roadmap, which I see it here, and we expect that travel along with the industry on that path? First is the product reform. Second piece will be distribution reforms, which we have been talking about more at this point of time. Third would be a capital reforms. So the capital is deployed more efficiently, and we have just started on Indian accounting standards this year and risk-based capital next year. Fourth element would be underwriting reforms. And there are elements at the moment each insurer, based on the data available to oneself, is doing that underwriting. Fifth element would be the claims reforms, which builds the trust. And the last and the sixth important piece would be on the awareness reform. So I see that 6 significant steps or pieces in that roadmap. And it's possible to do it in a couple of years.
Mr. Kumar, if I can come to you, sir. Distribution, what role do banks play, in your opinion, and what can they do to sort of achieve that aim of insurance for all by 2047?
See, insurance in last few years has done phenomenally well. If you see the penetration, all the penetration overall has not gone up. If you see globally, it is in the range of 7% to GDP ratio. India, still we are hovering around 4%. So that is where banks can play a role. Banks has three very important ingredients: trust of the customer. We have a great reach to the customers and very great connect with the customer. Apart from all these, we are also participating in lot of activity in the customer awareness. That can help in penetrating the insurance products. With the trust of the bank, customers may come and buy few products if bankers are pitching to them. Number two, reach. If you see in India, around 1.5 lakh branches are there. Out of that, 60%, that means 90,000 branches are in tier 2 and 3 cities. We have great distribution network. We can use that network very effectively for the cross-selling of our insurance product along with the banking product. Third, customer connect, which is related to the trust. So customer connect, we also have a very good customer connect, and they rely on bank throughout their life cycle. For various services, they come to bank, various financial support, they come to bank. So that can help in penetration of the insurance product. From the banking channel, we keep on doing lot of customer awareness like Kisan Goshti. We have financial literacy center. We have RCTs where we give training to the customers. So there we can have training program specialized for the, tier 2, 3 customers. We can have, awareness program for all of them. That may help gradually in adoption of the insurance, which is visible in case of like 2 products I would like to mention: PM Jeevan Jyoti Bima and PM Suraksha Bima Yojana. We have seen good penetration in tier 2 and 3 cities.
Mr. Balasubramanian, if I can come to you, sir, what are the key reasons to your mind, right? Because there is awareness and financial awareness is only on the rise. The gap between annuity products and protection products, are there any behavioral issues? Are there systemic kind of things which need to be addressed?
India is probably having a huge protection and annuity gap. Protection gap is the fear of dying young, and annuity gap is the fear of living long. Are you leaving enough money to have a peaceful living if you're going to live long?
Sure.
The behavioral reasons which come in the way are awareness is certainly one, but today, as I see it, inertia is a bigger reason. And inertia comes from certain behavioral aspects of mortality is not discussed in this country. People find it very uncomfortable to have a conversation around mortality. Second is there is a psychological term called future discounting. What does future discounting mean? It's a peculiar behavior where the perceived value of goods, services, and rewards today is always felt higher than the perceived value of rewards later. And this is where life insurance comes right in the middle of this conundrum. Because what happens is all our products are future ended because it tells you that, look, you pay this premium, you'll get benefits in the future. And that perceived value today is not so high in customers' mind. And therefore, the product needs to be conceptually sold to the consumers. So that is a second aspect. And today's generation are also grappling with today's needs of EMI, housing loan, education, right? Getting a better job, etc. So their priorities today are here and now. And therefore, trying to sell a product which talks about future priorities becomes a bit of a problem. The third is knowledge in terms of how much do I need, right? How much cover do I need? Do I need 20 times my salary, 30 times my salary? Similarly, for a pensioner at 45, 50, how much should I set aside today so that I can have a peaceful living adjusted for inflation 10 years, 15 years from now? I think these are the questions customers are grappling with. And therefore, a lot of inertia in saying, baad mein kar lunga, right? So the priority changes and they don't look at it as an instant decision to buy. We have got certainly products which are a little bit more complicated, and therefore we need to drill it down further, make it very simple so that customers who overcome the awareness, overcome the inertia, are able to buy it very easily.
You've kicked off, a public insurance registry. Is this, if I can use the word, like the Sybil moment for insurance in that sense? Data sharing, plugging the information gaps. Just talk to us a little bit about that. What are the aims and what do you plan to achieve?
This is a public insurance registry. And the way we are conceptualizing it, and we are again aiming for that by mid-June, the discussion paper is out. It is a digital public infrastructure for insurance industry. We have put it rightly that what the Credit Information Bureau did for the credit market, or somewhat what the depositories and the stock exchange, electronic exchange did for the capital markets. Of course, PIR is not a exchange per se, but is a data infrastructure. What it has a potential to do, I'll cite a couple of use cases. First, from the policyholder, a 360-degree view of products of all insurers.
Okay.
Second, 360-degree view of performance of each insurer and a distributor in terms of price, in terms of returns, in terms of claim settlement. Two examples or two potential use cases for insurer. Which are the markets, which are the segments of the entities which are underserved or unserved? Where to sell, what to sell. Second use case, how to underwrite based on the nation's data, not company's data alone. And that can make a significant change on the underwriting.
Okay.
Related with this would be, what are the fraud patterns coming up? How to overcome that? Then from the distributor side, first piece again is a common one. Where to sell, what to sell, which product is selling, which is not selling in which segment and which market. Second one, create an enabler so that a distributor can sell products of other financial sector entities which are non-conflicted.
Right.
At the moment, an insurance distributor can't do anything else. This is. Then from the regulator, an unobtrusive way of having an oversight on product, policies, insurer, and distributor. So they don't feel that they are being watched, but information is available. Second piece, how to enable trust of much higher order in the sector. So this is again the one, if I can put it, the present day equivalent is what is being planned. Credit Bureau Plus, which is a national financial information registry, which is in the making and the bill is under consideration. Something akin to for the insurance sector.
Mr. Kumar, I mean, technology is a big part of it now, right? And I don't think customers are reluctant to take to technology, as we've seen in other areas as well. So what are you doing? What are banks doing to leverage that, digital transformation to sort of, sell more effectively and reach more customers?
We are trying to bring transparency in the system, which relates to customer product suitability. The biggest problem, whether we are giving right product to the customer or not. With the help of technology, if we can do that this type of product will be suitable for this customer based on his income, based on his life, based on his remaining life. I mean, remaining life we cannot predict, but still, I mean, say somebody purchasing insurance at 50 and 60 years of age, then how long policy he should take. So these things we are trying to develop with the help of insurance, our insurance partners. Then insurance, how we can bring cost of distribution with the help of technology. Whether we can, with the help of AI is also now there, with the help of AI, with the help of various technology, can we bring cost of distribution?
Right.
If we are able to bring cost of distribution, I think penetration may go up. So that is the one thing. And still I believe insurance is such a product, it cannot be entirely digitally driven. It has to be physical. Digital for transparency, product suitability, physical for assurance, trust, explanation, etc. So
it's a
I
mix
believe
of physical and digital.
mix of
has to be.
physical and digital.
Mr. Balasubramanian, let me come to you. In terms of innovation for sort of, younger people, Gen Z, gig workers, women, what's happening? I mean, is the industry innovating enough? Does more need to be done? Give us a sense.
Coming to gig workers, I think the challenges have been, insurance products have been traditionally written, the life insurance side, on citing the income and then deciding based on your payment capability and the life cover that we offer. Now, gig workers, there is a challenge there because their incomes are variable. The volatility of income is also there. So we have to develop products which understand the nuances of their capabilities. So products with maybe short-term duration, smaller cover, sachet kind of products, giving flexibility of premium payment, so that if he misses a premium, doesn't matter, he can probably come back and pay in maybe 2 weeks' time or 3 weeks' time. Frequency of the payments that we collect. I think all this will be now coming in as innovations to address this particular segment. And the government is also talking about bringing them all under a common fold, etc. Coming to Gen Z, I think Gen Z is definitely a very different way of consuming products. For them, it's all about ease. It's all about simplicity. It's all about speed. It's all about easy accessibility. And they do not want education. They learn through experience, right? So I think when you design products for them, you have to keep in mind all these things. And that's where digital plays a very important role in making sure that we are able to offer products which suit their sensibilities. With women, I think more and more women are entering the career fold. And women have a different problem in terms of adjusting to the priorities that life throws them, because they probably are the backbone of our family structure. And there could be maternity breaks, there could be career breaks, they could come back. So how do you really adjust to the life cycle of women and make sure products are given to them at various stages in the life cycle? So these are the three segments, and these three segments have different nuances. Today, we have to go to customers where they go. Saying that I have a website, come to me and buy, or I have a mobile app, come to me and buy is passé. We got to be where the customer is. And where are they today? They are in UPI apps, they are in platforms, they are in marketplaces, purchasing things. So we got to go where the customer goes. Second, data today is throwing a lot of visibility about customers whom you didn't have visibility earlier. And if PIR also comes through as a reality, a lot more information comes in terms of their purchase patterns. Of course, with DPDP coming in, I'm saying that all those disclosures have to be taken, consents have to be taken. But platform will tell you platform fees. Somebody's a driver in a platform, you know how much he has earned through that platform, right? What is a person payments through the UPI platform, how much has been made? So just viable information or this kind of information help you get better quality about the customers so that you can underwrite easily for the customer. And then finally, I think we also have to make sure that we are creating products which are thematic and simple for them to understand. I think work is underway. A lot of us have products in the industry, but it's still work in progress. But the segment is too large, and we better get faster in catering to their demands.
Let's slip into that break, but when we return, we'll discuss how the insurance industry is leveraging AI, analytics, and new age technology to empower customers and distribution partners while accelerating the adoption of life insurance across India. Stay with us.
Kotak Life and CNBC TV 18 present Insuring Lives, Securing India. Insurance for all. Kotak Life and CNBC TV 18 present Insuring Lives, Securing India. Insurance for all.
Welcome back to Kotak Life Insurance, and CNBC TV 18 presents Insuring Lives, Securing India, Insurance for All. We continue our special discussion on the future of India's insurance sector and the vision for insurance for all by 2047 with Shri Ajay Seth, Chairman, Insurance Regulatory and Development Authority of India, Mr. Binod Kumar, Managing Director and CEO, Indian Bank, and Mr. Mahesh Balasubramanian, Managing Director and CEO at Kotak Mahindra Life Insurance Company. Gentlemen, thanks very much for staying with us on the program here. Mr. Seth, if I can start with you again. Bima Sugam is again the big talking point in the industry. So give us a sense of, again, I mean, what is the aim, what is the ambition that you see this platform, the impact you see this having?
First of all, Bima Sugam is a platform which is co-owned by all insurers,
yes,
regulated by IRDAI. This is not a platform of distributors.
Right.
Two fundamental differences. At the moment, irrespective of the distribution channel, price of a product or return of a product is uniform, irrespective of what the cost of that distribution channel is. Bima Sugam seeks to do it differently because it's co-owned by insurers, the least cost, but same quality or even a better quality. Second, present products in a standard manner, but with substantive value, so that the people can buy themselves. That's the second element which brings in. So moving forward, we see it that as the first phase, starting with term life, maybe ULIP. ULIP is generally considered to be a complex product, but people in this country have learned very well what the mutual fund means. So ULIP in 2026 is not a complex product, it's a simple product. Then moving on to other life insurance product later on, but on a general insurance, starting with motor insurance and also for a health product. So that is what it means. So better product discovery, better price discovery, where insurers compete on their performance rather than letting the distribution channels compete or push products where they get higher commission. So I see it here that Bima Sugam can be a transformative intervention in terms of getting value for the customers.
Balasubramanian, let me ask you, how is the industry leveraging AI, analytics, new age tech to enable customers and distribution partners to accelerate the adoption of life insurance products?
I think COVID taught all of us that, look, we all had the digital tools, but the adoption was partly physical, partly digital.
Yeah.
But COVID probably quickly cascaded the impact of digital. And today, all of us are in the digital era where we have almost all our processes today, which can be paperless or it can be digitally done on a workflow basis. That's already there. But the next step is, how do you use AI?
Yeah.
So if I'll have to put this whole framework, I'll probably put it in a 2x2 matrix of policy lifecycle, pre-sale, sale, and post-sale, generative AI, agentic AI, and conversational AI.
Sure.
If I then put this matrix and see, I think there is a lot of work already happening and some of us are doing it. For instance, creatives, which is generative AI. All the creatives today are done by AI by most companies. And I don't think the era of keeping a creative agency and churning out creatives is going to die down.
Sure.
Similarly, when we want to train people, we now have AI models which the person can train himself in terms of speaking and saying, I'm going to meet this customer. He does a role play of a pitch and it gives him back feedback, and that's a closed loop, right? Similarly, prospecting customers. We get a lot more data about customers and probably predictability of whom are we prospecting and what to pitch to that customer. Right product, which every other person spoke on this panel, that helps. Second is the underwriting stage. Agentic AI is coming in very handy now in underwriting, right? Where agents have been now used in underwriting. Many companies are concurrently doing it now. Do I say that has everybody moved on to only AI-based underwriting? We are going through the understanding of the hallucination and understanding the various nuances of the model. But at some stage, it will probably move to. Similarly, on claim side, automating the entire claims and using deep machine learning to automatically sign off claims and pay claims, that's happening. Then comes to conversational AI. India is a large country with a diverse population, multilingual. This is where NLP models are helping in conversational AI, chatbots, ability to probably listen to a customer on the call center and respond through an AI, conversational AI. So that's also being done. So a lot of things happening. But I think it will take some time for all these models to catch scale, and the resultant effect will be improvement in productivity and thereafter reduction in costs. Maybe it will move from today it's all OPEX. It'll probably move to CAPEX because investments are required in AI, but it's still sustainable because we'll all be able to do it better. If the customer is intuitively knows what to do now, I think he's capable of taking care of himself. So I think do it yourself is a great way. And there are lots of products globally which today operate on that design principles. I think if you do that, it'll help.
DIY is a big one when this entire, at least on the equity side, etc., it started in a big way. Mr. Kumar, as a bank, anything you'd like to see happen? I mean, from your perspective?
How we can take this insurance product to tier 2, tier 3 city. Percentage of population covered. So as a bank, I will also love, because we have a great reach. So if we can associate in some way, more fruitful way in taking this, deepening this relationship further, participating in the providing insurance to the customers, number one. Number two, I'll be happy if like GST is a one push. I mean, similar with the use of AI, some cost benefit can be passed on to the customers because distribution is a huge cost. So something with the help of AI or data analytics, can we do something to bring that cost down?
Mr. Seth, thank you very much for joining us. Thank you for taking out the time and sort of, kicking us off on this journey over the next 5 episodes. Mr. Kumar, thank you very much for being here. Mr. Balasubramaniam, thank you very much for being here as well. Well, valuable insights and perspectives on the launch episode today. What's clear from today's conversation is that India's insurance sector is no longer just evolving. It is being fundamentally reimagined, driven by progressive regulation, digital innovation, and stronger collaboration across the financial ecosystem. The industry is laying the foundation for a more protected and financially resilient India. And this was only the beginning of the conversation. Over the coming episodes, we will continue to explore the ideas, innovations, and policy shifts shaping the future of insurance in the country. Thank you for joining us on Insuring Lives, Securing India, Insurance for All, presented by CNBC TV 18 in partnership with Kotak Life Insurance. Stay tuned for the next episode.
Kotak Life and CNBC TV 18 present Insuring Lives, Securing India. Insurance for All.
This is the Bank of America flagship conference 2026. Lots of, chatter at the conference here already. It's a two-day conference, and you'll have top corporates, you'll have top investors. And of course, the entire Bank of America team sort of interfacing between both sides. And I'm sitting down with Vikram Sahu, who's the India CEO at Bank of America. Vikram, great to have you with us here. Thank you very much for your time.
Morning.
So what are you expecting personally from the conference? If you had to kind of sort of, maybe the top question which you think is on everyone's mind, which you hope gets answered through these conversations over the next 2 days, what is going to be the dominating sort of agenda of this conference?
Top question. That's a target-rich kind of topic to choose from, because we've had so many challenges that we faced in India over the last year. A lot of it not of our own choosing. But rather than top question, what I'd say is actually I'm slightly mildly surprised. And let me explain what I mean. Given everything that India has gone through, given where FII ownership is of India at present, given what's happened with the rupee, I wasn't really certain how much interest there was going to be in coming to India to be at this conference this year. What we've ended up with is a 30% increase to our foreign institutional investors who are participating in the conference this year relative to last year. And that tells you something. It tells you that investors, while India may have been out of favor in the last year, at least foreign institutional investors are prepared to look through that. They want to invest in India for the long term. And I think what they are here at this conference to do is to sharpen their pencils, talk to the sources, talk to companies, talk to policymakers, understand what's going on, and try to decide how to position themselves. So I think it speaks to the resilience of India to have this sort of participation in the conference.
As in 30% over last year.
Over last year.
And this at a time when, we've not done badly. There's too much, I think, negative narrative, self-loathing, that kind of thing, right, here in India right now. That's a general feel. And it's not just about markets, but generally outside of it, the macro-ish kind of environment. And sometimes those are times when you got to sort of look hard through some of this noise, and that's when you get to take positions which make you money over a period of time. Would you agree?
Yes. In fairness to investors, though, I think the noise through this last year has been louder than normal. And there are some very real issues that India does need to contend with. So if we think about the litany of problems that we've faced, and again, I want to emphasize, not all of this has been of India's making. So whether it was a border conflict about this time last year, whether it was the ongoing trade dispute, it's a little bit like waiting for Godot to see the US trade deal come through. The Russia-Ukraine conflict has been grinding on, going into its 5th year now. We've also seen West Asia, which has been problematic for India, given our dependence on imports from the Middle East. So these are all, and then as an overlay to that, it's the rise of AI. So some of these are real ongoing structural issues. But I think what we should not ignore is also two really important variables. One is that India is showing resilience through this, in part because of the investments that have been made by India in the decade prior to that, whether it was in the physical infrastructure realm or whether it's in digital infrastructure. And I think that's positioned India. But the second also is the responsiveness of the administration. So if you look at the period from, let's call it Diwali last year till now, we've seen a number of trade deals that have been announced by the government. We've seen a number of reforms. And if you look at the reforms individually, each of them are interesting, but when you accumulate them, it's probably the biggest wave of reforms we've seen since 1991. So I'm encouraged by the responsiveness and the resilience. And my belief, like you were saying, is I think we're going to get through this.
This last bit, Vikram, which is the AI bit, right? That I think is really put the spotlight. And I think that is one reason why you see markets around the region doing very well. And you say, oh boy, as you said, we've been resilient. We've not fallen too much despite this huge oil dependency, etc. But the point is, there's this huge AI capex super cycle going on. And you've got a bunch of countries in Asia, North Asia specifically, which are benefiting. And we're not sort of, we're not riding that boom. And that kind of makes that comparison more stark, right?
Yeah.
And I think that's been the differentiator, would you say, over the last 12 months more?
I think it's fair to say that because, one of the things that India's benefited from in the past has been the TINA factor. So if you think about countries that have growth of this scale and growth at this pace, there's been very, very few countries that have that to offer. And so India benefited. So 18 months to 24 months ago, when you look at valuations in India, we were trading 2 standard deviations above our own history. So very, very rich valuations. And as you said, in that environment, then you suddenly have this whole AI phenomenon play out. And India is not just perceived not to be participating in it, but it's also perceived to be a potential loser from this.
Net loser in that sense. That's the perception.
Perception. That's the perception. And the stats that people will cite is to say, if you look at per capita income in India, if you take out services, it drops from $3,000 a head to about $1,500 a head, and it underlines just our dependence on what's happening over there. And there's this known unknown about what AI will actually mean for the IT services industry in India. I think that narrative is overdone. For instance, what it does not adequately reflect is the investments that India has been making across the board when it comes to the whole tech stack. Whether it's from LLMs like Sarvam or whether it's coming to chips. Now, albeit these are going to be chips that are not going to be bleeding edge chips, but nevertheless, these investments are being made. So I believe that...
And of course, there is the application layer, which at some point...
Absolutely.
So much of the focus right now with regards to this AI thing is physical, right? But at some point, once enterprise adoption picks up, you will need that application layer to come in, right?
Yes.
What Jensen Huang calls the 5-layer cake. The 5th layer is the applications.
Yes.
And that's where India comes in.
True. And so when you look at some of the work that's done out there, some of the conclusions are it's counterintuitive. It's going to be that what AI is going to do is actually expand the set of solutions that are required, the opportunities that are there going to be to work on them, and that's going to create opportunities, I think, for potentially for Indian companies. But it's still murky. That's the known unknown that India needs to work its way through. So the bridge between now and then comes back to some of the things that we've been talking about, which is to say the continued investments India's been making in physical and digital infrastructure that continues apace. As well as the responsiveness of companies to the environment that they find themselves in.
The other big thing, which is sort of, it's all happened together over the last couple of years, is, local retail investors have become such an important part of the market. And that's been this constant bid, refusing the market to, not letting the market fall, right?
Yes.
And what that has also enabled is lots of exits, big exits.
Yeah.
Right? And now people are looking at capital. I mean, the reason why macros, perhaps the rupee has been under pressure is largely because of the capital account.
Yeah.
And these exits are being blamed, and then people sort of, work backwards and say, well, it's a domestic bid for equities, which is unrelenting, which is allowed for all of this. How do you think about it, Vikram?
So I'll break this up into 2 different parts. I think let's start with the first one, which is unequivocally healthy. And I think you and I have talked about this previously, which is the phenomenon of domestic AUMs. And I think, as I've said previously, this is a story that's still in a very early innings. We have a small part of household savings in India. That variable is changing. You're seeing new brokerage accounts being opened. And our view is that that's going to continue well into the future. So you've got 3 vectors 3 variables that all increase. Per capita income increases. For the proportion of India's population that has disposable income, that income increases. You have the number of households with brokerage accounts increasing, and equities as a share of household savings increasing. So we put those 3 variables together, and our belief is that those flows will continue for a long time into the future.
The worry is the last is happening. Number 3 is happening, which is number of brokerage account, demats accounts, etc. But per capita, and I've made this point to you at one point in one of our earlier conversations as well. The level of financial access to financial products at a per capita GDP that India has, it's unparalleled. You have this kind of penetration at much higher levels of per capita GDP, right?
Yes.
So, is that a worry? Do you worry about that at all? Or
No, I think it's just a function of time. And if you sit down and think about just that, how many Indian households had bank accounts? 10 years ago, the number was 35%. Now you've got the numbers in the 90s, and so I think it's just a function of time. And you may have some periods where it sort of plateaus, and then you'll see a step change taking place. So I'm not as worried about that issue. The second part of the topic has been what's happening with, and that's been enough to offset FII outflows, because had you had this volume of selling in the past, then Indian markets would not have held up as well as they have over the last year. The other issue, which is one that still is to be resolved, is the balance of payments issue that India faces, and that's a different matter altogether. And that's something that the government needs to focus on.
Again, there is the FPI bit, which is the exits. There is the FDI. FDI flows, which have kind of sort of slowed to a trickle as a percentage of GDP. I mean, over the last 2 years or so, right? Yes. I mean, you sit at the intersection of foreign investors wanted to come in, FDI wanted to come in. I mean, you're involved in lots of large transactions. What are you seeing, Vikram?
So undiminished interest. And what I mean by that is when you come back to what is it that investors find fundamentally, intrinsically interesting about India, it is size and scale, velocity, and last but not least is governance. You'll have lots of markets which will have one of those three variables, but the combination of all three is something that underlines the interest of global investors, and whether that is corporates who are looking to increase their exposure to India, or when it's FIIs who are trying to figure out what is the right entry point. So I'm seeing undiminished interest. Now, that does not mean that we should be complacent about it, because what India has to do for its own part also is to figure out how to roll out the welcome mat and to improve ease of doing business in India. Try to work on ways to reduce the regulatory cholesterol that we have within India. But again, I come back to this point, which is the posture of the administration, the posture of policymakers is very lean forward. The posture is to try to listen to what's being said, to take on board constructive feedback, and try to implement those changes that makes it easier for foreign investors to invest in India.
You think the FDI story will turn in a positive way, more in than out in terms of capital?
I believe so.
You think so? Which industries? I mean, one thing which is great, which is happening, is lots of niche, specialized manufacturing in all parts of the country, which doesn't get talked about because, I mean, it's not right now. I mean, lots of listed companies are doing it, but a lot of it is happening outside of the listed universe. So manufacturing, yes, I mean, we get that feedback quite often. But what else? Where else are you seeing this interest? You said undiminished interest.
So, I'm glad you brought that up, because at the start of this conversation, I was talking about being pleasantly surprised by investor interest in attending our conference. Manufacturing has actually been, when I came into this role a year ago, I had actually started out thinking that manufacturing was a disappointment. Because when you look at manufacturing as a proportion of GDP, it's largely unchanged relative to where it was a decade ago.
I mean, it's been
roughly about 15% of GDP. But as I go around the country and I meet with our clients and I go and do site visits and I visit the manufacturing facilities, what I've been is really, really impressed by the capability sets and the improvements over there and the vibrancy that I'm seeing on the ground. I'll give you a small example. If you look at the case of Apple, 4 years ago, we really didn't have much of a presence, and already this accounts for single-handedly over 10% of India's exports. The number of companies employed has gone from 0 to 76,000 workforce, on its way to 200,000. 3/4 of these are young women between the ages of 18 and 25. And when you look at the production runs in this country, the production runs in their quality are comparable to what China was doing for Apple.
Okay.
And this is just, like I said, one example, but a very tangible example of how you can manufacture world-class products in India if you set your mind to it. And it's not just Apple. I've gone and seen aerospace and defense manufacturing facilities, a whole range of areas. And I've actually been impressed. So my belief is that when you come back to this AI question, if India did not have the lever to move on manufacturing, I'd be saying, hey, this is something that we need to worry about. But the point is, if you can move that lever, if you can fire on all cylinders, then I believe that's another ground to believe that we're going to get through the period that we're in.
You know, the India-US question, Vikram, I mean, the headlines galore, and it's kind of hard to decipher what to pay attention to, and what is transitory and what is permanent, etc., etc. But just purely direction of travel-wise, I mean, it's not just about the trade deal and what percentage of tariff that you will pay, but it's a larger collaboration, right? Which I think matters in that sense. So just your thoughts. Are we sort of drifting further apart? Are two countries coming closer together? Where are we at?
So I think that tactically it's been actually quite frustrating to see us not have a deal come to fruition with the US over the last year, because the US is India's, largest trading partner. But when you look at the signals that are coming out from both sides, both from the Indian administration as well as the US administration, it feels like we are on the cusp of having some sort of deal announced and delivered. We already have the framework of a deal that was announced in February, and now it's just a function of the actual deal being announced. So that's the trade deal. And I think the thing to point out is also in the year since then, trade with the US has actually increased in value relative to a year ago. So the lack of trade deal has not affected actual trade relations between the two countries. And I think that speaks to the broader question over here, which is to say there may be disagreements between friends for short periods of time. But when you think of the natural alignment between India and the US, then I think that natural alignment still continues for very obvious reasons. Multi-party democracies, vibrant, raucous, all of the issues that come along with that, but that makes us natural partners to each other. And I don't see that changing.
You don't see that changing. And you think, 1.5 years of the Trump presidency in, Trump 2.0, 2.5 more to go. You think it'll be, did you see this as more kind of sort of stable or as volatile? It has been volatile, I mean, on so many fronts.
So, yes, it's been volatile, but I would actually argue that the Trump administration is remarkably consistent. Perhaps they are more transparent than other administrations in telling you what's on their mind, but they're quite consistent in their follow-through. And so I believe actually for partners of the US around the world, you have to just basically take the administration at face value, listen to what they're saying, and try to understand how that fits with your interests and respond in your own interests. So I think actually the Trump administration is actually quite predictable.
It's been predictably volatile? It's been...
it's consistent.
I mean, even if something is very volatile and it's predictable, it is predictable.
It's consistent in its policy objectives.
Yeah. And you think that will India and US, I mean, you think intrinsically they're both sort of are matching on most wavelengths that matter.
Natural allies.
Natural allies. Just to sort of take that point forward, but ask a bigger question, which I think gets asked around all the time, whether this is to use the B word, a bubble, the AI bubble. Is it a bubble? A big question mark. There are big IPOs, by the way, lined up for the end of the year, right? So just your thoughts.
Gosh, I think this is kind of similar to the question that was asked 25 years ago about whether the internet was a bubble. And I think when we look back from this vantage point...
What was your answer to that? My answer to that is, well, the technology was real, but prices were a bubble for a certain point, right?
And that's the right answer with the benefit of 2020 hindsight. Actually, at the time, I was an analyst based in London covering the European TMT sector. So I was right at the crossroads of this.
So you're the right man to answer that question now.
And my view at the time, and my view still now, is that we were in the middle of something transformative.
Yeah.
There may have been individual companies that were mispriced. There may have been individual companies that did not stay the course, but it was going to change everything. And I think the same holds true for AI right now, which is we are in the middle of something transformative, perhaps even more transformative than the internet bubble, the internet phenomenon has proven to be. There will be companies that are fully priced within that, but this is real. It will lead to real productivity gains for companies. It will lead to real business opportunities for companies in ways that we don't necessarily anticipate now. The other big qualitative distinction to make as well is that when you go back in time for the internet, we had to invent almost as an investment community new ways to value companies because you had companies that quite often had no revenues, no cash flows, just a good idea, and that we're executing on them and attracting valuations. Whereas now, when you look at some of the biggest investments that are being made in AI, they're being made by some of the largest companies in the world that have some of the greatest cash-generating abilities, as well as some of the strongest balance sheets in the world. So it's on a more stable footing than 25 years ago.
Absolutely. But will that same, you talked about it was absolutely transformative, right? Now, with the benefit of hindsight, we know that the technology, internet was transformative. But for investors, what does it mean? I looked at data, the seven what we call Magnificent Seven companies, when they IPO'd, the total value was about $130 billion.
Yeah.
Since then, they've added about $24 trillion in market value, right?
Yeah.
So, humongous. You think these companies at near $2 trillion valuations will be able to create that kind of value from here on? What's your sense?
So, coming back to our conversation on AI earlier, which was the known unknown, I think you've just articulated the known unknown question. The belief is that they will. That's what the market is pricing in. And that's really, really important to emphasize. That's what the earnings delivery is demonstrating to us. But over the next period in time, the next 12, 24, 36, 48 months, we'll start seeing that being validated. And it's going to be a really fascinating journey to discover that together.
But you don't think that these large IPOs, and it's often said, right? I mean, we've seen that here in India as well. A massive big IPO, much hyped, came in. Well, that was it for a while. That was the top in that sense. You think, US markets have done phenomenally well. They've had an incredible run for a market that size. You think these are kind of sort of, big seminal events just for the market, for the whole market itself, or not really?
Again, it's something that we're going to discover. You're going to have price discovery with these issuances that take place this year, and it'll be interesting to watch and see how that gets digested by the markets.
Vikram, we wish you all the best of luck for the conference. It's been a great conversation. Thank you for sitting down. Thank you very much.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan, and these are the headlines from the startup space. Consumer X Ventures has officially launched with a 150 crore rupees SEBI-registered Category 2 AIF. The fund plans to invest in 20 to 25 startups, focusing on pre-seed and seed-stage consumer companies.
Cars24 has launched AI Labs and committed $20 million to back startups building AI-first products. OpenAI, AWS, and 11 labs have joined the initiative as Cars24 looks to build, invest in, and accelerate the next generation of AI companies.
Cairo Capital has launched a 100 crore rupee pre-IPO private equity fund. The SEBI-registered Category 2 AIF will back profitable growth stage Indian companies with IPO plans over the next 24 to 36 months. The fund is targeting a 35% IRR.
Simple Energy has raised 250 crore rupees in a Series B round. The fresh capital will be used to scale manufacturing, expand capacity. The EV maker also reported a 4 times jump in revenue to 170 crore rupees in FY26.
Scriptbox has acquired the mutual fund distribution business of wealth management firm Blue Chip Capital. The deal will see Blue Chip Capital's clients and employees move to Scriptbox, gaining access to its research, asset allocation, and digital wealth management platform. Well, those are the headlines we've been tracking for you this evening. On What's Brewing, India's AI ambitions are getting a new engine. Ionos, the AI-native enterprise tech company co-founded by C.P. Gurnani, has forged a strategic alliance with Blackbox, a global digital infrastructure integrator, to take AI transformation end-to-end from the data center to the boardroom. The combined play targets triple-digit million revenue. My colleague Rachna Dhanrajani caught up with C.P. Gurnani to understand the company's growth plans. Take a look.
A client would see this of value because, for somebody who's willing to take responsibility from A to Z, the world around us is all about hybrid, and I think between infrastructure and the application layer and the AI services that we bring in, I think we will be able to get them to embrace AI much faster and to be able to get results much faster because the solutions that we bring to the table have now been proven and they're referenceable.
Well, moving on, India's wealth management industry is entering a phase of consolidation as firms look to scale, expand their geographic reach, and tap into the country's growing investor base. In the latest deal in the space, Scriptbox has acquired the mutual fund distribution business of Delhi NCR-based Blue Chip Capital, a firm that has been serving clients for more than 3 decades. The acquisition strengthens Scriptbox's presence in North India and comes as the company looks to build a national wealth management platform through a combination of organic growth and strategic acquisitions. To discuss the deal, the opportunity in India's rapidly evolving wealth management market, and the company's next phase of growth, we're joined by Atul Shinghal, the CEO of Scriptbox. Atul, thank you so much for taking time out and being here with us on Startup Street. The acquisition, as I pointed out, strengthens Scriptbox's presence in the Delhi NCR market, right? What sort of made Blue Chip Capital the right fit, and should we expect more acquisitions of independent wealth management firms going forward?
Thank you so much for having me on the show and for this opportunity. So the first time I met Ravi, and I think it was just a pleasure. What we look for in partners as we scale the business and fulfill our ambition or our mission to serve 1 million families in India was his humility, his alignment of values and ethics, of how he serves his clients. A business built over 3 decades obviously depends heavily on client trust, and that's the heart of Scriptbox. So I think the key point was the alignment of how we think about clients, how we think about long-term wealth creation, how we think about wealth is multi-generational. So if you think about as some of our partners get older, they're looking for continuity for their clients, both in terms of their wealth and their families. Also, the younger generation is much more digitally savvy. So a platform like Scriptbox, which is omni-channel, which combines the best of technology and digital, with traditional wealth management, which is human-centric, allows these companies to join us on this journey. I can never say what the future holds, but we're obviously looking to continue to scale our business and scale our footprint across the country. And more like-minded people are welcome to join us.
More like-minded people are welcome to join you all. But, consolidation is becoming this key theme in the wealth management space, right? How do you sort of plan to integrate Blue Chip Capital while preserving the trust and relationships it has built with clients over the last 3 decades?
That's an art and a science. We have done over the last few years a few such transactions and few such partnerships. So we've got a well thought through playbook on how we integrate multiple aspects, the processes, the people, the employees, the clients. Different clients have different needs. Each client is an individual. So the transition is actually very, very personalized, very, very individualized as to what their experience is over the next 12, 18, 24 months. And it's a continuous journey. So this is a well-defined playbook about how we sort of take each client and ensure that their journey is both a continuum and an upgrade. So that's essentially what we do in a very systematic manner. And yeah, obviously we've discussed this in detail with Ravi and his team as to how we'll manage this over the next few quarters.
All right, and what happens to the team? Do they become part of Scriptbox?
Absolutely. I mean, yeah, their blood changes color to orange and they become part of the Scriptbox family.
Amazing. And you've sort of described succession planning as a major opportunity in the industry, right? How large is this opportunity, and could acquisitions become a significant growth driver for Scriptbox over the next few years? If you can outline what your inorganic growth plan is.
I would not be in a position to describe the detailed growth plans for various reasons, but inorganic or like-minded people joining us is a part of our future. What exact role it plays depends on how the markets play out. But to your point, I think in any professional services category, especially these wealth management businesses built over decades, remember this is a compounding business, and to build a large franchise, a reasonable sized franchise, takes time. And at that time, you could be slightly older. And with the advent of AI, the advent of digital, the advent of technology, the investment required to provide the right client service to you requires consolidation as a playbook. So I think this combination of the market need, the client's need, the business partners' need, and Scriptbox's need comes together to create a genuine win-win-win situation, which allows us to scale on a continuous basis.
Absolutely. And you know, Scriptbox has evolved from a digital mutual fund platform into this broader wealth management player, right? What have sort of been the biggest growth drivers for you and for the business over the last 12 to 18 months? And what are you going to double down on going forward?
I think this is a business of trust. I think the only currency we actually have is the client trust we are able to go. And that's what drives our growth. Now, the clients could be organically acquired, could have joined us through a partnership, could have come through us through a referrals. It's our existing clients who are actually accumulators. So our client profile are people who are thinking long-term about their wealth, who are not looking for a quick fix. And these kind of clients tend to keep accumulating wealth. Not does their wealth only grow with us because of the advice or the what we're able to work with them on, but they're able to put aside more money on a continuous basis. And that's what drives our growth. And that's what will drive our growth for years to come.
You know, as markets mature and competition sort of intensifies, right? How is your revenue mix sort of evolving? Are you seeing stronger contributions from wealth advisory and high net worth clients, or does mutual fund distribution remain the core growth engine? If you could give us some targets that you have for the coming fiscal.
I would not be in a position to give targets again for various reasons. But yeah, I think we'll continue to compound our business. All the growth levers you talked about will play a critical role. Depends again on the market conditions, depends again on how the wealth solutions evolve. So we are a full stack wealth solutions provider for multiple segments. We have over 70,000 families we serve. So we are able to serve clients from, as I say, 50,000 rupees of assets to 500 crores and everything in between.
Absolutely. And how will, you know, the current acquisition that you've made sort of help you in terms of revenues? Is it going to make an incremental difference to the revenues?
That's not the major reason we did this. I think the major reason we've done this is because we believe in the long-term value we can add to the clients and to our franchise. Yes, it is material. I mean, any growth is good growth as long as it's in the right direction. So I think it is meaningful to us, and it will help us achieve our ambitions.
Absolutely. And with a stronger footprint now in North India, and that's in place, which geographies and client segments are next on Scriptbox's expansion roadmap, and where do you see the biggest opportunity for growth?
We are a pan-India business. We serve clients in over 600 towns and cities and probably 10,000 pin codes. So I don't, it'll be amiss of me to say any particular geography. In terms of like-minded partners ready to join us, we are happy to operate in any geography. We're a digitally backed business, so we can operate from Asansol down to Kanyakumari. So I think it's about where the right partners are available to join us, and we do that in a systematic manner. But as such, we are able to serve clients across the globe, really. Definitely in, as I said, over 10,000 PIN codes in India.
All right. And, before I let you go, if you could quickly tell us, where is the next lever of growth going to come for Scriptbox?
Our clients. I mean, our clients giving us more money and trusting us with more of their money. That's the only mantra we have. Our clients trusting us on a continuous basis for their lifetime and beyond is what drives us at Scriptbox and gets us out of bed.
Absolutely. All right, Atul, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much. And thank you for having me on the show, and all the best to everybody.
Thank you.
Well, moving on, also on what's brewing, FairDeal.market, a B2B quick commerce platform focused on inventory replenishment for retailers, has raised $15 million in Series A funding led by Bertelsmann India Investments. The startup promises delivery of over 1,000 SKUs to Kirana stores within 60 minutes and says it is already serving more than 20,000 active retailers across Delhi NCR. Joining me now is Prateek Bansal, the co-founder of FairDeal. Prateek, welcome back to Startup Street. You claim retailers can restock inventory within 60 minutes through your dark store network. Traditionally, Kiranas have relied on wholesalers, distributors and local markets for procurement. How does the economics of your model work, and what tangible benefits are retailers seeing in terms of inventory turns, working capital and sales?
Yes. Thank you so much for having me here. It's great to be again on CNBC TV in just in months, right? And I'll just reiterate by telling what we do. So it is like think it like a UPI, right? Larger payments were already solved, right? There was RTGS and NEFT, which existed for larger payments, but what was not solved was micro payments, right? And daily change, which was solved by UPI. Exactly, Kirana replenishment is same, right? Large retailers like DMart, they are well served. But if you actually understand the need of Kirana, they want to stock 500 rupees, right? Because they are small in nature. And for that, they have to actually walk to the nearest wholesale market or get at least 5,000 worth of goods from the distributor. But FairDeal changed it entirely, right? Now, retailers have an app from which they order and we deliver in 60 minutes. So, which helps a retailer to get at least the inventory turn 2 times better, right, than their previous supply chains.
Okay. All right. Prateek, in just 6 months, FairDeal has scaled to over 20,000 active retailers across Delhi NCR. Now, with over 80% retention among retailers who started ordering a year ago, what is driving this stickiness, and has procurement behavior fundamentally changed once retailers experience, faster replenishment?
Sure. So we deliver value to our retailers, right? And the value is fairly simple. We are able to increase their income, right? By increasing their inventory turns, which essentially means that their net take home increases by 10 or 20% monthly, right? And if you actually understand, these retailers earn 1 lakh to 2 lakh a month. For them, 10 to 20% incremental sales is 20 to 40,000. So that's what is driving the sticky user cohorts.
Okay. The company plans to expand beyond Delhi NCR and target over 100,000 retailers this financial year. Which markets are next on the roadmap, and what are the operational challenges of replicating a 60-minute delivery promise across multiple cities?
Sure. So so far we have been Delhi NCR business. Now with Bertelsmann coming in and leading the round, putting $15 million, actually help us to go for multi-city, right? And what remains constant in our model is supply, right? Demand is everywhere in India. India have thousands of demand pockets where FairDeal can go and set up one dark store. So yes, we are going multi-city. You will see the new cities soon.
And what about the challenges?
So challenges for us remain supply, right? And the supply challenges we are able to navigate over the last 2 years, and we are very confident that we will be again navigating the same supply challenges on this expansion.
Sure. Pratik, you also work with a growing network of emerging consumer brands looking for offline distribution. Now, traditionally, shelf access has been dominated by large FMCG companies. How is Fair Deal helping newer brands compete more effectively in the Kirana ecosystem?
Sure. See, new brands need smaller spaces, right? Smaller shelf spaces, but that was not possible with wholesale or traditional distribution. With Fair Deal replenishing inventory with every 60 minutes, now retailers can stock smaller quantities, which actually enables the newer brands to stay on the shelf of retailers.
Okay. Let's get to the fundraise quickly. The fresh capital, I believe, will be deployed towards expanding dark stores, strengthening technology and scaling retailer engagement. So, Pratik, what does the next phase of growth look like for you? If you could share current revenue metrics, the growth numbers and key milestones investors will be watching over the next 12 to 24 months.
So we will be touching 1 lakh retailers this FY, right? That's on our plate. Revenue numbers, we are good, double-digit multi-crore GMV monthly, right? And we are growing again double-digit every month. So that's where we are on the revenue side.
Okay. Pratik, as quick commerce reshapes consumer behavior, do you believe we are entering a new era of retail infrastructure as well? And could Kirana replenishment become India's next large-scale quick commerce opportunity, perhaps even bigger than consumer delivery in the long run?
Yes, absolutely, right? If you understand, Indian consumption is driven by kiranas, right? Or the neighborhood retailers. 85% of the consumption still remains with kirana. And Fair Deal becoming replenishment for kiranas, which is serving 85% demand of Indian consumption. So yes, we believe that this opportunity is far bigger than serving the end customers because Indian consumption sits with kirana.
All right, Indian consumption sits with Kirana. That's the big takeaway. But also, Pratik, an interesting aspect of your business is the data layer you're building. You know, every transaction gives brands real-time visibility into what is selling, where it's selling, and how demand is evolving. Could this data intelligence eventually become as valuable as the commerce platform itself?
Yes, so we have order level data, right? And when we actually discuss this data layer with brands, they find it really valuable. Now they are able to get to which specific pin code they want to sell their product to, right? And with what size of product. So yes, this data will help brands to stock better and replenishment better with Fair Deal.
All right. One final question before I let you go. What would you say is your biggest moat in terms of competition, and how competitive is this space really for you?
Sure. So our biggest moat is our team, right? And our belief in this category, which is B2B quick commerce, and also our understanding of our customers. So me and my co-founder and the entire team have been coming from offline retail and have 10 years of experience dealing with kiranas, right? So that is what we are very confident about moving forward.
All right, Pratik, on that note, it's time for me to end our conversation. Many thanks for joining us on Startup Street today, and wish you the very best with all your growth plans.
Thank you so much for having me here. All the very best.
On that note, it is time for us to head into a short break. But coming up next, AI-native logistics platform Shipsy crosses the $25 million ARR milestone. Founder Soham Choksi talks about AI strategy, global expansion plans, and a potential fundraise. Details when we come back. Stay tuned. Welcome back. You're still with us on Startup Street. AI-native logistics platform Shipsy has crossed $25 million in ARR, more than doubling its recurring revenue in just over a year as global enterprises embrace AI-powered supply chains. Speaking with Aishwarya Anand on the sidelines of the TIE Delhi NCR India Internet Day, founder Soham Choksi talks about the company's AI agent strategy, international expansion, and why Shipsy could explore a fresh fundraise later this fiscal.
So for someone who is watching right now, who moves goods for a living, what problem does Shipsy actually solve?
So the two core products that we have are around transportation, automation, and warehouse management, right? Now, if you look at transportation, it's about how a particular shipment goes from the source to the end mile, right? This includes planning, what mode should I choose? Right? Should it go by land? Should it go by sea? Should it go by air? It includes execution, actually getting all of the data, the proof of deliveries, settling bills, and there's a concept of digital workforce, which is essentially we have 6 agents. We've modeled them across the departments of logistics. With the horizontal agent, there's a cold start problem where you don't have enough data, you don't get results on the first go. We solve that, right? Because we're on the vertical and where the agents are experienced for these departments, they can hit the ground running and show results on day one.
Okay, all right. Now, just 2 months ago, you've launched Agent Fleet, right? Named AI co-workers like Clara, who handles customer queries, Astra, who coordinates drivers, Nexa for finance, and Vera for disputes.
Yes.
Right? So now these aren't just dashboards, they're agents, AI agents who are doing the human jobs.
Yeah.
Early data shows that there has been around 30 to 40% reduction in support volumes.
Yes.
So, I want to be direct here with you. Is Shipsy replacing logistics workers, or is that the wrong question to ask?
No, so look, our tagline is we amplify human potential. And I'll give you an example. If you look at Nexa, if you look at finance and freight settlements, today enterprises are able to validate just 10% of the invoices. Just 10% of the invoices. That's because it's just so manual. With agents, you can go to 100% invoice validation in 1/10 the time. So it's not about replacing people, but it's about augmenting their potential with agents.
Okay.
If you look at Vera, the dispute resolution, today, I'll give you an example of Heineken. We went live in Brazil. They had a control tower with 80 people managing vendor disputes, right? Even despite this, it took about 22 days on an average to resolve a vendor dispute, and most of the claims went unprocessed. Now with agents, this entire thing, the time to close a certain request by the vendors went down.
Now, Shipsy has also partnered with Aramex, Tech Mahindra, with DTDC, but most logistics companies in India still run on spreadsheets and WhatsApp groups. When you walk into one of those companies, what does day one of becoming an AI native operation usually look like, and how fast does that work?
Today, everyone would have like a small system of record, but pretty much everything works on spreadsheets. Now, one thing that the agents are very good at doing is actually mapping out from all of the spreadsheets what your SOPs are. So the first job actually is to map out the SOPs through AI itself.
Okay.
And then the agents get tweaked to map some of these workflows. I wouldn't say that you'd see results on day one. It takes about 4 to 6 weeks to actually deploy the whole platform and the agents in the context of the customer, and that's when you start seeing results.
Shipsy has clocked 103 crore rupees in revenue in FY25. Tell me what have been the growth factors there? What drove that kind of numbers?
So if you see, the key growth factors for us have been international markets and the platform becoming AI native. This has actually helped us. Our average ticket size went from about $71,000 annually with customers to $320,000 annually last year. And this has been because A, we've acquired a lot more customers across Latin America, Europe, Australia, and B, with AI, the business cases have become much bigger.
Okay. Now, because we were talking about your international expansion, you're in Europe, Australia, the Middle East, you've just launched Agent Fleet. Now, that's a lot of runway. There's a lot of runway to burn on that front. So when are you raising? And you've also raised $25 million in Series B back in 2022, which has been 4 years ago. How much money is still left in the bank? And when can we expect a Series C fundraise to happen? And at what scale would you like to go public?
Yeah. So look, we've been running the company in a fundamentally cash flow strong manner. In fact, our burn for the month of March was just about 50 lakh rupees, right? So the revenues catch up in terms of runway. On paper, we have more than 8 years of runway, from an on-paper basis. But there's a lot of inbound interest. Investors today are seeing that for the vertical of logistics and AI, Shipsy is kind of the breakout company because of all of these large logos. Being part of the Gartner Magic Quadrant globally, the top 14 companies that are there, and the growth that we're seeing, which is north of 80% year on year.
Correct.
So because of some of these, yes, there's inbound interest, and we'd be exploring potentially something in this fiscal year.
Well, with that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side.
We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
Every growth story has its headline numbers. Market highs, fundraising cycles, consumer demand, and global expansion. But behind those numbers are leaders making the decisions that shape what comes next. That is what The Titans is about. Bringing together leaders, building businesses, deploying capital, driving innovation, and shaping India's next phase of growth.
Let me start with you, Kasab. This evening we're celebrating endurance. We're celebrating the spirit of resilience. You've been playing the sarod, you've been performing, and you were even younger than Zohan and Abir when you actually started performing. I want to understand from you, Kasab, share with everyone who's watching us here tonight and those who are watching us on TV and online, what do you think is the X factor? What does it take to build a timeless legacy?
I think it's very, very important to have blessings of your guru and all the senior people. The credit goes of Abir and Zohan today. The credit goes to their parents, Ayan Ali Bangash and Nima Sharma.
Aman, the mic is yours. As you go through your own journey, and now you see Zohan and Abir's journey, how different is it?
Well, being Zohan and Abir's elder brother feels very nice. But anyway, they're my friends, they're my colleagues, and it's a beautiful experience sharing. I mean, you met us, Ayan and me, way back, Shireen, when we had started off as young people. And to be sharing the stage with my brother and his kids and my father, it's a pleasure and it's a very happy moment. So yeah, so we have fun together on stage.
It truly is a special moment. Let me ask you, you managed to skip school today to be here this evening?
Yes.
And do you enjoy being on stage performing?
Yeah, yes, I enjoy it. Like it's an amazing experience to be on stage and perform with my family, and I hope that this continues in the future.
This continues in the future. Who's more strict? Is Kansa more strict? Or is your dad more strict?
It has to be my dad because Dadava he lets us do anything, but Abbas I'd say a bit more firm when it comes to teaching us.
He's a bit more firm. So you're the disciplinarian in this relationship.
Well, he's not getting ice cream tonight. No, but the thing is that none of this was planned. I think when COVID had happened, the silver lining was that I was home. I was not traveling, so I was able to put in all that time. And then, they showed good results. But, you're a student till the last year you walk this planet. So they have to keep practicing if this is what they want to pursue. And it's a long journey. I tell them, to have humility and.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. Crude oil prices climb 3% after US strikes military targets in Iran over the weekend. Kuwait reports drone attacks as Tehran claims it struck a US base. Iran says a ceasefire in Lebanon is one of the preconditions for a peace deal after Israel seizes a strategically important castle. Tehran also denies any talks on its nuclear ambitions. US President Trump says it will all work out well in the end. Sensex and Nifty failed to hold opening gains and end near the low point of the day. Nifty drops below 23,500. Mid-cap sees sharper cuts. Rupee remains above the 95 mark against the dollar. The chairman of Tata Trusts, Noel Tata, writes to the RBI, opposing the listing of Tata Sons, says going public will risk its philanthropic mandate. Tata Sons chairman, Chandrasekaran, is non-committal on the listing. That's a money control exclusive. India and the US begin four-day talks in New Delhi to finalize the details of an interim trade agreement. US delegation is led by Chief Negotiator Brendan Lynch, and the Indian team is led by Additional Secretary at the Commerce Ministry, Darpan Jain. Commerce Minister Goel says that the broader issues have been finalized, adds that smaller details, commas and full stops were being negotiated. World's most valuable company, Nvidia, takes AI to the PC, unveils RTX Spark superchip for laptops and desktops. Nvidia claims that the chip can run AI models with up to 120 billion parameters, set to launch later this year in new Windows PCs from Microsoft, Dell, HP, Lenovo, and others. SoftBank pledges to invest 75 billion euros to build AI infrastructure in France. This will be the company's biggest investment outside the US. SoftBank also surpasses Toyota as the most valuable company in Japan. Industrial output grows 4.9% in April on robust capital goods and manufacturing performance, but mining growth contracts. This is the first set of data with FY23 as the new base year and includes gas, water, sewerage, and waste management activities. Automobile sales top estimates in May. Passenger cars see robust domestic sales growth on the back of low base. Commercial vehicles underperform. Tractors see strong growth and a positive trend ahead. The RBI is unlikely to hike rates in the upcoming monetary policy this week. CNBC TV 18 Citizens Monetary Policy Committee votes unanimously for a status quo amidst geopolitical tensions and adverse monsoon forecast. Technical issues continue to plague the CBSE re-evaluation portal for Class 12 students. The website was supposed to go live today after crashing on the 19th of May due to heavy traffic. More than 4 lakh students have applied for re-evaluation. The United States has no leverage on China, and Trump returned empty-handed from Beijing, says renowned American economist Jeffrey Sachs. Adds that India should not side with the US against China. says Trump needs India more than India needs the US. That's an exclusive. Well, first up, India's industrial output grew at a pace of 4.9% in April. This is the first set of data with FY23 as the base year. Robust performance by capital goods and manufacturing lifted growth even as mining output contracted. Now, apart from the change in base year, the IIP data will also include gas, water, sewage and waste management activities. Sapna Das is joining us now with the Secretary at the Ministry of Statistics, Saurabh Garg, on the new data series.
Well, it's a launch of another new series, and this time it's the Index of Industrial Production, and we are joined in conversation by none other than the MOSPI Secretary, Dr. Saurabh Garg. So thank you so much for giving time as always. I think it's a hat trick for the ministry, so to speak. You had CPI, then you had GDP, and now you have IIP. So does this trilogy more or less complete the work for the time being, or there is more expected over the next few months? I mean, something as important as a new series?
You're right that these are the three main macroeconomic indices, the GDP, CPI and the IIP. And all three have now been updated. Though obviously there are other activities which continue, but at least the major macroeconomic indices are now up to date. They reflect the current status of the economy. They reflect the improved data sources that have been made available over the past 10 years, especially in terms of the digital sources. And all of them are updated to the latest internationally accepted methodologies. So this work has been done over the past 2 years and more. And to that extent, we have crossed the first hurdle towards having better macroeconomic data available.
Right, sir. So now coming specifically to IIP, so you have the March number coming in. How do you read this number? And you have data for the previous 13 odd months, but over the last quarter of the financial year which has gone by and the kind of global situation that we are in. So how do we read this number? Though of course it pertains to March, as you have pointed out.
Yeah, March, though we have the April numbers also. The April numbers have been released today along with the previous 12 months. So we have the last 13 months starting
data
from...
Okay,
April.
fine.
Yeah. So, and if you see the numbers, for example, the April data is a robust 4.9% despite the broad geopolitical situation. And I think the IIP reflects the domestic production capabilities and outputs that are actually happened. And if you look at the last 1 year's data, or even if you look at the last 3 years' data as per the revised series, it shows that number one, it is higher than what the previous base year had reflected, which shows that the structure of the economy has significantly changed. There have been a number of new products that come in. And in fact, nearly 120 odd item groups we have added and 64 we have dropped, which shows the kind of churn that has happened. And the fact that the domestic production has remained robust. If you look at the last 3 years, it's consistently on an average above the 5%, the IIP growth rates. So the robustness and the resilience of the Indian economy gets reflected also in the industrial statistics as it had shown in the GDP numbers earlier.
Okay. Is this number higher than what was expected? I mean, if I may ask generally.
We don't make predictions of the future, but I think what the forecasters had, or the credit rating agencies, I think the revised estimates are higher than what was earlier estimated.
And definitely the change in the base year and hence the change in the weightage and the change in the number of items, all of that put together has made a material difference.
Absolutely. And it should also, because that's the idea of having regular base changes, that you capture the status of the economy more accurately. If I can just add, for example, out of the 120 items that have got added, some of them include things like we have now aircraft and space parts that we are manufacturing now, which we were not doing. Cards with magnetic stripes, credit card, debit card has usage, that has entered. stents and vaccine, they have been added. CCTV cameras, they have. If you look at some of the items which have gone out, they include things like fluorescent tubes, because many of them have been replaced by LEDs. Then you have kerosene, that production has gone down. Sewing machines, printing machinery, now that you all use printers attached to computers, you don't need separate printing machines. A lot of tubeless tires are there, so you don't have tubes of cycles and all. So this reflects that a number of items which were there earlier are not produced, and that's what the revision in the base rates helps to ensure.
Okay. And how do we capture the number of factories or the representative factories more accurately?
So
in comparison to the earlier.
Yeah. So we look at for each item group, we look at those factories which, in a combined manner, capture nearly 80% of the gross value added, and at the same time that they don't have less than 0.01% share of that sector. So very small production units we don't look at, but as long as 80% of the GVA is being reflected, that's how the selection of the factories is done.
Okay. Also, sir, you had mentioned this very clearly that obviously that some of the sectors have a lower inclusivity or a lower weightage, so to speak, in the basket, and probably refined petroleum products is one of them, if I'm not mistaken.
Yeah,
so
yes. So yeah. So
right now it's a hot topic. So people want to understand because the consumption numbers have really gone up. But of course, this is the IIP. It's a production it's a capturing index.
Yes. So for example, there has been a reduction in what the sector is called manufacture of coke and petroleum products. So it's both capturing that. And when we say the weight has gone down, it's not that the production has gone down. Production would have increased, but comparatively, production of other sectors has increased much more. So let me just give an example. For example, the share of chemicals, rubber products and pharmaceuticals has increased, plastics has increased. So it has increased in a greater numbers or in a greater proportion than it has increased in coke and petroleum products. Similarly, the share
production there has been higher in comparison
to this, and therefore the weight of that sector has increased, while weight of this sector has slightly reduced. But if you look at the absolute numbers, production of everything has increased much more. Similarly, manufacture of basic metals, even out there, the share of basic metals has reduced, though the absolute production of basic metals has been increasing in the country over the past decade. But this also reflects a lot of this would have shifted to value-added metals and those activities. Therefore, it's not when we say the share of a sector has reduced, it's not the absolute production, but compared to the overall basket, the production increase in these sectors, which may be called the traditional sectors, has not been as much. For example, the share of automobiles and trucks has increased, and that's where, because a lot more EVs, a lot more other types of trucks and vehicles, and the transport sector has really increased. So it's you must see it in that context.
You'd also mentioned about some work going on indices-based index. Indices, chain-based indices.
Yes.
I'm so sorry,
yes.
pardon me.
Yeah.
So could you explain or could you take us through that, and where are we on that right now? And in case GOI, actually accepts that or adopts it, by when would that be possible? What material change would it make?
Yes. So let me just explain what we mean by a chain-based index. We have the base year of 22-23 year in this index, and this base year reflects the weights of the different sectors in that particular year in the production of manufacturing scenario. In the chain-based index, based on the year-to-year changes of the annual survey of industries and the GDP national accounts, the weights of those sectors would get automatically updated. In this series, we have made the provision of moving towards a chain-based, but at the moment we have released the index based on the fixed base of 22-23. Over the course of the year, we will be doing an internal analysis of whether the chain basing is robust enough, is it resilient enough, is it stable enough. And once we are confident that the chain basing can be done, we would switch over and continue for some time to produce both the fixed base and the chain base, so that people get comfortable with the chain base and then switch totally to the chain base.
And this will of course not entail any change in the base year.
This will not entail any change in the base year.
Great. Also, sir, just wanted to understand that this is one thing that you're working on in terms of IIP. There were certain questions also raised that probably to do this, you have also included WPI and you have sourced it internally from DPI. So can you explain what is
Yes. The IIP is actually a volume index, a production index. But in some sectors, for example, even though where the production cycle is more than a month and you have a lot of inventory or a work in progress, we need to look at the value of the work done, for example, in terms of rupees or in terms of in value terms. So for value indexes, we need to deflate the numbers so that it doesn't include the inflation part of the change in impact. In the old series, we were using the WPI 2011-12. In the new series, we are using the WPI 22-23, which DPIIT is working, and it is soon going to be released in the next few weeks. And therefore, internally, we have used that data in the WPI, in the IIP. And the reason we did it is we didn't want to change within a couple of weeks to look at the WPI once it becomes in the public domain. But it would be available in the public domain soon. So at the moment, we have sourced the WPI 22-23 base and used it in this with the understanding that the WPI 22-23 is anyway going to be soon in the public domain.
Okay. One more question that had been raised was about the volatility of the IIP series. In the past, there have been kind of already even 13 months data that we have right now. You can see it's like a W. It's almost like a continuous W. So we just want to understand that is that an issue? Concerning the sanctity of the numbers, or rather giving that kind of confidence to the economy, and would it be addressed at some point in time, or not really? That's the way it is.
See, the volatility in the numbers would be a reflection of the actual production, and actual production may change for various reasons. If we see historically in India, in the month of October, the production, the IIP is always much, much lower, because traditionally that's when is the festival season and the number of holidays of the factories increases and therefore production reduces. Some other months there could be inventories which are available and which there has been changes in sales for various reasons. It could be monsoon, it could be depending on what the product is and what is the seasonal impact. But one area that we have taken care of in the new IIP is the fact that in the earlier series, we did not have a method of substituting factories which have either changed their line of production, which in modern times is much more frequent and happens more easily, or some factories which have closed down.
Yeah.
So
6 months or something, that's
yeah, we have a set protocol that in case in some factory there is no production shown for a certain period of time, then we'll substitute it, and the methodology of doing that so that it doesn't impact the volatility of IIP.
So you address that to an extent.
Absolutely.
Well, with that, it's time now for a short break. But coming up, the United States has no leverage on China, and Trump returned empty-handed from Beijing, says renowned American economist Jeffrey Sachs. More details when we return. Welcome back. Now, the top global story this evening. Iran has reportedly stopped negotiations with the US over Israel's actions in Lebanon. Here are the latest developments. Iranian state media has said that Tehran has stopped exchanging messages with the US. This after Iran's foreign minister pushed back on the escalation of strikes in Lebanon by Israel. In a post on social media, he said, and I quote, "The ceasefire between Iran and the US is unequivocal. A ceasefire on all fronts, including in Lebanon," end of quote. The breakdown in negotiation follows Israel's expansion of its invasion of Lebanon despite global condemnation. France called for an emergency meeting of the UN Security Council after Israel's Prime Minister Netanyahu ordered evacuations in southern Beirut. This is the most serious escalation in Lebanon since the ceasefire was agreed upon on 17th of April. This comes amidst fresh skirmishes between Iran and the US. The US carried out strikes on Iranian military targets over the weekend. The Pentagon claimed that the attacks were in response to what it called aggressive Iranian actions, including the downing of a US drone operating over international waters. In response, Iranian forces targeted a US military base. US forces said that it successfully intercepted 2 Iranian ballistic missiles targeting American personnel stationed in Kuwait. Kuwaiti Foreign Ministry has condemned what it calls heinous and repeated Iranian attacks.
We're focused on being postured and prepared to re-engage if we have to. I mean, this is a high-stakes negotiation. We've got the best negotiator in the world leading it. Iran may not want to give up their nuclear ambitions, but we believe at the table they can and will over time, given the right set of incentives. But the most powerful incentive is the capabilities we have there right now, which they can't ultimately defend against at any real level. And those are decisions in the future the president will make based on how this ends. But I feel confident that he'll get to a deal that serves the interests of the American people.
Violations of the ceasefire are themselves indicative of U.S. misconduct and bad faith and merely intensify the existing mistrust, which rightly must always remain in our minds in any interaction with the American side. These U.S. actions are not merely violations of the ceasefire, they constitute an act of aggression and a violation of Article 2, Paragraph 4 of the United Nations Charter. They entitle and authorize us, in line with the right of self-defense, to undertake corresponding defensive measures.
Well, on to a CNBC TV 18 exclusive. Noted economist Jeffrey Sachs has said that USA cannot win the war with Iran militarily and has no option but to end this conflict and go home. Speaking to CNBC TV 18, Sachs added that the United States has no leverage on China and that Trump returned empty-handed from Beijing. Sachs further said that Trump needs India more than India needs the US, reiterating that India and China must continue boosting their bilateral relationship. Here's an excerpt.
We're very close to resolution if the United States will face reality. Basically, this was a war that was supposed to last one day. Israel and the United States thought they would chop off the head of the Iranian regime, put in their own leader, and that would be the end of it. Of course, this was proven wrong within hours of the first strikes on February 28th. Since then, the situation is clear. The United States cannot win militarily. Since last year, the U.S. has no hold over China on anything. The United States doesn't produce anything that China is desperately in search of, not even advanced chips, because China's rapidly advancing its own capacity to produce semiconductors. When the NVIDIA chips were offered in this summit, China said, no, thank you. So basically, China has the upper hand right now. They respectfully greeted President Trump. They showed him some pomp. They acted with